Hello Kanna, I welcome you to the most important video for CA Intermediate Direct Tax paper for May 26, September 26 and January 2027 examinations. I promise you that if you watch this lecture till the very end, at least for 2 times, and along with that, if you solve the study material, revision test paper, mock test paper and case study book questions, you are definitely going to score an exemption in direct tax in your examination. This is the direct tax marathon for CA Intermediate Direct Tax. In this video, we are going to cover all the concepts in your entire syllabus. Not even one concept is going to be missed out in the shortest time possible. That is why everything is going to be covered in this lecture itself. However, if you want to go to some specific chapter, I have also given you the timestamp. It will be either in the description or in the comment section below. You can click on the timestamp and go to the relevant chapter that you want to watch. Sir, what about the material? The material is CA Intermediate Revised book for May 26, September 26 and Jan 27. The link is there in the description. It is a color book which is published at a very reasonable cost with the help of THARUN'S Brainery Academy. However, if you still find some difficulty in purchasing the book or you need some support, you can message me on Telegram or Instagram. I will definitely help you out. Okay, don't worry. And after watching this revision lecture, I definitely know that you will enjoy this lecture to the core. All your concepts are going to be clear. You are going to remember everything and you are going to rock in the examination. So let me know your feedback in the comment section, and also after clearing the examination, definitely please message me on Instagram or Telegram or wherever you can find me, so that I will also be happy that this lecture has brought some joy, some fruit to your life. Okay, with this I wish you all the very best and let's begin the direct tax marathon. Let us quickly revise the tax rates chapter, which is the most important chapter for your CA Intermediate Direct Tax. Sir, why the most important? Kanna, without tax rates, you cannot find out what is the income tax. That is why 110% it is going to be tested in your examinations. Moreover, it is even more crucial because in the new tax rates, there are loads of amendments. So that is also definitely going to be tested. So you need to be thorough with this chapter. So watch this revision lecture at least 2 to 3 times before the examination. Memorize the entire content of this chapter and confidently score at least 6 to 10 marks using this chapter alone in the exams. So tax rates for your May 26, September 26 and Jan 27 exams, the tax rates tested is for assessment year 26-27. It means what? The previous year is 25-26. So we are going to learn the tax rates for the incomes earned between 1/4/2025 to 31/3/2026. Fine. So tax rates are of 2 types, Kanna. One is normal tax rates, or you can call them as slab rates. Then special tax rates, you can call them as fixed rates. So slab rate and fixed rate. In slab rate also, there are 2 regimes. One is the optional tax regime. The other one is default tax regime. Optional tax regime is given in the normal provisions and Finance Act 2025. Whereas default tax regime is given under section 115 BAC. This default tax regime is also called as new tax regime, and optional tax regime is also called as old tax regime. So first let us see what are the tax rates in the optional tax regime, or we can also call it as opt-out regime. In question they will give you opt-out. The assessee wants to opt out, or they can also give you as shift out. The assessee wants to shift out. It means what? That they want to take the normal tax rates. Fine. So the tax rates are given under Finance Act 2025. First we are going to learn the tax rates of individual. Tax rates of individual is the most important because individual total income is only generally tested in the examination. So for an individual up to 2,50,000, the individual need not pay any tax. So this 2,50,000 hence is also called as basic exemption limit, or maximum amount not chargeable to tax. So up to 2,50,000 there is no tax. Above 2,50,000 up to 5 lakh rupees, the tax rate is 5%. Above 5 lakh up to 10 lakh it is 20%. So mind it, there is no 10% concept in old tax regime. Fine. After 5 directly you have 20 only. So 5, 20, then above 5 lakhs the tax rate is 30%. Then there is benefit given to resident senior citizen and resident super senior citizen. Sir, who is senior and super senior? If any individual turns 60 years of age or more at any time during the previous year, he will be called as senior citizen. If any individual turns 80 years or more at any time during the previous year, such person will be called as super senior citizen. So you can keep in mind, if a person is born on or before 1/4/1966, the individual is senior citizen. Any individual born on or before 1/4/1946, the individual will be super senior citizen. So if an individual is a resident senior citizen, then for such individual up to 3 lakh rupees there is no tax. And if an individual is a resident super senior citizen, for them up to 5 lakh rupees there is no tax. So I can say up to 2,50,000 or up to 3 lakhs or up to 5 lakhs as the case may be, the tax is going to be 0. Then above 2,50,000 or 3 lakhs up to 5 lakhs, the tax is going to be 5%. Above 5 lakhs up to 10 lakhs 20%, and above 10 lakhs 30%. So repeat once again, above 2,50,000 up to 2,50,000 or 3 lakhs or 5 lakhs it is 0. Above 2,50,000 or 3 lakhs up to 5 lakhs it is 5%. Above 5 lakhs up to 10 lakhs 20%. Above 10 lakhs 30% tax. So this is the tax rate of individual. Now let's talk about Hindu undivided family, that is HUF, then AOP BOI, so association of person body of individual, and AJP, that is artificial juridical person. For all these persons also, the tax rate is same as an individual whose age is below 60. So what is the tax rate? Up to 2,50,000 0, above 2,50,000 up to 5 lakhs 5%, above 5 lakh up to 10 lakh 20%, and above 10 lakhs 30% tax. Then for partnership firm, limited liability partnership, and local authority, on the entire income their tax is 30%. Now let's talk about cooperative society. For cooperative society, up to 10,000 10%, above 10,000 up to 20,000 20%, and above 20,000 tax rate is 30%. Fine. Now company are of two classes, that is domestic company and foreign company. For foreign company, the income tax rate is 35%. For domestic company, you have to see their turnover in previous year 23-24, previous year 23-24. In previous year 23-24, if their turnover is up to 400 crores, then their tax rate is 25%, and in other cases their tax rate is 30%. Sir, what if the company is born after 23-24? In such case, what to do? In such case, take the tax rate as 25 itself. Give them the benefit, 25% tax rate. Now let's talk about surcharge. But before that, let me tell you that income tax rate is a slab rate system. So for example, if a person is earning more than 10 lakh rupees, directly you should not take the income into 30%. You should give that person the benefit of all the tax slabs. So even if a person is earning more than 10 lakhs, still they will get the benefit of 2,50,000, 5 lakh and 10 lakh slab. Okay, but when you come to surcharge is not a slab rate system, it is a flat rate system. So fixed rate is there. So if the person is earning more than the surcharge limit, then the rate is going to be the same rate. Moreover, income tax rate is a percentage of income, whereas surcharge is a percentage of income tax. So on the income tax amount only you are going to apply this percentage. Now let us learn what are surcharge percentages. Firstly, for individual, HUF, AOP, BOI and AJP. Individual, HUF, AOP, BOI and AJP. It means all the persons who are enjoying the 2,50,000 basic exemption limit. So for all of them, up to 50 lakh rupees, no surcharge is applicable. But if the income is above 50 lakhs up to 1 crore, 10% surcharge. Income above 1 crore up to 2 crores, 15% surcharge. Above 2 crores up to 5 crores, 25% surcharge. And above 5 crores, 37% surcharge. Once more, above 50 lakhs up to 1 crore, 10%. Above 1 crore up to 2 crores, 15%. Above 2 crores up to 5 crores, 25%. And above 5 crores, 37% surcharge. So these are the surcharge rates. Then for partnership firm, limited liability partnership and local authority, for total income above 1 crore, 12% surcharge. Then for domestic company and cooperative society, total income above 1 crore up to 10 crores, 7%. Total income above 10 crores, 12% surcharge. Fine. Then for foreign company, total income above 1 crore, 10 crore, up to 10 crores, only 2% surcharge. Then total income above 10 crores, only 5% surcharge. Sir, why is the surcharge rate so less for foreign company? Answer is because foreign company tax rate is high, that is why their surcharge rate is less. Fine. Now let us talk about section 87A rebate. Sir, what is this section 87A rebate? There is a section called 87A which gives a discount on income tax. This discount is only rebate. Sir, who is eligible for this discount? Answer is resident individual having a total income of up to 5 lakhs is eligible. Who is eligible? Resident individual having total income up to 5 lakhs. And this total income includes normal income also, special income also. All the incomes included. Only if it is up to 5 lakhs, then the rebate is allowed. Sir, what is the rebate? rebate, entire income tax is allowed as a discount, maximum up to 12,500. So entire income tax up to 12,500 is allowed as a discount to the individual. Now in this rebate, there is no marginal relief concept. It means what? If you earn a little bit of income extra, still you have to pay huge amount of income tax. Let me give you an example. So let's say a person is having an income of 5 lakh rupees. So if the income is 5 lakhs, then the tax will come as 12,500. Let's say the person is a resident individual. So for resident individual, up to 5 lakhs, entire amount of income tax is allowed as rebate up to 12,500. So you can reduce 12,500 as rebate. So final income tax becomes 0. Now what happens if for the same individual, the income becomes 5 lakh and 5? That is just 5 rupees extra. So if the income is 5 lakh and 5, after rounding off, you will get the total income as 5 lakh and 10. On 5 lakh and 10, the tax is coming as 13,000 rupees. And since the total income is more than 5 lakh, no rebate is allowed for this individual. That is why even though the income is just 5 rupees extra, still the tax is 13,000 rupees extra. The tax is 13,000 rupees extra. This happens because there is no concept of marginal relief for rebate under the old tax regime. But in new tax regime, there is marginal relief, which I am going to tell you in some time. And one more point I would like to tell that, sir, you might have a confusion that when the income is 5 lakhs, you are getting the tax as 12,500. Entire tax is allowed as rebate. So can we tell that rebate, when it is applicable, always the tax is going to come as 0? Can we tell like this? Answer is no. You cannot tell like this. You know why? Because there can be some special rate of income also. Let me give you an example. Let's say the assessee has earned 5 lakh rupees as income, and this entire 5 lakhs is earned under section 111A. In section 111A, what is the tax rate? We are going to learn in this video only that the tax rate is 20%. So up to 2,50,000 it will be 0. Above 2,50,000 up to 5 lakhs, the tax rate will be 20%. So you will get the income tax as 50,000. On this 50,000, maximum you can claim how much rebate? You can claim maximum 12,500 only. So balance tax will be 37,500. And after finding this rebate only, you should add the health and education cess. Health and education cess. Fine. So rebate under section 87A is also covered. Now let us talk about health and education cess. Health and education cess is 4% of income tax plus surcharge. So find out income tax, then find out surcharge, then add income tax and surcharge. On this amount only you have to calculate 4%. That is only health and education cess. Generally whatever adjustment and all are there, that is rebate adjustment, surcharge adjustment, marginal relief adjustment, everything will happen before health and education cess only. Before health and education cess. Now let's talk about marginal relief. What is marginal relief? This marginal relief we are talking about surcharge karna. Surcharge karna. In surcharge we have learned that there is no slab rate system, it is a flat rate system. That is why what happens whenever the income is just above the surcharge limit, what happens, there is only little bit increase in income, but there is a huge increase in the income tax. Let me give you an example. So let's say the income is 1 crore and 1 lakh. If the income is 1 crore and 1 lakh, what happens? If you earn 1 crore rupees, the surcharge rate is only 10%. That is why your income tax will come to 30,93,750. But if you earn just 1 lakh rupee extra, what will happen? The surcharge rate is 15%, and that is why your tax will come to 32,68,875 rupees. So that much will be extra. How much income extra did you earn? You earned only 1 lakh rupee extra income. But how much extra tax you are paying? You are paying 1,75,000 as extra tax. This is very, very unfair, no? That is why the Act allows marginal relief. So marginal relief concept tells that the additional tax should not be more than the additional income. If additional tax is more than the additional income, maximum up to the additional income only you can charge the tax. So here how to calculate the marginal relief? First you have to calculate the tax on actual income, then you calculate the tax on the surcharge limit, then you see what is the total income above the limit, then you reduce all the three. So from the actual tax, reduce the tax on limit and reduce the total income above limit. So B minus C minus D, you will get the marginal relief as 75,125. Then how to find out what is the final tax? The final tax is equal to actual tax minus marginal relief. So you will find out what is the final tax. After finding final tax, then you add health and education cess. I told you all this adjustment will happen before calculating the cess. So finally you should calculate health and education cess, and then whatever tax is there, you round off to the nearest multiple of 10. Speaking of round off, there are two sections which speak about round off, that is section 288A and 288B. 288A tells that the total income should be rounded off to the nearest multiple of 10. It means what? That the last digit should always be 0 for total income. Then 288B tells that the tax payable or refundable also should be rounded off to the nearest multiple of 10. So how to do rounding off? If the last digit is 5 or more, then you go to the next, that is 955 will become 960. But if the last digit is less than 5, then you go to the previous one. So 853 will become 850. Sir, what if there is decimal? For example, 1154.94. In such case, you are going to ignore the decimal and then solve the rounding. So in this case, you just have to see 1154. It will become 1150. Ignore the decimals while doing round off calculation. Fine. So these are the old tax regime tax rates. Now let us come to new tax regime or default tax regime, which is given under section 115 BAC. Sir, for whom is this default tax regime applicable? Default tax regime under 115 BAC is applicable for individual, HUF, AOP, BOY and AJP other than cooperative society. Individual, HUF, AOP, BOY and artificial juridical person other than cooperative society. So it is applicable on the total income chargeable to tax as per normal tax rates. So whatever is the slab rate that we discussed, instead of that slab rate, you have to put section 115 BAC. However, if at all our income is taxable at special tax rates, then whether it is old regime or new regime, it does not matter. The income will always be taxable at special tax rates. Special tax rate we will study after this Kanna. Okay. So normal tax rate. So default tax regime, what are the tax rates? The tax rates have completely changed for May 26 exams onwards. So what are the tax rates? Up to 4 lakh rupees 0, above 4 lakh up to 8 lakh 5%, above 8 lakh up to 12 lakh 10%, above 12 lakhs up to 16 lakhs 15%, above 16 lakhs up to 20 lakhs 20%, above 20 lakhs up to 24 lakhs 25%, and above 24 lakhs 30% tax. So how to remember these tax rates? Very simple. After 4 lakhs, you keep on adding 4 lakhs to each slab. So 4, 8, 12, 16, 20, 24. And then in the tax rate, you keep on adding 5%. So 0, 5, 10, 15, 20, 25, 30. So from 24 lakh onwards, the tax rate is going to be 30%. So once again I am repeating, and in this there is no senior citizen, super senior citizen concept. For everyone the tax rate is same only. So up to 4 lakh rupees nil, above 4 lakh up to 8 lakh 5%, above 8 lakh up to 12 lakhs 10%, above 12 lakhs up to 16 lakhs 15%, above 16 lakhs up to 20 lakhs 20%, above 20 lakh up to 24 lakhs 25%, and above 24 lakhs the tax rate is 30%. Fine. Now let's talk about surcharge. Surcharge is also same as old tax regime, but here in the new tax regime, that is 115 BAC or default tax regime, there is no 37% slab, okay, or there is no 5 crore slab. So total income up to 50 lakhs, there is no surcharge. Above 50 lakhs up to 1 crore, 10% surcharge. Above 1 crore up to 2 crores, 15% surcharge. And above 2 crores, 25% surcharge. That's it. There is no 5 crore slab. Now let's talk about section 87A rebate. Karna, section 87A rebate in the old regime and section 87A rebate in the default tax regime are totally different. There is only one similarity. What is the similarity? In old scheme also it is applicable only to resident individual. In default tax regime also it is only applicable to resident individual. Now let us see what are all the different things in 87A rebate for the default tax regime. Default tax regime 87A rebate is applicable only to resident individual having the total income chargeable under section 115 BAC up to 12 lakhs. So here you are not seeing total income, you are only seeing the total income which is chargeable under 115 BAC. That means the normal rate income only you have to see, the slab rate income only you have to see. If the slab rate income is up to 12 lakhs, then the individual is eligible for rebate. Here what is the maximum rebate? Maximum rebate is 60,000. So entire income tax up to 60,000 will be allowed as rebate. Entire income tax up to 60,000 allowed as rebate. So for whom it is eligible? Resident individual having the total income taxable under section 115 BAC up to 12 lakh rupees. What is the maximum rebate? Maximum rebate is 60,000 rupees. And in the new tax regime, that is default tax regime, there is the concept of marginal relief. Marginal relief in case of rebate also. So how does this marginal relief work? Marginal relief concept I already told you, that the additional tax should not be more than the additional income. So what happens if you earn just a little bit more than the rebate limit? So let's say the person has earned 12,20,000. If the person earns 12,20,000, up to 12 lakhs rebate is there. So the tax going to come as 0. So if it becomes 20,000, what is the extra income? Extra income is 20,000. That is why the tax also will be 20,000. Extra tax cannot be more than extra income. So if the income is 12,50,000, then the tax is going to be 50,000. If the income is 12,55,000, the tax is going to come as 55,000. Fine. So like this, you have to calculate the marginal relief. So calculate marginal relief only if the total income is up to 12,75,000. Above 12,75,000, no need to calculate. How to calculate marginal relief, sir? Marginal relief is equal to the actual tax minus total income above 12 lakhs. Actual tax minus total income above 12 lakhs. So whatever amount is coming in positive, it will be marginal relief. If the answer is negative, it means there is no marginal relief. One more thing I would like to say is that there is another difference between the rebate of old tax regime and new tax regime. In the old tax regime, rebate is allowed against a special tax rate income also, except to 112A. Only for 112A income alone, the rebate is not allowed in old tax regime. But in the new tax regime, rebate is not allowed for any special rate. Rebate is only allowed for slab rate income. It is not allowed for special rate income. Now let's come to health and education cess. Health and education cess is the same in the default tax regime also, that is 4% of income tax and surcharge. Now let's talk about marginal relief. Marginal relief in case of surcharge is the same as old tax regime. So here also the same concept, the same type of working you have to do. But remember, in the default tax regime, only 2 crores slab is there, 5 crores slab is not there. Fine. Then in default tax regime also 288A and 288B are applicable, that is round off to the nearest multiple of 10. Now let us see what is the difference between the incomes in old regime and new regime. You would have seen that in old regime the tax rate is higher and in new regime the tax rate is lower. You know why it is lower? Because in the default tax regime under 115 BAC, so many exemptions and deductions are not allowed to the assessee. So many exemptions and deductions are not allowed. Sir, what are all the exemptions and deductions not allowed? Let us see. First and foremost, alternate minimum tax is not applicable in default tax regime. Sir, but alternate minimum tax is an extra tax only, no? So it is beneficial. Answer is yes. But alternate minimum tax is not applicable because whatever are the components of alternate minimum tax, that is also not applicable. For example, section 10AA not applicable, 80IA to 80 RRB not applicable, 35 AD specified business also not allowed under default tax regime. Since all these benefits are not given, that is why alternate minimum tax also not applicable. But one thing you have to be careful. If at all a person is changing from old regime to new regime, and if the person is having AMT credit, that is alternate minimum tax credit, then that alternate minimum tax credit will lapse. It will become 0. That is why if you are converting from old scheme to new scheme, then if at all you want to use the credit, then don't convert to new scheme. You wait in the old scheme itself, you take the use of the credit, and in the later on years you can convert to the default tax regime. Fine. Now let us see what are the other benefits which are not allowed in the default tax regime. Firstly, in the salary chapter, you will learn Section 10 clause 5, leave travel concession not allowed under 115 BAC. Then house rent allowance 1013A not allowed under 115 BAC. Then in section 10 clause 14, there are so many allowances. All these allowances are not allowed under 115 BAC, but only 4 allowances are allowed. What are the 4 allowances? The 4 allowances are transport allowance, conveyance allowance, travel allowance and daily allowance. Transport allowance, conveyance allowance, travel allowance and daily allowance. Transport allowance is allowed only up to 3,200 rupees per month for blind, deaf, dumb and handicapped, that is specially abled people. So they can take this transport allowance benefit in the old regime also, new regime also. Then conveyance allowance, travel allowance and daily allowance is given for the people who are using the money of the allowance for official purposes. So for these 3 allowances also, you can take the benefit of exemption in the old regime also, new regime also. But all the remaining allowances are not allowed in the new regime. They are only allowed in the old tax regime. Fine. Now let's come to deductions. There are 2 deductions, that is entertainment allowance and professional tax, which is only allowed in old regime, not allowed under section 115 BAC. Now let's come to house property. In house property, we will learn section 24B, that is interest on housing loan. This interest on housing loan for self-occupied property is only allowed in old tax regime, not allowed under section 115 BAC. So in house property, interest on housing loan on self-occupied property only allowed under old tax regime, not allowed under new tax regime. You know, in house property, what else is the loss? in house property, if at all you are having a loss, then you can't do inter-head adjustment for that loss. You can't set off the loss of house property against other head of income under section 115 BAC. Moreover, if there is a loss during the year, you cannot carry forward the house property loss if you choose the default tax regime. So what did I tell? You can't do inter-head adjustment also, and you can't carry forward the house property loss also. So that is the disadvantage in house property. Now let's talk about PGBP, business head of income. In PGBP head of income, if at all the depreciation rate is more than 40%, then restrict the depreciation rate to 40%. And one more thing, additional depreciation is only allowed in old tax regime, not allowed in new tax regime. Additional depreciation is not allowed in 115 BAC. Sir, what if there is any brought forward unabsorbed depreciation, and in that unabsorbed depreciation you are also having some additional depreciation? So if at all you are having some brought forward additional depreciation which is unabsorbed, and if you are converting to new tax regime, then you have to cancel that brought forward additional depreciation. So that brought forward additional depreciation is not allowed to be carried forward. Then what to do with that amount? That much amount you add to the WDV of the asset. So for example, you are having unabsorbed depreciation during the year, and this unabsorbed depreciation contains additional depreciation of 10 lakh rupees. And in this case, the assessee chooses 115 BAC. If the assessee chooses 115 BAC, then additional depreciation is not allowed in unabsorbed depreciation. Then what to do with this 10 lakhs? This 10 lakhs you add to WDV. Add to WDV of the block. Okay, now let's come to next part. In PGBP, in section 35, we will be learning about the deduction of scientific research expenditure. In that there are two types, in-house research and contribution. In-house research is allowed in old regime also, new regime also. However, all the contributions are only allowed in the old tax regime. They are not allowed under the default tax regime. Now let's come to 35 AD. 35 AD is the deduction given for capital expenditure of specified businesses. Okay, all that cold chain facility, warehousing facility, hotel, okay, hospital, all those businesses, the deduction is only available in the old regime. It is not available under section 115 BAC. Then section 10AA, deduction given to special economic zone. 10AA deduction also only allowed in old regime, not allowed under section 115 BAC. Then section 10 clause 17, daily allowance and constituency allowance given to member of parliament and member of legislative assembly, that is also only allowed in the old regime, not allowed under 115 BAC. Then when you come to the clubbing chapter, you will be learning section 10 clause 32, exemption on the clubbing of the income of minor child, that is 1500 rupees. That 1500 rupee exemption is only allowed in old tax, it is not allowed in default tax regime. Then let's talk about deductions. Kana, entire deduction chapter itself not allowed under default tax regime. Entire deduction chapter not allowed under default tax regime. However, only 3 deductions are allowed. Only 3 deductions. What are they? 80 CCD subsection 2, 80 CCH subsection 2 and 80 JJAA. 80 CCD subsection 2 speaks about employer contribution to pension scheme, that is allowed. Then 80 CCH subsection 2 talks about Agniveer Corpus Fund employer contribution, that is also allowed. And section 80 JJAA speaks about emoluments of additional employees, that is also allowed as deduction. So these 3 deductions alone can be claimed in both regime, but all the other deductions are only allowed in old tax regime, not allowed under section 115 BAC. Fine. Now let's talk about, so set off carry forward is over. Then if you see the salary chapter, we will study perquisites of up to 50 rupees per meal will be exempt. That this 50 rupees per meal is there. No, this is also not allowed under new tax regime of section 115 BAC. Not allowed. Now, all these cases we have seen that the new tax regime will give you disadvantage only. Only old tax is more advantageous in terms of deduction and exemption. But you know what? There are 3 places where new tax regime or 115 BAC is giving you extra benefit. There are 3 places where 115 BAC will give you extra benefit. What are the 3 cases? Let us see. In case of salary chapter, in the default tax regime, the standard deduction is 75,000. But in old regime, it is only 50,000. So extra 25,000 deduction the salaried employees will get in the new regime. Then in case of family pension deduction, the extra deduction given is 25,000 instead of 15,000. So in old regime, maximum deduction is 15,000, but in default tax regime, it is 25,000. Then in case of 80 CCD subsection 2, that is employer contribution to pension scheme, if the employer is not a government employer, then in old regime 10% of the salary is only maximum allowed, but in the new regime, 14% is allowed as deduction. Fine. So there are 3 benefits also given. Now let's talk about option to opt out of the optional tax regime. Now when to choose default, when to choose the old tax regime, let us see. Kanna, if a person is filing the income tax return, by default they are coming under default tax regime only. That is why it is called default tax regime. By default they are coming under default tax regime. However, if a person wants, the person can shift out or opt out to take the old tax regime also. The person can opt out to take the old regime also. However, there are 2 types of assessees. Assessees not having PGBP income and assessees having PGBP income. If assessee does not have PGBP income, for them it is jolly. They can choose the old regime or new regime every year. So this year, if I want, I can stay in the default tax regime. Next year, if I want, I can choose the old tax regime. Then again, the next year to that, if they want, they can come back to default tax regime. Any number of times they can keep on changing year after year based on what is beneficial. So this year, if the old tax is beneficial, I will take the old tax. Next year, if new tax is beneficial, I will take the new tax. This is only for the assessees not having PGBP income. But if the assessee is having business income or PGBP income, in such case, there is a restriction. What is the restriction, sir? The assessee will always stay in default tax regime only. But if the assessee wants to shift out of the old tax regime, only once they can shift out to the old regime. Only once they can shift out to the old regime. If they shift out to the old regime, they should stay in old regime only. So every year they should stay in old regime only. But if at all from old they want to come back to new, then also they can come back, but only once. So you can go to the old regime only once, you can come back to the new regime only once. If you go once and come back once, after that you can never change your tax regime. Always you will be there in default tax regime only. So what did I say? By default they are in default tax regime. They can go to old tax regime only once in lifetime. Then they can come back to new tax regime only once in lifetime. After they come back to new regime, they can never go back to old regime once again. Till they are having PGBP income. Let's say their business itself is over. So later on they are not having any business. Then now can they come to the first category and choose every year? Answer is yes. So only when they are having the business, this restriction is there. If they are not having any business or profession, there is no restriction. Fine. Now let's talk about employer-employee. If at all there is an employee, that employee should intimate the employer that which tax regime he wants to choose. So the employee will tell, I want to go for old tax or I want to go for new tax. So based on his declaration only, the employer will deduct the TDS. Employer will deduct the TDS. Let's say the employee told that he is going to go for old tax regime, but now while filing the return of income, he feels that new tax regime is only more beneficial. Can he change while filing return of income? Answer is yes. So even though first the TDS was deducted under old tax, still if the employee wants, the employee can convert into new tax while filing the return of income. Fine. So this was the new tax regime. Now let us talk about the new tax regime, that is default regime for other persons. So let us discuss about domestic company and resident cooperative society. So section 115BAA and 115BAB is the new scheme for domestic company. For domestic company, you should see whether the company is a new manufacturing company or other company. If the company is new manufacturing company, then they can go for section 115BAB, where the tax rate is 15%. And there is always surcharge of 10%, health and education cess of 4%. So the effective tax rate will come as 17.16%. Then the other domestic companies can choose section 115BAA. There the tax rate is 22% plus 10% surcharge plus 4% health and education cess. Hence the effective tax rate is coming as 25.168%. Similar provision is also there for resident cooperative society. So if resident cooperative society is engaged in manufacturing newly, then their tax rate is 15 plus 10% surcharge plus 4% health and education cess. So effectively 17.16%. If they are going for 115BAD, then it is 22% tax plus 10% surcharge plus 4% health and education cess, effectively 25.168%. For company and cooperative society, if you know this much, that is enough. You need not go into depth of the section. So this much is only there in your syllabus. So now we have covered what are all the normal tax rates or slab rates. Now we are jumping into special tax rates. Special tax rates. Special tax rates are given for special incomes. These special incomes are the incomes which are referred into some specific sections. So that only we are going to study now. So first special rate of income is section 115 BAC, which talks about undisclosed source of income. So undisclosed source of income is taxable under section 115 BAC. What is the tax rate? It is 60% tax plus 25% surcharge plus 4% health and education cess. 60% tax plus 25% surcharge plus 4% health and education cess. So total tax will come as 78%. Fine. Then we have learned alternate minimum tax now. So what is the AMT rate? Alternate minimum tax rate is 18.5%. So cooperative society, this is all not applicable for your exam. You can ignore it. AMT rate is how much? 18.5%. Then in capital gain chapter, there is section 111A, 112A and section 112. 111A is special cases of short-term capital gain. So what are all the short-term capital gain covered here? Short-term capital gain on transfer of equity shares in a company, units of equity oriented fund and units of business trust on whom the STT should have been paid on transfer. What is the tax rate? 20% tax. 20% tax. Sir, what about the short-term capital gain which is not covered under 111A? If any short-term capital gain is not covered under 111A, it will be taxable under the normal tax rate only. Fine. Now let us talk about long-term capital gain. Long-term capital gain covered under section 112A. Under 112A, what is covered? Long-term capital gain on transfer of equity shares in a company on whom STT is paid on purchase also, transfer also. Then unit of equity oriented fund and unit of business trust on whom the STT is paid on transfer. So all these are covered under section 112A. What is the tax rate under 112A? Here there is a slab rate system. What is the slab rate? Up to 1,25,000 no tax, above 1,25,000 12.5% tax. So in 112A, what is the tax? Up to 1,25,000 no tax, above 1,25,000 12.5% tax. Now let's talk about 112. So whatever is the long-term capital gain, if it is not covered under 112A, it will be covered under section 112. So what is the tax rate under 112? The tax rate under 112 is 12.5% without indexation. 12.5% without indexation. However, if a person is a resident individual or HUF, okay, resident individual or HUF who is having a long-term capital asset, being a land or building or both, which has been purchased before 23/7/2024 and it is being sold on or after 23/7/2024, then they are having a benefit. So for whom did I say? For resident individual and HUF who are having a long-term capital asset, being a land or building or both, which has been acquired before 23/7/2024 and it is being transferred on or after 23/7/2024, then they are having a benefit. You know what is the benefit? While calculating the tax under section 112, they can choose either 12.5% without indexation or 20% with indexation. 12.5% without indexation, 20% with indexation. You know, from 23/7/2024 onwards, only this tax rate 12.5% without indexation came. Up to 22/7/2024, the tax rate for long-term capital gain was 20% with indexation. Sir, should I remember the old tax rate also? Answer is yes, you should remember, because you might get some old transfers in your question. That time you should be able to calculate the tax rate. Fine. So up to 22/7/2024 for long-term capital gain, the tax rate was 20% with indexation. Then from 23/7/2024 onwards, the tax rate on long-term capital gain became 12.5% with indexation. However, if at all there is a resident individual who are having long-term capital asset, being land or building or both, acquired before 23/7/2024 and transferred on or after 23/7/2024, then they are having the option to choose between 12.5% without indexation or 20% with indexation, whichever is lower. Fine. Then in income from other sources, under section 115 BB, winnings from lottery, crossword puzzle, horse race, card game, betting, gambling, all this is taxable at 30% tax rate. 30%. Then online games are taxable under section 115 BBJ at 30%. Alternate minimum tax, I already told you, it is 18.5%. So these are all the special tax rates. And you know what? For section 115 BB, section 115 BBE and section 115 BBJ, the person cannot use the basic exemption limit. No expenses allowed, no loss is allowed. So if there is any loss, you can't even set off against these incomes. So it is a very strict section. Now let's talk about surcharge in case of special income. There are 4 types of incomes where the maximum surcharge can be 15% only. What are the 4 incomes? Dividend income, 111A income, 112 income, 112A income. Dividend income, 111A income, 112 income, 112A income. For all these 4 incomes, maximum surcharge is going to be 15% only. Hence, if in the examination, if you get a question where the total income is greater than 2 crores, then you please refer the table which is given here. Okay? Refer the table that is given here. Obviously in exam you can't refer, so learn this table and go. That's what I am trying to say. So if the total income is greater than 2 crores, first let us talk about old regime, normal provision. If total income is greater than 2 crores, then for dividend, 111A, 112 and 112A, always the surcharge is going to be 15 only. Always the surcharge is going to be 15. Then you see what are the income other than dividend 111A, 112 and 112A. If income other than dividend 111A, 112 and 112A is up to 2 crores, then 15% surcharge. If it is more than 2 crores, 25% surcharge. If it is more than 5 crores, 37% surcharge. Fine. So like this you have to calculate the surcharge. And in case of new tax regime, there is no 37% slab. So there is only 15 and 25% slab. Fine. So these are all the tax rates we have covered comprehensively. I have given you some additional points also which is going to be helpful in your examination. Now let us start the revision of basic concepts chapter. First, introduction to income tax. So to develop the nation, the government needs 2 things, power and money. Power comes from the constitution and the money can come from 3 sources. That is government's own businesses, then taxes and borrowings. We are concerned about taxes because our subject is income tax. What is tax? Tax is nothing but the money charged by the government on products, income or activity to meet the common welfare expenses. The taxes can be of 2 types, that is direct tax and indirect tax. For direct tax the example is income tax, and for indirect tax the example is GST or custom duty. What is the difference between both? Direct tax is directly charged on income or wealth, whereas indirect tax is indirectly charged on goods or services. So for example, if I buy this pen for 100 rupees, the indirect tax is mixed in this 100 rupees. I will not pay it directly, I will pay it indirectly. Then direct tax, the incidence does not pass. I cannot recover the direct tax from somebody else, but in indirect tax, the incidence passes to the end consumer. It means what? The indirect tax can be recovered from the end consumer. Then direct tax is a progressive taxation where the rich are taxed more and the poor are taxed less. But indirect tax is a regressive taxation where everybody is taxed equally. Then let's talk about the constitution. Before giving the power the constitution places a restriction with the help of article 265. The restriction tells that no tax can be collected by the government without the help of a law. So to collect the tax, a law should compulsorily be there. Now who has the power to make the law? It is given in article 246 where there is 7th schedule. In the 7th schedule there are 3 lists: union list, list number 1, list number 2 is state list, and list number 3 is concurrent list. In list number 1, that is union list only, the parliament or the central government is having the power to create the law. And here only there is entry number 82 which states income tax on income other than agricultural income. So the central government is having the power, or the parliament is having the power to create the laws on income tax on income other than agricultural income. Sir, what about agricultural income? If there is any income tax on agricultural income, then the power is there with the state list, that is list number 2. Now let's come to the components of income tax law. If I tell you that income tax law and income tax act, are they one and the same? Answer is no, they are not one and the same, both are different. Income tax law is a much wider term and income tax act is only a part of the income tax law. So there are totally 5 parts. So out of that, the first part is only income tax act. This income tax act was passed in the parliament in 1961, came into force from 1/4/1962. Income tax act contains sections, chapters and schedules. Sections contain the wordings of the income tax act, or we can also call them as provisions of income tax act. Chapter is nothing but a group of sections, and schedules contain additional information. The income tax sections are numbered from 1 to 298. So does it mean there are 298 sections? Answer is no, there are way more than 298 sections. Now how to read a section? If something is given like this you read it as section number 5, subsection 1, clause A, subclause 2. Section 5, subsection 1, clause A, subclause 2. So what is a subsection? Subsection is a sub part of a section, and generally subsections are linked to each other. It means what? If you read all the subsection together only, you will get the complete meaning of the section. But sometimes, when you read the subsection, they are all independent of each other. You need not read the other subsection to know the meaning of the complete section. In such case, you should not call them as subsection. Directly, you should call them as clause. So in income tax, your syllabus, there are 3 sections where directly you will call it as clause. That is section 2, which deals with different definitions. Then section 10, which deals with exemptions, and section 47, which deals with transaction not regarded as transfer. So here, if you see the part of the section, they are not at all linked with each other. That is why you will not call them as subsection. You will directly call them as clause. So section 2 clause 1, section 2 clause 2, like that you should say. Then what about subclause? Subclause is a sub part of a clause. Then the sections also contain provisos and explanation. What is proviso? Proviso means exception to a particular section. Generally, it starts with the word provided. And what about explanation? Explanation means some sentences that carry the clarification regarding a section. If at all a section is confusing, the government will introduce explanation. So explanation will give the clarity for that particular section. Now let's talk about the second part of the income tax law, that is Annual Finance Act. Annual Finance Act is passed in the parliament every single year, and in the year of Lok Sabha election it is passed twice in the year. Now what is the work of this Finance Act? The work of this Finance Act is to amend the Income Tax Act. Amend means what, Kana? To change. Every year Income Tax Act keeps changing, no? That is because of the Finance Act only. So the work of the Finance Act is to amend the Income Tax Act and also to give the tax rates. But do you know that Finance Act is not the only act that can change the Income Tax Act? Income Tax Act can be changed by other legislations also. For example, during the period of COVID-19, the government had introduced the Taxation Law Amendment Act. So like this, other acts can also be brought to change the Income Tax Act. Now in Finance Act, there are 4 parts, Kana. Part 1, Part 2, Part 3 and Part 4. Part 1 of the Finance Act contains the rate of current assessment year. Part 2 contains the rate, that is TDS rates for current assessment year. Part 3 contains the advance tax rate and TDS rates for salary, and Part 4 contains the rules to compute net agricultural income. This Part 3 only will become the Part 1 of the next year. Fine. Now let's come to income tax rules. Income tax rules are created by CBDT, which is nothing but Central Board of Direct Taxes, or we can also call them as Income Tax Department. So CBDT means Income Tax Department. They are only having the power to create the rules. What is the purpose of the rule? The purpose of the rule is to carry out the purposes of the Income Tax Act in India. Okay, for example, depreciation rates are given in the income tax rules. The difference between agricultural income and business income are given in the income tax rules. Now let's come to the fourth component, that is circular and notification. So what is circular? What is notification? Circulars are brought by CBDT, whereas notification can be brought by central government also, CBDT also. Then what is the use of circular? Circular is passed to clarify the doubts or to solve the problems of the public. To clarify the doubts or to solve the problems. And this circular is there, no? It is binding on CBDT but not binding on the assessee. It means CBDT, that is the income tax department, has to compulsorily follow, but the assessee will only follow when it is beneficial for the assessee. If it is not beneficial, then you can also fight against the circular. Now coming to notification. Notification is passed by central government to implement the provision, and it is passed by CBDT to make the rules or to amend the rules. But notification gives power. That is why notification is binding on everybody. Everybody has to compulsorily follow notification. Then coming to the last component, that is decision by courts. The decision by courts, or we can also call it as judiciary. Judiciary is a part of your CA final syllabus, but now only if you know this much it is enough. What you should know, that if at all a case is fought in the high court and if the assessee wins the case, it is not applicable to the assessee, not only applicable to the assessee, it is also applicable to the entire state. So if I win the case in Madras High Court, it is applicable to entire Tamil Nadu. Similarly, if I go to Supreme Court, and if I win the case in Supreme Court, it is not only applicable to me, it is applicable to entire India. That is why Supreme Court is also called as apex court, and the decisions by the Supreme Court are also called as law of the land. Law of the land. Now let's come to the steps to calculate total income and taxes. Now what you are seeing on the screen is your entire syllabus summed up in just one page. So these are the steps to calculate total income and taxes. So step number 1 is determine the type of person. So before knowing what is the income and what is the tax, first what you should know, who is the person, whether the person is individual or HUF or AOP or BOI or firm or AJP, etc. That you should know. Then step number 2, determine the residential status. Based on the type of person, you have to determine whether the person is a resident or non-resident, because for resident, global income is taxable. For non-resident, only Indian income is taxable. Then step number 3. Now you know what are all the incomes that are taxable. You group the incomes into 5 categories. So first is salary head of income, second is house property head of income, third is profit and gains from business or profession, fourth is capital gains, and fifth is income from other sources. So these are the 5 heads of income. And you know what? In income tax, not only the gross income is taxable, net income is taxable. Sorry, the gross income is not taxable, net income is taxable. It means what? You can reduce the deductions also. So whatever deductions are available in that particular head of income, you reduce it, and whatever is exempt income, you give effect to the exemption. Sir, what is difference between exemption and deduction? Exemption means the income itself is not taxable, but deduction means it is an expense which can be reduced against the income. So that is the difference. Now let's come to step number 5. So after doing this, please give effect to the clubbing adjustment. Clubbing adjustment means what? Income of other people which is taxable in assessee's total income. So sometimes minor income will be taxable in the assessee's income, sometimes spouse income will be taxable, sometimes son's wife income will be taxable. So all those income you have to club in the hands of the assessee. After that, you have to give effect to set off and carry forward provisions. See Kana, when you are having the income, you have to pay the tax. But if you are having a loss, will the government come and give you money? Answer is no. When you are having a loss, then you can take the benefit of set off and carry forward adjustment. So whatever losses are there, you can set off against the incomes, and balance loss, if any, you can carry forward to the next year. So after doing all these adjustments, you will finally get gross total income. From this gross total income, you can further reduce the deductions that are given in chapter 6A and section 10AA for special economic zone. So both these deductions you can reduce, and after that you will get total income or net total income. However you want, you can call it total income or net total income. Now this total income is there, no, you have to round off to the nearest multiple of 10. It means what? The last digit should be 0. Then step number 8, after finding total income, now you have to find the tax. So to find the tax, you have to multiply income into tax rate. In tax rate also, there are normal tax rate and special tax rate. Normal tax rate means slab rate, special tax rate means fixed rate. So in normal tax rate also, there are 2 regime karna, old tax regime or optional regime, then new tax regime or default tax regime under section 115 BAC. So both tax regime you should see what is the tax that you are getting, and you should compare both of them. And special tax rates are the tax rates given in the particular sections. After finding out the regular income tax, you should see whether alternate minimum tax is applicable. If alternate minimum tax is applicable, then you should also find out what is the AMT. If regular income tax is higher, then you should pay regular income tax. But if alternate minimum tax is higher, then you should pay alternate minimum tax. So after doing all this, you should first then analyze what tax has to be paid, whether you have to choose default tax regime or optional tax regime. Now after doing all this, then you should add the surcharge, and if at all 87A rebate is allowed, then you should give effect to 87A rebate also, and if marginal relief is allowed, then you reduce the marginal relief also. After doing all these adjustment, lastly you should add health and education cess of 4% on income tax plus surcharge. After doing all this, you will find out what is the final total tax liability. From this tax liability, you should further reduce the taxes that have already been paid in advance, which is nothing but advance tax, TDS and TCS. So reduce it. Then finally you will get tax payable or tax refundable. This tax payable or tax refundable should also be rounded off to the nearest multiple of 10. It means what? Last digit should be 0. And lastly, you should file the income tax return using all this information. So these are the steps to calculate total income. Now let us come to the basic concepts part. Firstly, let us talk about section number 4. Section number 4 speaks about levy. Income tax is levied on. Levy means what kana? Applicability. So income tax is applicable on total income of the previous year of every person. Total income of previous year of every person. From total income we get income concept, from previous year concept, and from person concept. Firstly, let us discuss the income concept. So income, as per the Income Tax Act, income can be regular income also, it can be casual income also. So you might be regularly earning, or you might once in a while you might earn the income. Both are taxable under Income Tax Act. Then income means net income after deducting all the deductions. So I already told you, in income tax, income means net income. Then certain incomes are taxed on due basis while others are taxed on receipt basis. So whether it is taxed on due basis or receipt basis, it changes from case to case basis based on what is the head of income. Now let us see what is the difference between capital receipt and revenue receipt. Why are we learning the difference, sir? Because capital receipt is not taxable unless it is provided in the Income Tax Act, but revenue receipt is always taxable unless it is exempt from the Income Tax Act. Capital receipt comes from fixed capital like tangible assets, and revenue receipts come from circulating capital. For example, whatever assets are there, it is circulating in the business like stock. So that is circulating capital. Then capital receipts comes from the transfer of capital asset. So you transfer the capital asset and get the money, that is only capital receipt. But if there is trading asset like stock, if you transfer the trading asset and get the money, that is revenue receipt. Then capital receipt comes when the source of income itself is transferred. For example, I am having a house. From that house I am receiving some rent. If the house itself I transfer, then the amount that I receive is capital receipt. Then what is revenue receipt? Revenue receipt is the income from the source. So from this house the rent is coming, no, that is only revenue receipt, income from the source. Capital receipt arises when there is no ordinary course of business, but revenue receipt arises from the ordinary course of business. Then capital receipt arises by selling goods that are purchased without the intention to resell. So I did not have any intention to resell, but still I sold it. So whatever money I receive will be capital receipt. But if I'm having the intention to resell, then if I sell the goods and get the money, then it is revenue receipt. Shares, if I have acquired and sold the shares as an investor, it is a capital receipt. But if I acquire and sell the shares as a dealer, then it is revenue receipt. Except for financial institutions, FIIs, foreign institutional investors. Foreign institutional investors, in capital gain chapter you will learn that if they are having shares in security as per SEBI regulations, then whatever whatever profit they are getting, it will always be considered as capital gain. This you will learn in capital gain chapter. Then examples are there, this you can refer. Now let us come to year concept. Year concept. Sir, what is the difference between financial year, previous year and assessment year? Financial year means the year starting from 1st April to 31st of March. Then what is assessment year? Assessment year is also a financial year. That means starting from 1st April to 31st of March. Now what is special about this assessment year? In assessment year is the year in which the income becomes taxable. Assessment year is the year in which the income becomes taxable. That is why it is called assessment year. Now let us talk about previous year. Previous year is defined under section number 3. Why is it called previous year? It is called previous year because it is immediately preceding the assessment year. Previous year is the year in which the income is earned. The year in which income is earned. Previous year is also generally from 1st of April to 31st of March. However, if at all there is a new business or profession, then it is the date of setting up till 31st of March. And if there is a new source of income which has come into existence, then it is the date on which the source of income came into existence till 31st of March. So that is previous year. Now let us see what are the previous year for undisclosed source of income. Sir, what is this undisclosed source of income? Undisclosed source of income means the income which has been found out by the assessing officer and not properly disclosed by the assessee. These are very serious types of offences committed by the assessee, and that is why this undisclosed source of income is there. No, see the next page. It is taxable under section 115 BBE. What does 115 BBE tell? That the undisclosed source of income will be taxed at 60%, such a high rate, 60%. Moreover, there will be a surcharge of 25%. Even if you earn 100 rupees and undisclosed source, still there will be surcharge of 25% and health and education cess of 4%. So 60% tax plus 25% surcharge plus 4% health and education cess. If you add all of them together, you will get 78% combined income tax, effective tax rate. Moreover, there will be interest and penalty also, but interest and penalty on undisclosed source is not covered in CA intermediate level. And over and above this, basic exemption limit is also not allowed against undisclosed source of income. Then any deduction is also not allowed against undisclosed source of income. You can't set off any loss against the undisclosed source of income. So any loss is also not allowed to be set off. So it is such a serious type of income that it is punishable like this. Now what are these undisclosed source of income? Let us see. First undisclosed source of income is section 68, which speaks about cash credit. Section 68, cash credit, sum credited in the books of accounts. So if you find any sum which is there in the credit side of a balance sheet, that is sum credit in the books of accounts. The assessing officer will see this credit and he will ask the explanation from the assessee. If the assessee is able to offer explanation and if the explanation is satisfactory, then no problem. But if assessee does not offer explanation or the explanation offered by assessee is not satisfactory, then the assessing officer will treat the entire cash credit as undisclosed source of income in the financial year of credit. It will be treated as undisclosed source of income. And you know what? In this cash credit, there is another special point, that if the cash credit is in the form of a loan or borrowing, then the assessee should first tell that it is satisfactory, first give the satisfactory explanation. Then the person who has given the loan, they should also give satisfactory explanation that they are having the capacity or credit worthiness to give the loan. Only then it will be considered as normal, else it will be considered as undisclosed source. Let me give you an example. Let's say in the balance sheet you have received loan from Mr. X of rupees 1 crore. Okay, this is balance sheet of Mr. A. So in this case, this is a cash credit. The assessing officer will ask the explanation for this cash credit. He will tell the person, that is Mr. A, that this cash credit should be treated as undisclosed source. So Mr. A will give the explanation. First, Mr. A has to prove that this is actually a genuine loan received by him, and then Mr. X should also prove that he is having the capacity to give this loan. Only if both Mr. A and Mr. X, both of them are able to give satisfactory explanation, then it is alright. Even if one of them is not able to give satisfactory explanation, then this entire 1 crore will be treated as undisclosed source of income. You get my point? Moreover, let's say in the same balance sheet, let's say instead of loan, there is share capital. Share capital is also credit in the books of accounts. Let's say there is share capital of 1 crore which is invested by Mr. X. And this is a balance sheet of Messrs. ABC Limited. So in this case, the assessing officer will have a suspicion and he will ask for explanation of this 1 crore. If assessing officer asks for explanation, ABC Limited should also give explanation and Mr. X should also give explanation how he got the money to invest this 1 crore. If both explanation are satisfactory, no problem. But even if one of them are not able to give explanation which is satisfactory, then the assessing officer will treat this 1 crore as undisclosed source of income and it will be taxed at 60% plus 25% plus 4%. Okay, you get my point? So this is cash credit. Now let's talk about section 69, unexplained investment. If there is investment, example share, property, etc., which is not recorded in the books of accounts and assessing officer finds out this, then assessing officer will ask for explanation. If explanation is given, no problem. But if satisfactory explanation is not given, then the assessing officer will treat the investment value as undisclosed source of income in the financial year of investment. Now let's talk about section 69A, that is unexplained money, bullion, jewelry or any other valuable article. If there is any money, bullion, jewelry or any other valuable article that is not recorded in the books of accounts and assessing officer finds out, then he will ask for explanation. If no explanation is given or if the explanation given is not satisfactory, he will treat it as undisclosed source of income in the financial year in which he is finding out. Then section 69B talks about investment, money, bullion, jewelry or any other valuable article. It is disclosed, sir, but it is not fully disclosed. For example, 1 kg gold is been found out, but in the books of accounts only 200 grams of gold is written. Balance 800 is not written. In such case, assessing officer will ask for detail or explanation. If no explanation is given or if the explanation given is not satisfactory, then the difference amount that the assessing officer finds out will be treated as deemed income in the financial year in which it is found or undisclosed source of income. Fine. Then section 69C, it speaks about unexplained expenditure. The assessing officer finds out that you don't have income at all, but you are having expenditure worth crores. You are spending 1 crore rupees in your daughter's wedding, but in your income tax return you are showing that your income is only 5 lakh rupees. How is it possible? So assessing officer will ask for explanation. If no explanation is given or if the explanation given is not satisfactory, then the assessing officer will treat this expenditure as your undisclosed source of income and you have to pay the tax in the financial year in which you have incurred the expenditure. Then section 69D. Section 69D speaks about amount borrowed or repaid on hundi. Amount borrowed or repaid on hundi. Hundi means what? Hundi is nothing but a bill of exchange transaction, but this bill of exchange transaction does not happen between the bank. Instead, it happens with the hundi lender, that is from an individual. So in such case, hundi transaction, it should always be through account pay check. If the hundi transaction is not through account pay check, then it will be treated as undisclosed source of income in the financial year of borrowing or repayment. However, if both borrowing and repayment, if both are not through account pay check, then only one of the transaction will be treated as undisclosed source of income. Both will not be treated. Fine. If they treat both, then it will be like double taxation. That is why. Now one point I missed out when I spoke about section 68, and that point is that here I told if Mr. X is investing 1 crore as share capital in ABC Limited, then Mr. X should also give explanation. However, if this Mr. X, that is the person who is investing, if they are a venture capital fund or venture capital company registered with SEBI, then they need not give the explanation. Only other than venture capital fund or venture capital company should give the explanation. Okay, wow. Now let's talk about the income of previous year taxable in the previous year itself, or we can say previous year is equal to assessment year. Generally, previous year income is taxable in the next year, that is assessment year. However, in 5 cases, income of previous year will be taxable in previous year. Listen, here the first case alone is a compulsory case. It means always it will be taxable in the same year only. But all the different other sections are there, no? From section 174 to section 176. All these 4 cases are at the discretion of assessing officer. If the assessing officer wants, he can tax it in the same year. But if he is okay with it, he can let the assessee pay the tax in the next year also. So both are possible. Let us discuss the first case. First case talks about non-resident shipping business. So if a non-resident shipping company is coming into India, in such case 7.5% of the freight will be considered as deemed income. 7.5% will be considered as deemed income, and on this income only they have to pay the tax. So 7.5% is not the tax, Kanna, it is the income. On this income they have to pay the tax. Now let's talk about section 174. 174 speaks about person leaving India during the previous year or shortly after the previous year with no intention to return back. So if assessing officer finds out that there is some person who is going to leave India, then he will feel that before he leaves India itself, let me tax him in the same year. So income of the year till the probable date of departure can be taxed in the same year itself instead of waiting for the next year. Then section 174A, association of person, body of individual or artificial juridical person formed for a particular purpose. So sometimes some AOP, BOI like joint venture etc. will be formed for a particular purpose. After the purpose is over, they will get dispersed and then it will be very difficult to contact them. So if assessing officer wants, the income of the year till the date of dissolution can be taxed in the same year itself. Then let's talk about section 175. If there is any person who is likely to sell, transfer, dispose or part with any asset or property to avoid paying the taxes, in such case the assessing officer can come and tax the income in the same year itself. Then if at all a business is getting discontinued and the assessing officer feels that later on it is very difficult to extract the money from this discontinued business, then income of the year till the date of discontinuance can be taxed in the same year itself. So these are the 5 cases where income of the previous year is taxed in the same year. Fine. Now let's come to the person concept. First let us see section 2 clause 8 which speaks about assessment. What is assessment? Assessment is nothing but the procedure by which an income of an assessee is determined. So procedure of determining the income is only assessment. Assessment can be normal assessment or reassessment. Assessment procedure is generally tested at CA final level. In your level, that is CA Inter level, you are only having self-assessment, which is what? Which is filing the return of income, your last chapter. Fine. Then section 2 clause 7 defines who is assessee. Who is assessee? Assessee is a person by whom any tax or any other sum of money is payable. So if any person is liable to pay any tax or any amount as per the Income Tax Act, that person will become assessee. Then apart from that person also, every person in respect of whom any proceeding under this act has been taken for the assessment of his income. So the income tax department has taken some action against you, then also you will become assessee. Fine. So against his income or income of any other person in respect of whom he is assessable. For example, if I am having a minor child and against my minor child department wants to take action, then they will send me only the notice. They will not send the notice to my child. Then also I will become assessee. Then if there is any loss sustained by him or such other person or any amount of refund or such other person. So even related to loss or refund, if they want to give me any notice or take any action, then also I will become an assessee. Then every person who is deemed to be an assessee will be called an assessee, and every person who is deemed to be an assessee in default also will be called an assessee. Then every assessee is a person, Kana, but every person need not be an assessee. Now let us see what is a person. Person is defined under section 2 clause 31 of the Income Tax Act. There are 7 types of persons: individual, HUF, firm, AOP, BOI, company, local authority and artificial juridical person. First let us talk about individual. Individual means natural person, that is human being. If the individual is a minor, then the assessment of individual is done on guardian. If the individual is of unsound mind, then the assessment is done on the manager. If the individual is no more or deceased, then the assessment is done on the legal representative. Now let's talk about Hindu undivided family. Hindu undivided family is not defined under the Income Tax Act. It is actually defined under Hindu law. In Hindu law, in HUF means a family which consists of all males lineally descended from a common ancestor, and it includes wife and daughter also. So this is the meaning of HUF. Every Jain, Buddhist, Sikh also can form Hindu undivided family. So Hindus can form HUF, Sikh can form HUF, Jain can form HUF, Buddhist can also form HUF. But other than these religions like Islam and Christianity cannot form Hindu undivided family. The head of the family is called Karta. Kana, in HUF there are three types of participants. HUF there are 3 types of participants. First is called Karta, who is nothing but head of the family. Then is co-partners. Co-parceners. Co-parceners are all the members who are having right to property. Right to property. And then all the other family members will be called as members. So head of the family is called Karta. Then the members who are having the right to family's property will be called co-parceners, and all the other members will just be called as members. Fine. The members who acquire interest in the joint family by birth are called co-parceners. From 6th September 2005 onwards, even daughters can become co-parceners, but wife and daughter-in-law, they cannot become co-parceners. Daughter are co-parcener, but wife and daughter-in-law can only be members. They cannot be co-parceners. Why are they not co-parceners? Because they can become co-parceners in their parents' property, but they can't become in husband property. Fine. Members can enjoy family expenses like food and clothing. So all the members will enjoy the expenses by the HUF. Fine. There are two schools of Hindu law, Dayabhaga school and Mitakshara school. Dayabhaga school is prevalent in West Bengal and Assam. Mitakshara school is prevalent in the rest of India. So if you find a HUF question, in that HUF question if you find West Bengal or Assam written as the state, then you should know that it is Dayabhaga school. If it is any other state, then you should understand that it is Mitakshara school. Now what is the difference? In Dayabhaga school, no right till the head of the family dies. So only the parents and the brothers of the parents will be, that is father and brother of father will be having the co-parcener right. Children will not be having co-parcenery right. So father and his brothers will be co-parceners. But in Mitakshara, the right is by birth. So if a person is born in the family, as soon as the person is born, the person will get co-parcenery rights. Fine. Now let's talk about firm. Partnership firm includes LLP. The meaning of partnership firm is taken from the Indian Partnership Act 1932. Meaning of LLP is taken from Limited Liability Partnership Act of 2008. Then what about minor? If a minor is admitted for the benefits of the partnership, the minor will be treated as a partner. He will be treated as partner. Now let's talk about company. Section 2 clause 17 defines company. Company means number 1, Indian company, which is defined under 2 clause 26. Sir, what is this Indian company now? Indian company means company that is registered under Companies Act. Companies Act can be 1956 or 2013 and having registered office in India. Moreover, if there is any corporation established by central, state, union territory or any provincial act, then also such corporation will be called as Indian company. And if there is any institution and CBDT declares that institution as an Indian company, that is also Indian company. So who is Indian company? A company that is registered under Companies Act and having registered place of business in India. Then number 2, central, state, union territory, they create some corporation under their respective act, that is also Indian company. And if CBDT calls a company as Indian company, that is also Indian company. So now what did we learn? The meaning of Indian company. So Indian company is included in the definition of company. Apart from Indian company, who and all else can become company? Let us see. Body corporate incorporated by or under in the laws of any country outside India. So outside the India also, if there is any company, they also will be considered as company under Income Tax Act. For example, Meta, Amazon, Google, all these are companies in USA. They also will be considered as company in India under Income Tax Act. Then if a person is assessed as a company under Income Tax Act 1922 before 1/4/1970. So in old Income Tax Act, if you are assessed as company, then also considered as company. And then last point, whether incorporated or not, Indian or not, if CBDT declares someone as a company, they are also company. So who is company? Indian company is a company. Body corporate incorporated outside India is also company. Then company as per old Income Tax Act is also company, and if declared by CBDT, then also they will be called as company. Now in company, there are two classes, domestic company and foreign company. Foreign company is defined under section 2 clause 23A, and foreign company means it is not a domestic company. Foreign company means not a domestic company. Then what is domestic company? Domestic company includes Indian company. So Indian company is always domestic. Indian company always domestic. Apart from Indian company, if there is any company that has made any arrangement to declare and pay dividend in India out of income taxable in India, they are also called as domestic company. So two types of companies are included in domestic: Indian company and company that has made arrangement to declare and pay dividend in India out of the income taxable in India. Practically speaking, there are no such companies. Okay, now let us continue. Association of person and body of individual, AOP and BOI. Now what is difference between AOP and BOI? Before that, you should know that if there is a group of persons and if the group of persons form a partnership firm, they will always be called as partnership firm. So you should never confuse partnership firm with AOP, BOI. So firm is always a firm. If a group of persons is not a partnership firm, then only you can consider them as AOP or BOI. So what is difference between AOP and BOI? AOP means association association of person. It means what? Even individual can be a part of the group, company can be part of the group, firms can be part of the group, all different types of persons can come. But in body of individual, only individuals can come and form the group in body of individual. Now, what if there is a group which contains only individual? Then how to differentiate? In that case, in association of person, the individuals join for a common purpose to produce the income, whereas in body of individual, they merely receive the income. For example, if you take a trust, the trustees are body of individual because they are receiving the income, but they cannot use the income for themselves. However, if donation is given to a group of people, they are called donees. The donees will be association of person because they can use the income for themselves. So co-donees are coming under AOP. But practically speaking, the difference is not that important because both AOP, BOI will be treated in the same manner in the Income Tax Act. Okay, wow. Now let's talk about local authority. So local authority, for example, Coimbatore Municipal Corporation, Chennai Corporation, etc. Local authority is the authority entrusted with control or management of a local or municipal fund. A local authority is taxable in respect of the business carried on by it. However, if the income is coming from the supply of a commodity or service within its own jurisdictional area, then it is not taxable. So if Chennai Corporation is only supplying the goods and services in Chennai and earning the income, that is not taxable. But what if Chennai Corporation is supplying outside Chennai? In such case, the supply of water and electricity is not taxable, but other than water and electricity, whatever income is earned from outside Chennai will be taxable. Fine. Now let's talk about artificial juridical person. Artificial juridical person is a residual category. It means if there is any person who is not covered in the other categories, they will be covered under artificial juridical person. For example, deity. So even God is artificial juridical person. Bar Council is AJP. Universities also are considered as artificial juridical person. So these are all the examples. Now you should know the central government and state government are not persons because in point number 6, it is specifically telling that local authority is a person. That is why the Income Tax Act wants to exclude central government and state government from the meaning of person. That is why central government and state government are not considered as persons. Now without further ado, let us begin the residential status revision. Residential status will come in your examination for at least 4 to 6 marks. So you have to be thorough with the provisions. Fine. Let us start with the definition of India. India is defined under section 2 clause 25A of the Income Tax Act. India means the territory of India as per Article 1 of the Constitution. So Article 1 only includes all the states and union territories. Even Jammu and Kashmir is a part of India. Even Ladakh is a part of India as per Income Tax Act. Then territorial waters, seabed, subsoil underlying such waters, continental shelf, exclusive economic zone, any other specified maritime zone, and lastly the airspace above the territory and territorial waters is also a part of India. So all this is included in India. Now let us talk about determination of residential status of individual. This is most important part of your chapter. Fine. So how to determine the residential status of individual? For that you have to see section 6 subsection 1, 2 basic conditions. If any one of the 2 basic conditions are satisfied, the individual is said to be a resident in India. First basic condition is that the individual's stay in India should be 182 days or more during the previous year. And second basic condition is that the stay in India should be 60 days or more in the previous year and 365 days or more in the 4 preceding previous years. If any one is satisfied, the individual will be a resident. However, for the second basic condition, there are 4 exceptions, 3 full exceptions and 1 partial exception. So if the individual is covered in the full exception, then they need not see the second basic condition. They should see only the first basic condition. What are the exceptions? Let us see. First exception is that Indian citizen leaves India as a crew member of an Indian ship. Second exception, Indian citizen leaves India for employment outside India. Third exception, Indian citizen or person of Indian origin visiting India at any time during the previous year and his total income other than income from foreign source is up to 15 lakh rupees during the previous year. So if any one of the 3 conditions are satisfied, then no need to see second basic condition. Now let us see the partial exception. Who is covered in the partial exception? Indian citizen or person of Indian origin visiting India at any time during the previous year and the total income other than income from foreign source is more than 15 lakh rupees. In such case, for such people, what you will do? Instead of taking 60 days in the second basic condition, take 120 days and solve the answer. So these are the exceptions. Now, if first basic condition also not satisfied, second basic condition also not satisfied, then you are going to see the deemed resident concept, which is given under section 6 subsection 1a. So if all the four conditions are satisfied, then the individual will be said to be a deemed resident as per Income Tax Act. What are the conditions? Number 1, the individual should be an Indian citizen. Number 2, the total income other than foreign source should be more than 15 lakh rupees. Should be more than 15 lakh rupees. Number 3, the individual is not liable to tax in any other country by reason of his domicile or residence or any other criteria of similar nature. So he should not be paying tax in any other country. And fourth condition, the individual should not be a resident as per section 6 subsection 1. If all four conditions are satisfied, then the individual will be called a deemed resident. Now you will know whether individual is a resident or non-resident. If an individual is non-resident, then well and good. But if an individual is resident, then the resident can be resident ordinarily resident or resident not ordinarily resident. So how to determine whether it is ROR or RNOR? For that you have to see section 6 subsection 6 additional conditions. There are 4 additional conditions. If any one of the 4 additional conditions are satisfied, then the individual will be called as resident but not ordinarily resident. However, if all the 4 conditions are not satisfied, then the individual will be called resident and ordinarily resident. What are the 4 conditions? Number 1, non-resident in at least 9 out of 10 preceding previous years. Number 2, the stay in India is 729 days or less in the 7 preceding previous years. Number 3, Indian or citizen or person of Indian origin visiting India during the previous year and total income other than foreign source is more than 15 lakhs, whose stay in India is 120 days or more but less than 182 days. So this is the third one. And fourth one, deemed resident under section 6 subsection 1a. So if any one of the 4 conditions are satisfied, then the resident individual will be RNOR. However, if all 4 conditions are not satisfied, then the resident individual will be ROR, resident and ordinarily resident. The same concept, so that you don't make any mistake in the examination, I have also explained in the form of a Mario game, which is there at the end of this video. Please watch that part as well. If you watch it and then solve the questions, 1 or 2 questions also enough, you will never make a mistake in your examination. That is my guarantee. Okay, so now let us continue the discussion. So there is one special provision for an Indian citizen who is a crew member of Indian ship. Indian citizen, crew member of Indian ship. What is the provision? If all of the following conditions are satisfied, then the period from the date of joining in CDC to the period of signing off in CDC will be treated as the stay outside India. So what are the conditions? Number 1, Indian citizen. Number 2, crew member. Number 3, foreign bound Indian ship on an eligible voyage. So if there is any Indian citizen who is a crew member of a foreign bound Indian ship on an eligible voyage. Eligible voyage means what? Ship is going from India to out of India or out of India to India. That is only eligible voyage. So if all these conditions are satisfied, then the date from joining in CDC to the date of signing off in CDC will be the period excluded from India. So joining till signing off will be treated as outside India. It will be treated as outside India. Fine. Now let us see some notes which will help you to solve the questions. Firstly, concept of resident and concept of citizen are different. So resident is not equal to citizen karna. In income tax, a citizen can be a non-resident also. Non-citizen can be a resident also. So there is no linkage. Then residential status has to be determined every year. So if this year if I am a resident, next year I might be non-resident. Like that every year I have to calculate. Then date of arrival and date of departure is calculated in India. So for example, if a person has left India on 25th June, okay, and the person has returned India on 25th July, okay, then 25th June is also counted in India and 25th July is also counted in India. Both arrival date and departure date are counted in India. But for this there is one exception, that is the crew member provision we saw, no, date of joining till date of signing off. In that case, date of joining is considered outside India, date of signing off in CDC is also considered outside India. So signing in, joining in and signing off both are considered outside India. So that is one exception to the general rule. There CDC means continuous discharge certificate karna. This continuous discharge certificate is nothing but an attendance register. You will sign and go inside the ship, you will sign and come outside the ship. Okay, for simplicity's sake you can remember like this. Now, so date of arrival, date of departure is counted in India. However, in case of Indian citizen, crew of foreign bound Indian ship, the date of joining in and date of signing off is counted outside India. So that you have to be thorough. Then continuous stay in India is not compulsory. The stay in India can be in bits and pieces separately also. Then stay in India includes the stay in territorial waters as well. Then individual can be resident in more than one country also. So I can be resident in India also, I can be resident in USA also. Then what to do? Both places I will pay the tax. Answer is no. Both India and USA will be having a double taxation avoidance agreement, with the help of which they will decide I have to pay tax in which country, whether I should pay tax in India or USA. But this double taxation avoidance agreement is a part of your final syllabus. Fine. Then, sir, who is a person of Indian origin? Person of Indian origin is a person who himself or either of his parents or either of his grandparents were born in undivided India, that is India before partition in 1947. Then, sir, what is income from foreign source? Income from foreign source means purely foreign income. I am going to tell you in some time. Then ROR means resident, ordinarily resident, RNOR means but not ordinarily resident, and NR means non-resident. This I have already told you. Now let us see how to determine the residential status of all the persons other than individual. So for HUF, firm, AOP, BOI, local authority and HAP. So for all of them, if the residential status is given under section 6 subsection 2. Here what you have to see? You have to see the control and management of affairs. If the control and management of affairs is fully outside India, then they will be called non-resident. But if the control and management of affairs, even if it is partly in India, they will be considered as resident. And in case of HUF, you should also see whether the HUF is a resident, ordinarily resident, or resident but not ordinarily resident. So how to see? First you see whether HUF is resident or non-resident. If the HUF is a resident, then you see the Karta, whether Karta is ROR or not ROR. If Karta is ROR, HUF will be ROR. But if Karta is not ROR, then HUF will be RNOR, that is resident but not ordinarily resident. Fine. Now let us discuss residential status of company. It is given in section 6 subsection 3 of the Income Tax Act. For company, non-resident means the companies other than resident. Then who are resident companies? First, Indian company defined under section 2 clause 26. Okay, Indian company is a resident company. Indian company definition I have already discussed in the basic concepts revision lecture. Okay, so Indian company is always resident. Other than Indian company, the companies whose poem is in India will be considered as resident. Sir, what is this poem? Poem means place of effective management. It is a place where the key management and commercial decisions of an entity are in whole, in substance made. Fine. So the key management decisions where they are taken, that is only place of effective management. If place of effective management is in India, then it is considered as a resident company. Fine. Now let us discuss scope of total income. So scope of total income is given under section 5. This is only the reason why we are learning residential status. You know what is scope of total income? Scope of total income is that for resident and ordinarily resident, global income is taxable. Indian income is also taxable. Foreign income is also taxable. Then for non-resident, Indian income is only taxable. And for resident but not ordinarily resident, income other than foreign source is taxable. Income other than foreign source is taxable. So now let us discuss what is this Indian income. Indian income, you can divide it into 4 categories. Income received in India, income deemed to be received in India, income accruing or arising in India, and income deemed to accrue or arise in India. Okay, say one more time. Income received in India, income deemed to be received in India, income accruing or arising in India, and income deemed to accrue or arise in India. All these 4 categories are considered as Indian income, and Indian income is taxable for everybody irrespective of residential status. Fine. It is taxable for ROR also, RNOR also, and non-resident also. Now let us discuss the next one, that is income accrued and received outside India but from a business controlled or profession set up in India. So if there is any income which is accrued and received outside India, it means what? It is a foreign income. But that foreign income is there? No, it is from a business controlled or profession set up in India. It means that the source is in India but the income is foreign income. That is why you call it as income other than foreign source. Income other than foreign source. So that is why income other than foreign source includes all the Indian income, because all the Indian incomes are definitely other than foreign source. And other than that, even the income accrued and received outside India from a business controlled or profession set up in India, this is also income other than foreign source. In residential status, while telling you, I also told you about the 15 lakhs limit. No, income other than foreign source, that is this only. So point number 1 to point number 5 is income other than foreign source, which means what? Received in India, deemed to be received in India, accruing or arising in India, deemed to accrue or arise in India, and accrued and received outside India from a business controlled or profession set up in India. So all these 5 categories will be called as income other than foreign source. Income other than foreign source. Then next one, income accrued and received outside India from a business controlled and profession set up outside India. So it means this is a purely foreign income. And then last one also you can see any other foreign income. This is also purely foreign income. So pure foreign income is taxable only for resident and ordinarily resident. So resident, ordinarily resident has to pay tax on the global income. Resident but not ordinarily resident has to pay tax on the income other than foreign source, and non-resident has to pay tax on the Indian income only. So this is the scope of total income. Now let us talk about about remission. Sir, what is remission? Remission comes from the word remittance, and remittance means to send the money from one person to another person. So if at all there is remittance, then remittance is not taxable, Kanna, because remittance only means sending from one person to another person. But sometimes no, students will get confused in the examination. Sometimes in the examination it will be given that Mr. X has received some rent in London and remitted to India. Remitted to mother in India. So students will feel since remittance is there, it means the income is not taxable. But you should not get confused, Kanna, because here there are two transactions. One is earning the rent in London and the second transaction is remittance in India. You should see both the transactions separately, differently. For the rent in London, ROR will pay the tax, but RNOR and non-resident will not pay the tax. However, for remittance, nobody will pay the tax. So here, if such type of question comes in the examination, you should know that in the same sentence there are two transactions. One is earning the rent transaction, second is remitting the money to India transaction. So for both transactions, you have to find out whatever income is taxable and what is not taxable. You get my point? Now let us come to the special points. First, accrual and receipt is only taxable. Transmission of the same amounts to remittance. So first, wherever the money is received, there only it is considered to be taxable. So I told you, income received in India is taxable. So first time if the money is received in India, it will be taxable in India. Then receipt by other person on behalf of the assessee shall also be considered as receipt of the assessee. For example, I have earned the income, but my friend is receiving on my behalf. Then who will pay the tax? My friend will pay the tax or I will pay the tax? I will only pay the tax. Then foreign income shall not be considered as income accrued in India just because it is included in balance sheet in India. So in the balance sheet, if at all some foreign income is mentioned, just because it is mentioned in balance sheet does not mean that it is accrued in India. Fine. Then there is one point which might come in MCQs. What is that point? If any salary is received by a non-resident seafarer for a service rendered outside India on a foreign going ship and received in NRE account, that is non-resident external account, will not be taxable. So this is a special point. Remember this if it comes in MCQs. So we have discussed what is received in India. Received in India means first time receiving in India. Then second is what? Income deemed to be received in India. It is discussed in section 7. So there are 4 items where income is deemed to be received in India. So what are they? Contribution to recognized provident fund greater than 12% of salary. Then interest in recognized provident fund greater than 9.5%. Then employer contribution in pension scheme under section 80 CCD. And lastly, employer contribution and interest transferred from unrecognized provident fund to recognized provident fund. So these are all related to provident fund and pension scheme, which we have already discussed in the salary chapter. We would have discussed that recognized provident fund up to 12% employer contribution is exempt and interest also up to 9.5% is exempt. So over 12%, 9.5%, whatever amount is there, that amount will be taxable and it is always deemed to be received in India. Fine. Next, accrue or arise in India. Accrue means the right to receive the income. So in India, if the work is being done, or in India, if the asset is there, for example, fixed asset is there in India, fixed deposit is there in India. On this, the interest keeps on accruing. It means accruing in India. So business is there in India. So from that business only income is arising. That is only called arising in India. So income accruing or arising in India will always be considered as Indian income. Fine. Then now let us discuss section 9, income deemed to accrue or arise in India. So in all these cases, there is no confusion at all. The income will be considered as deemed to accrue or arise. So if it is deemed to accrue or arise, then what will happen? It means that it will be considered as Indian income and hence it will be taxable for everybody, for resident also, for non-resident also. So all these cases, for all these cases, the tax has to be paid by resident and non-resident both. Okay, let us discuss all the cases one by one. So first is income through or from any business connection in India. So one foreign company or foreigner is there, he is appointing an agent and through the agent he is doing the business. This is only called business connection in India. So business connection in India is deemed to accrue or arise in India. However, there are some exceptions to business connection, Karna. There are 5 cases where it will not be considered as business connection and hence it is not deemed to accrue or arise in India. Let us see what are the 5 cases. Number 1, business operations which are not carried out in India. So if business operation is not in India, it is not business connection. Then purchase of goods in India for the purpose of export. So if a person is purchasing goods in India and that same goods the person is exporting outside India, then also it is not a business connection in India. Third one, collection of news and views in India for transmission outside India. So for example, some foreign news channel or newspaper is coming to India, taking the news from India and publishing outside India. So this is also not business connection in India. Then fourth one, shooting of cinematographic films in India. If such non-resident is an individual who is not a citizen of India, or a firm which does not have any partner who is citizen of India, or a company which does not have any shareholder who is citizen or resident of India. So it means what? If a foreign person, that is non-resident, non-citizen, if such foreigner comes to India, shoots films and takes in outside India, then it is not business connection in India. But the rule is that the foreigner should not be Indian citizen also, should not be Indian resident also. If the foreigner is a partnership firm, they should not have any citizen or resident partner. If the foreigner is a company, they should not have any citizen or resident shareholder. Fine. Now last one, activities confined to display of rough diamond in special notified zone by foreign mining companies. So foreign mining companies, when they are coming here to India and in special notified zone, when they are displaying their diamonds and earning the income, this is not a business connection in India. So these 5 cases are exception to business connection. Now let us see the next one, income through or from any property in India. So if any property is located in India, from that if some income is coming, it is deemed to accrue or arise in India. The next one, income from any asset or source of income in India. So if there is any asset in India, from that asset if the income is generated, that is always deemed to accrue or arise in India. And lastly, transfer of assets situated in India. So if India there is some asset, that asset is transferred from one person to another person, whatever is the capital gain or profit on sale of profit on transfer will be taxable in India, because it is deemed to accrue or arise in India. Then next point, salary earned in India and pension earned for services rendered in India is also deemed to accrue or arise in India. So some foreign person is coming to India, working in India and earning the salary. So this salary also will be taxable in India. Moreover, let's say I worked in India for 30 years and after 30 years I moved to foreign country, but my Indian company is giving me pension in the foreign country. So this pension is also taxable in India, because for my Indian services only I am receiving the pension. Then rest and vacation immediately before or immediately after entering the service is also included in the deemed to accrue or arise in India. So if the foreigner is coming to India for 6 months, 2 months he is working and 4 months he is there for vacation, then entire 6 months salary will be considered as deemed to accrue or arise in India. Next one, salary given by the Indian government to the Indian citizen outside India. So if any Indian citizen is working outside India and receiving salary from Indian government, so mostly they are the people who are working in Indian embassy outside India. So for them the salary is deemed to accrue or arise in India, and hence they have to pay the tax in India. However, there is a section called section 10 clause 7 which tells that the perquisites and allowances received by the Indian government are completely exempt. So only salary is taxable, but perquisites and allowances are completely exempt. Now let's talk about dividend. So if any dividend is distributed by the Indian company outside India, that dividend is deemed to accrue or arise in India. Now let us discuss the last point first. So the last point is money paid without consideration by an Indian resident to a non-corporate non-resident or a foreign company, or resident but not ordinarily resident, if the aggregate sum exceeds 50,000 and is taxable under 56(2)(10). So what did I say? If any Indian resident is giving any gift, that is money or assets, without consideration or for inadequate consideration, to whom? To a non-resident, to a foreign company, or to a resident but not ordinarily resident, then in the hands of non-resident, if the amount is more than 50,000, we have discussed in IFOS section 56(2)(10). So it will be taxable because it is deemed to accrue or arise in India. So if resident is giving gift to non-resident, if it is more than 50,000, non-resident has to pay the tax. Fine, that only I was telling. Now let us discuss about interest, royalty and fee for technical services. Interest, royalty and fee for technical service. Before discussing the residential status, let me tell you what is the meaning of royalty, what is the meaning of fee for technical service. First, let us talk about royalty. Royalty means any consideration, including lump sum consideration but excluding capital gains. So if any amount is taxable in capital gain chapter, then you should not call it as royalty. Only if it is not covered in capital gain, you can call it as royalty. Fine. So royalty is the consideration coming from what? Number 1, transfer of all or any rights in respect of a patent, invention, model, design, secret formula, process or trademark or similar property. So if the intangible assets, all these are what? Intangible assets. If these intangible assets are sold from one person to another person, whatever consideration is received will be called royalty. If it is not taxable in capital gain chapter. Then imparting of any information concerning the working of or the usage of patent, invention, model, design, secret formula, process, trademark or similar property. So you are giving the information concerning the working or usage. So that is also included in royalty. Then usage of any patent, invention, model, design, secret formula, process, trademark or similar property. So the person who is having this intangible asset is allowing other person to use these intangible asset. That is also called royalty. And then Next one, imparting of any information concerning technical, industrial, commercial or scientific knowledge, experience or skill. This is also royalty. Then use or right to use any industrial, commercial or scientific equipment. This is also royalty. Then transfer of all or any rights, including granting of license in respect of any copyright, literary, artistic or scientific work, including films or videotapes, is also called royalty. So copyright is also included in royalty. Then rendering of any service in connection with the activities listed above is also royalty. Then let us see some specific points about royalty. Consideration for right to use or usage of computer software is also included in royalty. Then the term process includes transmission by way of satellite, cable, optic fiber, etc. So transmission does not mean, or process does not mean only transferring the process by way of hard copy, physically transferring. Even electronically it is transferred, still it will be considered in the meaning of royalty. And lastly, consideration for sale, distribution or exhibition of cinematographic films is covered within the scope of royalty. So this is also covered in royalty. Now let us discuss what is fee for technical service. Fee for technical service means consideration received for managerial, technical or consultancy service. Managerial means related to leadership. Technical means some service which requires some specialized knowledge, and consultancy means giving advice regarding some subject. So managerial, technical, consultancy, all the three are included in fee for technical services. It also includes providing services of a technical or other personnel, but does not include salary. So for example, if I am a computer engineer and you have hired me as a computer engineer, I am providing you technical service and I am sending my staff to your place. So for my staff also you are giving money. This is also included in fee for technical service. But if you yourself hire a staff and you are paying salary to that staff, that is not fee for technical service. That is called salary only. Fine. So my employee will be fee for technical service, but your own employee will be considered as salary. Fine. Then fee for technical service does not include construction, assembly and mining. So construction, assembly, mining not included in fee for technical services. Fine. Now let us discuss about the residential status of fee for technical service. Okay. What is income deemed to accrue or arise in India? So here we are discussing what happens when interest, royalty or fee for technical service is received by a non-resident. So whose income it is? It is the income of a non-resident. Now in the hands of this non-resident, whether it is deemed to accrue or arise or not, that we are going to see. Firstly, let us discuss the cases where the government is paying interest, royalty or fee for technical service to the non-resident. If government is paying to the non-resident, then in the hands of non-resident, it is always deemed to accrue or arise in India and taxable in India. Fine. Now let us see the cases where a resident is paying interest, royalty and fee for technical service to a non-resident. If a resident is paying to a non-resident, generally it is taxable. Generally it is taxable because it is deemed to accrue or arise in India, but it is not taxable if the interest, that is money borrowed, royalty or fee for technical service, is used outside India. It can be used outside India for business also, for any other income also. It does not matter. If the resident is using the money borrowed, royalty or fee for technical service outside India, then in the hands of this non-resident, it is not deemed to accrue or arise. Now lastly, let us discuss one non-resident is paying interest, royalty or fee for technical service to another non-resident. Okay, non-resident to non-resident. If non-resident is paying to non-resident, generally it is not deemed to accrue or arise in India. Generally not deemed to accrue or arise. Why? Because some foreigner is paying another foreigner. Why should we be bothered? However, in two cases it will be deemed to accrue or arise. So firstly, if the money borrowed, royalty or fee for technical service is used for business or profession in India, then it will be deemed to accrue or arise in India. And then lastly, if the royalty or fee for technical service is used for earning any other income apart from business, then also it will be considered as deemed to accrue or arise. Here, if you have my book, then one change I want you to make, this outside you please cut it and write in instead of the page. There is a printing error. Fine. So please make this correction. So now here you have to be very careful. If the money borrowed, royalty and fee for technical service, all the three, if they are used for business in India, then it is deemed to accrue or arise in India. But if it is other than business, then only royalty and fee for technical service will be deemed to accrue or arise. But however, money borrowed will not be deemed to accrue or arise. I'll give you an example. Let's say non-resident A borrows from a non-resident B and invest in the shares of an Indian company. So if you are investing in Indian company, what income do you receive? You will either receive dividend or you will receive capital gain. Both dividend and capital gain are not business income. That is why, since you have borrowed money and paying the interest, this interest will not be deemed to accrue or arise in India. That is why I wrote money borrowed and cut it here. Fine. So this you have to be careful. Now last point about this concept is that no territorial nexus is required for interest, royalty and fee for technical service. It means what? The person who is receiving this interest, royalty, fee for technical service, no, it is not necessary that that person should be in India. or that person should be having any permanent establishment in India or any office in India. It does not matter. What matters is where the money, interest or fee for technical service is being used. That only matters. So that is why territorial nexus is not required for interest, royalty and fee for technical services. Now quickly, you see the part where I am explaining that Mario game so that you don't make the mistake, and after that you solve all the questions in your study material. You will be good to go for your examination. If you know how to play Mario, you will never make a mistake in residential status. Let me show you how. Just imagine that you are Mario and you have to jump across 3 walls so that you receive your trophy, which is non-resident, because for non-resident only Indian income is going to be taxable. However, if you satisfy the conditions, you will dash across the wall and fall into the dungeon where either you will be resident, ordinarily resident, for whom global income is taxable, or resident not ordinarily resident, for whom income other than foreign source is going to be taxable. The first 2 walls are the 2 basic conditions and third wall is the deemed resident condition. So the basic conditions are stay in India should be 182 days or more in the previous year, and second basic condition is that stay in India should be 60 days or more in the previous year and 365 days or more in the 4 preceding previous years. So if your stay in India is less than 182 days, then you can jump across the wall and go to the next stage, where before the second wall you are going to find a tunnel of exceptions. So if you are satisfying any one of the 3 exceptions, you can go inside the tunnel and you can skip the second wall. So what are the 3 exceptions? Number 1, Indian citizen leaving India for employment outside India. Number 2, Indian citizen leaving India as a crew member of Indian ship. And number 3, Indian citizen or person of Indian origin visiting India and their income other than foreign sources up to 15 lakh rupees. But sir, what if it is more than 15 lakhs? If it is more than 15 lakhs, then you can't go into the tunnel. But for you, the wall of 60 days is going to be a smaller wall, that is only 120 days you have to see. Then if this condition also not satisfied, then you can go to the next stage and see if you are a deemed resident. If you are not satisfying deemed resident also, then hip hip hooray, you are going to be a non-resident. Now let's say if you dashed against the wall and fall into the dungeon, then what will happen? Then there are 4 doors kana. If any one of the 4 doors you are able to open, then you will become resident, not ordinarily resident. But you are not able to open any door, then you will stay resident and ordinarily resident. What are the 4 doors? Number 1, the individual should be non-resident in 9 out of 10 preceding previous years. Number 2, stay in India should be 729 days or less in the 7 preceding previous years. Number 3, Indian citizen or person of Indian origin whose stay is 120 days or more but less than 182 days and having income other than foreign source more than 15 lakh rupees. And fourth one is the deemed resident. Now without further ado, let us begin the revision. Salary, head of income. Firstly, let us discuss what is the concept of salary as per the Income Tax Act. In Income Tax Act, not only the regular monthly amount which is received by the employee is taxable, other than that also, if any amount is arising due to an employer-employee relationship, that amount is taxable under salary head of income. To understand what is employer-employee relationship, you should know what is the difference between contract of service and contract for service. Because if there is a contract of service, it gives rise to employer-employee relationship and hence it is taxable under salary. But if there is contract for service, then it is taxable under profit and gains of business or profession. For example, if there is Laika production is going to Rajnikant and offering Rajnikant a movie that he should act in this movie, and that is the contract. They are going to pay him 100 crores for this movie. This case is called contract for service, and in hands of Rajni, it is going to be taxable under PGBP head of income. However, if Laika production go to Rajnikant and tell him that we are going to pay you 100 crores and you have to be our employee for 1 year, and this in 1 year we can ask you to act in movie also, we can ask you to act in serial also, we can ask you to do advertisement also. Whatever we say about acting, you have to do everything. So that is called contract of service, hence it is taxable under salary head of income. You got the difference? Next, let us discuss a few intricate points. Firstly, salary to partner is not salary kana, because partner is not an employee of a partnership firm. Partner is a part owner of the partnership firm. That is why when partner is receiving salary, it is always taxable under PGBP head of income, never under salary head. Then member of parliament and member of legislative assembly. So when they are receiving salary, the member of parliament and legislative assembly are not the employee of the government kana, they are only the people who are forming the government. That is why when they are receiving the salary, it is taxable under income from other sources head of income. Fine. Next, sir, whether full-time salary is only taxable under salary head or part-time also taxable? Answer is both full-time as well as part-time is taxable under salary head of income. There should be employer-employee relationship. Only that is the core principle. Then salary forgone is also taxable. For example, if the employee is asking the employer to donate his salary to charity, in such case that donated amount also will be taxable in the hands of the employee because it is salary forgone. However, in some cases where central government is asking central government employee to forgo the salary, then it will not be taxable. Then, can there be tax-free salary? Answer is yes, because the employer pays the tax in behalf of the employee, that is tax-free salary. But however, when employer is paying tax on behalf of the employee, then this is also a benefit given by the employer. That is why the tax paid by the employer on behalf of the employee is also taxable under salary head of income. But what if there is a tax on this tax also? Then tax on tax will not be taxable, because we will learn the tax paid on non-monetary perquisites is exempt from tax. So tax paid on non-monetary perquisites is exempt. Similarly, in the hands of the employer also, when employer is paying the tax on non-monetary perquisites, that is not allowed for them as deduction. Okay. Next, place of accrual. So wherever the salary is received, in that country it will be taxable. So if salary first time it is received in India it will be taxable. Moreover, if the employee is working in India, then also it will be taxable in India. This we have learnt in residential status chapter. Now let us come to charging section, because every head of income will have a charging section and a computation section. In salary, the charging section is section 15. What does it say? Salary is chargeable to tax on due or receipt, whichever is earlier. So if it will be due, then it will be taxed on due itself. However, if the salary is received in advance, then in advance itself it will be taxable. So due or receipt, whichever is earlier. So where salary is paid in advance, it was taxed in the year of payment, then it cannot be taxed once again when it becomes due. So if an amount is already taxed, it cannot be taxed once again. Similarly, where arrears of salary were taxed in the year it was due, it cannot be taxed once again in the year in which it is actually received. Then now let's talk about computation of salary. So section 17 is the computation section, but before that let us learn, section 17 is the computation section. Let us learn what and all is included in salary head of income. In salary head of income, there is no specific format. You should just know what is taxable under salary, what is not taxable under salary. So whatever is taxable you add it, whatever is not taxable you ignore it, then you will get the total salary income. From that you reduce the section 16 deductions, and finally you will get the income from salary head. Okay, well, it is very, very simple. There is no specific format for salary. Sir, if I am having basic salary, should I write that basic salary first, then I should write DA, then I should write allowance, like that in order I should write? Answer is no, there is no specific order. So if you want, you can write gratuity first, bonus next, basic salary you can write in the last also. That is not a problem. Fine. Now let us talk about what and all is taxable under salary head of income. This we will learn in 3 subsection. Section 17 subsection 1, 17 subsection 2 and 17 subsection 3. 17 subsection 1 speaks about salary. So whatever is included in salary, what and all are included? Allowance is included in salary, wages is included in salary, annuity means monthly or quarterly, whatever amount is received, that is included in salary, pension is included, gratuity is included, fees, commission, advance salary, leave encashment. So all this is included in salary. Moreover, if there is any employer contribution to this retirement funds, that is also included in salary. Now let's talk about section 17 clause 2, which talks about perquisite. To know what is perquisite, it is better if you know what is the difference between allowance and perquisite. See, allowance is already included in the salary. Okay, but perquisite is mentioned separately in section 17 subsection 2. Now what is the difference? Allowance is always a fixed amount that is received. So it is a fixed amount, it does not change. However, perquisite can change based on the benefit or facility. Okay, so perquisite can be given in money form also, perquisite can be given in kind form also. So both forms it can be given, but allowance will always be in money form. Then whether incurred or not, allowance will not change. So for example, if I am getting some allowance, it is not necessary that I should spend that allowance. But if it is perquisite, then it is considered as perquisite only when it is spent. Let us see one small example to know it better. For example, the employee is there. From the employer, he is getting facility of cab. That facility of cab can be in 3 ways. First, he is getting 2000 rupees per month for cab expenses. Now this 2000 rupee per month is a fixed amount which is given for cab expense. It does not matter what is the actual amount spent by this employee. In this case, hence this 2000 per month will be called as allowance. Okay, because it is a fixed amount. Then let's talk about next example, that is cab facility. So employer himself is giving the cab facility to the employee. In this case, it is in kind, hence it will be called as perks. Okay, and then lastly, reimbursement of cab expense. So whatever expense is incurred by the employee, that employee is giving the bills to the employer and employer is reimbursing it to the employee. In this case, the expense depends on the amount which is incurred by the employee. That is why even this will be called as perks, perquisites or perks. Fine. So this is the difference between allowance and perks. Now let us talk about section 17, subsection 3, which is profit in lieu of salary. In capital receipt versus revenue receipt, in basic concept chapter, I would have told you that capital receipt is taxable only if it is mentioned in the Income Tax Act. That is why 5 capital receipts are mentioned in the salary head of income, so that it will be taxable under salary head of income. So what are these 5 capital receipts? Number 1, compensation on termination of employment. So if employee is asked to leave the organization, if he is getting some money for that, that is called compensation on termination. Then compensation on modification in terms of employment. So if employment terms are modified, okay, from one role he shifted to another role, for that he is getting some extra amount. This is called compensation on modification in terms of employment. Then payment from provident fund or any other fund. So whatever retirement benefit is received, no, provident fund, gratuity, pension fund, all these are also taxable under salary head of income. Then keyman insurance policy. Keyman insurance policy amount, if it is received by the employee, it is taxable under salary head of income. If it is received by the employer, it is taxable under PGBP head of income. If it is received by any other person other than employee or employer, it will be taxable under income from other sources. Okay, then lastly, lump sum or any other amount before joining the employment or after cessation of employment. So for example, before joining, the employee has received some joining bonus. So this joining bonus is also taxable under salary head of income. Fine. So these are all the capital receipts. Now you know what and all is taxable. Now let us learn some small points before beginning the chapter, so you are clear with all those terms. Fine. Terminology, let us clear. First and foremost, let us discuss what is pay scale, because sometimes in question they give pay scale and students are unable to answer. So for example, in question, if you find something like this, Vanya joined Best Academy on 1/7/2023 on a pay scale of 10,000, 1,000, 13,000, 1,500, 16,000, 2,000, 20,000. So this means what? This means that the monthly salary is going to be 10,000 rupees, and after 1 year it is going to be increased by 1,000 rupees. So next year it will become 11,000 rupees. Then after 1 year it will become 12,000 rupees. After 1 year it will become 13,000 rupees. So till it reaches 13,000, it will be increasing by 1,000 every year. After it reaches 13,000, it will be increasing by 1,500 every year. So 1,000, so it will become 14,500 till it reaches 16,000. After it reaches 16,000, the salary will increase by 2,000 rupees every year till it reaches 20,000 and so on. So like this, you have to read what is the pay scale. Now in this example, if you calculate for 25-26, your amount of salary will come as 1,41,000. If you yourself want to calculate, you can pause the video, calculate, so that your concept is clear, and then move on to the next part. Now let us talk about specified employee. Specified employee, no, for exam point of view, this time it is very important. Generally it is not tested. However, this time there is an amendment. You can see in green color, no, there is an amendment in this part. That is why it is examination point of view, it is very important. So let us discuss who is specified employee and why we are learning about specified employee. So specified employee means big employee. Like this you can remember. Specified means big employee. Specified employee means big employee. So who are all these big employees? Let us see. Number 1, if an employee is a director of the company, that employee is a specified employee or big employee. Then if an employee is having substantial interest in the company or partnership firm or whatever the concern may be, substantial interest. Substantial interest means what? Either 20% or more voting power or 20% or more profit share. So if a person is having substantial interest, that person also will be called as specified employee if the person is working in the organization. And thirdly, if the salary is more than 4 lakh rupees. If the salary is more than 4 lakh rupees, and this 4 lakh rupees no kanna, you have to do after the calculation of taxable salary minus non-monetary perquisites minus deductions. So deductions also include standard deduction, correct? So first you have to take the entire taxable salary. From this, what are all the non-monetary perks you have to reduce. From that you also have to reduce the deductions. So after reducing this both, if your amount is coming up to 4 lakh rupees, then not specified. But if it is greater than 4 lakh rupees, then the employee is a big employee or a specified employee. So who is a specified employee? Number 1, director. Number 2, a person who is having substantial interest. And number 3, whose net salary is more than 4 lakh rupees. Now what is net salary? Net salary means taxable salary minus non-monetary perquisites minus deductions. So now why we are learning this specified employee kana? Because for specified employees only 5 types of perquisites are going to be taxable. For non-specified employees, which means small employees, it is going to be fully exempt. Okay, there is no rules, no condition, no limit, nothing. These 5 perquisites which I am going to tell you now are going to be fully exempt for non-specified employees, means small employees. It is fully exempt. What are the perquisites? Number 1, provision of sweeper, gardener, watchman or personal attendant. So some domestic servant has been given to the employee. In such case, case, it is fully exempt in the case of non-specified employees. Then facility of gas, electricity, water supplied by employer. So employer is only paying the gas, electricity, water bill. In such case, it is fully exempt for non-specified but taxable for specified employees. Then free or concessional tickets. So travel tickets, if it is given to the non-specified employees like railway employees, okay, bus employees, airline employees or any other employee, if they are getting free or concessional tickets, travel tickets, then it is fully exempt. Then use of motor car. So if the employer is providing motor car facility, that is also fully exempt for non-specified but taxable for specified. Then lastly, free or concessional educational facility. So educational facility also fully exempt for non-specified employee, but it might be taxable for specified. For specified also there are some limits up to which it is not taxable. That and all we are going to study. But however, for non-specified, it is fully exempt. However, you should know one point, that obligation of the employee met by the employer is not exempt, Kanna. The facility directly if it is given, then only it is exempt, but obligation is not exempt. Sir, can you give me an example? Yes, Kanna, definitely. So let's say there is a sweeper. Sweeper facility is given to the employee. Sweeper means what? Who will sweep the floor. So sweeper facility is given to the employee. Now this employee, the sweeper is there, no? The sweeper is hired by the employer only. Employer is only paying the salary of the employee. Hence, it is called sweeper facility. In the hands of non-specified employee, it is completely exempt from tax. But now let us talk about another situation where sweeper is actually employed by the employee himself, but employer is just reimbursing the salary of the sweeper. This type of case is called obligation of the employee met by the employer. Sir, how can I know whether it is obligation of the employee met by employer? You should only ask one question. Very simple question. What is that? If employer didn't reimburse, still will the employee have to pay or not? If the employer did not reimburse, still will the employee have to pay that salary? If the answer is yes, then it is an obligation of the employee met by the employer. It is not exempt for specified also, non-specified also. Okay, well, however, if directly the facility is given. Now in the first example that I told you, what will happen? Let's say the employer did not pay the salary. In such case, should the employee have to pay? Answer is no. Employee also need not pay because the sweeper was hired by the employer only. So in this case, sweeper facility is exempt in the case of non-specified employees but taxable in the case of specified. But if it is obligation, it is taxable for specified also, non-specified also. There is no such difference. So I'll give you one more example. Let's say gas, electricity, water bill. So gas, electricity, water bill, if it is directly paid by the employer, then it is a facility. Then employee in the hands of non-specified employee, it will be exempt. However, if gas, electricity, water bill is paid by the employee, however, employer is just reimbursing the amount, then it is not facility, then it is just obligation of the employee met by employer. So how will you know that it is obligation? Because you should answer one question. The question is that if the employer is not paying the gas bill, should the employee have to pay or not pay? If the employee has to pay, if employer is not paying, if the employee has to pay, then it is an obligation. If the employee need not pay, then it is not an obligation. You get my point? I hope you are clear. If you are not clear, no still, then you rewind in the last 20-30 seconds, watch this concept once again till you have clarity, till you understand my example. Then we will move to the next part. Okay, well? Now let us see what are all the salary definitions which is going to come in your salary chapter. So there are 5 types of definition, Karna. I have named it as salary 1, salary 2, salary 3, salary 4 and salary 5. So salary 1 is basic salary. It is only going to come in entertainment allowance deduction. Then basic plus DA. This salary definition is only going to come in gratuity PGA calculation. But then this salary definition, third one is very important. Basic plus DA term plus commission turnover. Okay, or turnover commission. This salary definition is going to come in many places. So gratuity, non-PGA, leave encashment, voluntary retirement scheme, retrenchment compensation, house rent allowance and recognized provident fund. So all these places the same salary definition is going to be tested again and again. And then lastly there is salary number 4, which is a big salary definition. It is going to be tested in rent-free accommodation and hotel facility. You have to buy hard. And lastly, salary plus DA terms. This one definition is there, no? It will not come under salary head of income, but it will come in PGBP and deduction head of income, Karna. So PGBP head of income also about when it is about contribution of employer to pension fund, there it will be tested. Similarly in deduction also, contribution to pension fund, this salary definition is going to be tested. So now itself you be thorough and you know the difference between all the salary definitions so that you don't get confused in the examination. Clear? Now, in the different places, somewhere we will find number of years of service rounded off or number of years of service completed. So if it is number of years of service rounded off, then you have to do the rounding kanna. So if it is 6 months, up to 6 months, it will be taken as 0. Here you have to be very, very careful that 10 years, 6 months. If it is exact 6 months, generally what do? We do upper rounding. But if it is exact 6 months, you have to do lower rounding in case of number of years. So 10 years, 6 months will be considered as 10 years only. But even if it is 1 day extra, 10 year, 11 months, it will be considered as 11 years. So you have to do rounding off wherever we find number of years of service rounded off. Okay, we will find in two places, that is gratuity PGA calculation, retrenchment compensation calculation. Then you will find in three places, you will find number of years of services completed. Completed means what? Only completed years of service you have to take. So if 10 years 11 months is completed, then how many years are complete? Only 10 years is complete. That is why you take only 10 years of service. Okay, it is used in gratuity non-PGA calculation, leave encashment, and also in voluntary retirement scheme. Then in some places the question will ask you to find, or you are required to find, the average salary. So average salary also, different places, the method to calculate average is different. When it comes to gratuity non-PGA calculation, it is 10 months before the month of retirement. But in case of leave encashment, it is 10 months before the date of retirement. So this also you have to be careful. And retrenchment compensation totally different. It is, if at all the employee is receiving monthly salary, then it is 3 months before the month of retirement. If the employee is receiving weekly salary, then it is 4 weeks before the week of retirement. And if the employee is receiving daily salary, then it is 12 weeks before the date of retirement. 12 weeks before the date of retirement. This is not that important. If you remember, well and good. If you don't remember also, don't worry. It might, most probably will not be tested in the examination. So gratuity, leave encashment, and retrenchment compensation. So different average definitions, salary definition, and years definition I have given you in the same page so that it is easier for you to memorize. Now let us come to the actual salary terminology. What and all is going to be taxable and what is their meaning? Let us see. Firstly, basic salary. Basic salary is only the regular monthly salary which is received by the employee. It is taxable under salary head of income. Next, if any fees is also received by the employer due to employer-employee relationship, then such fees also will be taxable under salary head of income. Then commission. In commission Nogana, we should know the difference between turnover and commission and other than turnover commission. Turnover commission means what? Commission which is given as a percentage of turnover achieved by the employee. For example, the employee is a sales employee. The sales employee, they will generally get fixed pay plus variable pay. So fixed amount will be a monthly amount. Variable amount will be based on the sales achieved by the employee. So if as an employee, if I am able to achieve 1 crore sale, sometimes the employer will give me 1%. That is 1 lakh rupees I will get. So this 1 lakh rupees, which is 1 crore into 1%, will be my turnover commission. So in certain definitions, turnover commission is given separately. So you should know what is the difference between turnover and other commission. So turnover commission means what? Commission as a percentage of turnover achieved by the employee. Now let's come to bonus. Bonus means what? Lump sum amount given to the employee. It can be fixed bonus also, it can be variable bonus also. However, bonus is there, it is always taxable on receipt basis. So whenever bonus is received, then only it is taxable. Now let's talk about advance salary. Advance salary is the salary which is received in advance. So before itself the employer is paying, it is advance salary. If the advance salary is already taxed, then once again when it is due, it will not be taxed once again. Okay, then advance salary, it is taxable as salary. However, you should not get confused between advance salary and advance against salary kana, because advance salary is salary received in advance, but advance against salary is a loan given by the employer against the salary. So it is a loan. It means what? The employer is giving a loan to the employee. If at all employee is not able to repay the loan, then it will be deducted from the salary. That is only advance against salary. If at all you find advance against salary, then perquisite also might be there in the question. So you have to calculate the interest perquisite also. Fine. If the loan is given for concessional interest or low interest or no interest, then you have to calculate what is the interest perquisite. That also we are going to discuss in this video only. So don't worry, watch this video till the very end. Okay, so arrears of salary. What is arrear of salary? Arrears of salary means past years disputed salaries is received in the current year. That is only arrear of salary. If it was already taxed when it was due, then no need to tax when it is received. However, if it was not taxed earlier, then in the year of receipt, the arrear salary is going to be taxed. And when it comes to arrears, you should also get 89 relief. 89 relief, that also we will discuss at the end of the video. So now all the basic terms we know. Now let us jump to allowances. So let us first discuss fully taxable allowances. Karna, fully taxable allowances are there, no? So many are there in your study material, but I am not going to discuss all of them. You know why? Because if you know what is exempt, that is enough. All the other allowances are, however, going to be taxable. So you just learn what is exempt, that is enough. Other allowances, if you see in the question, it means they are going to be taxable allowances. Fine. So I am not going to discuss them separately. So some burden I want to relieve from your shoulders. Okay, wow. Dearness allowance. Sir, however, the students are not studying this salary chapter properly. So let me make some effort from my end to do all this consolidation in the chapter, so that at least you will put some effort. Now that I have put some effort, you also put some effort, balance effort, so that you are remembering the salary provisions and not making a mistake and scoring marks in the examination. The salary chapter is a scoring chapter. It is not concept based. It is fully memory based only. So if you remember the provision, you will easily be able to attend and score full marks in the examination. And you know what? Other people skip this chapter and go. So if you are not skipping the chapter, you are learning this chapter thoroughly, you will have an edge over the other students, and definitely you will be able to score exemption in the income tax paper. Okay, coming back to revision. Fully taxable allowances. First allowance that I want to discuss is dearness allowance. So dearness allowance, if you find in the examination, it is always fully taxable. There is no exemption, no nothing for dearness allowance. Okay, but why are we learning separately? Because in dearness allowance, there can be two types of DA, that is dearness allowance in terms and dearness allowance not in terms. If it is dearness allowance in terms, it means what? While the terms of the salary were decided, that time itself dearness allowance was decided. Hence, dearness allowance in terms generally forms part of retirement benefits. But if dearness allowance are not in terms, it generally does not form part of retirement benefits. So in question, they can give you DA terms also, or DA in terms, they can write it and give you also, or they can also tell that this dearness allowance form parts of retirement benefit. So with the wordings itself, you should be able to identify whether it is DA terms or DA not in terms, and you have to apply to the salary definition accordingly. So what if it is not given in the question, whether it is DA terms or not in terms? So if it is not given in the question, then you have to assume. What to assume, sir? You can assume both, both are good assumption only. You can assume in terms also, you can assume not in terms also. But for simplicity's sake, let me just tell you, you just assume in terms and solve the question. Okay, so this is dearness allowance discussion. Then what about all the other allowances? Whatever exempt allowance that I mentioned, other than those exempt allowances, all the other allowances are going to be taxable allowance. Okay, now let us discuss exempt allowances. So firstly, any allowance paid to a judge of a high court or a supreme court as per the respective act is going to be exempt. But this high court, supreme court judge and all no, for this, the allowances are exempt only in the old tax regime. They are not exempt in the new tax regime. Fine. So this you have to be careful. When the judge is receiving the allowances, they are exempt in the old tax regime, not in the new tax regime. So allowance received by United Nations Organization. So salary and allowance both received by a salaried employee of United Nations Organization is fully exempt in the old tax regime, but not exempt in the new tax regime. Then sumptuary allowance received to a judge of a high court or supreme court, that is also exempt in the old tax regime, not exempt in the default tax regime. Then section 10 clause 7, if there is any allowance and even perquisite paid by an Indian government to an Indian citizen outside India, it is fully exempt. And this exemption is there under both tax regime, under default also, optional also. Now let's talk about house rent allowance. Section 10 clause 13a HRA. So HRA allowance is given by the employer to meet the rental expenditure of the employee. Okay, now there is an exemption under section 10 clause 13a for the house rent allowance, but this exemption is only available in the old tax regime, exemption not available in the default tax regime. So not allowed under section 115 BAC. What is the exemption, sir? To calculate the exemption, you have to first step you have to take what is the HRA actually received. HRA actually received. Sir, but for what period I will take this house rent allowance? The period should be the relevant period. Relevant period means period during which the accommodation was occupied by the assessee. So during the period during which the assessee is staying in the accommodation, rented accommodation, that period you have to take. So what is the HRA actually received? Number 2, rent paid minus 10% of salary. So here rent paid also for what period I should take? Rent paid also you have to take for the period during which the employee is occupying the accommodation. Rent paid minus 10% of salary. So here salary is salary 3. Salary 3 means what? Basic salary plus dearness allowance in terms, DA terms, and turnover commission plus turnover commission. So basic pay plus DA terms plus turnover commission. This is only salary 3. In your exam, don't write as salary 3. In your exam, you have to write the entire formula. Okay, that is important. Then And lastly, 50% of salary for the relevant period. So 50% in case of metro city, however it is 40% in case of non-metro city. And as per Income Tax Act, there are only 4 metro city karna, that is Delhi, Kolkata, Mumbai and Chennai. Delhi, Kolkata, Mumbai, Chennai. There are only 4 metro cities. In these 4 cities, if the employee is residing, then 50% of salary you have to take. In other cities, 40% of salary you have to take. Whichever is lower will be exempt, balance amount will be taxable. So first in the salary head of income, you have to take the entire HRA and you have to put in the inner column. From that you have to reduce the exemption. To calculate the exemption only, either you can calculate there itself or you can put a separate working note, and in working note you have to calculate HRA actually received or rent paid minus 10% of salary or 50% of salary or 40% as the case may be. Whichever is lower will be the exemption. Okay, now let's talk about the partly exempt allowances given under section 10 clause 14 subclause 1. So 10.14.1 speaks about 6 allowances which are fully exempt subject to official use. It means what? Allowance will be given by the employer. So whenever the employee is using it for official use, that much amount will be exempt. Okay, for example, employer gave 10,000 rupees, but the employee has used 8,000 for official purpose. In such case, 8,000 will be exempt, balance 2,000 will be taxable. You get my point? Now, here also 3 allowances are such which will be exempt under both the default tax regime as well as optional tax regime, but there are 3 allowances which is only exempt in the old tax regime or optional tax regime. So firstly, let us see what are all exempt under both tax regime. So first is conveyance allowance. Conveyance allowance is the allowance given for the employee so that they can do the conveyance within the city. Okay, for example, I am working in an auditor office, my client is there in the same city, I am going to the client place and coming back to office. This is only called conveyance. So for this, whatever allowance is given is called conveyance allowance. Then second one is traveling allowance. Traveling allowance means traveling from one city to another city. For that, if I am getting any allowance, that is traveling allowance. Then daily allowance. Daily allowance means when I am going to any other city, I want to meet the expenses of staying there and eating there. Correct? Food expense and hotel expense. So for that only, whatever expense allowance I get, it is called daily allowance. So conveyance allowance, traveling allowance, daily allowance is exempt in both tax regime subject to official use. So whatever amount is incurred for official purpose, that much amount will be exempt. Balance amount will be taxable. Now let's talk about old tax regime only. For that, there are 3 allowances. First is uniform allowance. Uniform allowance means what? Allowance for stitching the uniform. So for new uniform, whenever allowance is received, subject to the expenditure incurred on uniform, it is allowed as exemption in the old tax regime. Then is research allowance. So research allowance is for doing the research. That is also only allowed in old tax regime. And lastly, helper allowance. For office work, if any helper is hired, then salary paid to that helper is exempt. Balance amount of allowance will become taxable under old tax regime. New tax regime, all the 3 will be fully taxable. Okay, fully taxable. Now let us talk about section 10 clause 14 subclause 2, partly exempt allowance subject to limit. So now whatever allowance that I am telling you, it does not matter how much amount is used for official purpose or not. Here we are going to study about the limits. Up to the limit, the allowance will be exempt. If it is above the limit, balance amount is going to be taxable. So up to limit exempt, balance amount taxable. Up to limit exempt, balance amount taxable. Okay, so what are they? First, let us talk about the exempt allowance under both tax regime. So it is transport allowance. Transport allowance means what? For transport from office to home and home to office, or office to shop. Home to shop and shop to home. So that is only transport allowance. This transport allowance, if it is given to an employee, that up to 3,200 per month is fully exempt only in case of specially abled employees. Specially abled means what? Blind, deaf, dumb and handicapped. Blind, deaf, dumb and handicapped. So only in these 4 cases, the entire allowance up to 3,200 per month is exempt. Balance amount will be taxable. But sir, what if the employee is not specially abled? If employee is not specially abled, then entire amount of transport allowance will be fully taxable. Okay, now for this both tax regime, many students get confused that sir, what are all exempt in both tax regime, what are all exempt only in older tax regime? We are getting confusion, sir. So for that only, I have given you a memory technique. What is the memory technique? This sentence you have to remember. I took transport to office, then conveyance to client place, then I had to travel to their outstation branch and work there daily. So once again, I took transport to office. Transport means transport allowance. Okay, wow. So transport means what? From home to office, office to home. That is why I have given transport to office, so that now you remember what is the meaning also, because students get confused in the meaning also. Sir, what is difference between transport, conveyance, travel? So students will get confusion. So you have to be clear. So I took transport to office, then conveyance to client place. So within the city, if you are traveling to client place, it is called conveyance. So conveyance to client place. Then I had to travel to their outstation branch. So in another city you are going and traveling, that is only called travel allowance. And lastly, and work there daily. So there, if you are spending for hotel and food, that is daily allowance, correct? So daily. So I took transport to office, conveyance to client place, travel to outstation branch, and work there daily. So like this, if you remember, now these 4 allowances are the allowances which are exempt in both old tax regime as well as new tax regime. And the first one alone, that is transport, it is subject to the 3,200 limit for specially abled employees, and balance 3, that is conveyance, travel and daily, subject to official purpose, it is allowed to all the employees. Now let us discuss all the other allowances which is only exempt under the old tax regime, only under old tax regime. So what are they? Tribal area allowance or scheduled area or agency area. So up to 200 rupees per month exempt, balance amount taxable. Next, transport system allowance. Transport allowance, system allowance means the daily allowance for transport system employees. For example, a bus driver is there. Bus driver will go to different cities and live there. No, for that they will be getting transport system allowance. So this is also like a daily allowance only. However, if they are also receiving daily allowance, then this transport system allowance will not be exempt. Then daily allowance you can claim the exemption. So they should not be receiving any daily allowance. Now what is the exemption? 70% of allowance or 10,000 rupees per month, whichever is lower. 70% of allowance or 10,000 per month, whichever is lower, will be exempt. Balance amount will be taxable. Next, underground allowance. For example, employee working in mining, okay, who are working underground, for them up to 800 rupees per month is exempt, balance amount taxable. So 800 rupees per month exempt, balance amount taxable. Children education allowance. Children education allowance, 100 rupees per month per child, maximum 2 children, exempt, balance amount taxable. Hostel allowance, 300 rupees per month per child for maximum 2 children, exempt, balance amount taxable. Then hilly area allowance, depending on the hilly area, it is either 800 or 300, not that important. Then for armed forces also there are some special allowances. What are they? Island duty allowance. So for working in island, okay, up to 3,250 exempt, balance taxable. Next, high altitude allowance. If the altitude is above 9,000 feet but up to 15,000 feet, then 1060, that is 1060 per month, exempt, balance taxable. And if the altitude is greater than 15,000 feet, then 1600 rupees per month, 1600, 1600 rupees per month is exempt, balance amount is taxable. Then border area allowance, depending on the area, allowance is given. Then compensatory field area allowance. So compensatory field area allowance up to 2,600 rupees per month, exempt, balance amount taxable. Compensatory modified field area allowance. So it is little bit lesser than compensatory, that is why it is 1000 rupees only, 1000 rupees per month, exempt, balance amount taxable. Then special compensatory highly active field area allowance. So this is more than compensatory because this is special compensatory, okay. So 4,200 rupees per month, exempt, balance amount taxable. Lastly, counter insurgency allowance, 3,900 rupees per month, exempt, balance amount taxable. So all these should we remember? Answer is yes. You have to memorize all these thoroughly so that you are able to attend. If you don't memorize, you will not be able to attend. So don't leave all this for the last moment, Kanna. When you are seeing this revision lecture, if at all you are seeing before the examinations, then now itself you sit, spend some time and complete the memorization part, because one day before the examination it is next to impossible to remember everything. Then it is totally dependent on your luck. If at all something sticks in your brain and if you are able to answer in the exam, well and good, congratulations, you are lucky. But highly possible that it forms a khichdi inside your head of all these different limits, terms, formulae, etc. So it becomes very difficult for the examination. So now itself, either you spend some time and memorize, or watch this revision lecture at least 2 to 3 times so that it becomes installed in your brain. Now let's talk about retirement benefits. So allowance is over. Now we are jumping to retirement benefits. Retirement benefits means sum received during the retirement. Firstly, let us talk about gratuity. What is gratuity? Any voluntary payment which is given by the employer in appreciation of employees' services. However, nowadays gratuity is not voluntary. Gratuity has become mandatory to give to the employees. If gratuity amount is received during the service, then gratuity is fully taxable. But if gratuity is received on death or retirement, then exemption can be claimed under section 10 clause 10. Sir, here retirement does not mean only retirement. Here retirement also means termination, resignation or incapacitation. So termination, resignation, incapacitation or death, in all these cases exemption can be claimed under section 10 clause 10. So if a government employee is receiving gratuity on retirement or death, entire amount is exempt under section 10 clause 10. Entire amount received by government employee on retirement fully exempt. Now let's talk about other than a government employee. If it is other than government employee, you have to see whether the employee is covered under Payment of Gratuity Act, that is PGA, or not covered under Payment of Gratuity Act, or we can call it as non-PGA. So PGA case, non-PGA case. First let us talk about Payment of Gratuity Act, who and all are covered. For them, what is the exemption? So for them, the exemption is maximum 20 lakhs or actual gratuity received, or you have to apply the formula. What is the formula? 15 divided by 26 into salary 2 per month into number of years of services rounded off. What did I say? 15 divided by 26. Sir, how to remember this? Very easy, Karna. 15 means 15th of August, Independence Day. 26 means 26th of January, that is Republic Day. So Independence Day by Republic Day you have to do. 15 divided by 26 multiplied by salary 2 per month. What is salary 2? We have already discussed. Salary 2 means basic plus dearness allowance. And here in salary, in this PGA calculation, no, this dearness allowance, entire DA you have to take. You should not differentiate between DA terms and DA not in terms. Both DA you have to take. So that is why I have given it both. Fine. So basic salary plus dearness allowance is the salary calculation, and number of years of service rounded off. So rounded off means what? Up to 6 months you will do lower rounding, more than 6 months you will do higher rounding. Okay. So that is rounded off. And here for salary, what period salary you have to take, sir? You only have to take last drawn salary. So here average and all is not given, no. That is why you have to take the latest salary or the last drawn salary. So once again, let me tell you what are the exemption limits. Exemption is 20 lakh rupees or actual gratuity, or 15 divided by 26 multiplied by salary multiplied by number of years of service rounded off, whichever is lower. So lower amount will be the exemption, balance amount will be taxable. Now let's talk about non-PGA employees. For non-PGA employees, how to calculate the exemption? So first step, it is 20 lakhs, which is the same. Second step is actual gratuity received, that is also same. Third step only there is a change because the formula is different. Here what is the formula? 1 by 2 into average salary 3. Okay, average. So here it is not latest salary, Karna. Here it is average salary. So average salary 3 multiplied by number of years of services completed. Here it is completed year of service. So here how to calculate the average? Average means you have to take the last 10 months salary before the month of retirement and then you divide it by 10. So that way you will get the average salary. So average means average of last 10 months preceding the month of date or retirement. Okay, death or retirement. And then lastly, number of years of services you have to take only completed years. So if there is any incomplete year, you ignore it. Only completed years you have to take. So once again I am telling you, in case of non-PGA employees, how to calculate the exemption. So exemption is equal to 20 lakh rupees or actual gratuity received, or 1 by 2 into average salary into number of years of services completed, whichever is lower. So like this you have to calculate. Now let us talk about one small point, and that is about this 20 lakh limit. This 20 lakh limit is there, no Kana? It is a maximum exemption during the lifetime. So for example, if the employee has already received some exemption for gratuity, in such case, this 20 lakh rupees limit is there, no? You have to reduce by the exemption that is already received. Hence, maximum exemption that can be claimed in the lifetime is only 20 lakhs. So if gratuity is received from 2 or more employers, then aggregate cannot be more than 20 lakhs, and if gratuity was already received before, then limit of 20 lakhs shall be reduced by the income that has already been exempt. Now let us talk about the next part, that is pension. Pension is the periodic payment received for the past services after retirement. So this pension, no, generally it is uncommuted, Karna. Uncommuted means what? Received monthly. Okay, every month some amount is received. But if pension is received monthly or quarterly, that amount is fully taxable. It is fully taxable. Then how to claim exemption, sir? To claim exemption, you have to commute the pension. Commuting pension means what? Commuting means giving up the monthly pension and receiving a lump sum amount today itself. Okay, let me give you an example. Let's say a person was receiving 5,000 rupees per month as pension. Now this person is telling, out of this 5,000 rupee per month, no, I want to give up 3,000 rupee per month, so that my future pension is only 2,000 rupees. Future pension 2,000 rupees, 5,000 minus 3,000. If he gives up 3,000, he is receiving 3 lakh rupees as lump sum payment. So this lump sum amount of 3 lakh rupees is only called commuted pension. This commuted pension, no, on this you can claim the exemption. To claim the exemption, you should know certain terms. What is the term? First is commutation percentage. Commutation percentage means what percentage of the pension has been commuted. So 3,000 out of 5,000 has been commuted. No. So how much percentage is commuted? 3,000 divided by 5,000%. 5,000 is equal to 60%. So 60% has been commuted. Then you should know what is the meaning of full pension kana. Full pension. Full pension means commuted pension divided by commutation percentage. So here it is 3 lakhs divided by 5 lakhs, or very simple. What is full pension? Full pension means if entire pension is given up, then how much amount will be received in today? That is only full pension. Why we are learning full pension? Because in the formula you will get full pension only to claim the exemption. Now let us see how to claim the exemption kana. Firstly, if commuted pension is received by a government employee, then under section 10 clause 10A, it is fully exempt. However, in case of other than government employee, you have to see whether the employee is also getting gratuity or employee is not getting any gratuity. Because if the employee is already getting gratuity, then he will be claiming the gratuity exemption also. That is why in Income Tax Act for pension, he will receive only 1/3 as exemption. But if he is not receiving gratuity, he will be receiving half amount as exemption. Okay. So if the employee is receiving gratuity, then 1/3 of full pension is allowed as exemption, and if the employee is not receiving gratuity, then half of the full pension is allowed as exempt. Okay Karna? So here you have to put full pension in the formula. So what is full pension? If entire pension is given up, then how much amount will be received? That is only full pension. So 1/3 into full pension or 1/2 into full pension, as the case may be, will be exempt. Balance amount will be taxable. Okay, if you want, you can just pause the video and note down this example so that you are clear with the terms. You can have a sticky note. In this sticky note, you can note this example and stick it on this page so that whenever you want, you can refer. And in pension, no kana, one thing, 2 silly mistakes the students make. What silly mistake, you know? First silly mistake is that the students get confused and they sometimes think what is the salary they had to take for the pension calculation. Kana, in this pension exemption, there is no salary definition at all. There is only one definition, that is full pension. So 1/3 into full pension or 1/2 into full pension is exempt. So that is one silly mistake. Students get confused. And second silly mistake that students do is that ignoring the balance future pension after the commutation. Now listen, let's say this 5,000 rupees per month is received for 6 months. Okay, after 6 months, the pension has been commuted, so 3,000 is given up. So balance 6 months, how much will be received? For balance 6 months, 2,000 rupee per month will be received. The student make a mistake, silly mistake, that this 2,000 rupees per month they are not putting in the answer. This 2,000 rupee per month also will be taxable, no, because it has been received after the commutation till the end of the year. So this also will be taxable under salary head of income. So uncommuted pension will be taxable. Commuted pension exemption can be claimed. Sir, what is the exemption? If the employee is receiving gratuity, then 1/3 of full pension. If employee is not receiving gratuity, then 1/2 of full pension will be exempt. Balance amount will be taxable. Okay, wow. Then commuted pension received from annuity plan of LIC is fully exempt. Then commuted pension received by a High Court judge or Supreme Court judge also fully exempt. Then section 10 clause 18, it says that pension received is fully exempt if the following conditions are satisfied. The individual is an employee of central government or state government and has been awarded the Paramveer Chakra, Mahavir Chakra or Veer Chakra. So if an individual is a central government or state government employee who has received the gallantry award means what? Paramveer Chakra, Mahavir Chakra or Veer Chakra. In such case, whatever pension they are getting will be fully exempt. And if the employee is no more, then the family will receive the pension, which is called family pension. Then this family pension is also fully exempt. Okay. And who is family member? Family member means spouse plus children plus parents, brother, sister if they were dependent on the employee. Then exempt disability pension. So disability pension or disability element of pension received by a armed forces personnel who have been invalidated out of service on account of bodily disability attributable to or aggravated by such service is fully exempt. So in armed forces, sometimes what will happen? Sometimes there can be injury for the armed forces person. Because of this injury, now they are disabled and not able to work for armed forces. In that case, whatever amount of pension they get, in that you have to see what is the disability pension. This disability pension will be fully exempt. Fine. So this was the pension discussion. Now let us come to leave encashment kana. Leave encashment means what? How much ever leave was taken, was not taken, for this some extra money is received by the employer. This is only called leave encashment. So leave encashment means you are not taking the leave. Since you are not taking the leave, the employer is giving you some extra money. That is leave encashment. Generally, leave encashment is received during service. So generally during service. If it is received during service, it is fully taxable. However, if it is received on retirement, in such case, it will be exempt. How to calculate the exemption? In case of government employee, it is fully exempt under section 10 clause 10AA. Then in case of other than government employee, you have to calculate the exemption, which is the lower of 4 steps kana. So here there are not 3 steps, here there are 4 steps. So step number 1 is the upper limit, that is 25 lakhs. Step number 2, actual leave salary received. Then step number 3, 10 months multiplied by average salary. So 10 months average salary. So 10 months means 10. Then you have to see average salary. Average salary means what? First you should know what is average. Average is the average of the last 10 months salary before the date of retirement kana. So on what date the person retired, before that take the 10 months. For that 10 month salary, find out the average. So 10 month salary divide by 10, you will get the average salary. And here what is the salary definition? Here salary definition is basic salary plus DA terms plus turnover commission. So that is salary 3. So 10 months average salary. Then you have to find what is leave equivalent divided by 30 multiplied by average salary. So leave equivalent by 30 into average salary. So step number 3 was what? 10 months average salary. And step number 4 is leave equivalent by 30 into average salary. Now what is leave equivalent? Leave equivalent means very simple. The leaves that are not taken by the employee. Leaves not taken. See, if at all the question is giving you leaves not taken, then directly you can take it as leave equivalent. Okay, wow. However, if the question is giving you earned leave and actual leave, then you have to do the calculation. Leave equivalent is equal to earned leave minus actual leave. And here the earned leave is there no kana. It can be maximum 30 days per completed year. So in question, if it is giving you that the employee has earned 45 days per year as leave, then you should not take 45 days as earned leave. You should take only 30 days as earned leave, and only for completed year you have to take. So earned leave minus actual leave will give you leave equivalent, and in formula you have to write leave equivalent by 30 into average salary. Now let me tell you all the 4 steps again. Once again, listen carefully, install it in your brain. So what is the exemption under section 10 clause 10AA for leave encashment? So number 1, 25 lakhs. Number 2, actual leave encashment received. Number 3, 10 months average salary. And number 4, leave equivalent divided by 30 multiplied by average salary, whichever is lower. Where leave equivalent is equal to leave not taken, or you can say earned leave minus actual leave, where earned leave can be maximum 30 days per completed year. Okay. So this is the, and here also similar to gratuity, this 25 lakh rupee exemption is there. No, it is a maximum exemption during the lifetime of the employee. So even if the employee is getting from 2 or more employers, it cannot cross 25 lakhs. Now let's talk about voluntary retirement scheme. So voluntary retirement scheme is where the employee is voluntarily retiring from the organization because the organization is giving a scheme and they are paying a lump sum amount. So this amount, whatever amount is received from the VRS, if the undertaking is an eligible undertaking and if the conditions are satisfied, then it is exempt. However, if it is not eligible undertaking or if conditions are not satisfied, then it is fully taxable. If nothing is given in the question, you assume that it is eligible undertaking also, conditions are satisfied also. So now if conditions are satisfied, then how much amount of VRS will be exempt? Let us see. Under 10 clause 10C, VRS exemption is lower of the following, and here also there are 4 steps kana. There are not 3 steps, 4 steps. What are they? Number 1, 5 lakhs. Number 2, actual amount of VRS. Number 3, 3 months multiplied by salary 3 per month into number of years of completed service or number of completed years of service. So 3 months into salary per month into number of years of service. So here it is salary, not average salary. So if only salary is given, then you have to take the latest salary karna. So 3 months multiplied by latest salary into number of years of services completed. And here completed means what? Only completed years you have to take. And here salary means salary 3, which is basic plus DA terms plus turnover commission. And last step is salary multiplied by balance months of service left. Balance months of service left. So once again I am telling what are the steps. Number 1, 5 lakhs or actual VRS, or 3 months into salary into number of years of services completed, and number 4, salary multiplied by balance months of service left. Whichever is lower will be exempt, balance amount will be taxable. Okay. Next. If nothing is given in the question, you assume, this I have already told. Who is eligible undertaking? Eligible undertaking means central government, state government, any company. So any company is eligible. Then cooperative society, local authority, university, IIT and Institute of Management. So all these are eligible undertakings. Then what is the condition? The condition is that the employee should have completed at least 10 years of service or at least 40 years of age. So 10 years of service or 40 years of age. However, this condition is there. No, it is not applicable to public sector undertaking. Okay, public sector undertaking means what? An undertaking where the government is the majority shareholder. So for this company employee, this condition is not required. Okay, what is the condition? The employee should have at least completed 10 years of service or 40 years of age. Then VRS is a once in a lifetime exemption. So one time if exemption is claimed under 1010C, it cannot be claimed once again. And lastly, if section 89 relief is availed, then for such amount VRS exemption is not there. Now let's talk about retrenchment compensation. Retrenchment compensation means what? Retrenchment means reduction in the number of employees. So the employer is reducing the number of employees and now asking the employees to go out from the organization. This is called retrenchment. In case of retrenchment, the employer will give the compensation as per the Industrial Disputes Act of 1947. So compensation as per Industrial Disputes Act will be exempt under section 10 clause 10b subject to the condition. So what is the exemption Kanna? Exemption is number 1, 5 lakh rupees or actual compensation received, or the formula, that is 15 divided by 26 into average salary 3 into number of years of service rounded off. Whichever is lower will be exempt, balance amount will be taxable. So here also 15 by 26 you have to take, and here you have to take average. So average I already discussed. No, there are 3 types of average that you have to take care. And then salary 3 means what? Basic plus DA terms plus turnover commission, and number of years of service rounded off means what? If it is up to 6 months, then you do lower rounding. More than 6 months you do upper rounding. So retrenchment compensation, once again I am telling you, 5 lakh rupees or actual compensation, or 15 divided by 26 into average salary into number of years of service. Whichever is lower will be exempt, balance amount will be taxable. Now let's come to Provident Fund. Provident Fund is a scheme given to give substantial benefit to an employee at the time of retirement. So monthly or yearly, the employee will deposit some amount in the PF of the employee, and on the time of retirement, the employee can withdraw this amount. The employee himself can also contribute. So finally, lump sum amount the employee can withdraw and use during the retirement phase. So this is only Provident Fund. Similarly, Superannuation Fund also similar concept, where regularly amount is being contributed by employer as well as employee, and lump sum amount can be withdrawn later on. So now what are the types of Provident Fund Kanna? First is recognized Provident Fund. Recognized Provident Fund means what? It is recognized by the Commissioner of Income Tax. Unrecognized Provident Fund means not recognized by the Commissioner of Income Tax. Then Statutory Provident Fund. Statutory Provident Fund means governed by the PF Act of 1925. It is the Provident Fund for government employees. So when the government is putting the money in Provident Fund, that is called Statutory Provident Fund. And lastly, Public Provident Fund. Public Provident Fund is the Provident Fund for all the people other than employees. So for example, if I am not an employee, I can deposit the money in PPF, that is Public Provident Fund. So what are the Provident Fund? Recognized, unrecognized, statutory and Public Provident Fund. Now based on the Provident Fund, let us see what is the taxability. And in case of superannuation fund also, it can be either approved superannuation fund, which means it is approved by Commissioner of Income Tax, or unapproved superannuation fund, which means it is not approved by Commissioner of Income Tax. So now let us study the taxability of everything. So there are 4 types of transactions Kanna. First transaction is employer contribution, second transaction is employee contribution, third transaction is interest provided by the fund, and fourth transaction is maturity. So in all these 4 transactions, how will the taxability be? Let us see one by one. Firstly, let us talk about Statutory Provident Fund. So Statutory Provident Fund is the provident fund for government employees. I told you, no. So employer contribution is fully exempt. So no need to pay the tax. Then employee contribution you have to ignore. Sir, why to ignore, sir? Because when employee is contributing out of his pocket, then for him, is it an income? Answer is no, it is not an income. Then why are we even speaking about taxability? That is why when employee is contributing, it is an expense for the employee. It is not an income for the employee. That is why it is never taxable. So employee contribution should be ignored. However, if you go to the deduction chapter, you will be learning that if employee is contributing, then the employee can claim ATC deduction in the deduction chapter. So that you have to refer the deduction chapter. Now let us talk about interest. So whatever interest is paid by statutory provident fund is fully exempt, and even maturity, section 10 clause 11 says that the entire maturity is fully exempt. So employer contribution exempt, employee contribution should be ignored, interest is exempt, maturity is also exempt. So everything is fully exempt in case of statutory provident fund. Statutory provident fund. Now let's talk about recognized provident fund. Recognized provident fund means what? Recognized by the income tax commissioner. So in the recognized provident fund, when the employer is contributing, then up to 12% of the salary, if he is contributing, it is exempt. Balance amount will become taxable. So up to 12% exempt, balance amount will be taxable under salary head of income as perquisites. Okay, wow. So this salary means what? Here salary means basic salary plus DA terms plus turnover commission. That is salary 3. Okay, wow. So basic salary plus DA terms plus commission turnover into 12% you have to see. If the contribution is within 12%, fully exempt. If it is above 12%, then balance amount alone will be treated as salary. In question, what you are going to do? In question, first under the salary head of income, you put the employer contribution. Then from that you reduce 12% as exemption. 12% of salary as exemption. Here, no, one silly mistake students do, that also let me tell you. In examination, no, the examiner will tell the employer has contributed 16% of basic salary. But while calculating the exemption, should you take only basic salary? Answer is no. While calculating the exemption, you should take 12% of basic salary plus DA terms plus turnover commission. Like that, you have to take all the amount. So here you should not make silly mistake. Okay, well, students just take 16%, compare it with 12% and give the answer. That is completely wrong. Next. Now let's talk about employee contribution. So here also, if employee is contributing, then that can be ignored, and ATC deduction can also be claimed. Then interest up to 9.5% is exempt, balance interest will be taxable. Now let's talk about maturity. Maturity also under section 10 clause 12, maturity of recognized provident fund is fully exempt. However, it is subject to a condition. In a condition, the condition is that the employee should be a member of a recognized provident fund for at least 5 years. So before 5 years, you should not withdraw the amount. If before 5 years you are withdrawing the amount, then the maturity is going to be taxable. Sir, but for this 5 years, there are some exceptions. What are the exceptions? Number 1, transfer of funds from the old employer RPF to new employer RPF is allowed. So for example, within 5 years itself, you are shifting from the employer to another employer. However, the recognized provident fund money is there, no, that you are not withdrawing. Instead of withdrawing, you are transferring it to the new employer. So that case, it is not taxable. Similarly, if you are transferring from old employer recognized provident fund to NPS under section 80CCD, then also it is not taxable. So conversion from RPF to NPS, new pension scheme or national pension scheme, that is also not taxable. And then there are 3 exceptions where even if you withdraw within 5 years, still it will be exempt. Exception number 1, due to ill health of the employee. So the employee is suffering from some disease, for the treatment only they are getting that money. So it is fully exempt. Number 2, discontinuance of employer business. The employer itself has stopped doing business, hence now you are forced to get the money from the PF, hence it is fully exempt. And third one, any other cost beyond the control of employee. Now it is not in the employee's hands, the employee has to forcefully get the amount from RPF. In such case also it is exempt. So what did I say? Recognized provident fund, very important kana. In recognized provident fund, when they look at my face, don't look at the screen, look at my face. Employer contribution, if the employer is contributing up to 12% of basic plus DA terms plus turnover commission is exempt, balance amount is taxable under the salary head of income. When it comes to employee contribution, you have to ignore it, but you can claim deduction under section 80C for employee contribution. When there is interest up to 9.5% per annum, it is exempt, balance amount of interest will be taxable. Sir, what about maturity? maturity. Maturity is generally exempt. However, if you withdraw the money within 5 years, then the maturity will be taxable. But for this 5-year condition also, there are some exceptions. What is the exception? Number 1, you can transfer the money from recognized provident fund to new employer recognized provident fund, or you can transfer money from RPF to National Pension Scheme, that is NPF, or you can withdraw due to any of the 3 reasons, that is ill health, discontinuance of employer business, or any other reason beyond the control of employee. So if all these conditions are satisfied, any of these conditions are satisfied, then maturity will be exempt even if the amount is being withdrawn within 5 years. After 5 years, however, it is exempt, not a problem. Okay, so I hope you are clear. Now let us talk about unrecognized provident fund. Unrecognized provident fund, employer contribution is not taxable. Employee contribution also you should ignore, but in case of unrecognized, there is no ATC deduction also. Then interest also is not taxable, but maturity will be taxable. Employer contribution not taxable, employee contribution ignore, there is no ATC deduction also, interest also not taxable, but maturity will be fully taxable. How to tax the maturity, sir? In the maturity amount, no, you have to divide it into 4 parts. Okay, so first part is employer contribution, second part is employee contribution, third is interest on employer contribution, fourth is interest on employee contribution. So now employer contribution and interest on employer contribution will be taxable under salary head of income. Then interest on employee contribution will be taxable under income from other sources head of income, and employee contribution is never taxable because it is the amount spent by the employee. Okay, so this is the taxability of unrecognized provident fund on maturity. And you know what? If a recognized provident fund is withdrawn within 5 years, I told you, no, it is taxable. If the conditions are not satisfied, it will be fully taxable. Then that also will be taxed like this only. So even recognized provident fund, if it is withdrawn within 5 years, it is taxed the same way as unrecognized provident fund. However, sometimes some amount will already have been taxed. For example, in recognized provident fund, if the contribution is more than 12%, already it would have been taxed. So if any amount has been taxed already, that much amount you don't tax during the time of maturity. So let me read the sentence for you. Maturity of a recognized provident fund is taxable if it is taxable due to not satisfying the condition, it will be taxed in the same manner as unrecognized provident fund. However, the amount already taxed, if any, will not be taxed once again. So the next paragraph you can cut because I have repeated it again in the next page. 2 times it has come in your book. Fine. So now recognized provident fund over, unrecognized provident fund over. Now let us discuss about public provident fund. So for public provident fund, employer contribution not applicable. Then employee contribution you can claim deduction under section 80C. Interest is exempt, maturity also exempt. Now let's talk about superannuation fund. Superannuation fund can be approved or unapproved. First let us talk about approved superannuation fund. Approved superannuation fund, employer contribution fully exempt. Then employee contribution can be ignored. However, employee can claim ATC deduction. Then interest will be fully exempt. Maturity also is received on death or retirement. It will be fully exempt. Then unapproved superannuation fund. Unapproved superannuation fund is taxed the same way like unrecognized provident fund. So for them both, it is the same treatment. Okay. So I hope you are clear. Now let's talk about second level Kanna. So first level we have studied. Now let us see second layer. What is the second layer? Second layer is the perquisite as per section 17(2)(7), which is excess employer contribution. There is one more section called section 17(2)(7), which says that aggregate of employer contribution in any of the following in excess of 7,50,000 shall be taxable perquisites. And what are the 3? Recognized provident fund, national pension scheme, approved superannuation fund. If all the 3 funds combined, if the employer contribution is more than 7,50,000, then the excess amount will be taxable in the hands of employee. So maximum 7.5 lakhs. So first level, what did we see? 12% of salary. Correct. What is the second level? Second level is that recognized provident fund plus NPS plus approved superannuation fund. All the 3 put together, 7,50,000. If it is more than 7,50,000, then the excess amount is taxable. Moreover, section 17(2)(7)(a) tells that whatever amount has been taxable due to 17(2)(7), which is excess of 7.5 lakh rupees, then interest on such amount also will be taxable under 17(2)(7)(a). Okay, and not only in the same year, next year also whatever interest is coming because of the previous year's taxable amount will also be taxable. So if a perquisite is taxable under section 17(2)(7), annual accretion, that is interest, on such amount by way of interest, dividend or any other amount of similar nature shall be considered as a perquisite in the hands of employee. So first, what did I say? Amount in excess of 12% is going to be taxable in recognized provident fund. Then what did I say? Second layer. Second layer, I told you that if any amount of employer contribution in all the three funds combined is more than 7.5 lakh rupees, then the excess amount is going to be taxable. And third layer is the interest. Interest on such excess amount also is going to be taxable. And next year also whatever interest is received on the taxable amount as well as interest. So interest on the taxable interest also will be taxable. Sir, this 7.5 lakh rupees easy to calculate, but how to calculate this taxable interest? For this, it is sounding complicated. No, the formula is also complicated. So what is the formula? To calculate the taxable interest under section 17(2)(7)(a), you have to apply a formula. So the formula is PC divided by 2 multiplied by R plus PC1 plus TP1 multiplied by R. So PC, what is TP? TP means taxable perquisite karna. Taxable perquisite under section 17(2)(7)(a). So TP means taxable perquisite. Then is equal to PC divided by 2. So what is PC? Perquisite contribution. Perquisite contribution means the contribution which is more than 7.5 lakh rupees. So that is only perquisite contribution. So perquisite contribution divided by 2 multiplied by R. R means what? R means rate. And rate means I divide by F average. How to find out the rate? I divided by F average. So income divided by average of funds. Income of funds divided by average of funds is equal to rate. So what is I? I means income. Income means what? The aggregate income from RPF, NPS and approved superannuation fund combined. And then what is F average? F average means average of funds. So you have to take what is the opening balance, then add the closing balance, divide by 2. That only will give you the fund average. So what did I say? That first TP, taxable perquisite, is equal to PC divided by 2 multiplied by R plus PC1 plus TP1 multiplied by R. Sir, now what is this PC1? What is this TP1? PC1 and TP1 means this section Nogana, it was started from 1/4/2020 onwards. So from 1/4/2020 till 31/3/2025, what are all the PC you have to add it together. So it will become PC1. Similarly, from 1/4/2020 to 31/3/2025, what are all the TP that you had find out in that year, you have to add all of them together. That is only TP1. So PC1 means the sum of PC of the past years and TP1 means sum of the taxable perquisite of the past years. And here also you have to multiply by R. So once again, what is TP? Taxable perquisite is equal to PC divided by 2 multiplied by R plus PC1 plus TP1 multiplied by R, where PC is equal to perquisite contribution during the year, R is equal to I by F average, means income of funds divided by average of funds. Income of funds means the interest received during the year, and average of funds means opening balance plus closing balance divided by 2. Then what is PC1 and TP1? PC1 and TP1 means sum of all the perquisite contribution of all the years from 1/4/2020 onwards, and TP means sum of TP1 means all the sum of all the taxable perquisite in all the years from 1/4/2020 onwards till the preceding previous year multiplied by R. So this formula you have to remember and apply it. There is one question in your study material, beautiful question. Definitely solve that question to get a grip over this formula. Okay, if you solve the question, no, then it will become very, very easy. And formula you have to remember for sure. Now let's talk about excess employee contribution. This is level number 4 karna. So first level means the 12% level, okay, of RPF. Second level is 7,50,000 kamala. However, how much ever employer contribution is there, that will be taxable. Then third level is the interest on such employer contribution also will be taxable. And fourth level, interest on excess employee contribution also will be taxable. So now let us read. Exemption under section 10 clause 11 and 10 clause 12 shall not be available in case of employee contribution. Can employee contribution be taxable? Answer is no. Employee contribution is only the amount spent by the employee, hence it is never taxable. But interest on employee contribution is going to be taxable if the employee contribution is more than 2,50,000 rupees per annum. So if employee contribution is more than 2,50,000 per annum, then on the excess amount, whatever interest is coming, it is going to be taxable. However, if employer is contributing, then it is 2,50,000. But if employer is not contributing, then the employee can contribute 5 lakhs also, not a problem. So if employer is contributing, then up to 2,50,000 only can be contributed. But if employer is not contributing, then up to 5 lakhs can be contributed by the employee. Balance amount is there, no? On that the interest is going to be taxable. So in such case, what should the employee do? The employee will maintain two accounts. the employee will maintain non-taxable contribution account and taxable contribution account. In non-taxable contribution account, they will have closing balance as on 31/3/2021. You know why? Because this section started from 1/4/2021 onwards. 1/4/2021 onwards. Plus contribution made which is not taxable. That is up to 2,50,000 or 5 lakhs as the case may be. And whatever is the interest on above has to be taken in the non-taxable account. Then in the taxable account, first you take contribution on or after 1/4/2021 exceeding the limit of 2,50,000 and 5 lakh rupees plus interest on the amount minus withdrawal from the account. So Kanna, this part is there, no? Practically it is not going to be tested in your examination. If at all, theoretically it can be tested, or if practical question comes for the employer contribution part, that is 7.5 lakh rupees, this TPPC and all, then you also have to write about the employee contribution. Okay, so this same question, if you see in their study material, no, the same question, you will also have a note about this employee contribution. Make sure to read that note also so that you are thorough with the provision. Now let's talk about Agniveer Corpus Fund. Whatever amount has been contributed to Agniveer Corpus Fund, entire amount should be added to the salary head of income. So employer contribution added to the salary head of income. However, in the deduction chapter, we are going to learn that amount is allowed as deduction. So employer amount first you add to salary head of income. Later on, you can claim the deduction in the deduction chapter. Fine. Agniveer Corpus Fund. Now let us discuss the perquisites under the salary head of income. Let's start with the fully exempt perquisites. Firstly, section 10 clause 7 is there, which tells that if the Indian government is giving any perquisite to an Indian citizen outside India, it is fully exempt for that Indian citizen. Then, if the employer is providing any telephone to the employee at his residence, that is also fully exempt. Then, any transport facility provided to airline or railway employees, that is also fully exempt. Then, training of employees or any amount paid for management course, including the expense of boarding and lodging, also fully exempt. So management training fully exempt. And then rent-free official residence provided to High Court and Supreme Court judge in the old regime, it is fully exempt. And then conveyance facility provided to High Court and Supreme Court judge in the old regime, it is fully exempt. So these are all the fully exempt perquisites. Now let us talk about partly exempt perquisites. Partly exempt perquisites means what? Some part of the perquisite might be exempt, some part of it might be taxable. So let us discuss. Firstly, let us discuss the 5 perquisites which are fully exempt for the non-specified employees, only taxable for specified employees. Okay, the 5 perquisites we are going to see, starting with motor car facility. So motor car facility, very important from examination point of view. Multiple times it is tested, maybe for 1 marks or maybe a full question also can come. Motor car facility means what? The motor car is provided to the employee for driving for the official purpose. It can be personal also. So if at all the motor car is used for fully official purpose, if only it is used for official purpose, in such case it is fully exempt. The facility is not taxable. For this, how to prove that it is official purpose? So for that, the employer should maintain the details of the journey undertaken for official purpose. Employer should also give a certificate that the expenditure was incurred wholly and exclusively only for performing the official duties. So if employer is giving this declaration, in such case, then the entire perquisite is exempt in the hands of employee. Okay, but what if the employee is only using for personal purpose? If the employee is only using for personal purpose, then first let us see whether the employer has provided his own car or employer has provided a hired car. Means employer has taken the car on rent and given to employee. If the employer is only having the car, if it is own car, in such case 10% of the cost of the car will be treated as perquisite in the hands of employee, and over and above that you also have to add the driver salary which is paid by the employer, and also the running and maintenance expenses paid by the employer. Running and maintenance expense means fuel expense, insurance expense, repair expense, etc. So if there is employer's car, then 10% of the cost plus driver salary plus running maintenance expense. However, if it is a hired car, then you have to take what is the higher charges paid by the employer, that will be treated as perquisite in the hands of employee, plus driver salary plus running and maintenance expenses. But you know what, in examination they don't ask official purpose, they don't ask personal purpose, they only ask partly official, partly personal purpose. So this is only more important from examination point of view. So partly official, partly personal purpose, it means what? The employee is using for personal purpose also, For official purpose also, in such case what to do? In such case you have to see whether the car belongs to the employee or car belongs to employer. If car belongs to employee and running and maintenance expense also is paid by employee himself, then there is no perquisite at all, because all the expense are by employee himself. That is why it is not taxable. But if car belongs to employee, running and maintenance expense alone, if it is paid by employer, then you have to see what is the charges paid by the employer. From this charges paid, you have to reduce 1800 per month or 2400 per month as the case may be. The balance amount will be treated as perquisite. Sir, when 1800 per month, if the car capacity is up to 1600 cc or up to 1.6 liter engine, it is 1800 per month. And if it is more than 1600 cc or more than 1.6 liter engine, then you have to take 2400 per month. So what you have to do, if the car is employee's car but running and maintenance expense is paid by employer, then first you take what is the charges paid by employer. From that you reduce 1800 per month or 2400 per month as the case may be. So you will get the perquisite value. Then what if the car is employer's car and running and maintenance expense is paid by employee? If car is employer car, running and maintenance is paid by employee, in such case the perquisite value shall be 600 rupees per month up to 1600 cc car and 900 rupees per month for more than 1600 cc car. So 600 per month or 900 per month as the case may be. Then last one, if the car is the employer car and running and maintenance also paid by employer only. So this is only most important, most frequently asked in the examination. Car also employer car and expense also paid by employer. In such case what to do? Then the perquisite value shall be 1800 per month or 2400 per month as the case may be. So this is the perquisite calculation. Over and above that, if the employer is also giving driver, then for the driver, don't include driver salary kanna. For driver you should only include 900 rupees per month. 900 rupees per month. So this is the calculation of motor car facility. This motor car facility will be fully exempt for non-specified. It is only taxable for specified employees. Now let us talk about education facility. This is also fully exempt for non-specified. Now let's talk about specified employee. In case of specified employee, if the employer is sponsoring the education of employee himself or herself, in such case it is fully exempt. But other than that, if he is sponsoring for employee children, then what to do? Then there are two conditions kanna. If both conditions are satisfied, it is fully exempt. If one of the condition also not satisfied, it is fully taxable. Fully taxable. What are the condition? The value of education should be up to 1000 rupees per month per child. 1000 rupees per month per child. And second condition, the school should be either employer's own school or it should be a tie-up school. So either employer himself should be having the school or it should be a tie-up school of the employer. In such case, if both conditions are satisfied, then the education of children is also facility is exempt. Otherwise, it is fully taxable. Fully taxable. Kanna, sir, this up to 1000 rupees per month per child you told, no? What if the education is 2000 rupees per month per child? Then what will happen? In such case, the 2000 rupees per month per child, entire amount will be fully taxable. Okay? This 1000 itself you should not take. If it is excess, entire amount will be taxable. Kana in salary chapter, no, you have three places. Okay, first place is this education. Second place is gift. There also we will be learning that gift up to 4999 is exempt. More than 4999 will be fully taxable. And then you will have meals, where up to 50 rupees per meal it is exempt. More than 50 rupees fully taxable per month per child. In all these three cases, you are having an option. Okay, there are two methods to solve the question. Both methods are correct karna. Either you can take up to 1000 exempt and balance amount will be taxable. That method also you can follow. Or you can follow the method where if it is within 1000, it is fully exempt. If it is above 1000, it is fully taxable. That method also you can follow. Similarly, when it comes to gift also, if it is up to 4999, it is fully exempt. Above 4999, it can be fully taxable also, or only the excess amount is taxable. Like that also you can solve the answer. Similarly, if it is meals, up to 50 rupees per meal, it is fully exempt. Above 50 rupees per meal, it is fully taxable. Like that also you can solve. Or up to 50 rupees exempt, balance amount is taxable. Like that also you can solve. It is totally your wish. Fine. However, I teach to my students only one method, that is in all the three cases, if it is up to 1000 rupees per month, then it is exempt. If it is exceeding, then tax the entire value. Entire value has to be taxed. In case of education also, gift also, meals also. So all the three cases you remember, I am not going to repeat once again. So in case of education, for children, if the value of education is up to 1000 rupees per month per child, and if it is an employer school or tie-up school, it is exempt. Otherwise, it is fully taxable. And what if the employer is sponsoring any other person's education? In such case also, it is fully taxable. Now let's come to free tickets. Okay, well, in case of non-specified employees, free ticket is fully exempt. But in case of specified employee, then if the employee is an airline or railway employee, then whatever amount is received, whatever ticket is received from the respective airlines or railways will be fully exempt. But other than airline or railway employees, it will be fully taxable. Okay, so if Indigo Airlines employee is getting Indigo ticket, then that Indigo ticket amount is fully exempt for them. If railway employee is receiving railway ticket, it can be privilege ticket also, then also it is fully exempt. Now let's talk about domestic servant. This also I told you, sweeper, gardener, watchman, personal attendant, it is exempt in the hands of non-specified employees, but taxable in the hands of specified employees. So if salary of domestic servant, if it is paid by employee and reimbursed by the employer, then it is an obligation of the employee met by employer. In such case, it is taxable for both specified as well as non-specified. This also we had already discussed. Then gas, electricity, water supply. This also we have already discussed. If it is directly paid by the employer, then it is exempt for non-specified, taxable for specified. But if it is not directly paid, instead if it is reimbursed by the employer, then it is an obligation of the employee met by the employer. Then it will be taxable for both specified also, non-specified also. Now let's talk about leave travel concession. Leave travel concession LTC exemption can be claimed under section 10 clause 5 under the old tax regime, not allowed under section 115 BAC. So only old tax exemption is allowed. In new tax regime, that is default tax regime, exemption is not allowed. Exemption is not allowed. Fine. So what is the value of exemption for leave travel concession? First, whatever amount is LTC, you put it in the salary head of income. From that, you reduce the exemption under section 10 clause 5. If the travel has been taken through air, okay, aeroplane, in such case, exemption will be economy fare of the national air carrier, Air India, or actual expense, whichever is lower. However, if it is other than air, then you have to see whether railway service is available for that route. If railway service is available for that route, then first class railway fare or actual expense, whichever is lower. But if railway fare is not available for that route, then you have to see whether recognized public transport system exists. If recognized public transport system exists, for example, government bus facility, in such case you have to see deluxe class fare or actual expense, whichever is lower, it will be exempt, balance amount taxable. Then if recognized public transport system does not exist, then first class railway fare of a similar distance or actual expense, whichever is lower, will be exempt, balance amount will be taxable. And here this fare is there, this you have to take only for the shortest route, and LTC expenses can be paid by the employer for employee also and employee's family member also. And here you have to be thorough with the family member definition. Who is family? Family means spouse, children, parents, brothers, sisters if they are dependent. So children, parents, brothers, sisters alone if they are dependent on the employee. And for children also there is one rule that before 1998 there can be any number of children, but on or after 1998 if the children are born, then there should be maximum 2 children. However, first if one child was born and in the second birth there are multiple births, then such children in multiple birth also allowed. For example, twins born after one child born on or after 1/10/1998. In such case, for all the children, the exemption will be allowed. So what did I say? Here, the employer can sponsor the ticket leave travel concession for employee also, for family member also. Exemption can be claimed for both employee also, for family members also. Who is family member? Family member means spouse plus children plus parents, brother, sister if dependent on the employee. And here there is a maximum limit on the children. If the children are born before 1/10/1998, then there is no limit. But if the children are born on or after 1/10/1998, in such case maximum 2 children. However, if first child is born and in second birth, if there is multiple birth, so twins are born or triplets are born, in such case multiple birth also will get the exemption benefit. But sir, what if first there is multiple birth, sir, then one child is born, then can all child claim exemption? Answer is no. If there is multiple birth in the first birth itself, then the parents should have stopped there itself. They need not plan the third kid. That is why after multiple birth, whatever children is there, for that it will be taxable. Fine. So in our regular batch, we generally have a comedic discussion, long discussion about this LTC, but definitely in revision lecture, all of that is not possible. So be thorough with the family definition. Okay. Leave travel concession. This benefit of exemption is there, Nukanna. It is allowed only 2 times in a 4 calendar year block. So what is the block going on now? Now what the block going on is 1/1/2022 to 31/12/2025, which is for your examination. So between this period, for 4 years, for 2 times LTC benefit can be claimed. More than 2 times it cannot be claimed. But sir, what if it is claimed less than 2 times? Can I forward the LTC to the next block? Answer is yes. If you claim less than 2 times, then maximum 1 LTC you can carry forward to the next block, and in next block you can claim 3 times also. That is also allowed. So if one or both of the LTC is not available in the entire block, then 1 LTC can be carried forward to the next block. And here there is a condition that the travel should only be within India. For foreign travel and all, LTC benefit is not allowed as exemption. Then LTC can be given after retirement also, still exemption can be claimed. LTC to High Court Judge and Supreme Court Judge is fully exempt in the old tax regime. In new tax regime, it is fully taxable. Fine. So this is the relief travel concession. Now let us talk about medical facility. Medical facility no karna, for examination point of view, I feel it is very important, because separate question can also be asked. It can be asked for 1 or 2 marks in total income question also. It can come in multiple choice question also, and there is amendment also. That is why it is one of the favorite question for May 26, September 26, Jan 27. So listen carefully. Medical facility karna. Firstly, let us talk about treatment in India. What happens if the employer is either sponsoring or himself he is giving the treatment of the employee or family members in India? Here, employee can also get the treatment, family member can also get the treatment. Sir, who is family member? This family member definition is there, no? It is similar to LTC, that is spouse plus children plus parents, brother, sister if dependent on the employee. But here it is a medical purpose, that is why there is no limit on the number of children. Okay, wow? So spouse, children, parents, brother, sister if dependent on the employee. So they can claim the benefit. And here you have to be thorough with family definition, because if they give the question in the examination, no, they will be playing with that only. See, they will give, what if the treatment for grandfather has been done, can the benefit be claimed? Answer is no. For grandfather, the grandfather is not considered as family member as per this definition, that is why no benefit. Sir, what if sister is there but sister is not dependent? In such case, can the benefit be given? Answer is no. It is not exempt, it will be fully taxable. But if the benefit is given to children, and if children are not dependent, still can the children claim the exemption? Answer is yes. Children need not be dependent karna. Our parents, brothers and sisters need to be dependent on the employee. So be very thorough with the family definition. Now let's talk about the provision. When can exemption be claimed? Treatment is fully exempt if any one of the conditions are satisfied. So there are 4 conditions. If any one condition is satisfied, then the treatment expense which is sponsored by the employer will be fully exempt. So what is the first? Treatment should be in employer's own hospital. Let's say the employer itself is Apollo Hospital and the employee treatment is sponsored in Apollo Hospital. In such case, it is not taxable in the hands of employee. Then treatment in government hospital. Government hospital also includes local authority and approved by government. So if it is a government hospital or approved hospital, and if treatment is done in that hospital, then it is fully exempt, not taxable. Then in respect of prescribed diseases, if there is any prescribed disease like cancer, etc., in such case, sometimes in government hospital, no, treatment will not be given. In that case, principal chief commissioner or chief commissioner will give approval for the private hospitals. In that approved hospital, if you go and get the treatment done, then it is fully exempt. Even if employer is sponsoring, it is not taxable. Then in respect of illness related to COVID-19, subject to conditions. So subject to condition, even COVID-19 treatment will not be taxable. So what are the 4 conditions? Either treatment should be done in employer hospital or in government hospital, or it should be a prescribed disease and approved hospital. In such case, the treatment sponsored by the employer will be completely exempt, or else it will be taxable. Then, sir, what if treatment is done outside India? If treatment is done outside India, first let us talk about treatment expense and stay expense. Then we will talk about travel expense. Okay, wow. First, what about treatment and stay? If treatment and stay for foreign medical treatment is sponsored by the employer, in such case, actual expense by the employer for treatment subject to RBI limit will be exempt. So up to RBI limit, it will be exempt. If it is above RBI limit, it will be taxable. But what about travel, sir? Traveling from India to the foreign country. For that, you have to see what is the gross total income of the employee. If the gross total income is up to 8 lakh rupees, then it is exempt. But if gross total income is more than 8 lakh rupees, then the travel expense will be treated as perquisite in the hands of employee. So once again, I am telling, for treatment, sir, who can get treatment? Employee can get treatment and family member can get treatment. On for whom the employer can incur expense? Employer can incur expense for the patient also and 1 attendant. Maximum 1 attendant can go. So patient plus 1 attendant, treatment expense plus stay expense up to RBI limit will be exempt. And in case of travel, if the gross total income of the employee is up to 8 lakh rupees, then the travel is also exempt, or else the travel will be taxable in the hands of employee. Fine. So I hope you're thorough. Now let's talk about insurance. What if insurance premium is paid by employer? So if health insurance is paid by employer, it is fully exempt. Then if health insurance is paid by employee and if it is reimbursed by employer, then also it is fully exempt. Personal accident policy also exempt, staff group insurance also exempt. But remember, life insurance fully taxable. So health insurance exempt, reimbursement of health insurance exempt, personal accident policy exempt, staff group insurance policy exempt, but life insurance policy taxable. Life insurance policy taxable. Okay, wow. Then here hospital includes dispensary and nursing home also. So both of them also will be considered as hospital. Then so this is medical facility. Now let us talk about free food. If food is sponsored by employer, then how to tax that food? First, let us talk about alcoholic beverage. Alcoholic beverage is always fully taxable. Fully taxable. Then tea, coffee and refreshments. So tea, coffee, bhaji, bonda, snacks, whatever is given by the employer, it is fully exempt. It is not taxable. What about other than that? If full meals has been sponsored by the employer, in such case, you have to see whether the employee is working in a remote area. If employee is working in remote area, it is fully exempt. But if employee is working in normal area, then you have to see whether it is default tax regime or old tax regime. If it is default tax regime, it is always fully taxable. But in old tax regime, up to 50 rupees per meal, up to 50 rupees per meal, if it is directly given or given in the form of voucher, it will be exempt. And if it is more than 50, it is fully taxable. So up to 50, it is exempt. More than 50, fully taxable. Okay. Now let's come to club facility. Club facility is given by employer to employee. Firstly, let us talk about fitness club. So if fitness club facility is given, like health club, sports club or similar facility is given to all the employees in general, then in such case it is fully exempt. But other than fitness club, if it is given, then you have to see whether the employer has taken corporate membership or other than corporate membership. If the employer has taken corporate membership no kanna, then you cannot find out what is the per employee cost, because corporate membership will be a lump sum amount. Hence, initial expense by the employer will be exempt, but remaining expense will be taxable. Remaining expense will be taxable because in initial expense you cannot find out what is the per employee cost, because it is a lump sum amount. So initial expense, it is exempt, but remaining expense, if the employer incurs any additional expense on behalf of the employee, that will be taxable. And in case of any other case, whatever expense is incurred by the employer will be taxable in the hands of employee. But here also, this club is there, no? It can be for official purpose. Official purpose means what? The employer should maintain the details of expense for official purpose, and the employer should give a certificate that the expenditure was incurred wholly and exclusively for official duty. If both conditions are satisfied, then this club fee amount is there. No, it is not taxable. So only if it is not official purpose, it will be taxable. The same condition we also saw in motor car facility already. Same we are also going to see one more time in credit card facility. So in all these three facility, this official purpose is there. Now let's talk about travel, tour or accommodation sponsored by the employer other than LTC. So other than LTC, if the employer is sponsoring a tour, you have to see whether it is an official tour. If it's an official tour, then whatever amount is spent for the employee will be completely exempt. But if they are spent for employee's family member, it will be taxable. Okay, but if it is an official tour extended to vacation, so first official tour was there, later on it is extended to vacation, then in such case official stay is there, no, that will be exempt, but vacation stay will be taxable. Then what if it is not official tour? If it is not official tour, then whatever amount is incurred, no, that will be taxable as perquisites. Now let us talk about credit card. So credit card also I told you, membership fees, annual fees, reimbursement of credit card expense is fully taxable. However, if credit card expense has been incurred for official purpose, it will not be taxable. Now let us talk about other taxable perquisites. Let us start with rent-free accommodation. Rent-free accommodation is important, very important, very important from the examination point of view. So let us discuss this. In your institute study material, this will be at least for 8 to 10 pages, this one discussion. But I have tried to sum it up all in just one single chart so that it is very easy for you to memorize. So I have done my hard work. Now you have to do your hard work of by hearting all this. Okay, wow. So rent-free accommodation. Rent-free accommodation means what? The accommodation which is given to the employee by the employer, where the employee will either not pay any rent or the employee will pay just some concessional amount of rent. That is only rent-free accommodation. You can also call it as RFA. Okay, wow. Now for this RFA, you have to see whether government employee is getting or other than government employee is getting. For government employee, the license fee prescribed will be treated as taxable perquisite. Listen Kanna, for RFA, no, there is no exemption at all. Fine. So don't get confused. In case of government employee, there is no exemption. We are only discussing how to calculate the value of perquisite. Okay. So value of perquisite is equal to license fee prescribed by the government. So whatever is license fee, that will be taxable in the hands of employee. Now other than government employee or a government employee where there is no license fee available. So how to calculate? First you see whether the property is a employer property or other person's property. Employer property or other person's property. If it is the employer property, then you have to calculate 5% or 7.5% or 10% of salary as the perquisite. So 5%, 7.5% or 10%. 5% if the population was up to 15 lakhs, 7.5% if the population was up to 40 lakhs, and 10% if the population is more than 40 lakhs. So in the examination, if you get any city like Mumbai, Delhi, Chennai, Kolkata or such cities, Bangalore, etc., there definitely the population will be more than 40 lakhs. So don't put an assumption and all that I assume that the population is going to be more than 40 lakhs and solve the question. Directly you can solve the question, no problem. But if it is some other city, then the population will be given. Okay, don't worry. So if population is up to 15 lakhs, 5% of salary will be perquisite. If population is up to 40 lakhs, 7.5% will be perquisite. If population is above 40 lakhs, 10% of salary will be perquisite. And here what is salary, Kanna? Here salary is a definition that you have to memorize, and that is ABBCDM minus AAPR. So ABBCDM minus AAPR. It means what? Take all the allowances that are taxable. All the allowances that are taxable, then basic salary, bonus, commission, and here you have to take both commission, turnover also, other than turnover also. There is no differentiation. But in dearness allowance, you have to take only DA in terms. DA in terms. So commission means all the commission, but DA means only the DA in terms. Then all the monetary payments, but do not include advance salary, arrears of salary, perquisites, PF contribution by employer, retirement payments. So what you should take all the taxable allowance, basic salary, bonus, commission, DA in terms, and all the other monetary payments. But don't include advance salary, arrears of salary, perquisites, PF contribution by the employer, and retirement payments. So this should not be included. So what you should take, one more time, very, very important. So what you should include: allowable taxable allowances, basic salary, bonus, commission, both commission, then DA in terms, and then all the monetary payments. But don't include advance salary, arrears of salary, perquisites, PF contribution, and any other retirement payment should not be included. So this definition you have to remember. Multiplied by 5%, 7.5%, 10% as the case may be, will be the value of the perquisite. Then what if it is other person's property? In such case, the employer will be paying the rent. No. So see what is the rent paid by the employer and compare it with 10% of salary. Here also salary definition is the same. Whichever is lower will be the perquisite. So 10% of salary or rent paid by employer, whichever is lower will be the perquisite value. Then after finding out this value, you also have to add the value of the furniture that has been provided by the employer. How to add the value of furniture? You see whether the furniture is the employer furniture or it is other person's furniture. If it is employer furniture, then 10% of cost of furniture will be the value of perquisite. If it is other person furniture, then the higher charges paid by the employer will be treated as perquisite. Okay, so first take RFA value, then add furniture value, then you have to reduce the rent recovered. So RFA value plus furniture value, then reduce the rent recovered from the employee. Rent recovered means what? Whatever rent is being paid by the employee, that you have to reduce. So after doing this calculation only, you will find out the RFA value. So RFA means what? Rent free accommodation is equal to RFA perquisite value plus furniture value, okay, minus rent recovered. With this formula, you will find out what is the final RFA value. From this, you also have to do comparison with the last year inflated amount. So for example, last year, whatever rent-free accommodation value was there, that you have to do the indexation and bring it to current year price. So how to do that? See the whatever is the value of the perks last year multiplied by cost inflation index of the previous year, that is 376, divided by cost inflation index of preceding previous year, that is 363. Sir, should I remember this? Answer is yes. Please remember this. If at all they don't given the question, you should be able to answer. Mostly they will given the question, but still if they don't given the question, you should be able to answer. So perks in the preceding previous year multiplied by cost inflation index of the previous year divided by cost inflation index of preceding previous year. So perquisite value, whatever you are getting for previous year, 2425, correct? 25 multiplied by 376 divided by 363. So this is the maximum perks in the current year. So if whatever value you are getting after doing this calculation, if it is more than the maximum value, then restrict it to the maximum value. So maximum perks can be how much? Previous year 2425 value multiplied by 376 divided by 363. So this is the formula. So once again I am telling you how to find out RFA. First find out the perk value of the property, then add the perk value of furniture, then reduce the rent recovered by the employee. Whatever value is there, that value you compare it with the inflated value of the preceding previous year. So how to find out that inflated value? Take the preceding previous year value multiplied by 376 divided by 363. So you will get the value. This is the maximum perks during the previous year. So if the calculated perks is more than the maximum perks, then restrict the perks amount to the maximum value. So like this you have to do the calculation. Then salary should only be taken for the period during which the employee was occupying the accommodation. Then if the employee is transferred and given two accommodations, so for example, let's say employee is living in Chennai, now transferred to Mumbai. So in Chennai, family and all will be there, no? So sometimes employer will give two houses, one house in Chennai also, one house in Mumbai also, for a temporary period. In such case, what to do? For the first 90 days, whatever is the lower value, that you tax it. However, after 90 days, both accommodations will be taxable. Both will be taxable. Rent-free accommodation is fully exempt for High Court and Supreme Court judge in the old regime, not in the new regime. Fine. So this is the rent-free accommodation. Now let's come to hotel facility. So hotel facility, very simple. The employer is sponsoring the hotel stay of the employee. In such case, taxable perquisite is equal to 24% of salary or rent paid by the employer, whichever is lower. So 24% of salary. So here, what salary we have to take? The salary is the same as rent-free accommodation. That is ABB, CDM. Don't include AAPR. Okay, taxable allowance, then basic salary, bonus, commission, DA terms, monetary payments. Don't include advance salary, arrears of salary, retirement benefits, and provident fund payment, etc. So that you have to remember. So this salary you have to take for what period? The period for which the employee is staying in the hotel. For that period you have to take multiplied by 24% or rent or charges paid by the employer, whichever is lower. It will be the perks value. In case of transfer of employee, perquisite is fully exempt if the hotel stay is up to 15 days. So if the employee is getting transferred 15 days varikum, there is no perquisite. Above 15 days only there is perquisite. Salary shall be taken for the period during which the employee is staying in the hotel. Now let's talk about loan for concessional interest. Concessional interest loan means what? The employer is giving a loan to the employee, and on that loan, either the employer is not at all charging any interest or the employer is charging a very low interest. In such case, what to do? Whatever interest difference is there, it will be treated as perquisite. So how to calculate? Taxable perquisite is equal to loan value multiplied by SBI interest rate as on the first day of the previous year. SBI means what? State Bank of India. So State Bank of India interest rate minus actual interest rate. Okay, this calculation has to be done at the end of every month and all the amount should be added up. So every month end this calculation has to be done. That is loan value multiplied by SBI interest rate minus actual interest rate. Then add up all the monthly value, you will get the total value of perquisite. Okay, this loan can be given to the employee or any family member also. Now, there are two cases where no need to tax this interest perquisite. Case number 1, where the loan value is up to 20,000. Case number 2, the loan is given for specified disease like cancer or tuberculosis, etc. In these two cases alone, no need to tax the perquisite value. Now, let us talk about gift, voucher or token given by the employer to the employee. So, if gift is given in money form, it is fully taxable. If employer is giving gift in money, fully taxable. But if it is other than money, if it is given in kind, then up to 4,999 it is fully exempt. If it is 5,000 or more, it is fully taxable. Up to 4,999 exempt, 5,000 or more fully taxable. Now let's talk about specified security. Specified security means what? Sweat equity. Sweat equity means the company is giving its employees the company's own shares at a very concessional price. Let's say the market value of shares is 1,000 rupees, but they are giving only for 200 rupees. Market value 1,000 rupees, but they are giving only for 200 rupees. In such case, the balance 800 is there, which is market value minus exercise price. This 800 will be treated as perquisite. Okay, so it means shared offered at concessional rate. Taxable perquisite is equal to fair market value as on the date of exercise minus issue price. How to calculate this fair market value, sir? First, we have to see whether the shares are recognized in stock exchange or not recognized in stock exchange. If it is recognized in stock exchange, then you have to see as on the date of exercise whether it was traded or not. If it was traded, then fair market value is equal to opening balance plus closing balance divided by 2. Opening balance plus closing balance divided by 2. But if it was not traded on the stock exchange, then you have to see only the closing balance on the last date on which the trading previously took place in the highest volume stock exchange. Okay, so if during the date of exercise, if trading has taken place, which stock exchange you have to choose where there is highest volume? Go to that stock exchange, take opening price and closing price, do divide by 2. That is only the fair market value. If trading has not taken place, take the previous date on which trading took place, take the closing price alone. No need to take average. Then if buy price is given, sell price is also given in the question, then just take the sell price and solve the answer. Then what if the shares are not recognized in stock exchange? In such case, fair market value is the value that is determined by the merchant banker. Value determined by merchant banker on the exercise date. But sir, every day and all, it is not possible to get the value of merchant banker. That is why this merchant banker value can be up to 6 months old also. Up to 6 months old also. So if above is not available, then fair market value is the value determined by merchant banker, not being a date which is more than 180 days earlier than the exercise date. So up to 180 days old value is also acceptable if it is not recognized in stock exchange. Then now let's talk about employee of a startup. If the employee is employee of a startup, in such case, they can postpone the taxability of this sweat equity shares. How can they postpone? See here, if an employer is an eligible startup, then the above perquisite shall be taxable in the year after the expiry of 48 months from the end of relevant assessment year. So come to the end of the year, from there you calculate 48 months. So for previous year 25-26 up to 31/3/2031, no need to pay the tax on the perquisite. Then or the year in which the sale of such security or share is made by the assessee. Let's say before this 31/3/2021 itself, the employee has sold these sweat equity shares to some other person. Then in such year it will become taxable. And lastly, in the year in which the assessee ceases to be the employee of the employer. So let's say up to 2031 it is not taxable, I told you, no. But in 2027 itself the employee has quit the organization. Then in 2027 it will become taxable. So what did I say? 48 months, or sale of share is made by the employee, or employee ceases to be the employee of the organization. In such case, whichever is earlier, it will become taxable. So what did we see? In case of eligible startup, the sweat equity amount is taxable. However, the taxability can be postponed to a future date. Then fair market value of shares will be there, no, they will become the cost of acquisition for the future capital gain purposes. So Kanna, listen here, let's say employer is giving 1000 rupee fair market value shares, but exercise price is only 200 rupees. So how much is the employee paying to the employer? Only 200 rupees is being paid. So what will be the cost? The cost will be 200 rupees per share in the hands of employee. However, in the salary head of income, the employee is considering 1000 rupees as fair market value, and balance difference of 800 rupees he is paying the tax. He is paying the tax under salary head of income, correct? That is why, as per Income Tax Act, even though he has paid only 200, but since he has considered 1000 rupee fair market value to pay the tax, that is why 1000 rupees will become his cost of acquisition for future. The same concept I am also going to explain you in capital gain revision. There also we will see that if at all you are receiving some amount or some security, for that security you have considered some other value and paid the tax on that value, then that fair market value will become your cost. It will become your cost. So fair market value of shares will become the cost of acquisition of such shares for future purposes. So in future, whenever you are going to sell, no, at that time the cost will be taken as 1000. It will not be taken as 200. You know why? Because considering 1000, you have already paid the tax. So now onwards you can take your cost as 1000. I hope you are clear with the concept. Now let us talk about usage of movable assets. So use of laptop and computer. If the employer is providing laptop computer to employee, it is always exempt, never taxable. It is assumed by the Income Tax Act that laptop and computer is always for official purpose. That is, it is exempt. What about other movable assets, sir? Sir, listen, laptop and computer, does it include mobile phone? Answer is no. It does not include mobile phone. So laptop computer is exempt, but mobile phone will be taxable. Fine. So other movable asset, you see whether the asset given to the employee, whether it is owned by the employer or rented by the employer. If it is owned by the employer, then 10% of the cost will be the value of perquisite. If it is rented by the employer, then the amount of rent paid by the employer will be taken as the value of perquisite. Now let us talk about transfer of movable asset. So first, what did we see? Usage of movable asset means what? Employer is only having the asset. He is just giving to the employee for usage. However, now we are seeing transfer of mobile asset. It means what? The employee is getting the asset and the employee will become the new owner of the asset. Employer is giving the asset to employee that niye vechuko, it is your asset from now onwards. So that is only transfer of mobile asset. In such case, how to calculate the value of perquisite? So value of asset you have to find out. Value of asset only will become the value of perquisite in the hands of employee. So how to find out value of perquisite? For that you have to find what is the depreciated value. Depreciated value minus amount recovered by the employee. Let's say the employer has given some asset to the employee for which he has paid some amount. So that amount also has to be reduced, correct? So that net amount will become perquisite value. So how to find out depreciated value, sir? For that, if at all the asset is a computer or electronic item, for that you have to do 50% WDV method. Follow 50% WDV method. For motor car, it is 20% WDV method. For any other asset, it is 10% straight line method. So what did I say? Computer or electronic item 50% WDV method, motor car 20% WDV method, and any other asset 10% straight line method. You have to do the depreciation, and depreciation is not for financial year kanna. Depreciation is for completed year of usage. So listen, for example, the asset was purchased on 29/3/2024. In such case, 1 year will be over on which date? 29/3/2025. Okay, 2 years will be over on 29/3/2026. Fine. So if the asset is sold on 30 June 2025 to the employee, then how much year depreciation you have to minus? Only 1 year depreciation, because only 1 year is over. After 1 year it has been sold. Let's say the asset is being sold on 31/3/2026. In such case, how much depreciation you will take? You will take 2 years depreciation, because 2 years are over, 1 and 2. That is why 2 years depreciation you will take, and then only you will compare it with the, you will take it as the value of perquisite. So like that, for completed year of usage, you have to calculate depreciation. So computer and electronic item 50% WDV method, motor car 20% WDV method, any other asset 10% straight line method. So here you have to be very, very careful. This depreciation and PGBP depreciation, there is no link. Okay, this is completely different. That is completely different. Now let us talk about all other perquisites. So all other perquisites will be taxable at fair market value. Fair market value, or whatever is the amount incurred by the employer, will become the perquisite value of the employee. Now let's talk about deductions. Deductions are given under section 16. In section 16 there are 3 deduction kana. First is the standard deduction. Standard deduction is the only deduction which is allowed in old regime also, and it is allowed in new regime also. Moreover, in new regime extra benefit is given. In old regime 50,000 is the standard deduction. In new regime 75,000 is the standard deduction. So very rare case where new regime is giving extra benefit to the employee. So old regime 50,000, new regime 75,000. Now let's talk about entertainment allowance. Entertainment allowance is allowed as deduction only in case of old regime, not allowed in case of 115 BAC. So first, what you have to do, whatever entertainment allowance is received, that you have to add it to the salary head of income. Then you can claim the deduction also. But you know who can claim deduction? Only government employee can claim deduction. Other than government employee cannot claim deduction for entertainment allowance. That also, how much deduction, sir? The deduction shall be 1/5 of basic salary or entertainment allowance received, or 5,000 per annum, whichever is lower. Whichever is lower. Karna, it is not 5,000 per month, it is 5,000 per annum. So in the entire year itself, maximum deduction can be claimed as 5,000 only. So 1/5 of basic salary or entertainment allowance, or 5,000, whichever is lower. So in computation of income, first add to salary, then claim the deduction if the employee is a government employee and taking the old regime. Now let's talk about professional tax. Professional tax is the tax on employment that is to be paid to the municipal authorities. This professional tax also, it can only be claimed as deduction in the old regime, not allowed in the default tax regime. Here, what you have to do, if employer is paying the professional tax, then first add the professional tax to salary, then you can claim it as deduction. But if employee is paying the professional tax, then no need to add to the salary, directly you can claim it as deduction. And here there is no limit. Whatever amount is paid can be claimed as deduction. Now let's talk about section 89 relief. Section 89 relief is for arrears of salary. Now listen carefully, Kana. What is the concept? Let's say for the past 5 years, arrear salary has been received in the current year. Then what will happen? In current year, my income will go up like anything. Since my income goes up, I have to pay tax in the higher tax slab. That is 30% slab I have to pay the tax. But if this amount was received in that year itself, then I would have paid the tax in the lower tax slab. correct? So if arrear amount is received in same year, it will be paid in lower tax slab, but since entire amount is received in current year, I will pay the tax in higher tax slab. That is why whatever is the difference of tax, no, how much ever extra tax that I am paying, that is allowed as relief. That is allowed as relief. So first you have to calculate the tax for current year and all the arrear assessment year, including arrear and excluding arrear. Then find out what is the arrear tax. So arrear tax means what? Tax including arrear minus tax excluding arrear. That is only arrear tax. So find out the arrear tax. Then what is the relief? Relief is equal to arrear tax in the current assessment year minus sum of arrear taxes of the relevant assessment years. So that is only arrear tax. This arrear tax you can reduce from the total tax and balance amount only has to be paid by assessee. Now here you listen one very important point. Generally whatever adjustment is made, no, is made before health and education cess. For example, rebate calculation is before health and education cess, marginal relief is before health and education cess, surcharge is before health and education cess. So all these adjustments are before health and education cess. However, when it comes to relief, relief is calculated after calculating health and education cess. So in this arrear tax, you have to include health and education cess also and then solve the question. Fine. Now let us talk about the exemptions. First exemption is section 10 clause 6 subclause 2. Very, very important. Official. Now all these exemptions that we are going to discuss now are all for non-resident, non-citizen. They are not citizen of India also, they are not resident in India also. Non-resident, non-citizen can claim these exemptions. So first exemption is for official of an embassy, high commission, legation, consulate or trade representative of a foreign state. So from foreign country, the government staff is coming here and working in India. For example, in Chennai, there is a US consulate, correct? In US consulate, US citizens will be working here. So their salary will be exempt. Their salary will be exempt, but there is a condition. In a condition that when our people are working in USA, then our salary also should be exempt in USA. So remuneration of our corresponding government official in such foreign country should also be exempt. That is a condition. And second condition is that the employee should not be engaged in any business or profession or employment in India. So the employee should not be doing any other business. Let's see next section, section 10 clause 6 subclause 6. Foreign national employee of a foreign enterprise. So if any foreign person is coming to India and working here, then generally their salary will be taxable, because if you work in India and earn the salary, that salary is taxable. However, this foreign national person, if they are coming to India and India they are doing some project and working over here, then their salary will be exempt, subject to condition. What is the condition? The foreign enterprise should not be doing any business or trade in India. So whatever company they are working for, no, they should not be doing any business in India. Then second, employee stay should be maximum 90 days. So it should not be more than 90 days. And third condition, the remuneration is not liable to be deducted from the employer's income chargeable to tax. So employer should not claim deduction also. So employer should not be doing any business also. Employer should not claim deduction also. And employee should also stay for maximum 90 days. In such case, the salary received by the foreign employee will be exempt from tax. Then section 10 clause 6 subclause 8, non-citizen non-resident employee of foreign ship. So if non-citizen non-resident employee of a foreign ship is coming to India, if their stay is up to 90 days, then their salary is exempt. Then last one, section 10 clause 6 subclause 11, employees of a foreign government. So if foreign government employee is coming to India and doing the training in Indian government, then their salary will be exempt. So remuneration received from their respective government during their stay is fully exempt. Condition, the remuneration should be received in connection with their training in any undertaking owned by government or company wholly owned by central or state government, or any company which is subsidiary of the above, or statutory corporation, or any registered society which is wholly financed by central government, state government, etc. So it means what? In government organization, if the foreign government employee is coming here and doing the training, then their salary is going to be fully exempt. Swaha. Now without further ado, let us begin the revision. We are going to revise the house property head of income. In this head of income, I would just like to say one point before beginning. That is, while learning the house property head of income in theory, it might look very, very simple. But when you solve the problems only, you will get to know that the institute can ask some tricky points in the question which might be difficult for you to answer. That is why after seeing this revision lecture, I definitely want you to solve at least 3-4 questions from the study material, if possible RTP and MTP questions also, so that you are confident in the examination. Fine. With this background, let us begin. In house property head of income, like any other head of income, there is a charging section and a computation section. Charging section is section 22, computation section is section 23. Now what does the charging section say? The charging section says that for income from house property to be there, number one, there should be a house property. Then assessee should be the owner of the house property, and house property should be used for any purpose other than assessee's own business or profession and other than the business of letting out of commercial properties. So for these two purposes, if it is used, then it is not house property income. Fine. Now let's see what is house property. House property means building or land appurtenant thereto. Building means what? Permanent structure. Land appurtenant means what? Land that is attached to the building. For example, statue is there, garden is there, parking lot is there, swimming pool is there. All these are land appurtenant thereto. Then building does not only mean residential building, it also includes factory building, office, shops, godown, etc. So all permanent structure that is building is covered under house property head of income. Fine. However, if the assessee is having only land, no building is there, if this land is given on rent, then the rental income will be taxable under PGBP or IFOS head of income. It will not be taxable under income from other sources. Fine. Now let's talk about the types of house property. House property is of majorly two types, that is self-occupied property and let-out property. Self-occupied property means the assessee himself is occupying the property or nobody is occupying the property. Both cases it is called self-occupied property. Then what is let-out property? Let-out property means the assessee has given the property on rent, then it is let out. And you know what? In income tax, there is a concept of notional taxation. It means what? There is no income at all, still that income will be created by the Income Tax Act and it will be taxed for the assessee. This brings the concept of deemed to be let out property, that is DLOP. In Income Tax Act, if the assessee is having more than two self-occupied property, then only two self-occupied property can be treated as self-occupied. Balance properties will become deemed to be let out property and the assessee has to pay the tax on such properties. So any two can become self-occupied, balance will become DLOP, that is deemed to be let out property. Fine. Sir, what happens when the house property is outside India? If house property is outside India, then if the assessee is a resident, ordinarily resident, it is fully taxable in India. But in case of resident, not ordinarily resident and non-resident, the house property income is taxable in India only if the income is received in India. Fine. Then what if the house property is held as a stock in trade? For example, builder. The builder will be having so many buildings as their stock. In such case, these buildings are also house property for the builder, no? So it will be deemed to be let out property and the builder has to pay the tax. But it is such a bad provision. That is why the Income Tax Act is also giving a relief of 2 years. That means from the end of the financial year in which the certification of completion of construction is received, from that you can take 2 more years. For 2 more years, the house property income will be taken as 0. But after this 2-year period is over, deemed to be let out property provision will trigger and the builder has to pay the tax. So what should the builder do? Within 2 years, the builder has to sell the property so that he should not pay any tax under house property income. Fine. Now let us talk about the business of letting out of house property. If the assessee's business itself is giving house property on rent, then what to do? Then you should see whether the property is a residential property or a commercial property. If it is a residential property, then tax under income from house property. But if it is a commercial property, then it will be taxable under profit and gains from business or profession. Fine. Now let's talk about owner. Who is the owner? First and foremost, we learned that assessee must be the owner of the property. So what is owner? Owner is the person who is having the right to receive the income from the property. Owner includes deemed owner. This deemed owner concept we are going to discuss now. Fine. So what is owner? Owner is the person who is having right to receive the income. Owner includes deemed owner, and here registration of sale deed may be there or may not be there. It does not matter. Ownership includes both freehold rights as well as leasehold rights. Owner of the building need not be the owner of the land. House property only talks about building. So we have to see only the owner of the building. Owner of land might be separate. It does not matter. Then the assessee must be the owner during the previous year. Ownership is not compulsory in the assessment year. So while receiving the income, assessee should be the owner. But later on, if he is not the owner, then it is not a problem. Fine. If title of ownership is under dispute, then income tax department will decide who is the owner and they have to pay the tax under house property. And lastly, exception to ownership. there are two exceptions to ownership, that is recovery of unrealized rent and recovery of arrears of rent. Whenever there is recovery of unrealized rent or arrears of rent during the year of recovery, it is not necessary that the assessee should be the owner of the property. Fine. Now let us see what are the cases of deemed ownership. There are total 6 cases of deemed ownership. It is given under section number 27. So let us see all the 6 cases. Case number 1, transfer of house property to spouse without consideration or for inadequate consideration. So if I am having a house property and if I am transferring my property to my wife without consideration or for inadequate consideration, then in such case I only will be considered as the deemed owner of the property. Even though my wife is now having the property, but still I will be considered as the owner as per Income Tax Act. But for this there is an exception. The exception is agreement to live apart. So if husband and wife agree to live separately and in that agreement only the husband is giving property to wife or wife is giving to husband, then it is not covered under this section. Fine. Now let's talk about second point. Transfer of house property to minor child without consideration or for inadequate consideration. So if I transfer my house property to my minor child without consideration or for inadequate consideration, then also I only will be considered as deemed owner of the property. Here there is an exception. Exception is transfer to minor married daughter. So if a person is transferring to minor married daughter, in such case this deemed owner concept will not apply. Now let's talk about third point. Holder of an impartible estate shall be deemed owner of the property comprised in the estate. For example, there is a property where two brothers A and B are the owner, but you do not know what is the share of A and what is the share of B. In such case, A and B both will be considered as an association of person. This association of person will be deemed as the owner and the association of person has to pay the tax. Fine. Then member of a cooperative society, company or AOP to whom a building is allotted under a house building scheme. Sometimes you know what will happen, one apartment will be constructed where there are 100 flats or 200 flats. This apartment will be in the name of a cooperative society or company. In such case, the owner is not the cooperative society or company. The owner as per Income Tax Act is the member or shareholder of that cooperative society or company who is living in the flat. Okay, then if 3 conditions of Transfer of Property Act are satisfied, then even though possession is transferred, the person who is receiving the possession will be considered as owner. The person who is receiving the possession will be considered as owner, and here sale registration is not necessary. What are the 3 conditions of Transfer of Property Act? Condition number 1, possession should be transferred. Condition number 2, sale consideration should be paid or promised to be paid by the seller. Okay, paid to the seller. Then third condition, even though sale deed has not been executed, but some other document like power of attorney or sale agreement should be executed. So some document should be executed. If these 3 conditions are satisfied, then the person who is receiving the possession will become deemed owner of the property. And lastly, if the person is having right to property for not less than 20 years, then such person will become deemed owner of the property. Okay, so these are the 6 cases of deemed ownership. Now let us come to computation section. Section 23 talks about computation of house property income. So how to compute house property income? Take municipal value or fair rent, whichever is higher. Municipal value or fair rent, whichever is higher. The higher value or standard rent, whichever is lower, will give you expected rent. Then you compare expected rent with actual rent. Whichever is higher will give you gross annual value. Gross annual value. From this you reduce the municipal taxes, it will give you net annual value. From the net annual value, you can further reduce 2 deductions. First one is section 24A, standard deduction, which is nothing but 30% of NAV. And second deduction is section 24B, that is interest on housing loan. After reducing these 2 deductions, you will either get income or loss from house property. Fine, income or loss. So once more I am repeating, because this format you have to be thorough. So take municipal value or fair rent, whichever is higher. Higher value or standard rent, whichever is lower, will give you the expected rent. Expected rent or actual rent, whichever is higher, will give you the gross annual value or GAV. This GAV, from this if you reduce the municipal taxes, you will get the net annual value, which is nothing but NAV. From the NAV you can further reduce section 24A standard deduction, which is 30% of NAV, and section 24B interest on housing loan. After these 2 deductions, finally you will get income or loss from house property. Income or loss from house property. Now see this chart. Let's talk about self-occupied property first. in self-occupied property, you have to see whether the assessee is opting for the opt-out scheme or the default scheme. If the assessee is opting for opt-out scheme, then only the assessee can claim the interest on housing loan as a deduction, and because of this interest on housing loan, the assessee will get a loss from house property. But if the assessee is opting for default tax regime under section 115 BAC, then the assessee cannot claim interest on housing loan as a deduction. That is why always his income will be zero for self-occupied property. Now let's talk about let out property. In let out property, all the figures are there. If you do the calculation, you will have final income or loss from house property. Then let's come to deemed to be let out property. In deemed to be let out property, you will see that everywhere I have put the figures. However, only in one place it is blank, and that is actual rent, because deemed to be let out property is nothing but a self-occupied property. Hence, it will not have any actual rent. Okay, wow. So I hope you are clear with this. Now let us see what are the meaning of the various terms. What is municipal value, sir? Municipal value is the value determined by municipal authorities. Then what is fair rent or reasonable rent? Fair rent or reasonable rent is the rent of a similar property in the same area or same locality. You can also say that fair rent means market rate of rent. Fine. Then what is standard rent? Sometimes in some areas the rent will be very high. So the government will bring Rent Control Act. This Rent Control Act will fix the maximum rent for that area. This maximum rent is only called standard rent. Standard rent. So expected rent we have already studied. Take municipal value or fair rent, whichever is higher. Higher value or standard rent, whichever is lower, will give you expected rent. Then what is actual rent, sir? Actual rent means rent received plus rent receivable minus unrealized rent. So what is it? Rent received plus rent receivable minus unrealized rent. But you know, to reduce this unrealized rent, you have to satisfy rule for 4 conditions. Rule for 4 conditions. What are the 4 conditions? Number 1, the tenancy should be bona fide. It means what? The tenancy should be genuine. The tenant should actually have been staying in the place of the landlord. So the tenancy should be real. Then the default, just a second. Yes, the defaulting tenant should have vacated or steps should have been taken to compel him to vacate the property. So that is second condition. Third condition, the defaulting tenant should not be in occupation of any other property of the assessee. So the assessee should not give any other house on rent to this defaulting tenant. And fourth condition, the assessee has taken all reasonable steps to institute legal proceedings for recovery of unpaid rent, or he satisfies the assessing officer that legal proceeding will be useless. So if these 4 conditions are satisfied, then you can reduce this unrealized rent from the actual rent. Now in question, if it is silent, if it does not mention about this condition, then you put an assumption that it is assumed that the 4 conditions given in rule 4 have been satisfied. That is why we are reducing unrealized rent. Fine. Now let's talk about municipal taxes. From the GAV you can reduce municipal tax? No. So what is this municipal tax? Municipal tax is nothing but the tax collected by municipal authorities. So example, property tax, house tax, water tax, local tax, sewage tax, drainage tax, garbage tax. So by whatever name called, if the municipality is collecting the taxes, it is called municipal tax. Fine. It is allowed as deduction from GAV on payment basis only if it is paid by the assessee. Only if it is paid by assessee. So assessee should himself pay the municipal tax. Only then it is allowed. If tenant is paying municipal tax, will it be allowed? Answer is no. If tenant is paying, it is not allowed. And moreover, this municipal tax is only allowed on payment basis. Payment basis. It means what? If it is paid, then only it is allowed. If it is not paid, it is not allowed. Sir, what if for last year also I was not able to pay? That is why in the previous year I have paid for 2 years. So can I claim the deduction for 2 years? Answer is yes. Even if you pay for 2 years, you can claim the deduction for 2 years. How much ever you pay, that you can claim as deduction. Fine. If arrears are paid in the previous year, such arrears are also allowed as deduction. If property is outside India, then the tax levied by the respective country will be allowed as municipal tax. Then municipal tax is not allowed as deduction for self-occupied property. So for self-occupied property, municipal tax cannot be claimed. For self-occupied property, no kanna, in the new regime, nothing can be claimed as deduction. In the old regime, only interest on housing loan can be claimed as deduction. Okay, wow. If at all this municipal tax is given in percentage in the question, then what to do? Then you take the percentage of municipal value as municipal tax. Fine. So for example, municipal tax is given as 10%. Then what you will do? Take municipal value multiplied by 10%. This will give you the municipal tax. Fine. Now let's come to deductions. First, section 24A, standard deduction, which is nothing but 30% of NAV, net annual value. In house property head of income, no other deductions like repair, painting, carpenter work, mason work, nothing is allowed as deduction. Instead of all of that, the Income Tax Act allows the assessee 30% of NAV as a standard deduction. So apart from these, no other deduction are allowed to the assessee. Now let's talk about section 24B, that is interest on borrowed capital. So interest on loan is allowed as deduction, but the loan should be taken for the purpose of purchase or construction or repair or renewal or reconstruction. What are they? Purchase, construction, repair, renewal, reconstruction of the house property. Only then the interest will be allowed. Unpaid purchase price can also be treated as loan. For example, if you are taking a loan, if you are buying a house property from me and you have to pay me 1 crore rupees. Instead of paying me 1 crore, you paid me only 20 lakh rupees. And for balance 80 lakhs, you are telling me, sir, this 80 lakhs, no, I will pay later on along with interest. So can this unpaid purchase price be treated as loan? Answer is yes. Unpaid purchase price also can be treated as loan. Then interest on loan taken to repay the original loan. For example, I took a loan from State Bank of India, but now I do not like State Bank of India, so I want to change this loan to HDFC Bank. So what do? I take another loan from HDFC Bank and I repay the loan of State Bank of India. Now this new loan of HDFC Bank is there, no? Interest on this HDFC Bank, can I claim as deduction? Answer is yes, you can claim as deduction. Then loan can be taken from anyone. So housing loan you can take from bank also, from NBFC also, from your friends also, from your relative also, from anyone you can take the loan. Still the interest will be allowed as deduction. Then in the year of completion of construction or purchase, interest of the entire year can be fully claimed as deduction. So if I have purchased in between the year and while making the purchase only I have in between the year, but I have paid interest on loan for the entire year, can I claim the interest on loan for entire year? Answer is yes, I can claim for entire year. If I have completed construction only in between the year, then also I can claim the interest for entire year as deduction. Fine. Then interest is allowed on accrual basis. So for example, for previous year 25-26, my interest came as 1 lakh rupees. But I have not paid the interest. Still can I claim as deduction? Answer is yes, because interest is accrued. That is why it can be claimed as deduction. Then interest on unpaid interest, penal interest, is not allowed as deduction. For example, if you pay your EMI late, then what will happen? You have to pay some extra interest. This extra interest is not allowed as deduction. Then if interest is paid outside India, the person has to deduct TDS if TDS is applicable. If TDS is applicable but TDS is not deducted, then interest on housing loan cannot be claimed as deduction. So fine, these are the points for interest. Now let's speak about limits on interest deduction. What is the maximum amount of deduction that can be claimed by assessee? Let us see. Firstly, let us talk about let out property and deemed to be let out property. For let out property and deemed to be let out property, entire interest that is accrued during the year can be claimed as deduction. Entire interest. So there is no limit and all. Now let us talk about self-occupied property. For self-occupied property, if the assessee is choosing the default tax regime under 115 BAC, then deduction itself is not allowed. Then let's talk about old tax regime. In opt-out scheme or old tax regime, if the conditions are satisfied, up to 2 lakh rupees interest can be claimed as deduction. If conditions are not satisfied, only 30,000 maximum can be claimed as deduction. So if conditions are not satisfied, maximum 30,000. If conditions are satisfied, maximum 2 lakhs. Now what are these conditions? The conditions are that number 1, the capital or the loan should be borrowed on or after 1/4/1999. Then second condition, the borrowing should be for the purpose of either construction or purchase. It should not be for any other purpose. So if you take a loan for repair, then maximum 30,000 only you can claim. But if it is for purchase or construction, you can claim up to 2 lakh rupees also. Then if loan is taken for construction, then the construction should be complete within 5 years from the end of the year in which the loan was taken. So the construction should be completed within 5 years from the end of the year in which loan was taken. And lastly, you should take a certificate of interest from the loan provider. Only if all these conditions are satisfied, then the upper limit of 2 lakhs can be claimed by assessee. Fine. This above limit is there, no, is both for both house properties in aggregate. But you know what? This interest deduction of 30,000 and 2 lakhs, no, it is per person also, it is per property also. Let us see with the help of a few examples. Let's say the assessee is having two properties, self-occupied property 1 and self-occupied property 2. In first property, let us see case number 1. First property, all the four conditions are satisfied. So how much is the maximum deduction? Maximum deduction is 2 lakhs. In second property also loan was taken but conditions not satisfied. Hence the maximum limit is how much? 30,000 rupees only. But for both the properties combined, maximum deduction is 2 lakhs. Maximum deduction is 2 lakhs. That is why I told this limit is both per property as well as per person. Okay, wow. Hence maximum deduction for both properties combined also cannot cross 2 lakh rupees. Let us see second case. For first self-occupied property, condition satisfied. Second also condition satisfied. So for first also you can claim maximum 2 lakhs. Second one also you can claim maximum 2 lakhs. But combined maximum is also 2 lakhs only. Now let us see third case. Condition not satisfied for first property, also not satisfied for second property. So for both properties you can claim maximum 30,000, but both combined also you can claim maximum 30,000 only. Fine, you get my point. Now let us talk about pre-construction or pre-acquisition period interest. Sir, what is this pre-construction or pre-acquisition period? It is the period before the previous year in which the property was acquired or constructed. Here, no, students make a silly mistake. They think that pre-construction period means the period before the date of construction. It is not date of construction karna, it is previous year of construction. For example, let's say the loan was taken on 1st June 2022. Then the construction got completed on 31st July 2025. In this case, what is the pre-construction period? Pre-construction period is from 1st June 2022 till 31st March 2025. Okay, from 1/4/2025 onwards, current year will start. It is not called pre-construction interest. Now, what is special about this pre-construction interest? Karna, whatever interest that has been paid or accrued during this pre-construction period, no, that can be claimed as deduction from the year of completion of construction or acquisition in 5 equal annual installments. So interest during such period can be claimed as deduction over 5 equal annual installments starting from the year in which the construction or acquisition got complete. Fine. And moreover, the limit of 30,000 2 lakhs is there, no? This also includes pre-construction and pre-acquisition interest. So all the interest put together, you add pre-construction interest also, you add self-occupied 1 also, you add self-occupied property 2 also. Everything combined also, maximum interest deduction cannot cross 2 lakhs. Cannot cross 2 lakhs. Hence, for self-occupied property, the highest loss that you will get is 2 lakh rupees only. Okay? Per property. Now let us talk about special cases. So now computation section is also over. Now let us talk about what are the different types of adjustments that can come in the examination. First is the most important adjustment, that is vacancy. What is vacancy? Vacancy means house property is available for rent but no one has come to occupy it. So the landlord is there, no, he has put the to let board before the house but no tenant has come. In such case, this is called vacancy. So if vacancy comes, what you will do in the examination, if vacancy comes in the question, then you will do expected rent and actual rent comparison, no, in the computation of computation of house property. See here, you will do comparison between expected rent and actual rent. So whichever is higher will give you GAV. But whenever vacancy is there, you should not do expected rent and actual rent. You should compare expected rent with actual rent plus vacancy rent. So while doing the comparison, you should also add the vacancy rent in the actual rent and do the comparison. However, if actual rent plus vacancy rent is the higher value, then while writing the GAV, in GAV you should not write actual rent plus vacancy rent. In GAV you should write actual rent only. In GAV, you should write the actual rent only, vacancy will not come. So vacancy comes only while doing the calculation or comparison, but while writing the final answer, you should not write vacancy. Okay. So that is what I have given here. So if expected rent is greater than actual rent plus vacancy, then expected rent is GAV. If actual rent plus vacancy rent is greater than expected rent, then only actual rent is GAV. So while writing the GAV, you don't take vacancy rent. Now let us see what happens if assessee is having more than 2 self-occupied property. If the assessee is having more than 2 self-occupied, then what will happen? Only 2 can be chosen as self-occupied, balance will become deemed to be let out property. Hence, if you get such a question, how to solve the question? Because you have to find what is the most beneficial answer. So assume that all the properties are deemed to be let out property, and then you find out what is the income from house property for all the 3 properties. Then you take option 1, option 2, option 3, like that you create the different types of option to cover all the types of cases. For example, if there are 3 properties, house property 1, house property 2 and house property 3, then what you will do? In first option, you assume that if 1 and 2 are self-occupied and number 3 is deemed DLOP, then what will be the answer? Then take the second option. If 2 and 3 are self-occupied but 1 is DLOP, then what will be the answer? And third option, if 1 and 3 are self-occupied but 2 is DLOP, then what will be the answer? And while taking the answer, take what is the least income, because if the income is the lowest, then the tax also will be low, no? So that will be the most beneficial answer. Fine. So now, partly let out and partly self-occupied for different parts of the year. So now there is a case in the question where for some part of the year the assessee was self-occupying the property, and for remaining part of the year it was given as rent. Okay, part of the year self-occupied, part of the year let out. In such case, what to do? In such case, very simple. Treat the property like a let out property and then solve the question. That's it. So no confusion at all. So let's say the property was let out for 9 months and it was self-occupied property for 3 months. So then what you will do? You just treat the property like a let out property and solve the question. But sir, while writing expected rent versus actual rent, what we should do? Expected rent will be for 12 months, but actual rent will only be for 9 months. So is it okay? Answer is yes. Like this only you have to do the comparison. So here high chances that expected rent only will become GAV. Expected rent only will become GAV. So that is only the disadvantage, unfair comparison with expected rent. But there is one advantage also. The advantage is that municipal tax is fully allowed on payment basis and interest is also fully allowed. In self-occupied property, interest is having limit, no? But in DLOP or let out property, interest is not having any limit. Entire interest you can claim as deduction. Fine. So if it is partly let out, partly self-occupied for different parts of the year, in such case, just treat it like a let out property question and solve the answer. In your institute study material, there will be one Raj Lakshmi question that you can refer to know how to solve this type of question. Fine. Now let us see next one. Part of the house is let out and other part is self-occupied. So for example, one house is having 2 floors. Out of the 2 floors, one floor is let out and the second floor is self-occupied. Then what to do? Then very simple. Treat both the parts as separate house property and find out the income. So now you have to split everything. So municipal value, fair rent, standard rent, municipal tax, interest, everything you split on proportionate basis. What is the proportion of the let out part? What is the proportion of self-occupied part? You have to split both of them. However, don't split actual rent. Don't split actual rent because actual rent belongs to the let out portion only. Fine. Now let's talk about what happens when property is acquired in between the year. If property has been purchased in between the year, then municipal value, fair rent, standard rent should be taken on proportionate basis. But don't take municipal tax on proportionate basis, don't take interest on proportionate basis. Entire municipal tax will be allowed on payment basis and entire interest will be allowed on accrual basis. Fine. Next, recovery of unrealized rent or arrears of rent. So if unrealized rent or arrears of rent are recovered during the year, what to do? Firstly, what is unrealized rent? Unrealized rent means in the previous years, the tenant did not pay the rent. At that time, it must have been reduced if rule 4 conditions are satisfied. But now the tenant has come and paid the rent. So this is only called recovery of unrealized rent. Now what is recovery of arrears of rent? Arrears of rent means in the past months you were having dispute with the tenant, but now that dispute is sorted and all the past month arrear rent has been paid in the current month. So that is only called recovery of arrears of rent. So in both these cases, in the year in which there is recovery of arrears of rent or unrealized rent, you have to treat it as income under house property. And against this income, you can also claim 30% standard deduction. 30% standard deduction. However, and it is taxable even if the assessee is not the owner of the property in the year of receipt or realization. I already told you, it is an exception of ownership. So while receiving the recovery of arrears of rent or unrealized rent, at that time it is not necessary that the assessee should be the owner of the property. Then no other expenses allowed as deduction. No other expenses allowed as deduction. And here you should know one point, that if this arrear of rent and unrealized rent, if it was already taxed, then it need not be taxed in the year of recovery. Only if it was not taxed earlier, it will be taxed in the year of recovery. Fine. Now let's talk about co-ownership or joint ownership. So if the house property is jointly owned or co-owned, then what to do? In such case, you should see whether the share is definite and ascertainable or not definite and ascertainable. If the share is not definite and ascertainable, the house property will be treated as AOP and then taxed. But that is covered in CA final. In your CA Inter level, you will always get the question where you know what is the share. So whether the owners are having it in the 50-50 ratio, 40-60 ratio, whatever the ratio is there, it will be given in the question. So in case of let out property, calculate the income of the entire property. And after calculating the income, then you divide the income into ownership ratio. Fine. However, in case of self-occupied property, you have to calculate the income from house property separately, because all the co-owners are having the benefit of interest deduction. Okay, the 2 lakhs deduction is there, no? All the owners will be having separate limit. That is why calculate separately. So if it is a let out property, calculate income of the property first, then divide into ownership ratio. If it is a self-occupied property, then calculate separately for each and every owner. Now let's talk about composite rent. Composite rent means what? Along with the building, some other assets are also given on rent, like furniture, plant and machinery, and services are also offered. For example, security service, power backup service. In such case, what to do? In such case, you have to see whether it is compulsory to give it on composite rent or not. For example, in the hotel industry, they can't just like that give you hotel room. They have to provide bed also. They have to provide electricity, water supply, everything. They have to provide security, everything they have to provide. That is why in hotel industry, composite income is compulsory. If composite income is compulsory, then composite income will be taxable under PGBP or income from other sources head of income. PGBP or income from other sources. However, if composite income is not compulsory, then you have to see the agreement. Whether in the agreement, rent of house property and rent of other assets are given separately or if they are given together. If the rent of house property is given separately, then house property rent will go in house property head of income, other asset rent will go in the PGBP or IFOS head of income. However, if both rent are not given separately, if it is given together, then the composite rent will be taxable under PGBP or IFOS head of income. Fine, PGBP or IFOS. So this is the house property. While studying, it is easy. Definitely you have to solve the questions also. Then you will have some confidence before going into the examination. Now, without further ado, let us begin the revision of profit and gains from business or profession. This PGBP head of income is the biggest head of income, also the largest chapter in your CA Intermediate Direct Tax syllabus. But not to worry at all. It is more or less concept based, very little of memory, and definitely if you watch this video till the very end, at least 2 or 3 times you have to watch this revision lecture, 100% you are not going to miss even a single adjustment in the examination, and you are going to score full marks. You know that total income question that you get in your examination, which is the first question for 15 marks, the major adjustments are going to come from this chapter only. So you have to be well prepared from this chapter. Minimum 10 marks is going to come from PGBP head of income, and it is very simple if you watch this lecture. Fine. So let us begin the PGBP head of income. Firstly, introduction to PGBP. First, what is business? What is profession? Let us quickly see. Section 2 clause 13 defines business, that business includes trade, commerce or manufacture, or any adventure or concern in the nature of trade, commerce or manufacture. So trade relates to buying and selling, commerce means providing service, or manufacturing means production of goods or manufacturing of goods. So if you do it regularly, then also it is included in business. If you do once in a while also, then also it is included in business. Then what about profession? Section 2 clause 36 defines profession. It means an occupation requiring some degree of learning. It also includes includes vocation. Vocation means any work which requires some special knowledge. So whatever requires special knowledge, it is called profession. Now let us talk about concept of profit in the PGBP head of income. Profit can be in cash or in kind. So you can receive in money form also, or you can receive in kind form also. Both will be considered as profit. Then profit includes capital receipts only if it is specifically provided. So capital receipts will be taxable in PGBP only if it is specifically provided under the act. It includes voluntary receipt in the course of business or profession. So if I am doing profession, okay, I am doing teaching profession, maybe you did not take my coaching and you did not pay me the fees, but you saw this revision lecture and you scored all India top marks in direct tax paper, and you are so happy that because of me you are scoring the high marks. So you gave me one gold chain as a gift. Okay, wow. So this gold chain has come because of teaching only. No, that is why it will be taxable for me in PGBP head of income. So even though you have not taken my direct tax batch, still from my direct tax lectures only you have given me a gold chain. That is why it will be taxable under PGBP head of income. Then applications of gains is immaterial. So it does not matter where I am spending the PGBP money. So business and profession income, whatever I am getting, it does not matter where I am spending. For example, a customer was there. Customer was giving me the money. Instead of giving me, I asked the customer that you please donate this money to charity. Does it mean that it is not my profit? Answer is it will be considered as my income only, because applications of gains is immaterial. Then income can be legal also, illegal also. So if I am doing money laundering, if I am doing smuggling, kidnapping, murder, for that if I am earning any money, that money is also taxable under PGBP head of income if doing all these activities is my business. Okay, but it is not my business, don't worry. Next, PGBP is the aggregate of profit of all the businesses. So Kanna, some people get a confusion. Sir, only main business will be considered as business, all the other side business will be considered as other sources. But that is not the case. All the business will be covered under profit and gains of business or profession only. Fine. So if there are multiple businesses of a assessee, then take the profit of all the businesses separately, add them together, you will find the total PGBP income. Then profit is the net profit, not the gross receipts. So the sales is not taxable under PGBP. Net profit is only taxable under PGBP. But net profit does not mean net profit as per books of accounts. It means net profit as per the Income Tax Act. So this is the concept of PGBP. Now let us come to section 28, which is the charging section. Every head of income has a charging section and a computation section. In PGBP head of income, 28 is the charging section, 29 is the computation section. So what does the charging section say? First line itself covers all the business and profession. That is, income from business or profession is taxable under profit and gains of business or profession. So first line itself covers everything. Now what and all we are going to study are some extra points only, which is also covered under PGBP head of income. So let us see one by one. However, if an assessee is engaged in the business of letting out of residential houses, such income shall not be chargeable under PGBP head of income. While discussing the house property head of income, I already told you that if the assessee is having the business of giving the house property on rent, and if the house property is a residential property, it will be taxable under house property head of income. If the house property is a commercial property, it will be taxable under PGBP head of income. Then any compensation or any other payment due to or received by a person managing the affairs of an Indian company or Indian affairs of a foreign company. So if I am managing the affairs of an Indian company and getting the money, then it is taxable under PGBP head of income. For example, in insolvency and bankruptcy code, I became the resolution professional and getting the money from the company. So it is taxable under PGBP. Then by any agent or for termination of agency. So if I am doing any work on behalf of another person, that is doing agency, it is also taxable under PGBP. Or if the person is terminating my agency and giving me the money, that is also taxable under PGBP. Then if I am doing any government contracts and government is giving me money, that is also taxable under PGBP. And lastly, any person for termination or modification of business terms. So I am having any business terms or contract, there is change in that contract. Because of that change, I am receiving any money, that is also taxable under PGBP head of income. Then income of trade, professional or commercial association by giving service to its members. So trade, professional, commercial association, whenever they are giving services to its member, then the money received by them is taxable under PGBP head of income. Then export incentives. All these export incentives and all are covered in your CA final syllabus, not there in CA intermediate. But this much you know, if at all these words are coming in the question, it means it will be covered under PGBP head of income. Fine. So what are they? Profit on sale of import entitlement, profit on sale of duty entitlement passbook scheme, profit on sale of duty-free replenishment certificate, cash assistance against exports, and duty drawbacks. So all these will be taxable under PGBP head of income. Then any benefit or perquisite related to business in cash or in kind or partly cash, partly kind will also be taxable under PGBP. For example, I am a dealer of a company. Now that company is very happy with me, so they are giving me a foreign trip. This is also taxable under PGBP. They are giving me a gold coin. This is also taxable under PGBP. All the gifts, whatever I am receiving in course of my business, will be taxable under PGBP. Moreover, However, when the company is giving me the foreign trip, that time if the trip value is more than 20,000, that is during the entire year, if the benefit is more than 20,000, they will also deduct TDS for me under section 194R. This you will be learning in TDS chapter. Okay, then sum due to or received by any partner or partnership firm. In salary chapter revision itself, I told you partner means what? Part owner. That is why whatever money is received by a partner of a partnership firm, in such case it is always taxable under PGBP head of income. Then sum received for not carrying out any activity. So if I'm not doing any activity, for that if I'm getting any money, then it is taxable under PGBP head of income. Then sum received under key man insurance policy. Okay, before point I did not discuss. No, sum received for not sharing any know-how, patent, copyright, trademark, license or franchisee. So for not sharing my intangible asset, if someone is giving me money, that is also taxable under PGBP. Then sum received under key man insurance policy. Key man insurance policy, I already told you, when the employer is receiving the money from the company, insurance company, it is taxable under PGBP head of income. When the employee is receiving the money from insurance company, it is taxable under salary head of income. When a person other than employer or employee is receiving the money, it is taxable under income from other sources head of income. Okay, then when inventory is converted into capital asset, okay, stock converted into capital asset, that is also taxable. So fair market value of the inventory will be considered as income under PGBP. Fine. Then sum received from the transfer of capital asset on which deduction has been claimed under 35AD. So 35AD deduction, if you are claiming on a capital asset, whenever you sell this capital asset, whatever money is coming will be fully taxable under PGBP head of income. 35AD we are going to discuss in this video only. It talks about specified businesses. Okay, now let's come to section 45, method of accounting. Before beginning the computation, 2 or 3 concepts let me quickly discuss so that you are clear in your mindset. So first let us talk about method of accounting, section number 145. Assessee can follow either cash system of accounting or mercantile system of accounting. Kanna, for salary head of income, for house property head of income and for capital gain, it is very clear how you are going to tax the income. That is why method of accounting is not required. However, in profit and gains of business or profession and also in income from other sources, in these 2 heads of income, many different types of incomes are taxable. That is why it is very important to have a standard method of accounting. The Income Tax Act allows both method of accounting, that is cash system also, mercantile system also. Cash system means payment basis of accounting. A mercantile system means accrual basis of accounting. So one time if you start one method of accounting, then year on year you have to continue with the same system of accounting. Unless there is a very specific reason and you want to change, then you can intimate to the assessing officer and change the method of accounting also. Fine. Then exception to method of accounting, that there are 2 cases where you should not at all see the method of accounting. Always the income is going to be taxable on receipt basis. You should not see the method of accounting. What are they? Number 1, interest on compensation or enhanced compensation received on compulsory acquisition. So when the government is compulsory acquiring your property, the government will give you compensation. On that compensation, if they are paying late, they will give you some interest on compensation. This interest on compensation is always taxable on receipt basis. Always taxable on receipt basis. Then subsidy, incentive, etc. received from any government or others. So if any subsidy or incentive is received, that is also always taxable on receipt basis. Fine. Then all the assessees have to compulsorily follow ICDS, that is Income Computation and Disclosure Standards. So this ICDS is nothing but the accounting standards you are studying in accountancy. Similarly in direct tax, it is Income Computation and Disclosure Standards, okay, for showing the income. So it is compulsory, but don't worry, it is a part of CA final syllabus. Now if you know that it is compulsory to follow, that is enough. Okay, however, there are 2 exceptions to ICDS. 2 types of people need not follow ICDS. Who are they? Number 1, individual or HUF who are not required to get their books of accounts audited under section 44AB, and number 2, assessees who is following the cash system of accounting. So in both cases, no need to follow ICDS. All the other persons have to compulsorily follow ICDS. So this is method of accounting. Now let us come to section 44AA, compulsory maintenance of books of accounts. So who has to compulsory maintain the books of accounts? Let us see. First and foremost, where should the books of accounts be maintained? What is the place to maintain books of accounts? Answer is principal place of business. So books of accounts always have to be maintained at principal place of business. Then what is the time period to maintain this books of accounts? So time period is 6 years from the end of the assessment year. So 6 years from the end of the assessment year, till that you have to maintain the books of accounts. So what and all books of accounts you have to maintain? The previous year you have to maintain, then assessment year you have to maintain, then 6 years you have to maintain. So totally including current year, if you see, 8 years you have to maintain. Previous year plus assessment year plus 6 years after the assessment year. Fine. Now what are the books of accounts to be maintained? Very simple. Okay, the Income Tax Act does not tell anything. It gives only a simple definition. Just maintain such books of accounts that will enable the assessing officer to compute your income. So assessing officer should be able to see the books of accounts and should be able to calculate what is your income. That is only the books of accounts that you have to maintain. So such books that may enable the assessing officer to compute the total income. Now let us see who has to compulsorily maintain the books of accounts. First, let us see section 44AA subsection 1. 44AA subsection 1 talks about prescribed professionals. These prescribed professionals have to compulsorily maintain their books of accounts, and moreover, this 44AA definition is going to come in other places also, so you have to be thorough with the definition. It comes in presumptive income section 44 ADA, and it also comes in TDS section 194J. All that it will be tested. So you should know who are these prescribed professionals. Who are they? The professionals are legal professional, medical, engineering, architecture, accountancy, technical consultancy, authorized representative, interior decoration, film artist, company secretary, and information technology professional. And here film artist includes actor, cameraman, director, music director, art director, editor, singer, lyricist, story writer, screenplay writer, dialogue writer, and dress designer. So all these are prescribed professionals. So these prescribed professionals should compulsorily maintain the books of accounts. What books of accounts, sir? Such books of accounts which will enable the assessing officer to calculate their total income. Sir, should I memorize all these names? Answer is not required. You just read them 2-3 times, then automatically it will get installed in your brain. When you see it in the question, you will be able to identify. Don't worry. Now let's come to section 44AA subsection 2. Other than these prescribed professionals, who should compulsorily maintain the books of accounts? First, let us talk about individual or HUF. In case of individual or HUF, if at all their income is more than 2,50,000 or turnover is more than 25 lakhs in any of the 3 preceding previous years. So before the previous year, you have to see the 3 years. In any of the 3 preceding previous year, if income is more than 2,50,000 or turnover is more than 25 lakhs. So any one condition need to be satisfied. In any one of the years also, if it is satisfied, then maintenance of books of accounts is compulsory. Okay. So income greater than 2,50,000 or turnover greater than 25 lakhs, then they have to maintain the books of accounts. Sir, what if in this year only the business has started, in the previous year, then what to do? Then in case of the new business or profession, if the income is likely to exceed 2,50,000 or turnover is likely to exceed 25 lakhs during the previous year, then such individual or HUF has to compulsorily maintain the books of accounts. Then let's talk about other than individual or HUF. In case of other than individual or HUF, if the income is greater than 1,20,000 or turnover is greater than 10 lakh rupees in any of the 3 preceding previous years, then they have to compulsorily maintain books of accounts. And in case of new business or profession, if income is likely to exceed 1,20,000 or turnover is likely to exceed 10 lakh rupees during the previous year, they have to compulsorily maintain books of accounts. And other than these, if at all, for a person to whom section 44 ADA or section 44 AE or section 44 AD is applicable. So what are they? These are nothing but presumptive income section which we are going to learn in this lecture only. So presumptive income, if it is applicable and if the assessee is showing the profit lower than presumptive income, then such assessee has to compulsorily maintain books of accounts. So 44 AD, 44 AE and 44 AD. All these 3 cases, if profit is shown as lower than presumptive income, compulsory to maintain books of accounts. Moreover, in 44 AD, if at all you are coming out of 44 AD within 6 years, then for the next 5 years also compulsorily you have to maintain books of accounts. So 5 years after the previous year in which the income is shown less than the presumptive income, for that also you have to compulsorily maintain books of accounts. So current previous year also, after that next 5 years also. So total 6 years previous year plus next 5 years. Fine. Now let's talk about rule 6F. Prescribed professional should maintain prescribed books of accounts. Sir, you already told all the professionals have to maintain books of accounts. Now again you are telling prescribed professionals have to maintain books of accounts. Sir, what is the difference? Answer, the difference is all the professionals have to maintain such books of accounts which will enable the assessing officer to compute the total income. However, prescribed professionals that we are going to study now, they have to maintain prescribed books of accounts. What are these prescribed books? Prescribed books means cash book, journal, ledger, bills, that is sale bill more than 25 rupees and expense bills or purchase bill more than 50 rupees. What did I say? Cash book, journal, ledger, sale bill more than 25 rupees, expense bill or purchase bill more than 50 rupees. They have to maintain. Who has to maintain, sir? Prescribed professional. Who are prescribed professional? For a professional, if the gross receipt exceed 1,50,000 in all the 3 preceding previous years, or if it is a new profession likely to exceed 1,50,000, then such professional will be called as prescribed professional. So here there is a fundamental difference. Here first, where we studied about individual HUF and others, we saw any of the 3 preceding previous years. However, in case of prescribed professional, the condition is all the 3 preceding previous years. So here you should not make a silly mistake. In all the 3 preceding previous years, if the income is gross receipts is more than 1,50,000, then such professional have to maintain books of accounts. In case of new profession, if it is likely to exceed 1,50,000, then the professional has to maintain prescribed books of accounts. Prescribed books of accounts means cash book, journal, ledger, sale bill more than 25 rupees, expense bill more than 50 rupees. And if the professional is a medical professional, then the medical professional should also maintain a daily case register in form 3C and also inventory of medicine on the first day and last day of previous year. So these are the provisions for maintenance of books of accounts. Now let's talk about exemption under section 10 clause 2a. So 10 clause 2a tells that the share income received by a partner is exempt from income tax. So share income of a partner of a partnership firm or limited liability partnership as per profit sharing ratio is exempt. Even if the income was exempt in the hands of partnership firm, still it will be exempt in the hands of partner. So partnership firm is paying the tax, no. Now the taxed income is only shared with the partner. That is why when the partner is receiving the share income, it is tax free. No need to pay the tax. Now let us talk about section 29, that is computation section. Computation section in PGBP is very simple. It is just telling you follow section 30 to section 43D. You just follow section 30 to section 43D. Automatically you will be able to compute business income. Now let us start from section number 30. But before beginning the computation provisions, first and foremost, I would like you to come to the last page of this chapter in your book. And in last page, I want you to write something. First, what you have to do, first you please pause the video. Okay, and make note of whatever I have given on the screen. In the screen is not visible. Okay, now pause the video and first write down this part. Fine. Then you unpause the video, pause the video once again and write down this part in the 1 page space that I have given you after the PGBP chapter. Fine. Completed. Now let me explain you quickly. Karna, when you come to your examination, in examination you can either get a total income question or you can get a comprehensive PGBP question. Both type of question can come in 2 types of method. Karna. One is direct method and the other is indirect method. In direct method, you will be directly getting all the adjustments, and based on the adjustment you have to calculate the PGBP head of income, or you can also get receipts and payment account, or you can get cash and bank account, whatever it is you might get in the direct method. However, in indirect method, you can either get income and expenditure account or you can get profit and loss account. So in both cases, it is the indirect method, and you know what? Frequently only indirect method is being asked in the examination. That is why you have to be thorough with the indirect method. What I see, that the students are knowing all the provisions, but just because they are not comfortable with the indirect method, in spite of knowing the provision, they are making mistake in the examination and losing the marks. So if you study and in spite of studying, if you are losing the marks, then it will cause a pain in my heart. Obviously in your heart also, that in spite of studying you are not able to score the marks. So to avoid that silly mistake, listen to me carefully. Next 4-5 minutes, very important for you, so that you don't make a mistake. And before entering the exam hall also, last moment, I want you to see this table and then only go into the examination hall. Fine. Now let us imagine that this is a profit and loss account of a business. In profit and loss account, there will be many expenses in the expense side and incomes in the income side. Both you have to see, and net profit will be given. Finally, there will be some other adjustment which is outside the profit and loss account. Now on this net profit is there, here already while calculating the net profit, certain incomes have been added and certain expenses have been reduced. Correct? Then only net profit is calculated. In indirect method, you have to indirectly calculate the PGBP income, which means what? You have to take the net profit as the base and you have to do the reverse working to find out what is the PGBP income. So now let me tell you how to do the reverse working. First, what you have to take the net profit as per the books of accounts, which is 65,000 in this case, 65,000. Then you have to see all the adjustments one by one. First, you have to do all the addition adjustment, then you have to do all the deletion, that is subtraction adjustment. Here I am doing in mixture itself so that you are aware how to do the adjustment. So first and foremost, let us see. In the P&L account, there is an income of 70,000, but it is given that as per Income Tax Act, it is an exempt income. So it means what? While calculating the net profit, you have added the income. But now in Income Tax Act, that income is not taxable. So now what you have to do? Now from the net profit, you have to reduce that income. So exempt income have to be reduced. So 70,000 you will reduce from the net profit so that you are getting the PGBP income. Fine. Now let's talk about second adjustment number B. Adjustment number B is a taxable income of 50,000. So as per profit and loss account, it is shown in the income side. As per income tax also, it is a taxable income. So that is why what you should do, you should not do anything Kanna. You should just ignore it, because while calculating the net profit itself, this income has been added. So now since the income is already added, you need not do anything. That is why you should ignore this income. So taxable income of 50,000, since it is already included in the net profit, we need not do anything. We will just ignore it. Next adjustment. As per profit and loss account, the income is 20,000, but as per Income Tax Act, the income is actually 25,000. So now what to do? Kanna, while calculating the net profit, already 20,000 has been added. That is why you have to add only the balance 5,000 rupees. So 25,000 minus 20,000, which is 5,000, should be added in the PGBP head of income, added to the net profit to find out PGBP head of income. Next, 30,000 is the income as per profit and loss account. But however, as per Income Tax Act, only 10,000 is taxable. Entire 30,000 not taxable, only 10,000 is taxable. Then what you will do? Since while calculating the net profit, you have included 30,000, but you have to include only 10,000. So what you will do? You will reduce 20,000. So 30,000 minus 10,000, 20,000, you have to reduce from the net profit. Okay. If you're not understanding any adjustment, you rewind the video, you see once again and try to understand, because this concept has to be clear before entering the exam hall. Okay. Then E, there is an adjustment E, which is an income of 5,000 in the profit and loss account, but you know that it is not taxable and that the PGBP head of income, it is actually taxable in income from other sources head of income. For example, dividend income will be there. Okay. Now what you will do? So since it is not taxable under PGBP, first you have to reduce it from the net profit, so that you get correct PGBP income, and then you have to go to the income from other sources, and there you have to add it in income from other sources. So double adjustment you have to do, Kanna. So this is also very important. Then let's talk about item number F. Item number F is a taxable income of 45,000, which is not at all mentioned in the profit and loss account. So now what you have to do, since while calculating the net profit, this 45,000 rupees has not been included, that is why now you have to include manually. So 45,000 you have to add to the net profit. Now let's come to the expense side. First, let us talk about item number T. Item number T is an allowed expense in the Income Tax Act, but it is not shown in the expense side of the P&L account. Since it is not shown, the expense might not have been reduced. So that is why now you have to reduce this expense. So 15,000 you have to reduce from the net profit. Now let's talk about item number V. Item number V is 5,000, which is shown in the expense side of profit and loss account, but you know that it is an expense in capital gain head of income. It is not expense in PGBP head of income. So what you have to do, this expense you have to add back. Earlier it was reduced, no. Now you know that it should not be reduced. So what you will do, you will do the reverse calculation. So you have to add back to the net profit. So 5,000 you will add back to the net profit, and you will reduce it in the capital gain head of income. You get my point? Now let's talk about item number W. Item number W is 10,000, which is shown in the expense side of P&L, but as per Income Tax Act, it is not allowed as an expenditure. Okay, well, not allowed, disallowed. So what you have to do, you have to add back the amount. Then item number Y. Item number Y is 30,000 rupees in the expense side of P&L, and in Income Tax Act also it is allowed as an expenditure. So what you have to do, you need not do anything, Kanna. You have to ignore, because it is allowed in income tax. It is also reduced in profit and loss account. Since while calculating the net profit, already the amount has been reduced, the correct amount, that is why you need not do anything. Now let us talk about last adjustment. As per P&L, 40,000 is the expense. However, as per Income Tax Act, 50,000 is the expense. So now what you have to do, already 40,000 would have been reduced while calculating net profit. So further 10,000 now you reduce, so that you find out the correct PGBP profit. So 10,000 to be reduced. So after doing all this adjustment, finally whatever total you are getting will be the profit and gains from business or profession. I hope you are clear, comfortable with the indirect method. Very, very important, Kanna. Only then you will be able to solve it in the examination. Fine. Before going into the exam hall, I want you to refer this page once. Now let's come to the Now let's come to the computation provisions. First, let us start with the deductions. So what are all the different types of expenses that is allowed under PGBP head of income? Let us see. Firstly, let us talk about section 30. Section 30 tells rent, rates and taxes, repairs and insurance to building is allowed as deduction. Now what are the conditions? Let us see. First and foremost, the building should be used for business. Only if the building is used for business, then expense related to the building will be allowed as deduction. In case of partly business and partly other purpose, proportionate expense will be allowed as per section 38. So for example, in building there are two floors. One floor you are using for business, one floor you are using for personal purpose. In such case, what will happen? Only for the floor related to business you can claim the expense. The floor which is used for personal purpose, you cannot claim the expense. Then in case of sublet premises, allow net rent. Sometimes what the assessee will do, assessee will take a building on rent, and this rented building the assessee will give on rent, sublease to some other person. In such case, the assessee will be paying rent also, he will be receiving rent also. In such case, the difference of rent will be either allowed as expense or will be added to income, as the case may be. Then in case of own premises, no notional rent is allowed. So if, for example, if I am having a building, that building I am using for my own business, can I pay rent to myself and claim the deduction? Answer is no. That is not allowed as expense. In case of partner's premises, if the partnership firm or LLP is paying the rent to the partner, in that case, reasonable rent is only allowed. Excess rent is not allowed. For example, if the partnership firm is paying the rent, let's say the rent amount is 1 lakh rupee per month, but the market rate is only 80,000 per month. In such case, what you will do? 80,000 is allowed. Balance 20,000 is the excess rent. No, that is not allowed as deduction. Next case, capital expenditure is not allowed as deduction. So if at all there is a capital expenditure done to the building, then the capital expenditure should be added to the cost of the building, and for that cost you can claim the depreciation. So it is not allowed as deduction. Okay, well, however, tenant can also incur capital expenditure. No, tenant does not own the building. He is not the owner. But what if tenant is doing the capital expenditure? If tenant is doing the capital expenditure, then such expenditure will be deemed as building, and on such deemed building, the tenant can claim depreciation. Okay. Then expense is allowed to the person who is incurring the expense. So if tenant incurs the expense, tenant will get the deduction. If owner incurs the expense, owner will get the deduction, provided the building should be used for the purpose of business. Now let's talk about section number 30, repairs and insurance of machinery, plant and furniture. So first we were talking about building. Now we are talking about plant and machinery and furniture. So for plant and machinery, repairs and insurance is allowed under section 31. Here also there are some conditions. What is the condition? The asset must be used for the purpose of business. So it should be used for business. Even passive use is allowed. So what is passive use? Passive use means not actively being used in business, but still it will be considered as usage. For example, you are having a machinery, 10 machines are there. Just in case if any machine gets repaired, you are having one extra standby machinery. So the standby machinery, even though it is not being used, still it will be considered as passive use. For example, you purchased one generator. This generator you have kept so that if at all there is no power, then you can use the generator for power. However, if the generator is not being used at all, still it will be considered as passive use, because you have kept it so that in case of emergency you can use it. Then let's say you are having fire extinguisher. That fire extinguisher you have kept hanging on the wall. Just in case if there is fire, you can use that fire extinguisher. So this is also passive usage. Then you are having some tools. Just in case there is any repair, you can use the tools to do the repair work. However, if there is no repair, you will not use the tool. This type of use is also called passive use. You get my point? So even passive use is considered as usage, and expense will be allowed as deduction. Now, if the asset is used for partly business and partly some other purpose, then proportionate expense will be allowed as per section 38. Repair includes renewal and renovation, but does not include replacement or reconstruction, because replacement and reconstruction is a capital expenditure, and capital expenditure is not allowed as deduction. Then rent, rates and taxes are not covered in section 31. However, they will be allowed in section number 37. Okay. Now let's talk about the biggest section in your entire direct tax syllabus, that is section number 32, which talks about depreciation. Okay, depreciation. There are 3 conditions to claim depreciation under the Income Tax Act. What are the 3 conditions? Number 1, assessee should be the owner of the asset. Number 2, asset should be used for business or profession. Number 3, asset should be a depreciable asset. So what are the 3 conditions? Assessee should be owner. Number 2, asset should be used for business. Number 3, asset should be a depreciable asset. So let us go into these 3 points one by one. Firstly, talking about ownership. So ownership is allowed, the depreciation is allowed to the owner. So if at all the asset is given on rent, then who can claim the depreciation? The lessor only can claim the depreciation. Fine. Whether it is a finance lease or operating lease, whether it is a short term lease or long term lease, it does not matter. In both cases, the lessor only will get the depreciation. Then if assessee is a part owner, then depreciation will be allowed only for the assessee's share of the asset. Then building owner need not be the owner of land. Kana for land there is no depreciation. For building only there is depreciation. So whoever is the owner of the building can claim the depreciation on building. Then depreciation is allowed even if owner is not the user. So for example, if I am having an asset, that asset I have given on rent, in such case I am not using the asset, my tenant is only using the asset. Still, who will get the depreciation? I only will get the depreciation. So for example, if asset is leased, rented, hired, etc., the lessor will get the depreciation. So if letting out is the business of the assessee, then depreciation can be claimed in PGBP head of income. If letting out is not the business of the assessee, then depreciation can be claimed in income from other sources head of income, but the rules will remain same. Now let's talk about assets should be used for business or profession. So here also even passive use is allowed. Kana. So fire extinguisher, tools, standby machinery, all these are passive uses. If asset is used for partly business and partly other purpose, proportionate depreciation will be allowed, and only such proportionate depreciation should be reduced from the cost of the asset. Okay. Then asset should be a depreciable asset. Kana, depreciable asset means what? The asset can be either a tangible asset or an intangible asset. In tangible asset, there are three classes. In intangible asset, it itself is a class of asset. So what did I say? Tangible asset has three classes. Intangible asset itself is a class. So total there are four classes. Kanna. Firstly, let us talk about intangible asset. Intangible asset is the asset that you cannot touch and feel, but it still exists. For example, know-how, patent, copyright, trademark, license, franchisee, or any other business or commercial or rights of similar nature, but not goodwill. For goodwill, you cannot claim depreciation. For other than goodwill only, intangible assets you can claim as depreciation. So know-how, patent, copyright, trademark, license, franchisee, or any other business or commercial right of similar nature other than goodwill is included in intangible assets. So intangible asset is a class. Now talking about tangible asset. In tangible asset, there are three classes. So first class is building, second class is plant and machinery, third class is furniture. Building, plant and machinery, furniture. So what are the four classes? The four classes are building, plant and machinery, furniture, and intangible asset. So there are totally four classes of depreciable asset. Now let us speak about some special notes about depreciation. Depreciation is mandatory, Karna. It is not optional. The assessee cannot say that I don't want depreciation this year, next year I will claim depreciation. Like that, the assessee cannot tell. Mandatorily, the assessee has to claim depreciation and reduce the WDV of the asset. Okay, no depreciation on land. Then plant includes ships, books, vehicles, scientific apparatus, surgical equipment, but does not include tea bushes, livestock, building, furniture, animals, human body, and stock. So plant includes not only plant and machinery. Other than plant and machinery, it also includes the vehicles. That is, ships also included in plant, vehicles also included in plant, aeroplane, everything included in plant and machinery. Books also included in plant and machinery, Kanna. Then scientific apparatus in the lab and surgical equipment in the hospital, that is also included in plant and machinery. But what is not included? Tea bushes not included, livestock not included, building and furniture not included. So hence you can never say that building is also plant and machinery. It will either be building or it will be plant and machinery. It cannot be both. Okay, va? Similarly, furniture also, animals also, human body, and stock. All these are not plant and machinery. Now talking about building, building obviously includes the permanent structure which is used for the purpose of business. Other than that also, roads are also included in building, bridge also included in building, culverts are also included. Sir, what is culvert? Culvert is nothing but tunnels, Kana. So tunnels also included, well also included, tube well also included in building. Then capital expenditure by the tenant also, I told you, it is a deemed building, and on that you can claim depreciation. Then goodwill of a business or profession, earlier up to previous year 1920 it was considered a depreciable asset, but from previous year 2021 onwards it is not a depreciable asset. So now for goodwill you cannot claim depreciation. Then in case of composite income, entire depreciation is deemed to be allowed. Kana, we are going to learn composite income also in this lecture only, where I am going to tell sometimes in the income there is a mixture of agriculture income as well as business income. In such case, where the income contains both agriculture as well as business, still when it comes to depreciation, it is deemed that the entire depreciation is allowed, and you have to reduce the WDV of the asset by subtracting the entire depreciation. Fine. Now let's come to Additional depreciation we will discuss after depreciation. Firstly, let us talk about depreciation itself. Let us complete this discussion. So in depreciation, there are two methods kana. One is straight line method and the other is WDV method. Straight line method, WDV method. Sir, who can follow straight line method? Only the assessee who is engaged in the business of generation or generation and distribution of power. So which two business? Generation of power or generation and distribution of power. Only in such case the assessee can opt for straight line method. Straight line method. All the other assessees have to compulsorily follow WDV method. So for power generation, they have the option. They can either follow SLM or they can follow WDV. But all the others have to compulsorily follow WDV method. That is written down value method. So in straight line method, the method of calculation is a separate asset system. But in WDV method, the method of calculation is a block of asset system. Separate asset system, it means what? For each and every asset, you have to calculate the depreciation separately. But in block of the asset system, all the similar type of asset. What is meant by block? Block means same class, same rate. If any asset is in the same class and having the same rate, they should all be clubbed together to form a single block. For that block, you have to calculate the depreciation. Okay, wow. Now let's talk about depreciation formula. So in case of straight line method, it will always be cost multiplied by depreciation rate. In WDV, it will be cost, and in the second year onwards, it will be WDV multiplied by depreciation rate. Then actual cost. So actual cost we are going to discuss. It is going to be, the concept is same for both SLM method as well as WDV method. So for both of them, the cost concept is same. Talking about depreciation rate. Depreciation rate for straight line method, if at all it comes in the examination, the rate will be given in the question. So you need not by heart the rates. But WDV method, you have to learn the depreciation rates, which I am going to discuss in some time. Then additional depreciation. In case of straight line method, you cannot claim additional depreciation, but in case of WDV method only, you can claim additional depreciation in the optional tax regime. That also I am going to discuss. Then sale of assets I have discussed in the capital gain chapter, and asset purchase in between the year also I will discuss. So firstly, let me talk about actual cost and depreciation rate. Then we will come back to this discussion. Sir, what is actual cost, sir? What is actual cost? Actual cost means nothing but purchase price of an asset kanna. What cost you are paying to purchase the asset, that is only actual cost. But you have to do certain adjustment to find out the actual cost. What are the adjustment? Let us see. Firstly, you should take what is the amount you have paid to purchase the capital asset. That is only cost. In that, you add the trial run expenditure, reduce the trial run income. So for example, if it is a machinery, you will do the trial run. In trial run, you will put some sample and some product will come out. That product, when you're doing putting the sample and product is coming out, whatever expense is incurred, that should be added to the cost of plant and machinery. Similarly, whenever the product is coming out, let's say you have sold that product in the market and earned some income. This income also has to be reduced from the cost of plant and machinery. So what you have to do? Add the trial run expenditure, reduce the trial run income. Then whatever taxes are there now on which credit is not allowed, all those taxes has to be included in the cost of the asset. For example, if you are importing any asset, you will pay custom duty. That custom duty cannot be taken as credit. That is why custom duty has to be included in the cost. Similarly, let's say there is a normal business which is not involved in buying and selling cars or any driving school. If they are purchasing any passenger car, then for that passenger car, GST input tax credit is not allowed. So for that car, input tax credit has to be added to the cost of the asset. Since they cannot take the credit, they have to add it in the cost. Okay. Then interest on loan. If you have taken a loan to purchase a depreciable asset, then till the asset is put to use, whatever interest is being paid, that interest also has to be included in the cost of the asset. So interest on loan till the asset is put to use. But sir, after the asset is put to use also, let's say the loan is running, then interest is being paid. What to do about such interest? After put to use, whatever interest is being paid can be claimed as deduction under PGBP head of income. That I am going to discuss in section number 36. Okay, well, then subsidy received from government or any other person. So towards the plant and machinery, equipment, building, furniture, etc., whatever subsidy is received, that subsidy also has to be reduced from the cost of the asset. So for the depreciable asset, if you are receiving any subsidy, reduce it from the cost. Then lastly, payment should be made to a person in a day exceeding 10,000 in any mode other than account pay check, account pay bank draft, electronic clearing system or any other prescribed modes. Kana, it is compulsory that if you are making any payment to a person in a day exceeding 10,000 rupee, then that payment has to be made through prescribed modes only. What are the prescribed mode? Prescribed mode means account pay check, account pay bank draft, electronic clearing system and other prescribed modes. Other prescribed modes are there, no? This I have given in section number 40A3, where you can see all these modes of payments, that is credit card, debit card, NEFT, RTGS, IMPS, net banking, UPI and Bhim Aadhaar Pay. All these are prescribed modes. This same section, no, prescribed mode 10,000 to a person in a day, it is repeated in so many sections. So one time you learn, that is enough, and in all these sections you can apply that automatically. So what are the prescribed payments? Account pay check, account pay bank draft, electronic clearing system, credit card, debit card, net banking, IMPS, RTGS, UPI, Bhim Aadhaar Pay. So all these are the prescribed modes of payments. Now coming back to the discussion. So whenever any payment is made more than 10,000 to a single person in a day, it should be through prescribed modes only. It should not be through other than prescribed modes. If it is other than prescribed mode, then you should not include it in the cost. Let me give you an example and let us see whether you are able to understand or not. Let's say you have purchased a furniture for 1 lakh rupees. For 1 lakh rupees, you have purchased furniture. For that, you have made different payments on different days to that person, to the furniture vendor. So let us see how much should be taken as the cost in case of Income Tax Act. First payment was made on 1/4/2025 for 10,000 rupees. Payment was made through cash. Will this payment be included in the cost? Answer is yes, it can be included, because up to 10,000 rupees you can pay in any mode. It can be through prescribed also, other than prescribed also, not a problem. Since it is exact 10,000, it is allowed, so you can include it in the cost. Then on 2nd April, 25,000 was paid through UPI. Is UPI a prescribed mode of payment? Answer is yes. So 25,000 also you can include it in the cost. Then on 3rd of April, 15,000 was paid through cross check. Is crossed check a prescribed mode of payment? Answer is no. Crossed check is not a prescribed mode. Similarly, bearer check also not a prescribed mode. Only account pay check is a prescribed mode of payment. So crossed check not allowed, bearer check not allowed, account pay check only allowed. Fine. Last one. On 6th of April, 20,000 was paid through cash. Since it is more than 10,000 to a person in a day, it is not allowed as it is not allowed to be included in the cost. So now if you see in this 1 lakh rupees, you have to remove all the payments that are not allowed, that is other than prescribed mode. So balance amount only will be taken as cost as per Income Tax Act. So assessee has paid how much? 1 lakh rupees. But what will be taken as cost for calculating depreciation? Only 54,000 rupees will be taken as cost. Are you clear? Now let us come back to the discussion. Okay, so this is the normal method to calculate the actual cost in normal cases. Now let us talk about special cases. In special cases, how to calculate the cost. Firstly, the asset ceased to be used for scientific research. We are going to study in this video only that if at all an asset is used for scientific research, entire cost is allowed as deduction. Hence, actual cost minus deduction under section 35 will be taken as cost to calculate depreciation. So generally entire cost is allowed. That is why always the answer is going to come as 0, nil. So it will be added to the block, but the value of the asset will be taken as 0. Then inventory converted to capital asset. If inventory is converted to capital asset, then fair market value of the inventory as on the date of conversion will be taken as actual cost for calculating depreciation. Then asset acquired by gift or inheritance. So if you have gotten an asset as a gift, then what will be the cost? The cost will be actual cost to the previous owner minus depreciation allowable plus freight or installation, etc. So you take the cost of the previous owner, you reduce whatever is the depreciation that would have been allowed, and you also add the expenses which is incurred by the assessee like freight, installation, etc. Then coming to fourth, second hand asset. If an assessee is purchasing the second hand asset, generally the purchase price is only the cost. However, sometimes the assessing officer might be suspicious that the assessee has paid only some amount, major amount through white money and gotten some amount back as cash. So some black money is involved in the transaction. In such case, the assessing officer will determine the actual cost on the previous approval of joint commissioner. So for example, one asset price is 10 lakh rupees, but just so that I can claim high depreciation, I purchased that asset for 1 crore rupees, second hand asset, so that I can claim high depreciation. So that balance 90 lakhs is there, no, that secretly I gave as cash to the vendor. So in this case, the assessing officer might feel suspicious that the asset value is very low, but he has shown such a high value. So he will take the approval of joint commissioner and he will decide what is the value of the second hand asset. It is only applicable to second hand asset, not applicable to new asset. Now let us talk about reacquisition of asset. Reacquisition means what? My asset I have sold to someone and from them I have repurchased that asset. That is only reacquisition. In such case, you have to see actual cost when it was first acquired minus depreciation allowable or reacquisition cost, whichever is lower. So in this case, let's say I am having an asset, I sold the asset and purchased that asset once again. In such case, you have to see my WDV or my purchase cost, that is the reacquisition cost, whichever is lower will be taken as cost of asset. Now let's come to acquisition of asset previously owned by any person to whom such asset is given on lease, hire or otherwise. So for example, Mr. A purchased asset from Mr. B who was already using the asset in the business and gave the asset to Mr. B on rent, lease or hire, etc. So for example, I am using an asset in the business, I have sold my asset and from that person who has bought, from them I have taken that asset on rent. So what did I say? I have sold my asset and from the buyer I have taken my own asset on rent and now I am paying him the rent. In such case, for my buyer, what will be the cost? The cost will be WDV of the asset in the hands of Mr. B. So what will be my WDV will be my buyer's cost. Okay, now let's talk about building previously owned by assessee which is brought into business. For example, I am having a building. This building I was using for personal usage. Now after 2 years, I want to start using this building for my business. So first I was having building, I was using it for personal purpose. Now after 2 years, I want to convert this building into business purpose. So in that case, for the business, what will be the cost? The cost will be actual cost of the building minus depreciation allowable. So let's say I constructed this building for 1 crore rupees and after 2 years I am converting into business. So what will be my cost in the business? 1 crore rupees minus depreciation for 2 years I have to reduce. Whatever balance amount is coming, that only will be taken as cost of the building. But however, this rule is there. No, this is not applicable to the assets other than building. So for example, I am having a car. This car I had purchased for 10 lakh rupees and I was using for personal purpose. For 5 years I used for personal purpose. But after 5 years I converted into business. Now what will be taken as cost in the business? The cost in the business will be 10 lakhs only. Okay, I need not reduce any depreciation from car. I should only reduce the depreciation allowable from building. You get my point? If at all it is any asset other than building, then this provision is not applicable. Directly you can take the actual cost as the cost. So even after 5 years, I am bringing my car from personal use to business use. Still, before 5 years, whatever I paid as the purchase price will be taken as the cost in my business. But in case of building alone, what I will do? Actual cost minus depreciation allowable. Now let's talk about asset acquired by non-resident outside India and brought into India. So if a non-resident is purchasing the asset outside India, later on bringing it into India, then in that case also the same building point will be applicable to them. That is actual cost minus depreciation allowable will be taken as cost for finding out further depreciation. Okay, actual cost of the asset. Then asset on which deduction has been claimed under section 35 AD converted into non-specified business before the specified time. So this we will be learning in 35 AD kana. Next point also we will be learning in 35 AD itself. After learning 35 AD, you come back and see these points, you will be able to understand. So now we have seen all the special cases of actual cost also. Now you are thorough how to find out the cost of the asset. On this cost only you can claim depreciation. So to claim depreciation, you should also know what are the depreciation rates. So let us now see what are the depreciation rates under WDV method. So first let us talk about class by class. There are 4 classes no kanna: building, furniture, plant and machinery and intangible asset. So there are 4 classes. So first class let us discuss, that is building. In building, if the building is used for residential purpose other than hotel or boarding house, then the depreciation rate is 5%. So building other than hotel, boarding house, depreciation is how much? 5%. But if it is other than residential purpose, it is 10%. So residential purpose 5%, other than residential purpose 10% is the depreciation. However, if it is a temporary erection like a wooden structure etc., then for temporary building 40% is the rate of depreciation. Also, if a building is used in water treatment project or water treatment system, then 40% depreciation. So building, what did I say? Residential purpose 5%, other than residential purpose 10%. Hotel and boarding house, even though it is residential, still it will be 10%. Temporary building 40%. Water treatment project, water treatment system 40%. So these are the rates for the building. Now let us talk about furniture. For furniture, always the depreciation rate is 10%. Furniture 10%. Furniture 10%. And furniture also includes electrical fittings like wiring, switches, socket, fans, and other fittings. So electrical fittings is also included in furniture, for which the depreciation rate is 10%. Now let's talk about plant and machinery. For plant and machinery, generally the depreciation rate is how much? 15%. Generally it is 15%, but let us see for specific asset what is the different rate. Firstly, let us talk about motor car. Motor car can be given on hire or not on hire. If the motor car is not given on hire, in such case, the depreciation rate is 15%, 15%. However, if the motor car was acquired and used between 23 August 2019 to 31/3/2020, that is during this period, the government has brought a scheme that during this period, if any person is buying a motor car and started using it for the business, then they can claim 15% extra depreciation. So that is why if any motor car was purchased between 23 August 2019 to 31/3/2020, then 30% will be the depreciation. Then whatever motor car or motor vehicle is given on hire, in such case normal rate is 30%, and if it is acquired between 23 August 2019 to 31/3/2020, then the rate will be 45%. So generally 15 or 30, however 15% extra if it is acquired between 23 August 2019 to 31/3/2020. So you have to see what is the purchase date in the examination. If at all the examiner wants to set up a tough paper, they can give something like this. So you have to be thorough with the rates. Now let's talk about ship and boat. For ship and boat, always the depreciation rate will be 20%. Ship and boat 20%. Ship and boat 20%. Then molds used in rubber and plastic goods factory. So for molds the rate is 30%, and similarly for plant and machinery which is used in semiconductor industry, for that also 30%. So for mold it is 30%, for semiconductor industry plant and machinery it is 30%. Then for computer the depreciation is 40%. So now we are discussing the 40% category. Computer, it is always 40, and here computer does not mean only the computer, it also includes the software, and it also includes the computer peripherals and accessories like printer, scanner, mouse, keyboard, UPS, CPU. All these are included in the meaning of computer. So computer, the depreciation rate is 40%. But sir, can mobile phone be called a computer? Answer is no. Mobile phone is not a computer. That is why for mobile phone always you will be charging 15% rate only, 40% will not come. Then life-saving medical equipment 40%, pollution control equipment 40%, solid waste control equipment, solid waste recycling and resource recovery 40%, windmill 40%, generator on wind energy 40%, solar energy 40%. So solar panel also 40% depreciation, and moreover if you are buying an electric vehicle, for that also 40% depreciation. Aeroplane 40%, aero engine 40%, glass or plastic container used as refill 40%, electrically operated vehicle. So if you are buying a car which is an electric car, for that you can claim 40% depreciation. Then water treatment project, water treatment system, even if it is a plant and machinery, then also 40%. So water treatment project, water treatment system, if it is a building, then also 40. If it is a plant and machinery, then also 40. And lastly for books also, the depreciation is 40%. So what did I say? For computer, including computer peripheral 40%, life-saving medical equipment 40%, pollution control equipment 40%, solid waste control equipment 40%, windmill 40, generator on wind energy 40, solar energy 40, then solar panels also 40, aeroplane, aero engine 40, electrically operated vehicles, so electric car 40%, water treatment project, water treatment system 40%, books also 40%. So for all these assets, the depreciation rate will be 40%. Now let's talk about the last class, that is fourth class, intangible asset. So intangible asset, that is patent, trademark, copyright, etc. For them, the depreciation rate is always 25. 25% is the rate of depreciation for intangible assets. Now let us talk about block. You should know that for blocks you have to calculate depreciation together. So if there are two or more assets which belong to same class plus same rate, then you have to include the asset in the block, correct? Block. Now let me tell you an example. You see whether both the asset will be coming in the same block or different block. Let us see. First let us talk about commercial building. Commercial building, and there is a residential building. residential building. Will both the buildings be considered as same block or different block? Answer is it will be considered different block, because for commercial building the rate of depreciation is 10%. For residential building it is 5%. So you have to consider them separately. Okay, you can't club both of them together because rate is different. Now let us talk about commercial building plus furniture. So for furniture also 10% is the rate. For commercial building also 10% is the rate. Can you combine both of them to call them a single block? Answer is no. You can't combine them into single block, because commercial building is coming under the building class, but furniture is coming under furniture class. Both the class are different. So even though the rate is same, still you cannot combine them in a single block. Now let us give you another example. Let's say there is a computer and let's say there is a book. Both computer and book, can I club in the single block? Answer is yes, you can call it a single block, because computer is also plant and machinery at 40% and book is also plant and machinery at 40%. So both belong to the same class, that is plant and machinery, and also having the same rate, that is 40%. That is why you can club book and computer. Both of them together will be coming under single block. Fine, you understood now how to club all the assets into single block. Now let us come back to the depreciation discussion. So block is equal to same class plus same rate. Same class plus same rate. So depreciation rate we have studied, actual cost meaning also we have studied. Now let me tell you about the 180 days concept. 180 days concept. Kanna, if an asset is put to use for less than 180 days in the year of purchase, then for that asset you can claim only half depreciation. What did I say? In the year of purchase, if the asset was put to use for less than 180 days, you can claim only half depreciation. But if it was put to use for 180 days or more, you can claim full depreciation. Sir, what if the asset was not at all put to use? The assessee simply bought it and did not use the asset. In such case, no depreciation is allowed, because depreciation is only allowed if the asset is used for business. You get my point? So if it is put not used, no depreciation. If it is put to use for less than 180 days in the year of purchase, then less than 180 days in the year of purchase, then half depreciation. Otherwise it is full depreciation. So 180 days or more, it is full depreciation. And also if it is purchased in some previous year itself, preceding previous year itself it was purchased, but in the previous year it was used for less than 180 days, then also full depreciation. So half depreciation only comes when there is less than 180 days use and purchase during the same year. So then half depreciation. Okay, wow. Half depreciation. Now let me tell you about additional depreciation. Additional depreciation is allowed only if the conditions are satisfied, and the additional depreciation is always 20%. Always 20%. In additional depreciation also, if the asset was put to use for less than 180 days in the year of purchase, 10% is allowed in first year, balance 10% is allowed in second year. You get my point? So 10% in year 1 and 10% in year 2 will be allowed as deduction. Then what are the conditions to claim the additional depreciation, sir? To claim additional depreciation, the assessee should be engaged in business of any of the following, that is manufacture, production, printing and stationery, generation of power, transmission of power, or distribution of power. So what did I say? The assessee should be engaged in manufacture or production or printing and publishing, or generation or transmission or distribution of power. So only in these cases the assessee can claim additional depreciation. Other assessees cannot claim additional depreciation. So sir, one person is only doing trading business, sir, can they claim additional depreciation? Answer is no. Only in case of manufacture or production, or printing and publishing, or power generation, power distribution and power transmission business, you can claim additional depreciation. Then additional depreciation can only be claimed on new plant and machinery. It cannot be claimed on any asset other than plant and machinery. It cannot be claimed on old plant and machinery. And depreciation has to be calculated only as per WDV method. So SLM method cannot claim additional depreciation. And if the assessee opts out of default tax regime, they cannot claim, then only they can claim additional depreciation. So in default tax regime, it is not allowed. Only in the opt-out regime, it is allowed as deduction. So what did I say? Who can claim additional depreciation? Any assessee who is engaged in manufacture or production or printing and publishing, or generation or distribution or transmission of power. Then only they can claim additional depreciation. They should opt for the old tax regime. So they should opt out of the default tax regime. Then only they can claim additional depreciation. Additional depreciation can only be claimed on new plant and machinery. So the plant and machinery should be there and it should be new. Only then it can be claimed. Rate of additional depreciation is 20% and it is allowed only one time. It is not allowed every year, Kanna. It is allowed only in the first year and only one time. But in the first year itself, if it is put to use for less than 180 days in the year of purchase, then 10% is allowed in first year. Balance 10% is allowed in the second year. Fine, you get my point? Then exceptions. Now in the 6 categories of asset, you cannot claim additional depreciation. What are they? Number 1, used plant and machinery. So in case of used plant and machinery, you cannot claim additional depreciation. It does not matter whether the plant and machinery is imported plant and machinery or not, whether 20% is only used or not. That and all you should not see. All that condition is there only in special economic zone and 35 AD deduction. But here there is no such condition. It is very, very strict. If it is used means you cannot claim additional depreciation. Then for ship or aircraft you cannot claim. For road transport vehicle also you cannot claim. But you know what? There is a truck called forklift truck. This forklift truck is not considered as road transport vehicle. So for forklift truck you can claim additional depreciation. Okay. Then for office appliances you cannot claim. Plant and machinery installed in office premises or residential accommodation or guest house you cannot claim. Plant and machinery for which entire cost is already allowed as deduction, for that also you cannot claim. So when I cannot claim, number 1, for used plant machinery not allowed. Then for ship, aircraft, road transport vehicle not allowed. Then for office appliances not allowed. For plant and machinery installed in office or residential accommodation not allowed. And finally, if already deduction has been allowed in some other section, then you cannot claim additional depreciation. So all these are the exceptions for additional depreciation. Now let me show you how to do the calculation, sir. Be very, very attentive now. Listen carefully. Okay. So how to calculate depreciation? Firstly, you have to do step number 1. Take the opening WDV. So what is the opening WDV? Take the previous year closing WDV, and from that you reduce the preceding previous year closing WDV. From that you reduce the depreciation of preceding previous year. Okay, so you will get the opening WDV of the previous year. However, in the question, if you are not getting preceding previous year depreciation, then directly take the preceding previous year closing WDV as the opening WDV of the previous year. Fine. Now, step number 2, add all the purchases or additions during the year. Add all the purchases, add all the additions during the year. Step number 3, reduce all the sales during the year, or if the asset is destroyed, you will get insurance claim, no, that you have to reduce. Fine. So reduce all the money receivable on the asset sold or destroyed during the year. Then step number 4, the total value, you will get this total value for calculation. So first step, what you should do, take the opening WDV. Then from this, what you have to do, you have to add all the purchases. Okay. Then you have to reduce all the sales. But in income tax language, this purchases is nothing but additions, and sales is nothing but money receivable. This you have to reduce. So you will get the total. Now in this total only you have to calculate depreciation. But here you have to remember one point. Kanna, if the total is coming in negative, it means that it is short-term capital gain. So this negative amount, directly you have to add it as the income in capital gain chapter as short-term capital gain, and no need to calculate any depreciation if it is negative. However, if it is positive, then you have to see whether any asset is remaining. If asset is remaining, then only you have to calculate depreciation. If there is no asset remaining, means all the assets have been sold, still I am getting positive value, sir. In such case, it will be called a short-term capital loss. What did I say? Take the opening WDV plus purchases minus sales. You will get what is the total. If the total is negative, it means it is a short-term capital gain. If the total is positive, see whether there is any asset left in the block or not. If any asset is left in the block, then calculate depreciation. If no asset is left in the block, it means the block itself is not existing. So positive amount will be called as short-term capital loss. You get my point? Now, if at all you are having positive answer, and if any asset is remaining, then what you have to do, take this total and divide the total into 3 categories. First category is not put to use category. Second category is put to use for less than 180 days in the year of purchase category. And third category is the balancing figure, that is put to use for more than 180 days, that is 180 days or more. Always you have to fill first category. First that is not put to use category first, then less than 180 days second, whatever balance amount is there, no, that you bring it to the third category. So third category, don't calculate, don't sit in the exam hall and calculate, because depreciation is an illogical section. If you calculate, no, you will get confused. So always use this shortcut method. What is the shortcut method? Whatever total you are getting, this total you divide into three categories. First, you see whatever assets are not put to use, you put it here in the first category. Then you see whatever the asset are put to use for less than 180 days, you put in second category, and whatever balance amount is there, no, in the total, that you have to put in the third category. So for first category there is no depreciation, for second category there is half depreciation, and third category you have to calculate full depreciation. Okay, then whatever is the total, full depreciation plus half depreciation will give you the total depreciation. After that, you have to further reduce additional depreciation in case of old tax regime if the conditions are satisfied. So conditions I told you, no, assessee should be engaged in manufacture, production, printing, publishing, generation, transmission, distribution of power. The asset should be a new plant and machinery. The plant and machinery should not be a old plant and machinery. It should not be road transport vehicle. It should not be ship. It should not be aircraft. It should not be any office appliance, or it should not be installed in office or residential accommodation or guest house, or deduction should not have been claimed in any other sections. If all these conditions are satisfied, 20% additional depreciation can be claimed. If the asset is put to use for less than 180 days, then 20 days in year, 10% in year 1, 10% in year 2, you can claim as additional depreciation. If at all it is given in the question that last year, that is in preceding previous year, the assessee had purchased one asset on which additional depreciation was claimed, 10% was claimed in that year. So this year also you have to claim balance 10%. That you don't forget, Elena, you will make silly mistake. So you have to find out additional depreciation. Then from the WDV, reduce the depreciation also, additional depreciation also. You will find out what is the closing WDV of the previous year. So this is the method to calculate depreciation. So depreciation, such a long discussion. With this, depreciation is over, and now let us talk about last point. Okay, depreciation not yet over. One small point is pending, which is unabsorbed depreciation. Sir, what is this unabsorbed depreciation? Sir, unabsorbed depreciation means the PGBP income is not even sufficient to absorb the depreciation. Let me give you an example. Let's say there is a profit and loss account where the sale is coming as 2 lakh rupees, depreciation is 5 lakh rupees, and all the other expenses are 20 lakh rupees. So total expense is 25. Because total expense is 25, but the income is only 2 lakh rupees. That is why 23 lakh rupees is the loss of PGBP. Now this loss you can divide into two parts. That is, 3 lakhs is the unabsorbed depreciation. Because this 2 lakhs income was able to absorb only 2 lakhs of depreciation, balance 3 lakh is unabsorbed depreciation, and all the remaining expense will be considered as normal PGBP loss. Normal PGBP loss. It is important to differentiate the loss into unabsorbed depreciation and normal PGBP loss. You know why? Because unabsorbed depreciation will get some benefits. What are the benefits? The benefit is that unabsorbed depreciation can be carried forward for unlimited number of years. So next year you can carry forward, and if you are not able to adjust in next year also, then next year you can carry forward, and you can keep on carrying forward the unabsorbed depreciation. Moreover, after doing carry forward, generally you can adjust only against the same head of income, but in case of unabsorbed depreciation, you can adjust against the other heads of income also, other than salary. This I have also discussed when I am taking the set off and carry forward chapter. So that time once again it will be revised for you. Moreover, now listen here, additional depreciation should not contain unabsorbed depreciation should not contain additional depreciation when the assessee is going into new tax regime. Now what did I say? Additional depreciation is only allowed in the old tax regime. It is not allowed in the default tax regime. That is why if the assessee is taking the default tax regime, and while taking default tax regime, if at all there is any unabsorbed depreciation, and inside that unabsorbed depreciation if there is any additional depreciation, then that additional depreciation you cannot carry forward. So what you will do, whatever is the additional depreciation inside the unabsorbed depreciation, you have to add back to the WDV of the asset. You have to add back to the WDV whenever the assessee is shifting to the default tax regime. Fine. So this is the provision. Now let us talk about section number 35, which speaks about expenditure on scientific research. There are two types of expenditure on scientific research. First is in-house research, which means what? Doing the research within the organization. The assessee is doing research himself. That is only in-house research. And second one is contribution. It means what? The assessee is contributing to other organization for the purpose of scientific research. Firstly, let us talk about contribution. Because contribution is not allowed in the default tax regime. It is only allowed as deduction in the optional tax regime. Fine. What is contribution, entire contribution made to the following shall be fully allowed to the assessee if assessee opts out of 115 BAC. So these four cases are there. No, 100% of the contribution will be allowed as deduction under section 35. What are the contribution? Number 1, contribution to notified and approved research association, university, college or any other institution for scientific research, and also for social and statistical research, social science or statistical research. Then national laboratory, university or Indian Institute of Technology for the purpose of scientific research, and lastly approved Indian company which is registered in India and which is having a main object in the memorandum of association of scientific research for the purpose of scientific research. So to whom can assessee contribute? Number 1, notified approved research association, university, college or other institution for scientific research. Number 2, notified approved research association, university, college, other institution for social science or statistical research. Number 3, national laboratory, university or IIT for scientific research. And number 4, approved Indian company for scientific research. So in all these four cases, entire amount of contribution is allowed in the old tax regime. It is not allowed under section 115 BAC, that is default tax regime. Now let us talk about in-house research. In-house research is allowed both in the old regime as well. It is allowed in the default regime as well. What is in-house research? In-house research means assessee is doing scientific research within his own organization. So first let us talk about revenue expenditure. Revenue expenditure is fully allowed as deduction under section 35. Then capital expenditure also fully allowed as deduction other than land. So except land, whatever capital expenditure is done, entire amount is allowed as deduction. So it is a very huge section. Generally capital expenditure you will put it in the asset, block of asset, and you will claim as depreciation, correct? But however in case of scientific research, entire amount of capital expenditure is also allowed as deduction. Now let us talk about prior period. Sir, what is prior period? In case of section number 35, prior period means within 3 years before the date of commencement of business, before the year of commencement of business. Okay, well, if in the prior period there is any revenue expenditure, then only two types of revenue expenditure is allowed karna. That is salary, and second one is raw material for scientific research. That too in salary, no, perquisites is not allowed. Only other than perquisite, whatever salary is paid to the employee for the purpose of scientific research will be allowed as deduction, and raw material for scientific research also will be allowed as deduction. Then coming to capital expenditure, even prior period capital expenditure will be fully allowed as deduction except land. So land is not allowed as deduction under section 35. So what did I say? Once again listen, very very important. In-house research means doing research within the organization. If it is a revenue expenditure, fully allowed. Capital expenditure also other than land, fully allowed. Now let's talk about prior period expenditure. Prior period means that 3 years before the year of commencement of business. So within that 3 years, whatever revenue expenditure is done towards the salary and raw material is fully allowed as deduction, and capital expenditure also other than land fully allowed as deduction. You get my point? Now let's talk about sale of scientific research asset. So if you have purchased a capital asset on which you have claimed scientific research deduction, that is 100% deduction, and later on you are selling that asset, then what will happen? Firstly, let us see what happens if the asset is converted into business. So if the scientific asset is converted into business as a business asset, then add it to the block of asset and take the value as 0. This I already discussed while telling about the actual cost concept. Then what if without using in the business, if it is sold? If it is sold without using in the business, then PGBP income is equal to selling price or deduction claimed, whichever is lower, and capital gain income is equal to selling price minus cost of acquisition. So the entire cost only you are going to claim as deduction. No, cost of the asset into 100% will be claimed as deduction under section 35. So let's say if the asset is sold, then up to the cost whatever amount is received will be income under PGBP head of income. Okay, and above the cost if you are receiving, so for example the asset was purchased for 1 crore but it is sold for 1.2 crores. In that case 1 crore will be PGBP income, balance 20 lakhs is there, no, the balance 20 lakhs will be capital gain income. So capital gain income is equal to selling price minus cost price. So up to cost price PGBP income, above cost price it is capital gain income. There is no concept of capital loss karna. Okay, because the value itself is 0. So however whatever amount you are selling will be treated as profit only. Now let us see other notes. Deduction cannot be denied merely because approval was withdrawn after contribution. When the assessee is making the contribution, no, in case of the second category, that time the assessee should make sure that the association is notified and approved. But after doing the contribution, later on if the approval is withdrawn, then is it the assessee's mistake? Answer is no. While making the contribution he made sure that it is notified and approved. That is why still it will be allowed as deduction. If land and building value is not given separately in the question, then you have to find the value of building and allow it as deduction. So take the value of land, you separate it from land and building, balance amount will be the value of building. Value of building can be claimed as deduction. Then unabsorbed scientific research is treated the same way like unabsorbed depreciation. So unabsorbed depreciation, I told you, it can be carried forward for unlimited number of years, and in next year also it can be set off against any head of income other than salary. So that same rules will apply to unabsorbed scientific research also. Now let's come to section 35 AD, specified business. So 35 AD is a special section where entire capital expenditure including prior period capital expenditure 100% will be allowed as deduction if the assessee is doing any of the specified business which is mentioned in the section. So let me tell you more about it. This 35 AD specified business section is not allowed under section 115 BAC. So you cannot claim this deduction under the default tax regime. You can claim this deduction only in the old tax regime. Moreover, this deduction is an optional deduction. In the old regime also, if the assessee wants, he can claim the deduction. If the assessee does not want this deduction, he can ignore this deduction and go by the normal provisions of the PGBP head of income. You get my point? So what is the deduction, sir? The deduction is that if any of these specified business which I am going to tell you, if the assessee is going to start this business, then in the year of commencement of business, that is the first year of business, in that 100% capital expenditure including prior period expenditure can be claimed as deduction. So 100% capital expenditure in the year of commencement and even prior period expense. And in section 35, what did I tell you? Prior period means 3 years before the commencement of business. But here there is no such rule. Entire prior period expense, even if it is 5 years before the commencement or 6 years before the commencement, still it will be allowed as deduction. So even prior period is allowed. But you know what? 3 types of capital expenditure not allowed as deduction. In section 35, what did we study? Only one capital expenditure, that is land, will not be allowed as deduction for scientific research. But for specified business, there are 3 types of capital expenditure not allowed as deduction, and that is goodwill, financial instrument and land. You can remember like this: GIL, GIL. Okay, goodwill, financial instrument and land. So goodwill means goodwill of business, financial instrument includes shares, debentures, bonds, derivatives, etc., and land also not allowed as deduction under section 35 AD. So other than goodwill, financial instrument and land, all other capital expenditure in the year of commencement of business including prior period capital expenditure is fully allowed as deduction. Now what are the specified businesses? Let us see. So there are 14 specified business, Kanna. I am going to tell all of them one by one. Sir, you should you remember all this? Answer is not required. I am going to tell them. No, you at least listen to it 2 times or 3 times or 4 times, or read this at least 4 or 5 times, so that if you are seeing the business name in your question paper, you should be able to identify that it is a specified business. You get my point? So what are the businesses? First one, cold chain facility for agriculture produce, forest produce, meat, poultry, marine, dairy, horticulture, floriculture and apiculture. So agriculture produce, etc. For that, if there is a cold chain facility, that is a specified business. Then warehousing facility for agriculture produce, it is a specified business. Then warehousing facility for sugar, it is a specified business. But if at all there is warehousing facility for edible oil, is that a specified business? Answer is no. Edible oil is not a specified business, Kanna. Warehousing for agriculture produce is a specified business. Warehousing for sugar is a specified business. Then laying and operating natural gas, crude or petroleum oil pipeline network is a specified business. Then slurry pipeline to transport iron ore from one place to another place is a specified business. Then hotel of 2-star or above category in India. So in India, if you are having a 2-star hotel, 3-star hotel, 4-star hotel, 5-star hotel, everything is a specified business. Then hospital with at least 100 beds in India. In India, you are constructing one hospital, there should be at least 100 beds for the patient. So that is a specified business. Then housing project for slum redevelopment or slum rehabilitation. So housing project for slum redevelopment, and then second one is housing project for affordable housing scheme. This is also specified business. Then inland container depot, container freight station. This is nothing but warehouse for the purpose of storing the export import products. This you will be learning in your CA final level in customs. Okay, inland container depot and container freight station. Then semiconductor wafer fabrication manufacturing unit. It is also specified business. And then 12th one is infrastructure facility. So what is this infrastructure facility? It means constructing, developing, maintaining road, highway, bridge, rail system, port, airport, inland waterway, water supply project, water treatment system, irrigation project, sanitation, sewerage system or solid waste management system. So all these are infrastructure facility. Then 13th one is production of fertilizer in India. That is also specified business. And last one, beekeeping and production of honey and beeswax. So all these are specified business. Once more I am going to tell you what are all the 14 specified specified business. First, cold chain facility for agriculture and other products, then warehousing facility for agricultural produce, warehousing facility for sugar, laying and operating natural gas, crude, petroleum, oil pipeline network, slurry pipeline to transport iron ore, hotel of 2-star or above category in India, hospital with at least 100 beds in India, housing project for slum redevelopment or rehabilitation, housing project for affordable housing scheme, inland container depot, container freight station, then semiconductor wafer fabrication manufacturing unit, then new infrastructure facility, then production of fertilizer in India, and last one, beekeeping and production of honey and beeswax. So all these are specified businesses. For these specified businesses, I told you 100% capital expenditure is allowed as deduction in the year of commencement, including prior period expense and except goodwill, financial instrument and land. For that, there are some other conditions as well. What are the conditions? First one, payment should be made to a person in a day greater than 10,000 rupees, should be through any mode, which should be through prescribed mode only, should not be through other than prescribed mode. This we have already studied when we were discussing about the actual cost. Same type of provision is repeated once again in section 35 AD. So whatever payment should be made, it should be made through prescribed mode only. That is account pay check, account pay bank draft, electronic clearing system, debit card, credit card, NEFT, IMPS, RTGS, UPI, Bhim, Aadhaar Pay. So all those prescribed mode only payment should be made. If a payment is made greater than 10,000 to a person in a day, fine. Then business should not be set up by splitting up or reconstruction of an existing business. I told you in the first year of the business only this deduction is allowed. So this first year of business, some people will what they will do, existing business itself, they will rebrand it as a new business. Is it allowed as deduction? Answer is no. It should be a genuinely new business. Then third one, investment, if it is in plant and machinery, then the plant and machinery should not be a used plant and machinery. Plant and machinery should be new plant and machinery only. However, there are two exceptions for used plant and machinery. That is, the value of used plant and machinery should not be more than 20% of the total value of plant and machinery. So if 100 crores is spent in plant and machinery, up to 20 crores can be used also. It is not a problem. Even this 20% will be considered as new. And second one, imported plant and machinery will not be considered as old if at all it was used, but it was not used in India before installation and no depreciation has been claimed on it. So from outside India, if you are importing second-hand plant and machinery, however, you have not used it in India and in India you have not claimed depreciation also. In such case, even second-hand machinery that you are importing will be considered as new plant and machinery. But be careful, Kanna. These two exceptions are there. No, this is only there in section 35 AD that we are discussing now and in section 10 AA, that is special economic zone. But when we discussed about additional depreciation, there is no such exception. For additional depreciation, 100% should be new only. However, for 35 AD, there are two exceptions. What is the exception? The 20% old plant and machinery is also okay. Moreover, if imported plant and machinery is there, if it is second hand, but if it is not used in India and depreciation has not been claimed, then such imported second hand plant and machinery also will be considered as new plant and machinery. Fine. Then, if deduction is allowed under section 35 AD, then other deduction like section 10 AA or chapter 6A will not be allowed for the same expenditure. Okay, so once you claim in 35 AD, you cannot claim in other places. Then, the asset on which the deduction is claimed should be used for the specified business at least for 8 years. So, whatever asset you are claiming this expenditure deduction, 100% capital expenditure, this you should use it for the specified business only for at least 8 years. If you are not using for the same specified business, no problem, you can use it for other specified business also, but you should only use it for specified business. Audit of books of accounts by a chartered accountant is compulsory in case of 35 AD. Now let us talk about set off and carry forward of losses. For section 35 AD, the set off and carry forward provisions are little bit different. Generally, PGBP loss can only be carried forward for 8 years. Okay. However, in case of 35 AD business, if at all there is a loss due to this deduction, then you can carry forward that loss for indefinite number of years. There is no limit at all. Any number of years you can keep on carry forward. And then second one, that you can, in normal PGBP loss, you can set off against any head of income other than salary. You can set off against PGBP also, other heads of income also. However, when it comes to section 35 AD business loss, you can only set off against the profit of a specified business under section 35 AD. So loss of specified business can only be set off against the profit of another specified business. Set off can be done irrespective of whether the latter is eligible for deduction under section 35 AD or not. Kanna, I am having two business. One business is a hotel business. Another business is a hospital business. Let us assume both of them are specified business. Let's say in hotel business I am having 1 crore loss. Now in hospital business, I am having 2 crores profit. However, this hospital business, no, I have not claimed any section 35 AD specified deduction. Still, can I adjust this loss against the profit of hospital business? Answer is yes. Still you can adjust. So it does not matter whether the profit of specified business is there. No, in that you had claimed this deduction or not claimed the deduction. That does not matter. The only rule is that if at all you are having a loss from a specified business, you can set off against the profit of another specified business. That is only the rule. Okay, then next one, the loss which could not be set off can be carried forward indefinitely. This I already told you. Now let us see what happens if you are converting the specified business asset to non-specified business, or if you are selling the specified business asset, then what happens? Firstly, what happens if the asset is sold? If the specified business asset is sold, then the entire income the entire amount that is received will be treated as income under PGBP. Entire amount. Here in section 35, no, we had discussed up to cost it will be considered as PGBP income. Above the cost it will be considered as capital gain income. But here there is no such rule, Kanna. In section 35 AD, whatever amount you are receiving, even if it is above the cost, entire amount will be treated as income under PGBP. Okay, so whatever amount is received on sale will be treated as income under PGBP. Then if asset is transferred to another specified business, so if it is one specified business, you are transferring the asset to another specified business. Sir, I was having a hotel, sir. In that I was having a building where I had claimed a specified business deduction, the 35 AD deduction. Now this building I am transferring to hospital business. Is it allowed? Answer is yes. From one specified business you can transfer to another specified business. There is no restriction, Karna. Now let us talk about what happens when you are transferring from one specified business to a non-specified business. Here I told you, no, up to 8 years you have to compulsorily use in specified business only. So within 8 years if you are transferring to non-specified business, then the Income Tax Act will punish you. What is the punishment? You know, whatever deduction that you have claimed under section 35 AD, that now will become deemed as income. It will become deemed income. So whatever deduction was claimed under 35 AD will become deemed income. However, if you would have not claimed under section 35 AD, then you would have claimed depreciation. Okay, let's say I was having a section 35 AD specified business asset. There is one building. Okay, in the hotel asset, in the hotel business, there is a building. On this building, I had claimed a section 35 AD deduction. Okay, after 5 years, I transferred the building to my clothing business. Clothing business. So clothing business is a non-specified business. Correct? Now when I transfer within 8 years from specified business to non-specified business, then what will happen? Then I have to reverse my deduction. So let's say this building cost me 100 crores and I had claimed 100 crores as deduction. So now what I have to do? I have to reverse this 100 crores. So now this entire 100 crores will be treated as deemed income, Kanna, under PGBP. But you know what? If at all I had not claimed this 100 crores as deduction, then I would have claimed a depreciation, no? Then I would have claimed depreciation, no? That is why entire amount you need not reverse. You have to reverse only 100 crores minus the depreciation that would have been allowed. That would have been allowed. So here what you have to do, deduction claimed under section 35 AD minus the depreciation that would have been allowed had it been used for non-specified business. That only will be treated as income under PGBP. Fine. Then above amount shall also become the actual cost of the asset and added to the block of asset. So this same amount which is treated as income, no, it will be treated as cost of the asset, and that you have to add it to the block of asset. However, if you transfer the asset to a non-specified business after 8 years, there is no problem. So after 8 years, no income under PGBP, actual cost of the asset to be added to the respective block shall be taken as 0. So after 8 years, you can directly transfer to non-specified business, and when you are adding it to the block of asset, the cost will be taken as 0. So that is the only provision. So this is section 35 AD, very very important. After this revision lecture, definitely you are going to solve the questions, Karna. There are 2 or 3 questions only in the study material. All the 2 or 3 questions you solve it, you will be thorough with the deduction. Very important, because a specific question can be asked in the examination. If it is asked, it will come at least for 6 to 8 marks. Okay, now let us talk about section 35D, that is amortization of preliminary expenditure. So what is preliminary expenditure? Before the incorporation, whatever expenditure is done, no, that is only called preliminary expenditure. Preliminary expenditure is allowed as deduction under section 35D, but it is allowed only to resident and Indian company. So resident assessee and Indian company only can claim deduction. Non-resident foreign company cannot claim deduction. Moreover, this deduction is not allowed in one shot. This deduction is allowed in 5 equal annual installment, Kanna. 5 equal annual installment. So whatever amount that you are going to calculate, that you have to divide by 5 and every year you have to claim for 5 years. That is section 35D. In section 35D, now let us see what can be claimed as deduction. Firstly, let us talk about resident assessee. Resident assessee can claim actual expense or 5% of cost of project, whichever is lower as deduction. So what is this actual expense? Actual expense means feasibility report, project report, market survey, engineering service, legal charges. So there are 5 types of preliminary expense. What are they? Feasibility report, project report, market survey, engineering service, legal charges. So 5 types of preliminary expenditure. If at all it is an Indian company, so 3 more types of expenditure are allowed. That is drafting of article of association and memorandum of association, then printing of article of association and memorandum of association, and last one is underwriting commission or brokerage or any other expense relating to the public issue of shares and debentures. So there are 8 type of expense for Indian company, but for other than Indian company there are 5 types of expense. So once again I am telling what is actual expense: feasibility report, project report, market survey, engineering service, and legal charges. And for Indian company it also includes drafting of article of association and memorandum of association, printing of AOA and MOA, and lastly underwriting commission, brokerage, or any other expense relating to public issue of shares and debentures. So this is actual expense. This actual expense, entire amount you can claim as deduction. However, it should be restricted to 5% of cost of project. So maximum 5% of cost of project only you can claim as deduction. Now what is this cost of project, sir? Cost of project means amount invested in the fixed asset of a new business or extension or setting up of a new unit as per the big books of accounts as on the last day of the year of commencement of or extension. So during the year of commencement, you come to the last day. In the last day of the year of commencement, you see the books of accounts. Whatever is the investment of fixed asset, that only will be called as cost of project. So this cost of project multiplied by 5%. Maximum 5% of cost of project only allowed as deduction. However, you know what? For Indian company, they have the option to choose their higher limit as either 5% of cost of project or 5% of capital employed. So they can choose 5% of cost of project also. They can choose 5% of capital employed also. What they will choose? Obviously they will choose the higher amount so that they can get higher amount of deduction. Okay, wow. Now what is this capital employed? So capital employed means issued share capital plus long-term borrowings plus debenture. What did I say? Issued share capital plus long-term borrowings plus debenture as on the last day of the year of commencement. However, don't include reserves and surplus and security premium. Don't include reserves and surplus and security premium. You should only include what is the issued share capital. That's it. Other than that, long-term borrowings and debentures, this is capital employed. So capital employed also you have to multiply by 5%. So what did I say? In case of Indian company, first step, you take 5% of cost of project or 5% of capital employed, whichever is higher. Then the higher value or actual expense, whichever is lower, will be allowed as deduction under section 35D. And will the entire amount be allowed? Answer is no. It is allowed in 5 equal annual installments. Okay, wow. Entire amount you should not claim. Now what are the other points we have to keep in mind? So this deduction is not allowed to non-resident and foreign company. Then deduction is allowed for expenses incurred before the commencement of business or extension. So preliminary expense itself means prior period expense. Then assessee has to furnish the details of the expenditure to the income tax authority within 1 month prior to the due date of filing return of income. So it is compulsory to give the details to the income tax authority. So this is only section 35D kana, which is preliminary expenditure. So 2 more points are there. If deduction is claimed by a person other than company or cooperative society, then audit is compulsory. Audit is compulsory. Then if deduction is allowed under section 35D, no other deduction shall be allowed for the same expense. So same expense, that is prior period expense, you can't claim in 35D as well as 35. You can claim only in one place. Okay, wow. Now let's talk about section 35DDA, expenditure on voluntary retirement scheme. In salary also we studied voluntary retirement scheme. No, it was from employee point of view. Now we are seeing voluntary retirement scheme from employer point of view. So when employer is giving a voluntary retirement scheme, he has to spend so much money to give the lump sum amount to the employees so that they can leave the organization. Is voluntary retirement scheme expense allowed as deduction? Answer is yes. Entire amount can be claimed as deduction, but it can be claimed in 5 equal annual installment. 5 equal annual installment. So preliminary expense also 5 equal annual installment, VRS also 5 equal annual installment. Sir, what if within this 5 years there is an amalgamation or demerger? Then what will happen? Then the balance deduction is there. No, it can be claimed by the new company. The amalgamated company or the resulting company can claim the balance expenditure. Now comes section 36. But before discussing section 36, it is important that we discuss section 43B first. Section 43B, deduction allowed on actual payment basis. Okay, deduction allowed on actual payment basis is given under section 43B. So what are these deductions? Now I'm going to tell you certain deductions, point number 1 to point number 8. These deductions are only allowed if the actual payment of the amount has been made on or before the due date of filing return of income. So within the previous year, for you, what is the previous year? The previous year is 25-26. Okay, let's assume the due date is 31/7/2026. So whatever expenditure has been claimed in 25-26, that actually has to be paid within 31st July 2026. If it is paid within 31st July, entire amount will be allowed in previous year 25-26 itself. But sir, what if it is paid afterwards? If it is paid on 1st August, what to do? If it is paid on 1st August, then it will be allowed in the year in which the payment is made. So next year it will be allowed as deduction. Okay, so what are the expenses? Let us see. First and foremost, any tax, duty, cess or any other fee payable. So for example, if you are importing the goods and you are paying the custom duty, the custom duty you can claim as deduction only if you are making the actual payment of custom duty within the due date of filing return of income. Then interest, next 2, 3, 4, all 3 points are related to interest. Interest to scheduled bank, interest to cooperative society, interest to public financial institution, state financial corporation or state industrial investment corporation, and then lastly notified class of NBFC, that is non-banking finance company. So these 3 cases, if you are making the interest payment, generally in mercantile system you can take the deduction on accrual basis, correct? However, even if you are taking the deduction on accrual basis, the interest should be actually paid on or before the due date of filing return of income. Okay, and here now you have to keep one thing in mind. If this interest is converted into a loan or borrowing or advance or debenture or any other instrument by which liability is deferred to a future date, it shall not be considered as actual payment. The deduction will be considered as actual payment only in the previous year in which the converted interest is actually paid. So what did I say? Whenever there is an interest, sometimes the assessee will not be able to pay the interest on time. So as a settlement, what the bank will do, the interest itself is there, it will convert it into a loan and it will tell that now in the few more installments you can repay this loan. So when interest is converted to loan, is it called payment of interest? Answer is no. It is only converted into loan. When you are actually paying this loan only, it will be considered that you have repaid the interest and then only it will be allowed as deduction. So interest to scheduled bank, cooperative society, cooperative bank, public financial institution, state financial corporation, state industrial investment corporation and notified class of non-banking finance company will only be allowed as deduction if it is actually paid on or before the due date of filing return of income. Then now next 3 points are related to employer-employee relationship. So what is the first one? Bonus or commission. So if you are paying any bonus or commission to employee, then actually pay it to the employees within the due date of filing return of income. Then leave salary. Leave salary also has to be paid within the due date of filing return of income. And lastly, employer contribution to welfare funds. So if employer is making any contribution to any welfare funds like gratuity fund, provident fund, superannuation fund, pension fund, then it should be actually paid within the due date of filing return of income. And last one is payment to railway authority for using the railway asset. So payment to railway authority also should be made within the due date of filing return of income. So all these 8 cases, number 1 to number 8, is allowed as deduction only if the payment is made within due date of filing return of income. If payment is not made, it is not allowed. If it is late, let's say after the due date, if you have made the payment, then in that year you can claim the deduction. Okay, now let us talk about payment to MSME, that is micro or small enterprise as per MSMED Act. Here for MSME it is a little bit different and you have to be very thorough because there is amendment also. It is important also, there is amendment also. So what is micro enterprise and small enterprise? Micro enterprise and small enterprise is defined in MSMED Act. So you have to see what is the investment in plant and machinery or equipment and also what is the turnover. If investment in plant and machinery or equipment is up to 2.5 crores and the turnover is up to 10 crores. So it means both conditions should be satisfied. If investment in plant and machinery is up to 2.5 crores and the turnover is up to 10 crores, it is called micro enterprise. If investment in plant and machinery is up to 25 crores and the turnover up to 100 crores, then it is called a small enterprise. Small enterprise. So this micro is there. No, you learn micro, multiply it by 10, it will become small. Okay, that is the limit of small. So up to 25 crores and up to 100 crores is the limit. Investment in plant and machinery up to 25 crores and turnover up to 100 crores will be considered as small enterprise. Now why are we learning micro and small? Because if any payment is being made to the micro enterprise or small enterprise, then such payment has to compulsorily be made within the due date as per MSMED Act. So for first 8 points, what did we see? That the payment should be made within the due date of filing return of income. But for micro and small enterprise, the payment has to be made within the due date as per MSMED Act. Sir, what is the due date as per MSMED Act? Let us see now. Let's say Mr. A has purchased the goods from Mr. B. Mr. B is the centric creditor and Mr. B is also a micro or small enterprise. In such case, the payment has to be made within the time limit as per MSMED Act. What is the time limit? For this you have to see whether there is any agreement or no agreement. If there is any agreement, then the time limit should be as per agreement or 45 days maximum. The payment should be within 45 days maximum or time limit as per agreement. Let's say agreement is for 30 days, then the payment has to be made within 30 days. If agreement is for 40 days, then within 45 days. But if agreement is for 50 days, then what you will do? Then you should not see 50, then you should consider 45 only. So if there is any agreement, then you have to make the payment within the agreement date. However, maximum it can be 45 days. However, if there is no agreement, then within 15 days you have to make the payment. So Mr. A has to make the payment if there is no agreement within 15 days. If there is agreement, then as per the agreement he has to make the payment maximum within 45 days. So it cannot be more than 45 days. Never. Okay. If the amount is not paid, then amount will not be allowed as deduction. So whatever amount is paid only will be allowed as deduction. If not paid, not allowed as deduction. And if it is paid late, then deduction only will be allowed in the year of payment. So if you paid after 45 days, then what will happen? Then if you pay on the 46th day, whichever year you are making the payment, that year you can claim as deduction. Did you understand or not? Let us see if you understood or not. Let's say A has purchased the goods worth rupees 10 lakhs from B and A is making the payment. Case number 1. The purchase date is 1/4/2025 and payment date is 31/3/2026. Now, has he made the payment within 45 days? Answer is no. Payment is not made within 45 days. Then when is the payment made? It is made on 31/3/2026. That is why the payment will still be allowed in previous year 25-26. You get my point or not? So hence, if you don't make payment within the time limit, then see which year you are making the payment. So the year of payment becomes the year in which the deduction is allowed. If you made it in 25-26, you can claim in 25-26. Now next case, purchase date is 1/4/2025, but payment date is 1/4/2026. Did you make the payment within the time limit as per MSMED Act? Answer is no. So which year you made the payment? The payment is made in 26-27. That is why deduction is allowed in 26-27. Then next case, purchase date is 31/3/2026, but payment date is 10/4/2026. Here the payment has been made in the next year. However, it has been made within the time limit as per the MSMED Act. That is within 15 days itself payment was made. That is why it is allowed in 25-26, not in 26-27. Now let's talk about next case. Section 31/3/2026. The purchase was made. Agreement was there for 60 days and payment was made in 50 days. Now what will happen? Payment is made as per agreement, sir. However, even though there is agreement, what did I tell you? Maximum it can be 45 days only. Since it is made after 45 days, that is why in that year it will be allowed as deduction. So since it is made in 20th May 2026, it will be allowed in previous year 26-27. Now is it clear? Now you know how to solve the question. Very good, Kanna. So this is the actual payment basis. Now let us come to section 36, general deduction. Now this general deduction are there, no? This is not segregated like how I have segregated here, insurance related, salary related and all. I have only segregated so that it is easier for you to learn. Firstly, let us learn all the insurance related deductions. Firstly, we are going to learn about stock insurance. Stock insurance is only allowed if it is paid by the assessee. If it is not paid, it is not allowed. Here listen Karna, in your study material you will get confused between payment basis. Here payment means payment within the previous year. If stock insurance is paid within the previous year, it is allowed. If it is not paid, it is not allowed. If it is paid in next year, it will be allowed in the next year. Okay, here there is no concept of due date of filing return of income. That concept is only there in 43B. That is why here, to avoid the confusion, in my material I have given two types of wordings Karna. One is called payment basis and second is called actual payment basis. So if you see the payment basis word, it means you should understand that the payment has to be made within 31st March 2026 itself. only then it will be allowed as deduction. But if you see the word called actual payment basis, then you should know that the payment can be made within the due date of filing return of income. Okay, so that you don't get confused, I have given different wordings. So first, what we are learning, stock insurance. So if the assessee is taking insurance on stock, then the premium has to be paid within the previous year itself. It is paid, it will be allowed. If it is not paid, it is not allowed. Now let's talk about employee health insurance premium. Employee health insurance premium is allowed as deduction on payment basis. So within the year itself, it should be paid, and it should be paid through any mode other than cash. It should not be paid in cash. Now let's talk about salary related deductions. Firstly, bonus or commission. So if bonus or commission is paid to employee, we have already discussed in section 43B, no, it should be paid on or before the due date of filing return of income as per section 43B. Only then it will be allowed as deduction. Now let's talk about employer contribution to funds. In 43B, we have already discussed that if employer is contributing to the fund, then it is only allowed as deduction if it is paid within the due date of filing return of income as per section 43B. And in section 36, it is given that it is only allowed if it is paid to the approved funds, that is approved superannuation fund, approved gratuity fund, recognized provident fund, statutory provident fund, or any other fund as per law. Okay, so only to the legal funds if you are paying, it will be allowed as deduction. To other unapproved fund and all, it will not be allowed as deduction. Then employer contribution to pension scheme. Employer contribution to pension scheme also is allowed on actual payment basis as per section 43B. Moreover, here there is a limit kana. Employer can contribute maximum how much? Only 14% of salary. And here salary means basic salary plus DA terms. Basic salary plus DA terms. Okay, so up to that maximum 14% only employer can contribute. If employer is contributing higher amount, then only up to 14% will be allowed as deduction. Balance amount will not be allowed as deduction to the employer. Now let's talk about employee contribution. Kana, employee contribution is not at all an expense. Okay, let's say there is an employer, there is an employee. Employer contributes to the fund. Okay, this is called employer contribution. Employer can claim deduction if he is paying within the due date of filing return of income, and if it is to the approved fund, he can claim the deduction. When employee is contributing, then there is no question about deduction at all, because it is an expense which is made by the employee. Then why are we studying employee contribution here? Because generally you know what happens. Employee himself will not contribute. Employer only will be giving salary, no? Salary to this employee. In the salary only, he will cut some portion as employee contribution, and employer only will deposit the employee contribution to the fund. Okay, it can be provident fund, superannuation fund, whatever fund. So employee contribution will also be deposited by the employer only generally. If the employer is not depositing this employee contribution to the fund within the due date as per fund, within the due date as per fund, not return of income kana, due date as per fund, then what will happen, you know, this entire employee contribution, the Income Tax Act will give punishment that this entire employee contribution will be considered as deemed income of the employer. So what did I say? This employer is there, no? He should contribute employer contribution. That should be contributed within due date of furnishing return of income. It will be allowed as deduction on actual payment basis if the payment is made to a approved fund. Now let's talk about employee contribution. If the employee contribution, that also payment has to be made by employer only. Because what employer will do, when he is giving the salary, he will cut a portion of the salary, and that portion only he will be depositing to the fund as employee contribution. Here the Income Tax Act is very strict. When the employer is depositing employee's contribution, he should contribute within the due date as per the fund. If he is not contributing within due date as per fund, then entire amount of employee contribution will be treated as the income of the employer. Okay. So only if it is paid on or before the due date of fund. So due date of employee provident fund is how much? It is 15th of the next month. So if it is paid after the due date, then it is deemed as PGBP income. Now let us talk about other business related deduction. Firstly, interest paid. So if any loan is taken for the purpose of business, then whatever is the interest paid for such loan will be allowed as deduction. So interest on borrowings is allowed only if it is related to business, other than interest added to cost under section 43 subsection 1. What did we learn in 43 subsection 1? We had learned that if the loan is taken to purchase a depreciable asset, then you should add the interest up to the date of put to use to the cost of the asset, and balance interest you can claim as deduction under section 36. Fine. Certain interest we have already discussed, scheduled bank, etc. that can be claimed only on actual payment basis under section 43B. Now let us talk about bad debts kana. Bad debts means what? some amount that you were supposed to receive, but the person is not paying you and it is irrecoverable now. Hence, this irrecoverable bad debts can be claimed as deduction. But bad debts can only be claimed as deduction if it was taken into income earlier. For example, you have shown it as sales. Sales is an income. Now that value of sales, if it is credit sales, it will be standing in the sundry creditors. If the sundry creditors is not making you the payment, then it is called bad debts. This bad debts can be claimed as deduction. However, if you have given a loan, then the loan is not your income, Kanna. That is why when the person is not repaying you the loan, it is a bad debt of loan. Bad debt of loan is not allowed as deduction because earlier loan was not treated as income. Only one person can claim the bad debts of loan as deduction, that is the person who is having money lending business. So if the assessee is having money lending business, then bad debts of loan also can be claimed as deduction. Now, bad debts, to claim it as deduction, you have to take it into income earlier and also you have to write it off in the books of accounts. It is compulsory that you write off in the books of accounts. But provision for bad and doubtful debts and all not allowed as deduction. Only actual bad debts will be allowed as deduction. Provision will not be allowed as deduction. You get my point? Then let's talk about CTT and STT. Security transaction tax and commodity transaction tax can be claimed as deduction if it is for the purpose of business. But in the capital gain chapter, what did we learn? STT and CTT is not allowed as deduction. In PGBP, it is allowed as deduction. In capital gain, it is not allowed as deduction. Okay, well, now let's talk about other deductions. Firstly, discount on zero coupon bond. So what is zero coupon bond? Coupon means interest gana. Zero coupon bond means zero interest bond. So what is this zero coupon bond? It means bond will be first issued at discount. Let's say the bond value is 100 rupees. It will be issued at 90 rupees. But later on when there is maturity, entire 100 rupees will be paid, but there will not be any interest. So what is the interest? This discount on zero coupon bond is only the interest, that is 10 rupees is the interest. Now how to claim the deduction on discount on zero coupon bond? So to claim the deduction, what you have to do, deduction is equal to maturity price minus issue price. Okay, so here what is the maturity price? 100 rupees minus issue price, that is 90 rupees, divided by number of months. So let's say the bond is for 11 months, so you should divide by number of months, 11 months. So you will get deduction per month, Kanna. Deduction per month. Now in the previous year, how many months are there which is covered in the zero coupon bond that you see, multiplied by number of months. So that many months you multiply, you will get the deduction. So what you have to do? You have to do maturity price minus issue price divided by number of months multiplied by number of months during the previous year of the bond. Okay, now let's talk about promoting family planning expenses. Kanna, family planning is there, no? That will be done by individuals. Okay, husband wife will only do family planning, but expenditure is not allowed to husband wife. Expenditure is allowed to companies only. Expenditure is only allowed to whom? Only company can claim family planning expenditure. So when company is promoting family planning amongst the employees, then the entire expenditure can be claimed as deduction. If it is a revenue expenditure, it is fully allowed as deduction. But if it is a capital expenditure, it will be allowed in 5 equal annual installments. So capital expenditure, 5 equal annual installments. And here for family planning, if at all the profit is not sufficient to absorb the family planning expenditure, it will be called as unabsorbed family planning expenditure. This unabsorbed family planning expenditure is treated the same way as unabsorbed depreciation and unabsorbed scientific research expenditure. So it means what? You can carry forward for unlimited number of years, and after carrying forward also you can set off against any other income other than salary. Okay, so that is the benefit given to family planning expenditure. So these are all section 36 deductions. Now let us talk about section 37, which is residuary expenses. Now Kanna, we have discussed so many deduction, but so many deduction we have not discussed also. That is printing and stationery, travel, conveyance. So many deductions are there which we have not discussed. Does it mean that it is not allowed? Answer is no. Whatever is the any other deduction, if it is related to business, it will be allowed under section 37, that is residuary expenses. So any expense related to business will be allowed as deduction, but you have to satisfy certain condition. What are the condition? The expense should be for the purpose of business or profession. Only then it will be allowed. Then only revenue expenditure is allowed. Capital expenditure not allowed. Only revenue expenditure allowed, and only legal expenses allowed, Kanna. Illegal expenses not allowed. If it is illegal income, you should add it to the income. But if it is illegal expense, you should not allow it as deduction. Okay, then prior period expense is not allowed. So prior period expense can only be claimed in two places, section 35, that is 3 years prior period, and 35 AD, that is all the prior period you can claim. But in section 37, prior period is not allowed. Even in preliminary expense you are claiming prior period only. Okay, my mistake. Then contingent expense also not allowed as deduction. So I told you, provision for bad and doubtful debts, like this, if you are creating any provision, that is not allowed as deduction under PGBP. Only legal expense is allowed, illegal expense not allowed. What is illegal expense? Illegal expense means expense for any offense that is prohibited by law in India or outside India. For example, you are paying a bribe. This bribe you are paying for business purpose only, but it is not allowed as deduction because bribe is not a legal expenditure. Then providing benefit or perquisite to a person where acceptance of such benefit or perquisite is in violation of law. So it might be legal for you, but for the person who is receiving the money it might be illegal. Then also it is not allowed. For example, there is a laboratory. That laboratory is paying referral fees to doctor for referring the laboratory. For doctor, accepting this referral fees or commission is not legal. That is why for laboratory also it will not be allowed as deduction. So when lab is paying referral fees or commission to doctors, or pharma companies are paying freebies to doctors, it is not allowed as deduction, because for the doctors it is not allowed as it is not legal when they are receiving such income. Okay, then compounding fees paid for any offense. So compounding fees, and next one is settlement amount paid in relation to contravention of any law. So you are making any mistake as per law, it is illegal. Now to settle that mistake you are paying some amount for that authority. That is also considered as illegal expense only. It is not allowed as deduction. For example, you constructed one building. For that you had gotten an approval only for 2000 square feet, but you built 2500 square feet. This extra 500 square feet, now you are paying some compounding fees to make this 500 from illegal to legal. Is it allowed as deduction? Answer is no. It is not allowed as deduction. And here there is an amendment also. It is a clarificatory amendment. The amendment is telling, even if the settlement amount was paid as per SEBI Act, that is Security and Exchange Board of India Act, or SCRA, that is Security Contract Regulation Act, or Depository Act, or Competition Act, even then it will not be allowed as deduction. So what did I say? Even if the amount is paid as per SEBI Act or SCRA Act or Depository Act or Competition Act, still it will not be allowed as deduction. So if any amount is paid which is not legal as per law, it will not be allowed as deduction. But you know what? If an amount is paid which is a breach of contract, then it will be allowed as deduction. Breach of law not allowed as deduction, but breach of contract is allowed as deduction. For example, I am doing business with another person and I promised that I will do a delivery within 10 days. If I don't do delivery within 10 days, I will give you a fine of 5,000 rupees. Okay, fine of 5,000 rupees. Now this is my business contract. As per business contract, let's say I was able to do delivery after 12 days only. So I paid him 5,000 rupees as fine. Will this fine be allowed or not allowed? Answer is it will be allowed, because it is only a breach of contract. It is not a breach of law. Breach of law not allowed. Breach of contract is allowed as deduction. Now let us talk about other expenses. Some other expenses that are not allowed, I am going to tell you. First is corporate social responsibility. Kanna, CSR expense is the expense which is made by company for corporate social responsibility. This expense is a compulsory expense for the company. Still, it is not allowed under Income Tax Act. Then advertisement. If the advertisement is made in any souvenir, brochure, pamphlet, newspaper, etc., which is published by a political party, then such advertisement expenditure not allowed as deduction. Then if any dividend is paid, can you claim dividend as expense? Answer is no. Dividend is a distribution of profit, Kanna. It is not an expenditure. Hence dividend is not allowed as deduction. And lastly, any penalty paid to any tax authority. So as per Income Tax Act or as per any act, let's say GST Act also, if you are paying any penalty, that penalty is not allowed as deduction. Now let us see some expenses that are allowed as deduction. So firstly is gift to employees. To encourage the employees, the employer is giving gift. Can this be claimed as deduction? Answer is yes. You are promoting the employees only, so that they will be motivated and do work for your business. That is why gift to employees allowed as deduction. You are doing puja. With this puja, you are enhancing the spiritual atmosphere. You are increasing the positivity in your business. So this will be allowed as deduction. So puja expense allowed. Then seminar fees. So I am a chartered accountant. I am attending seminar, etc. This is for the purpose of my profession only. So I can claim the seminar fees as deduction. Then indirect taxes that are not claimed as credit on actual payment basis can be claimed as deduction. So for example, I am purchasing some goods. On this import purchase, I am paying custom duty. This custom duty is not allowed as credit. Can I claim this custom duty as deduction? Answer is yes. Since you are not getting credit, you can claim it as deduction. But you have to make sure that the deduction is on actual payment basis. Now let's talk about all the deductions are over. Now let us talk about inadmissible deduction kana, that is disallowances. So whatever is allowed that we have discussed. Now we are discussing what and all is not allowed as deduction. Firstly, let us talk about section 40 small a series. So 40 subsection A. So first one is payment outside India or within India to a non-resident without deducting a TDS. Or TDS is deducted but it is not paid within the due date of filing return of income, then entire expenditure is disallowed. So what did I say? If any amount is paid to a non-resident or if it is paid outside India, if TDS is supposed to be deducted, then it is compulsory to deduct the TDS and pay the TDS to the government within the due date of filing return of income. If TDS is paid within due date of filing return of income, then entire amount will be allowed as deduction during the previous year. However, if TDS is paid after the due date of filing return of income, then it will be allowed in that year kana. Let's say due date of filing return of income is 31st July. So TDS I paid to the government in August month only. Then what will happen? Then next year only I can claim the deduction. Now let us talk about resident. Okay, if payment is made to a resident and if TDS was supposed to be deducted but TDS is not deducted or deducted but not paid within the due date of filing return of income, then 30% of the expenditure will not be allowed. So when can I claim this 30%? In future when I actually deposit the TDS, no, after the due date, then I can claim the deduction of 30%. So if TDS is not paid within the due date of filing return of income, 30% of the amount is disallowed. It will be allowed in the year in which the payment is made. Now there is one exception karna. Let's say when I am making the payment, no, I forgot to deduct the TDS. But the opposite person, no, he was a very good person, genuine person. So what did he do? Correctly, he has shown his income in the return of income. He has paid taxes on that income and he has filed the return of income and is giving me the CA certificate that the chartered accountant is telling that this person has correctly shown whatever your payment is there. No, he has correctly shown it in the return of income and paid the tax. So what did I say? The person who is receiving the payment from us, that is resident or non-resident, both it is applicable. The person who is receiving the payment, that is the payee, okay, payee, should pay the tax, should show the amount in the return of income, should file the return of income and should give CA certificate. If all these four conditions are satisfied, then in the year in which that person is filing the return of income, in that year you can claim the deduction. Okay, so both above are allowed in the year when the TDS is paid. Also, if the payee has paid the tax, included the amount in total income, filed return of income and gives the CA certificate, the amount so allowed in the year, is allowed in the year in which the return of income is filed by the payee. Even if the payee files within due date, let's say the person who is receiving the payment, no, they are filing the return, but they are filing within the due date itself. Now, can you claim in previous year 25-26 or 26-27? Answer is 26-27. If they are filing the return of income, no, then you can't wait till the due date. Whichever year they are filing the return of income, that year it will be allowed as deduction. So still deduction will be allowed to the payer only in the year of filing. So in which year they are filing, that year you can claim the deduction. Now let's talk about salary payable outside India. This provision is very strict provision kana, because if the person is paying salary outside India or in India to a non-resident, then if the person forgot to deduct the TDS, 100% TDS is disallowed. 100% salary is disallowed and he has to pay within the TDS due date kana. Not within the return of filing date or due date of filing return of income. The person has to pay the TDS within the due date to pay TDS. If it is not paid within due date, it is not allowed. If it is paid late also, it is not allowed as deduction. If you pay within time, it is allowed. If you don't pay within time, it is never allowed as deduction. What did I say? Salary paid outside India or within India to a non-resident. If TDS is not deducted or if TDS is deducted but not paid within TDS due date, then 100% disallowed. Next. Income tax, surcharge, cess or any other tax on PGBP or interest on tax is not allowed as deduction. So income tax is not allowed as deduction under Income Tax Act. Okay, then tax paid on non-monetary perquisite of employee. If the employer is paying the tax on the non-monetary perquisites of employees, then it is not allowed as deduction for employer, and in the hands of employee it will be considered as exempt income. So for employer it is not allowed, for employee it is exempt income. Now let's talk about section 40 B series. So section 40 Small b, subsection B, let us discuss first. It talks about interest on capital to partner and remuneration to partner. Kana, interest on capital which is given to partner and remuneration given to partner, it is allowed as deduction but subject to the limits which are given in section 40b. Firstly, let us talk about the limits on interest on capital given to partner. Interest on capital given to partner is allowed only if it is authorized by the partnership deed, only if it is after the date on which it is entered in the partnership deed. So in the partnership deed you can't enter that I will be allowing the interest on capital from previous year onwards, like that you cannot say. Only after the date of deed it will be allowed, and maximum 12% only allowed. So what did I say? Only if authorized by partnership deed, only if it is after the date of the deed, and only up to 12% will be allowed as deduction. So it is very simple. Take the actual interest or partnership deed interest or 12%, whichever is lower will be allowed as deduction. What did I say? Actual interest or partnership deed interest or 12%, whichever is lower will be allowed as deduction. Now let's talk about remuneration paid to partners. So remuneration means what? Salary given to partners. Okay, salary is allowed only if it is given to working partner. Okay, salary given to non-working partner, sleeping partner, dormant partner, or sometimes they call them as investing partner, that and all is not allowed as deduction. Only working partner allowed as deduction. Then salary is allowed only if it is authorized by partnership deed. So in the partnership deed it should be mentioned that this much salary can be given to the partners. Then only if it is after the date of the deed, and only if it is within the limit. What is the limit? Up to 6 lakhs rupees, 3 lakhs or 90%, whichever is higher. So take the book profit, up to 6 lakhs of book profit, 3 lakhs or 90%, whichever is higher will be allowed as deduction. On balance book profit, 60% of book profit will be allowed as deduction. So up to 6 lakh 90%, above 6 lakh 60%. Up to 6 lakh 90%, above 6 lakh 60% will be allowed as deduction. But sir, what if there is a loss? If there is a loss, how much maximum partner salary can be given? Answer is 3 lakhs. Because 3 lakhs or 90%, whichever is higher. Okay, so 3 lakhs or 90%, whichever is higher, and on above 6 lakhs it will be 60% of the book profit. Fine. I have given you example also here. If the book profit is loss of 5 lakhs, then maximum partner salary can be given is 3 lakhs. If book profit is 1 lakh rupees, maximum salary is 3 lakhs. If book profit is 6 lakhs, then maximum is 90%. So 5 lakh 40. 540 or 3 lakhs, whichever is higher, that is why 540. And if book profit is 10 lakhs, then maximum salary is 7 lakh 80,000. This you can do calculation and see, you will get the answer. Fine. Now, sir, what is this book profit? What is book profit? Take the net profit as per PGBP head of income Kanna. So book profit has no relation with net profit as per books of accounts. Books of accounts has no relation with book profit. Okay, book profit means take the PGBP as per PGBP income. From the PGBP net profit, you reduce the interest on capital, you reduce the depreciation, you reduce the brought forward unabsorbed depreciation, brought forward unabsorbed scientific research expenditure, brought forward unabsorbed family planning expenditure. All this you reduce, then you will finally get the book profit. So what you should do? Take the PGBP net profit. Means what? As per profit and gains of business or profession, what is the income that you have to see? On this income, you can further reduce interest on capital, you reduce depreciation, you reduce unabsorbed depreciation brought forward, you reduce brought forward scientific research expense, you reduce brought forward family planning expenditure. Then whatever amount is remaining, this is only called as book profit. So on this book profit only you have to calculate 60%, 90% as the case may be. Now let us talk about section 40 capital A series. Firstly, related party transaction. So if any payment is made to a related party, then excess payment is not allowed as deduction. Reasonable payment will be allowed as deduction. Sir, who is related party, sir? Related party means spouse, brother, sister, lineal ascendant, lineal descendant. What did I say? Spouse, brother, sister, lineal ascendant, lineal descendant. Then for other than individual, who is the relative? Director, partner or the members will be the relative, and their relatives also will be the relative. So for example, for a company, director and the director's relatives will be the relative. For a partnership firm, partner and their relatives will be the relative. And for AOP, BOI, etc., member and their relative will be the relatives. You get my point? So all these are relatives. Then What is associate? Even associate is covered in this section Kanna. Associate means concern in which the person or relative is having substantial interest. Substantial interest means 20%. Always it is 20%. 20% or more voting power or 20% or more profit sharing is called substantial interest. So if any relative or any associate, if I am making any payment to a relative or associate, then reasonable payment is allowed as deduction, excess payment not allowed as deduction. So let's say I am making a payment of rent to a relative. Market rate of rent is 60,000, but what rent I am paying is 1 lakh rupees. So 60,000 allowed as deduction, balance 40,000 not allowed as deduction. You get my point? Now let's come to section 40A3. This is also very important. If payment is made above 10,000 to a person in a day, then it should be through prescribed mode. If it is other than prescribed mode, it is not allowed as deduction. What are the prescribed mode? Account pay check, account pay bank draft, electronic clearing system, or other prescribed mode, which is credit card, debit card, NEFT, RTGS, IMPS, net banking, UPI, and Bhim Aadhaar Pay. So all these are prescribed modes of payment. So here also the same example which I took for actual cost now, it will be applicable here. So in a day, if I pay exact 10,000 in cash, will it be allowed? Answer is yes. But if I pay more than 10,000, it is not allowed. Cross check, not allowed. Bearer check, not allowed. Account pay check, allowed. Okay, allowed as deduction. Fine. Now this limit of 10,000 now, it will be increased to 35,000 in case of transport expense. So if you are paying the transport expenses to a goods carriage, in that case, instead of 10,000 up to 35,000 also you can pay through other than prescribed modes. And if the payment is made as a retirement benefit to the employee, then you can pay up to 50,000 also. So let's say I am paying gratuity to my employee. That gratuity, can I pay in cash up to 50,000? Answer is yes, I can pay through cash also. You get my point? Now, let's say there is an expenditure. This expenditure now you claimed as deduction on accrual basis. Now in next year when you are making the actual payment, you have made payment of more than 10,000 to a person in a day other than prescribed mode in the next year. So previous year 25-26 you claimed as deduction, but in 26-27 you violated section 40A3 and made the payment through other than prescribed mode. Then what will happen? Then in the next year the amount that you have paid other than prescribed mode will be considered as deemed income. Deemed income. Okay, wow. Now let us see Rule 6DD Kana. Rule 6DD. What is Rule 6DD? Rule 6DD tells that what are all the places which is not covered under 40A3. It means what? For all these payments, no, I can make any cash payment also, 1 lakh rupees also, 2 lakh rupees also, it will be allowed. So for all these cases, I can make the payment through other than prescribed mode, even more than 10,000 in a day. So what are the exceptions? Number 1, payment is made to government. So I am going and paying my electricity bill to the government. This electricity bill is 20,000 rupees. Can I pay fully in cash? Answer is yes. Because you are paying to the government, no, you can pay in cash, not a problem. Then if you pay to RBI, you can pay. Then to cooperative banks, Primary Agriculture Credit Society, LIC. Then if you are paying to any employee who is posted in a place for 15 days or more where there is no bank or no authorized dealer or money changer, there also you can pay to the employee in cash. Then if you are paying to an agent, and if agent is going to pay in any of these mode, then also you can pay to agent also. Then you can pay to the agent also, it will be allowed. Then payment made through letter of credit is also allowed. Payment made through mail or telegraphic transfer allowed. Payment made directly to the bank account of the payee, that is also allowed. Then bill of exchange is also a valid mode of payment, and book adjustment also is a valid mode of payment. So what is book adjustment Kana? For example, I have to give you 1 lakh rupee. You have to give me 60,000 rupee. So 60,000 we will cancel each other through book adjustment. Balance 40,000 alone I will pay you. So what did I tell? I have to give you 1 lakh, you have to give me 60,000. Now 60 I cancelled and balance 40,000 only I paid you. This type of transaction is called book adjustment. I cancelled 60,000, no, that is only book adjustment. Is it allowed in Income Tax Act? Answer is yes, it is allowed because it is covered in Rule 6DD. Now let's talk about payment made to purchase. So all these products, if you are purchasing directly from the cultivator or producer, then it is fully allowed even if it is made through other than prescribed mode. What are they? Agriculture product, forest produce. So to the farmer, I am directly paying to the farmer and getting the agriculture produce. Is it allowed as deduction? Answer is yes. Then animal husbandry or dairy allowed as deduction. Poultry farming, fish or fish products, horticulture or apiculture, manufacturing in cottage industry without using power. So in all these places, if any payment is made other than prescribed mode also allowed as deduction, but only to cultivator or producer, not to the reseller. Kana, if I am going to Amazon and in Amazon if I am buying agriculture produce, Then can I pay through other than prescribed mode? Answer is no. For Amazon it is not allowed. Only directly if I am purchasing from the farmer, then only it is allowed. Okay, so this is rule 6DD. Last point, payment in a village or town where there is no banking facility. So if there is no banking facility, then you can pay in cash also, not a problem. Fine. So these are all the places which are exception to rule 40A3. This rule 40A3 no kanna, see, it comes in so many places. So all these places you learn only one time and you have to apply in these sections. So you will be sorted. Okay, now let's come to section 40A7. Provision for gratuity is allowed only if it is actually payable. So just like that, provision for gratuity is not allowed as deduction. Actually, if it is going to be paid to the employee, then only it will be allowed as deduction. Then contribution to welfare funds other than those mentioned in section 36 is not allowed as deduction. So it is only allowed to approved superannuation fund, approved gratuity fund, recognized provident fund, statutory provident fund, national pension scheme. Other than this, it is not allowed as deduction. Fine. Now let's come to section 43A, which talks about change in exchange rate of currency. Karna, it is very simple. Let's say you bought a plant and machinery and it is imported plant and machinery. You are buying from another country. Let's say while buying the plant and machinery, you bought for $1,000. $1,000. At that time, the conversion rate was 92 rupees per dollar. But now, while you are actually making the payment to the seller, that time you have paid $1,000, but while making the payment, the conversion rate was 95 rupees per dollar. 95 rupees per dollar. Now what to do? You have paid $3 rupees extra. No, this 3 rupees what you will do? First, while purchasing the plant and machinery, what entry you will put? 1000 into 92 is equal to 92,000. Will be taken as cost of plant and machinery. Now while making the payment, how much did you pay? 95,000. So what about this 3,000 difference? This 3,000 you add it to the cost. Add to cost. Sir, what if there is a profit in currency? If there is a profit in foreign exchange fluctuation, then you reduce from the cost. So that's what is given here. If an asset is acquired through foreign currency on credit or loan and payment is made late, then the difference in the liability, gain or loss because of the difference in exchange rate shall be adjusted with the block of asset. So if there is a loss, you add it to the cost. If there is a profit, you reduce it from the cost. Now let's come to deemed income. So there are 4 cases of deemed income in PGBP. First is remission or cessation of trading liability. So any amount, if it is received back after claiming it as a loss or expenditure or liability, will be deemed income. For example, I have to make a payment of salary. So salary payable I claimed as deduction 10 lakh rupees. But later on that employee ran away and now I need not pay him any salary at all. So now it is my deemed income. So I have to add it to my income. Okay, then balancing charge. Balancing charge means what? Balancing charge is the profit on sale of the depreciable asset, which we are going to learn in capital gain chapter. There I have discussed what is balancing charge. Then sale of capital asset used for scientific research, that is also deemed income. And then if bad debts, first if it is claimed as expenditure, later on if there is recovery of bad debts, then recovery of bad debt will be treated as income. Now let's talk about presumptive income. So all the deductions are over, all the disallowances are over, deemed income is also over. Now we are discussing about presumptive income presumptive income and audit. First let us talk about presumptive income, that is section 44 ADA, section 44 AD and section 44 AE. What is presumptive income? Presumptive income is a scheme which is given in the Income Tax Act. If the individual or HUF or any person who is eligible, if they want, they can choose this scheme. If they choose the scheme, they have to show the minimum income as per this section. For example, in 44 AD, the presumptive income is given as 6% or 8% of the turnover. So they have to show minimum 6% or 8% of turnover or actual profit, whichever is higher has to be shown. If presumptive income is shown, then the Income Tax Act will give benefit to the assessee. What benefit, sir? The benefit is that the assessee need not maintain any books of accounts. The assessing officer cannot ask for books of accounts from the assessee. Second benefit is that the assessee need not go for audit under section 44 AB. Audit will not be compulsory. And the third benefit is that in case of advance tax, instead of 4 installment, there will only be 1 installment. But that benefit is only given to 44 ADA and 44 AD. Okay, so let us see these presumptive income one by one. Firstly, let us talk about section 44 AD. To whom it is applicable? To resident individual, HUF and partnership firm other than LLP. It is not applicable to LLP. Other than LLP, resident individual, resident HUF, resident partnership firm only can take the benefit of 44 AD. for whom it is eligible. The assessee should be engaged in business kana. Okay, that is selling goods or providing services or manufacturing, whatever business it can be. Condition for eligibility: the turnover should be up to 200 lakhs only. So maximum turnover should be how much? 200 lakhs, that is 2 crores. However, there is an enhanced eligibility also. What is the meaning of enhanced eligibility? That if you are satisfying the condition, then instead of 200 lakhs, even up to 300 lakhs you can take the scheme. So this 2 crores will become 3 crores. If you are satisfying the condition. What is the condition? The condition is that aggregate cash receipt should be within 5% of the total turnover or gross receipt. So in the year, how much ever amount is received in cash, no, that should be within 5%. So up to 5% only maximum you should receive cash. Okay, wow. 5% of what? Total turnover or total gross receipt, as the case may be. If it is a business, it is turnover. In case of profession or service, it will be gross receipt. Fine. Then check and demand draft, which is not account pay check or not account pay demand draft, will be deemed as cash. So now what do I say? What is the eligibility? So cash plus non-account pay check plus non-account pay bank draft. All the three combined should be up to 5% of turnover. So within the year, how much ever amount is received through cash, non-account pay check, non-account pay bank draft, all the three combined should be within 5% of the turnover or gross receipt. If this condition is satisfied, then instead of 200 lakhs, the limit will be increased to 300 lakhs. So up to 300 lakhs also, the assessee will be eligible to claim the scheme. Now, who are all not eligible to claim section 44AD scheme? First, if you are covered under any other presumptive section, then you cannot come under 44AD. Then, if the person has claimed any deduction under certain income-based deduction, that is section 80JJAA, 80QQB or 80RRB, then such person cannot claim benefit of 44AD. Then, if the person is having commission income or brokerage income, then also it is not allowed. And in case of agency business also, it is not allowed. So what did I say? If the person is covered under other presumptive income, not allowed. If the person is claiming certain income based deduction, that is 80JJAA, 80QQB, 80RRB, it is not allowed. Then if a person is claiming deduction under 10AA, that is for special economic zone, for them also not allowed. Then for commission income or brokerage income also not allowed, and agency business also not allowed. So if you see the profit and loss account, in the profit and loss account, if you find some word like commission income or brokerage income, then you should know that you cannot take 44AD scheme. Okay. Now, what is the income that has to be shown, sir? If the amount is received through prescribed mode up to the due date of filing return of income, 6% of such turnover, 8% of balance turnover will be the income. Let me give you an example. Let's say the turnover is 1 crore and 98 lakhs. If turnover is 1 crore 98 lakhs, is the person eligible? Answer is yes, because it is within 200 lakhs, no, so eligible. Now let's say up to due date of filing return of income, the person has received 1 crore 50 lakhs through UPI payment. So since it is received within the due date of filing return of income, you multiply it by 6%. Then received 10 lakh rupees through cash. Cash is not a prescribed mode, so 8%. Received 15 lakhs through bearer check. Bearer check also not a prescribed mode, so 8%. 5 lakh rupees through net banking. Net banking is a prescribed mode, so 6%. And balance 18 lakh rupees is not yet received at all up to the due date of filing return of income. So that is why that also you multiply by 8%. So finally you will get the answer as 12,74,000. 20,74,000 you should compulsorily show it as income, or if your actual profit is even more, then the higher amount you have to show it as income. Fine. Then only you can take the scheme. If you are showing the income as presumptive income, then it is deemed that all the deductions are allowed. So further you cannot claim any deduction. So for example, here if 12,74,000 is shown as presumptive income, can I reduce any expense from this 12,74,000? Answer is no. This 12,74,000 only will be considered as my final profit. Okay, wow. Then WDV of the depreciable asset shall be reduced as if the assessee has claimed the depreciation. So WDV will keep on reducing. Now what is the benefit? If the scheme is chosen, no need to maintain the books of accounts, no need to get them audited under section 44AB. So no books of accounts, no audit. Then additional condition. Now in section 44AD alone, there is this additional condition also. What is the condition? That if scheme is opted once, it should be compulsorily opted for 5 more years. So 1 year if you are taking the 44AD scheme, the next 5 years also it is compulsory to choose the 44AD scheme if the turnover is within the limits. Okay. If in the next 5 years, if any 1 year also, if you want to come out of the scheme or you want to show the profit lower than presumptive income, then what will happen? If within next 5 years, if you are showing the profit lesser than presumptive profit, then for that year, it is compulsory to maintain books of accounts. It is compulsory to get them audited. And for further 5 years also, it is compulsory to get the books of accounts maintained and get them audited. So I'll give you an example. Let's say there is a timeline. Okay, wow. Here 1, 2, 3, 4, 5, then 6. For the previous year, you have taken section 44AD scheme. So for next 5 years also, year 2, year 3, year 4, year 5 and year 6 also, compulsorily you have to choose the 44AD scheme. It means what? Compulsorily you have to show minimum income as the presumptive income, that is 8%, 6%. If you are not showing it, let's say in year 6, no, I decided that I will show profit less than presumptive. Then what will happen? If within 6 years, if you are showing the profit less than presumptive, then in that year, it is compulsory to maintain the books of account as per section 44AA. Also, it is compulsory to get books of account audited as per section 44AB. And for the next 5 years also, that is for years 7, 8, 9, 10, 11 and 12, also it is compulsory to maintain books of accounts as per 44AA and compulsory to get the books of account audited as per 44AB. So very, very strict section. What they are telling, that for next 5 years also you have to compulsory take 44AD. If you are not taking 44AD, then that year books of accounts compulsory, tax audit compulsory, and for further 5 years also books of accounts compulsory, tax audit is compulsory. You get my point? So this is given violation. Now in advanced tax also there is a benefit that instead of paying 4 installment, it is okay to pay only 1 installment by 15th March of the previous year. Okay, so instead of 4 installment, only 1 installment. So this is 44AD. Now let us talk about section 44ADA. So 44ADA is also allowed only to resident individual, HUF and partnership firm other than limited liability partnership. So who is eligible? Only the person who is having a specified profession under section 44AA subsection 1 is eligible for this presumptive income. So we learnt in 44AA subsection 1, no, legal, medical, accountancy, technical consultancy, authorized representative, okay, film artist, company secretary, interior decoration, only all those professionals can choose section 44ADA. Now, for 44ADA, if you want to opt for the scheme, then the gross receipt should be maximum 50 lakhs. So up to 50 lakhs, you can opt for the scheme. If it is more than 50 lakhs, you cannot choose this scheme. However, here also there is an enhanced eligibility. This 50 lakhs will be seen as 75 lakhs if you satisfy the condition. What is the condition? Your aggregate cash receipt should be within 5% of your total gross receipt. So here also check and DD, which is not account payee, will be deemed as cash. So same condition like 44AD, cash plus non-account pay check plus non-account pay bank draft put together should be maximum 5% of gross receipt. If it is within 5% of gross receipt, then instead of 50 lakhs, the eligibility will be increased to 75 lakhs. Up to 75 lakhs also you can take the scheme. Then what is the presumptive income? Here presumptive income is 50%. 50%. So I am a chartered accountant. No, I am a chartered accountant in practice. That is why for me section 44ADA is only applicable. So when I am choosing the scheme, then I have to show minimum 50% as my profit. If my actual profit is even more, then I have to show the higher profit. Okay. Then here also all deductions are deemed to be allowed. Here also WDV of depreciable asset is deemed to be reduced. Here also if I am choosing the scheme, then no need to maintain the books of accounts, no need to get them audited under section 44AB. Here there is no additional condition karna. This 5 years condition and all is there. No, it is only applicable in 44AD. It is not applicable in 44ADA. Okay. Sir, what if I show profit lesser than the presumptive income? If I show profit lesser than the presumptive income, then it is compulsory to maintain the books of accounts and also compulsory to get them audited. But you know what? In 44AD as well as 44ADA, in both these sections, audit is compulsory only if the income is more than basic exemption limit. Audit is compulsory only if the income is more than basic exemption limit. Fine. And here also I am getting the benefit that for advanced tax, I can pay only in 1 installment, that is 15th March of previous year. Now coming to section 44AE. Section 44AE is allowed to any person. So the person can be individual, HUF, AOP, BOI, company, any person. Then the person should be engaged in business of plying, hiring or leasing of goods carriages. So he should be in the transport business. So goods carriage business. One more condition is that the person should be owning not more than 10 goods carriage at any time during the previous year. So during the entire year, not even a single day, he should be having more than 10 goods carriage. Goods carriage means what? The truck, lorry, all these are only goods carriages, tempo, all these goods carriages. Then there are two types of vehicle kanna, not heavy vehicle and heavy vehicle. Not heavy vehicle means gross vehicle weight is up to 12 ton. Heavy vehicle means gross vehicle weight is more than 12 ton. Now what is gross vehicle weight? It means vehicle weight plus load weight. That is only gross vehicle weight. If load is not given, you just take what is the vehicle weight given in the question. If the vehicle weight is up to 12 ton, it is not heavy. If it is more than 12 ton, it is heavy. What is 1 ton? 1 ton is 1000 kg. So 12 ton means 12,000 kg. If it is up to 12,000 kg, it is not heavy. If it is more than 12,000 kg, it means it is heavy. Now, here you have to calculate the presumptive income based on the number of months that the carriage is owned by the assessee. So month should be, even a part of month is considered in month. Okay, wow. So month includes part of month. Have I given it already? Yes, part of month is also included in month. You need not write once again. So month means what? The period for which carriage is owned by the assessee. Kanna, in depreciation, what did we discuss? That depreciation is provided only when the asset is used by the assessee, put to use. But here there is no put to use concept. Here ownership concept is there. So even if I am having, but if I am not using, still I have to calculate presumptive income based on that vehicle. Purinjada? So months means the period for which the carriage is owned by the assessee. Fine. Now, how to calculate presumptive income? For heavy goods vehicle, there is one method. For other than heavy good vehicle, there is another method. So for heavy goods vehicle, the presumptive income is 1000 rupees per ton per month. 1000 rupee per ton per month. 1000 rupee per month per ton per month. Here part of a ton also will be considered as 1 ton and part of the month also will be considered as 1 month. Then for other than heavy vehicle, it is 7500 rupee per vehicle per month. 7500 rupee per vehicle per month. Here, sir, how to do the calculation, sir? I will show you this table, Kanna. This is your institute study material question. In institute study material question, the answer which is presented by the institute, that you should not follow. It is a wrong presentation because that will work out only if the heavy vehicle is having the same weight. Okay, in the question if you see, both heavy vehicle, the weight is 15 ton only. That is why you are getting correct answer in the institute method. That method you should not follow. Then what method, sir? You please follow method which is given on your screen. So what you should do, put the serial number, then you put what is the date. Okay, then you mention whether it is a heavy vehicle or not heavy vehicle. Then you write number of vehicles. Then based on the date, you calculate what is the months. Then you write the number of months. So month and ton. In case of not heavy vehicle, you need not write the ton because in not heavy vehicle, the calculation is month multiplied by income. Okay, ton is not considered, only income is considered. But in case of heavy vehicle, ton is also considered. So that is why in not heavy vehicle, you need not write the ton. So then income, for heavy vehicle the income is 1000 rupees, then for not heavy vehicle income is 7500 rupees. Then it is very very simple, Kanna. You multiply number of vehicles multiplied by month, multiplied by ton, multiplied by income. So 1, 2, 3, 4, all these 4 figures you multiply, you will get the total answer and you add all of this together, final answer will be your presumptive income. You get my point? So like this you do the calculation. Month 10 vehicle, okay, multiplied by income. Month 10 vehicle multiplied by income for heavy vehicle and month vehicle multiplied by income for not heavy vehicle. So I have given it here also. 1000 into month vehicle ton and here 7500 into month vehicle. Like this you have to do the calculation. Finally add all of it together, you will get the total amount. Now here there is one minor difference, Kanna. In 44 AD and section 44 ADA, it is deemed that all the deductions are allowed. However, in section 44 AE, if the assessee is a partnership firm, then in such case, the remuneration to partner and interest to the partner is allowed as deduction. What did I say? In 44 AD and 44 ADA, no deduction is allowed. But in 44 AE, if the assessee is a partnership firm, then partner remuneration and interest is allowed as deduction up to 40B limits. So this is an extra deduction that can be claimed by the assessee. Then here also WDV is deemed to be reduced. Then if that scheme is chosen, no need to maintain books of accounts under section 44AA, no need to get them audited as per 44AB. And here, if you show the presumptive income less than the presumptive rate, okay, if the income is shown as less than presumptive income, then it is compulsory to maintain books of accounts and it is compulsory to get them audited. And listen here, the income greater than basic exemption limit, this condition is not there. So even if income is within the basic exemption limit, still it is compulsory to get the books of accounts audited under section 44AB. Fine. And here, for advance tax, the 4 installments only you have to pay. There is no benefit of paying the advance tax in one installment in section 44AE. 44AD and ADA, you are getting the 1 installment benefit. But for section 44AE, there is no 1 installment benefit. It is 4 installment as usual. So in 44AE, there are 2 major differences. First difference is that all deductions are deemed to be allowed, but partner interest and partner remuneration is allowed. So this is one extra benefit that is given. But one benefit is not given, that is advance tax benefit. So these 2 places, it is different from the other presumptive section. So I hope you are clear with presumptive income. Now let us talk about section 44AB, which discusses about tax audit. So who should get the tax audit done? If the business is having a turnover of more than 100 lakhs, that is 1 crore, it is compulsory to do the tax audit. So if turnover is more than 1 crore, compulsory tax audit. But here also there is an enhanced eligibility. What is the enhanced eligibility? If you satisfy 2 conditions, if 2 conditions are satisfied, then the 1 crore limit will be increased to 10 crores. So instead of 1 crore, up to 10 crores, no need to do the tax audit. What are the 2 conditions? Aggregate cash receipt should be within 5% of the total receipt. Aggregate cash payment should be within 5% of the total payment. If both conditions are satisfied, then 1 crore limit will become 10 crores. Okay, and this condition, it is different from 44AD and ADA condition. In 44AD and ADA, we were talking about turnover. Listen here. Here we are talking about 5% of total turnover or total gross receipt. But in 44AB, it is not turnover, it is 5% of total receipts and 5% of total payments. Okay, so aggregate cash receipts should be within 5% of total receipt. Aggregate cash payment should be within 5% of total payment. If both conditions are satisfied, then instead of 1 crore, tax audit need not be done if the turnover is up to 10 crores. And here also, check and demand draft that is not account payee will be deemed as cash. Fine. Now what about the other cases? If there is a professional whose gross receipt is more than 50 lakhs, it is compulsory to do tax audit. So in case of business, it is 100 lakhs. In case of profession, it is 50 lakhs. Then if profit is shown lesser than 44AE deemed income, it is compulsory to do tax audit. Then if profit is shown lesser than 44AD and 44ADA deemed income, okay, presumptive income, and if total income is more than basic exemption limit, then it is compulsory to do tax audit. Then if 44AD is chosen, but you show the profit lesser than presumptive income, then in that year you have to do tax audit, and in the next 5 years also it is compulsory to do the tax audit. Then for whom and all tax audit not applicable? So if a person has shown presumptive income as per 44AD or 44ADA or 44AE, then it is not compulsory to do tax audit. Then audit report. The audit report format is in form 3CA, 3CB and 3CD. Who is the auditor? Chartered accountant is the auditor. So as per income tax, the auditor is the accountant, and accountant means chartered accountant in practice. Fine. Due date. What is the due date to do tax audit? It is 1 month before the due date of filing return of income under section 139 subsection 1. In 139 subsection 1, we see that the due date to file return of income is 31st of October. So what is 1 month prior? It is 30th of September. So for previous year 25-26, the last date to do the tax audit is 30th of September 2026. Then what if books of accounts are not audited? Then what to do? Then there is a penalty. The penalty is given under section 271B. What is that penalty? 0.5% of turnover or gross receipts or 1,50,000, whichever is lower, will be the penalty that has to be paid by the assessee. So 0.5% of turnover or gross receipts or 1,50,000, whichever is lower, will be the penalty. So this is tax audit. Now let's talk about speculative business. Speculative business means what? Speculative business means a business where there is purchase or sale of commodities, including stock or shares, without doing delivery. So I am purchasing some shares and I am selling the shares, but I am not getting the delivery. It means what? I am not interested in the shares. I am only interested in the price differential of the shares. That is why it is called speculation. Example, intraday trading of shares is called speculation business. Why are we learning speculation business separately? Because if you are having a loss in speculation business, that can only be set off against the profit of another speculation business. Okay? With any other business, you cannot set off the loss. And this loss can only be carried forward for 4 years. Generally, you can carry forward loss for 8 years. But in case of speculation, you can only carry forward the loss for 4 years. And there are certain cases which is not considered as speculation karna, it is considered as normal business. What are they? Derivatives, commodity derivatives, future, option, currency future, forward contract, hedging contract. So all these are not speculation, all this is normal business only. Fine. So this is only speculation business. Now let us talk about section 10 clause 1, that is exemption from agriculture income. Agricultural income cannot be taxed under the Income Tax Act. That is why entire agricultural income is exempt from tax. Now what is the meaning of agricultural income? It is given in section 2 clause 1a. So 2 clause 1a tells there are 3 types of agriculture income karna. First is agricultural land, second is income from doing agriculture, and then third one is income from farmhouse. So first is rent from agricultural land, second one is income from agricultural land, and third one is income from farmhouse. So first let us discuss rent from agricultural land. Rent from agricultural land is considered as agricultural income, but only if the land is in India, then the land will be considered as agricultural land. Karna, if agriculture is done outside India, that is not exempt under Income Tax Act. It is fully taxable. Only if agriculture is done in India, it is exempt. Okay, wow. Then ownership is not necessary. So if I take some agricultural land on rent, and this agricultural land, if I give it on rent to some other person, so I am doing the sublease, then also will my income be exempt income? Answer is yes. So even if I am not the owner, still it will be considered as exempt income. Now let's talk about income from agricultural land. So if I am doing any activity of agriculture, that is also agriculture income. So for example, I am doing ploughing of land, I am sowing the soil, okay, seeds in the soil. So all this is activity of agriculture. By doing this activity, if I am earning any income, it is considered as agricultural income and it is fully exempt under Income Tax Act. Okay, then including nursery also. So listen, nursery is an exceptional case. Nursery, there need not be any agricultural land. Still nursery will be considered as agricultural income. So in exam, if you find a nursery income, it means it is fully agricultural income. Okay, wow. Then process to make the produce fit for the market. So if I am doing any process by which the agricultural produce is being fit to be taken to the market, then such process also will be considered as agricultural income. Then sale of agricultural produce. If I am selling raw agricultural produce, then it is 100% agricultural income. For example, I grew the tomato. This tomato I am selling in the market. So whatever is the income will be considered as pure agricultural income. Then sale after compulsory process to make the produce fit for the market is also 100% agricultural income. Karna, if I am having some produce, but I have to do processing, but without processing I cannot even sell in the market. In such case, even though I do processing, still it will be considered as agricultural income. For example, paddy is there, no? From paddy, you have to remove the chaff. After removing the chaff only, you will get the rice. This rice only you can sell it in the market. Paddy, no one is buying in the market. That is why, if I am doing the processing on the paddy to remove the chaff and getting the rice, then whatever rice I am selling now, this rice is also agricultural income. Fine. Then, however, if doing process is optional and still I am doing the process, then it is a mixture of business income and agricultural income. It is a composite income. For example, I am having tomato. This tomato I can directly sell in the market. So it will be 100% agriculture. But instead of selling tomato, what I do, I make tomato ketchup. I do the processing and I make tomato ketchup using the tomato and I am selling tomato ketchup in the market. In such case, the tomato ketchup has both business income also, agriculture income also. This we have to split up using Rule 7, Rule 7a, Rule 7b or Rule 8. These are the composite income rules. Okay, wow. Rule 7, 7a, 7b and Rule 8. Then income from farmhouse. So what is a farmhouse? Farmhouse means the building which is there in the agricultural land or immediate vicinity of the agricultural land. So it should be either on the boundary of the agricultural land or it should be in the agricultural land. Then it is a farmhouse. Can I put farmhouse on Airbnb and whatever money will I get? Will it be agricultural income? Answer is no. Airbnb is not agricultural income. Only if the farmhouse is used as a dwelling for the farmer or for the storage of farm products, then only it is agricultural income. So either the farmer should be living in the house or the house should be used for storage of produce. Then only the income will be agricultural income. Okay. Now let's talk about meaning of agricultural land. What is agricultural land? Agricultural land can be rural land also, urban land also. What is rural land? Our rural land means land which is not in urban area. Okay, so what is urban area? Urban area means, let me tell you in the next page. If the population is exactly 10,000, let us take an example of Chennai. The same I have also explained in capital gain revision lecture, but once again I am explaining here also. Let's take Chennai. For example, if population of Chennai is exactly 10,000, then Chennai is urban area. If population of Chennai is more than 10,000 up to 1 lakh rupees, then outside 2 kilometers also is urban area. If population of Chennai is more than 1 lakh up to 10 lakh people, then outside 6 kilometers is also urban area. If population of Chennai is more than 10 lakh people, then outside 8 kilometers is also urban area. If there is any land which is outside the urban area, will be considered as rural land. If agriculture is done on rural land, it will be called as rural agricultural land. But you know what? If it is urban area, just like that you cannot call it as agricultural land. If you want to do agriculture on urban area, then you have to assess the land to land revenue. It means what? You have to possess some government proof that it is an agricultural land. Only then it will be considered as agricultural land. So what did I say? Agricultural land can be rural, it can be urban. Rural means what? It is outside urban area. And in rural area, if you do agriculture, it will be considered as agricultural land. But in urban area, if you are doing agriculture, just like that you cannot call it as agricultural land. You also have to assess it to land revenue. Only then you can call it as agricultural land. So sitta, patta, sitta, dangal, whatever it is, you have to assess it to land revenue. You have to get a government proof that it is an agricultural land. Only then it will be called a agricultural land. Okay, wa? So urban area means population of 10,000 or more, and it also includes up to 2 kilometers if the population is greater than 10,000, up to above 2 up to 6 if it is greater than 1 lakh, and above 6 up to 8 if the population is greater than 10 lakhs. This population is taken as per the last census, and this 2 kilometer, 6 kilometer, 8 kilometer, no, it is the distance that is aerially measured. Aerially measured distance you have to take. So this is only agricultural land kana. Now let us talk about composite income. I told you some processing has been done by which there is business income also and agricultural income also. Now how to separate the agricultural income and business income? So first is the general rule, that is rule 7. Then we are going to see 3 special rules, that is rule 7a, rule 7b and rule 8. So firstly, general rule. How to separate tomato income and tomato ketchup income? Let us see. Agricultural income, that is income from tomato. How to separate? You take the fair market value of the agricultural produce used for processing. Let's say it is 20 rupees is the value of the tomato, fair market value of tomato. From that, you reduce the cost of agricultural produce. So cost of producing the tomato, let's say it is 15 rupees. So if you reduce it, the balance 5 rupees will be considered as agricultural income. Now let's come to the business side. So in business, first you take the sale of final product. So that sale of tomato ketchup, how much I am getting? Let's say I am getting 50 rupees. From this, you reduce the fair market value. So this fair market value which you took, no, the same amount only you have to reduce it here. Fair market value of tomato, you reduce it, and further cost of manufacturing tomato ketchup you reduce. Finally, you will get the business income of tomato ketchup. Like this, you can split the tomato ketchup income into tomato income and ketchup income separately. So here 5 rupees is the tomato income, 20 rupees is the business income. Now let's talk about special rules. There are 3 special rules. Rule 7a, Rule 7b and Rule 8. Rule 7a speaks about rubber, Rule 7b coffee, Rule 8 is tea. So firstly, let us talk about rubber. So in rubber, or you can also call it as rubber, latex, crepice or senex. Rubber, latex, crepice or senex. There, what is the ratio? A is to B is equal to 65 is to 35. A is to B, 65, 35. What is A? A means agriculture. B means business. Okay, so agriculture is to business is equal to 65 is to 35. Then in case of coffee, you have to see whether the coffee is grown and cured or grown, cured, roasted and grounded. If the coffee is only grown and cured, then the ratio is 75 is to 25. So agriculture 75, business 25. But if the coffee is grown, cured, roasted and grounded, then it is 60-40. 60 agriculture, 40 business, 60-40. Then what about tea? For tea, it is always 60-40. So for rubber, 65-35, coffee grown and cured 75-25, coffee grown, cured, roasted, grounded 60-40, and for tea also it is 60-40. So this is the composite income rates. Based on this rate, you have to split the income into agriculture income and business income. Agriculture income will be exempt, business income will be taxable. Okay. So now let's talk about partial integration. Before that, let me discuss the other concepts. What are the exemptions related to agricultural income? Other exemptions. Firstly, let us talk about section 10 clause 30. Whenever a person who is growing or manufacturing tea in India, then subsidy received from the tea board will be fully exempt. However, there is a condition. The condition is that the subsidy should be used for replantation, replacement of tea bushes, or rejuvenation or consolidation of tea cultivation areas. And then second condition, certificate should be obtained from tea board showing the amount of subsidy and submit this certificate to the assessing officer. If both conditions are satisfied, then the subsidy received from tea board is fully exempt. Then let's come to section 10 clause 31. If the person is engaged in growing or manufacturing rubber, coffee, cardamom or any other notified commodity, then subsidy received from that board will be exempt. And here also conditions are same as the tea bush condition. Okay, wow. So same conditions. If it is satisfied, then the entire subsidy is going to be exempt from tax. Now let us see few examples of agriculture income and non-agriculture income. So rent from land for grazing the cattle is agricultural income. Selling of seed is also agriculture. Selling of flower is also agriculture. Selling creeper is also agriculture. Creeper means the creepers like money plant, etc. That is creeper. Selling bamboo is also agriculture, and income from nursery, I already told you, that is also agriculture. Now, what is not agriculture? Income from milk of cattle, not agriculture. Livestock, not agriculture. Poultry, not agriculture. Dairy farming, not agriculture. Fish is not agriculture. Commission received on agricultural income is also not agriculture. Forest produce like timber, that is not agriculture. And lastly, if a company is doing agriculture and such company is giving dividend, that dividend income is also not agricultural income. Okay, when company is giving dividend, it is not agricultural income. Now let us talk about partial integration of agricultural income with non-agricultural income. When a assessee is earning both agricultural income as well as non-agricultural income, then the Income Tax Act will not give the benefit of the lower tax slab to that assessee. This is only called partial integration. So how to do partial integration? Firstly, you have to see if three conditions are satisfied. If three conditions are satisfied, then partial integration will be applicable. What are they? Agriculture income should be greater than 5,000. Non-agriculture income should be greater than basic exemption limit, and it is only applicable to the assessee enjoying the benefit of basic exemption limit, that is individual HUF, AOP, BOI or AJP. If these three conditions are satisfied, then partial integration is applicable. How to do partial integration, sir? You have to follow these steps. Step number 1, compute the tax on agricultural income and non-agricultural income. Step number 2, compute the tax on agricultural income plus basic exemption limit. Step number 3, do step 1 minus step 2. This is only the final tax that has to be paid, and then you add the surcharge and health and education cess as it is applicable. Okay, so what you have to do? First calculate tax on agriculture plus non-agriculture, then you calculate the tax on agriculture plus basic exemption limit, then you do step 1 minus step 2, and then add surcharge and health and education cess as usual. There is one question in your first chapter relating to partial integration. If possible, solve that question. Your concept will be clear. Very, very simple only, but you have to remember all these steps. Then only you will be able to solve in the examination. Fine. With this, all the concepts of profit and gains of business or profession is complete. I hope you are clear with all the different adjustments, and you are going to definitely score full marks in the examination. Now, without further ado, let us begin the most powerful revision lecture on capital gains chapter. So capital gain chapter is the fourth head of income, and like any other head of income, even capital gain chapter has a charging section and a computation section. Charging section is 45 subsection 1, computation section is section 48. Firstly, let us talk about charging section. Sir, what is taxable under capital gain head of income? In capital gain, tax is chargeable on the profit and gains from the transfer of capital asset in the year of transfer. So what is taxed? Capital asset is taxed. On what the tax happens? On transfer only the taxation will happen, and in the year of transfer only the taxation will happen. So now you should know what is capital asset, what is transfer, what are the transactions that are not regarded as transfer, to know the charging section better. So firstly, let us discuss section 2 clause 14, that is definition of capital asset. So what is capital asset, sir? Because capital asset is only covered in the capital gain chapter. What is capital asset? Section 2 clause 14 defines capital asset as number 1, it is a property of any kind held by the assessee whether or not connected with the business or profession. So the property is of any kind, whether it is personal property or business related property, whether it is tangible property or intangible property, whether it is movable property or immovable property, all kinds of property are capital assets. So in the first line itself, the act has brought all the types of assets inside the meaning of capital asset. So capital asset means property of any kind, whether or not connected with the business or profession, whether movable, immovable, tangible, intangible. Okay. However, there are some exceptions. So now let us learn the 6 exceptions to capital asset. It means what? There are 6 items which will not be included in the meaning of capital asset. So these will not be called as capital asset. What are they? Number 1, stock in trade. So stock in trade is a business asset. That is why it is not called a capital asset, because if there is sale of stock, it will be taxable under the profit and gains from business or profession head of income. That is why from all the assets, now it has removed what? It has removed stock in trade. So stock in trade is not capital asset. Stock in trade includes raw material also, consumable also, work in progress also, finished goods also. So all these are not capital assets. Then next one is personal effects. Personal effect means not capital asset. So personal effect means what? Personal effect means any movable property that I am having for personal use, that is only personal effect. For example, I am having a pen. This pen is for personal purpose. This is also a personal effect. I am having a car. That car I am having only for personal use. So this is also a personal effect. Like that, all the movable assets for personal use are personal effects. That is why on all these personal effects, they are removed from the meaning of capital asset. It means what? There will not be any capital gain. So if I am having a car which I am having for personal purposes, then if I sell that car and get a profit, will there be any capital gain? Answer is no. If I am having a pen, if I sell this pen and I get a capital gain, will there be any capital gain? Answer is no. There will be no tax because it is not a capital asset. Fine. Is it beneficial or not? Sir, you will feel it is so good, no, that all these movable assets like car, pen, etc., whatever movable property we are having, mobile phone, it is never treated as capital asset. So we need not pay any tax on capital gain. But that is your assumption, Kana. It is not beneficial for you. It is a loss for you. Sir, why is it a loss? Because if you are having a car, generally the value of car will not go up. The value of the car will come down, unless or otherwise it is a very luxurious car. So let us leave that. Generally, value of the personal effects don't go up. They come down. That since they come down, you will most probably have a loss, and that is why you will use that loss to set off against the other capital gain that the government does not want. That is why what they do, personal effect is removed from the meaning of capital asset. You got my point? But however, there are 6 personal effects, Karna, that are still kept in the meaning of capital asset. You know why? Because these 6 assets are the assets whose value generally increases over time. It does not decrease. That is why the government has smartly kept it inside the meaning of capital asset. So these 6 are exception to exception. So exception to exception means what? These 6 are included in capital asset. Included in capital asset definition. What are they? You can use it to, you can use this keyword to memorize it. That is JAD-SPA. JAD-SPA. Jewelry, archaeological collection, drawing, sculpture, painting, or any other work of art. So what did I say? Jewelry, archaeological collection, drawings, sculpture, painting, or any other work of art. So these 6 type of assets are personal effects. So for example, I am having jewelry. Jewelry is for personal use and it is a movable item, correct? So it is a personal effect. However, it is excluded from the meaning of personal effect. It means that jewelry will be considered a capital asset. Similarly, archaeological collection, drawings, sculpture, painting, or any other work of art will be considered as capital asset. So what did I say? Personal effect is not capital asset, but jewelry, archaeological collection, drawing, painting, or any other work of art will be considered as capital asset. Fine. Now let's talk about jewelry. Jewelry here means ornaments made of gold, silver, platinum, or any other precious metals, and also precious or semi-precious stones. So not only metal, even if there is precious stones, still it will be considered as jewelry, and whether or not it is set in any furniture, utensil, or wearing apparel. So for example, if there is a gold plate, that is jewelry. But if there is a silver plate, is it jewelry? Answer is no. Silver plate is not jewelry because generally on silver plate you have the food. That is why it is not considered as jewelry. But gold plate is considered as jewelry. Similarly, if there is any sari, on that sari diamonds are there, will it be considered as jewelry? Answer is yes. In the crown, it is made of precious metal and some diamonds are there. Will it be considered as jewelry? Answer is yes. So jewelry does not mean only wearing apparel. Even if in the furniture or utensils some precious metal or precious stone has been used, that also will be considered as jewelry. Fine. Now let's talk about the other items which are not included in the meaning of capital asset. So first is rural agricultural land. So rural agricultural land will not be considered as capital asset, Karna. So what is rural agricultural land? Rural agricultural land means a land on which you do agriculture which is there in rural area. But sir, what is rural area? Rural area means not urban area. Not urban area. So if the area is outside the urban area, it means it is rural area. But sir, now you tell me what is urban area. Don't tell me urban area means not rural area. Please tell me the definition definition of urban area. Okay, Kanna, I will tell you. Definition of urban area. So let's take an example of Chennai, Kanna. Let's take an example of Chennai. If the population of Chennai is, let's say, exactly 10,000, then Chennai will be considered as urban area. If it is less than 10,000, then it is not urban area. If it is exactly 10,000, it will be considered as urban area. And you know what? If the population is more than 10,000 up to 1 lakh rupees, then outside 2 kilometers of Chennai also will be considered as urban area. If the population of Chennai is more than 1 lakh up to 10 lakh people, then outside 6 kilometers also will be considered as urban area. Moreover, if the population of Chennai is more than 10 lakh people, then outside 8 kilometers also will be treated as urban area. So this entire area is urban area. If any land is falling outside the urban area, then it will be called as rural land. And if on the rural land you are doing agriculture, it will be called as rural agricultural land. Fine. So rural agricultural land is also not a capital asset. Then some small points. Specified gold bonds of 1977 or 1980 also will not be considered as capital asset. Then special bearer bonds of 1991 also will not be considered as capital asset. Then gold deposit bond under gold deposit scheme 1999, gold monetization scheme 2015 and gold monetization scheme 2019, they also will not be considered as capital asset. Moreover, you know what, for gold monetization scheme 2015, if the assessee is receiving interest, then that interest is also tax free. It is totally exempt from tax. Okay, under section 10 clause 15. This you would have learnt in your income from other sources chapter. Fine. So these are all exclusions from capital asset. So once more, I am telling you what is capital asset. Capital asset means all the property, whether personal or business, whether movable, immovable, tangible, intangible. But it does not include stock in trade. It does not include personal effect. It does not include rural agricultural land. Does not include specified gold bonds of 1977, 1980, special bearer bonds 1991, and then gold deposit bond under gold deposit scheme 1999, gold monetization scheme 2015, or gold monetization scheme 2019. So all these are not capital asset. However, in personal effect, 6 type of items are there which are personal effect, but still they will be considered as capital asset. That is JADSPA, jewelry, archaeological collection, drawing, sculpture, painting, any other work of art. Now let's see point number B. Now what else is capital asset? Let us see. So second point, in this there is an amendment also which is applicable only from May 2026 onwards, but not very important for you. Just if you know this much, it is enough. Just if you know the name, it is enough. If at all it is coming in MCQ, then you should be able to answer. So what is the second point? Any security held by a foreign institutional investor or an investment fund specified under section 115 UB as per SEBI guidelines. So if any security, that is shares etc., which is held as per SEBI regulations by a foreign institutional investor or investment fund specified under section 115 UB. So for these two category of people, if they are having any security, it will always be considered as capital asset. It will never be considered as stock in trade. Okay, wow. So always if they are having any income from security, it will be taxable under capital gain chapter. So what is the meaning, what is the reasoning and all we have discussed in regular batch. I hope that you remember the points that I told you, the story that I had told you. The third one, any unit linked insurance plan to which section 1010D does not apply. 1010D we will be learning in income from other sources chapter, which tells what are all the life insurance policy which is exempt from tax. So other life insurance policy which does not, on which 1010D does not apply, it means what? Life insurance policy which is taxable. If that life insurance policy which is taxable, it is a unit linked insurance plan, then it will be considered as a capital asset, because ULIP is taxable under capital gain chapter, but for Inter ULIP taxation is not there. For final syllabus only it is there, so don't worry. ULIP, but however you should know that ULIP also is considered as capital asset. So any security held by foreign institutional investor or investment fund is also capital asset. Any unit linked insurance plan that is not exempt under section 1010D is also a capital asset. Then interest on gold deposit bond I already told you. Now let's talk about transfer karna. We have already learned what is capital asset. I told you, transfer of capital asset is taxable. So what is transfer? Let us see. Section 2 clause 47 defines what is transfer, and transfer includes sale, extinguishment, relinquishment. So transfer includes sale, but other than sale also so many transactions are included in transfer. So what and all is covered in capital gain. Let us see. First is sale, selling from one person to another person. Then exchange of products or goods. Then relinquishment of any asset. Relinquishment means the asset itself is getting destroyed. And then extinguishment of any right. So the right in an asset is getting over. That is only called extinguishment of any right. Then compulsory acquisition. So if the government is coming and compulsorily acquiring the property, that is also considered as transfer. And whenever government is giving money, on that tax also you have to pay. So even compulsory acquisition is a part of transfer. Then conversion of capital asset into stock in trade. So if capital asset is converted into stock, that is also considered as transfer. And on the fair market value of the capital asset, you have to pay the capital gains. That also I am going to cover in this video, don't worry. Then allowing the possession of any immovable property in part performance of a contract. So this part performance of a contract we have also discussed in house property chapter in deemed owner concept karna. There what did I tell you? As per Transfer of Property Act, if you have transferred the possession alone, sale registration is not done, but still possession has been transferred, in that case also the person who is receiving will be considered as the owner, and here also it is considered as transfer. So allowing the possession of any immovable property in part performance of contract will be considered as transfer. Then transaction having the effect of transferring or enabling the enjoyment of immovable property. So this also you should link with deemed owner concept in house property karna. There I would have told you that there will be a society or a company, and the building, no, it will be in the name of the society or company. People who are living in that building will be considered as member or shareholder. So if the member or shareholder is transferring their membership or shares to another person, then their flat in the building is also transferred to another person. So this is what transaction that is having the effect of transferring or enabling the enjoyment of immovable property. So if I am transferring the shares, then it is considered that my flat is also transferred and I have to pay the capital gains. You get my point? And then lastly, redemption of zero coupon bonds. So redemption of zero coupon bonds is also considered as transfer. So what is transfer? Once again, very, very important. Sale, exchange, relinquishment of any asset, extinguishment of any right, compulsory acquisition under any law, conversion of capital asset into stock in trade, then allowing the possession of an immovable property in part performance of a contract, then transaction having the effect of transferring or enabling the enjoyment of an immovable property, and lastly, redemption of zero coupon bonds. So all these are considered as transfer. And now you know what is transfer. You should also know what are all the transactions not regarded as transfer. It is given in section number 47 karna, that is transactions not regarded as transfer. You know what? Whenever all these transactions are happening, no, the Income Tax Act will close its eyes. It will close its eyes as if nothing has happened. Okay, well, the Income Tax Act will, what they will do? It will close its eyes as if this transaction itself has not happened. That is why it is called as transaction not regarded as transfer, and that is why whenever these transactions are happening, capital gain will not come or it will not arise. So what are all those transactions? Let us see. First transaction is full or partial partition of HUF. So if HUF is partitioning the property, then property is going from HUF to the family member, no? So when the property is going from HUF to family member, so it is not a capital gain in the hands of HUF, not a transfer in the hands of HUF. So HUF need not pay any capital gain. Next, gift or will or irrevocable trust by an individual or HUF. So if an individual or HUF is giving a gift to someone, then the individual need not pay any tax under capital gains. Next, holding company to 100% Indian subsidiary company. So if holding company is transferring the asset to a 100% subsidiary company, which should be Indian, in such case it is not a transfer. The holding company need not pay any capital gain. Next, if subsidiary company is transferring to its in 100% holding company, which should be Indian, in such case also it is not considered as transfer. That is why subsidiary company need not pay any capital gain. Next one, when amalgamating company transfers to amalgamated company, then also it is not considered as transfer. However, this amalgamation, no, it should be as per the Income Tax Act. Only then this provision will apply. Now, what is amalgamation as per Income Tax Act? Let us see. First, let me give you an example of amalgamation. Let's say there are two companies, Inox and PVR. Both are related to movies. Now, both of them merged together to form another company called PVR Inox. So, this type of transaction is called amalgamation. Amalgamation. So, what is amalgamation? Amalgamation means defined under section 2 clause 1b, which says amalgamation means one or more companies join another company or two or more companies merge to form a single company. Both type of transactions are called amalgamation only. So in Income Tax Act, amalgamation is also called amalgamation, merger is also called amalgamation. Fine. So both are amalgamation only. But what are the conditions? Let us see. There are three conditions. Number one, all the property of the amalgamating company should become the property of the amalgamated company. So here, all the property of Inox should become property of PVR Inox. All the property of PVR also should become property of PVR Inox. Similarly, all the liabilities of the amalgamating company should become the liability of amalgamated company. So all liability also should be transferred to another person. And lastly, the amalgamated company. And lastly, shareholders having at least 3/4 shareholding in amalgamating company should get share in amalgamated company. So here, at least 3/4 shareholder of Inox should get the new PVR Inox shares. Similarly, at least 3/4 shareholders of PVR should get the new PVR Inox shares. Only then it will be considered as transfer. Sir, what about the balance 1/4? But they will not get shares. For them, you can give cash also and you can settle them, not a problem. But at least 3/4 shareholders are there. No, to them you should give the new company shares. So that is a rule. If all these three conditions are satisfied, then it is called amalgamation. And what did I say about amalgamation? When amalgamating company is transferring its assets to amalgamated company, it is not considered as transfer. The Income Tax Act will close its eyes when the transaction is happening. Next one, demerged company transferred to resulting company. So demerger, when it takes place, then also it is transaction not regarded as transfer, but demerger also is defined under the Income Tax Act. All the conditions should be satisfied. First, let me tell you an example of demerger. Let's say there is old Reliance company. In that old Reliance company, Jio Finance was there. Now that Jio Finance is coming out of old Reliance as a new company called Jio Finance, and now the balance company has become New Reliance company. So old Reliance has split into two companies, that is Jio Finance and New Reliance. So this transaction is called demerger. So now let us see the conditions for demerger. What condition number 1? Transfer should take place as a going concern. It means what? Both the new companies should be continuing businesses. You should not close down any business. So Jio Finance also should be a running business. New Reliance also should be a running business. So that is first condition. Second condition, all the property of the undertaking being demerged should become the property of the resulting company. So in this old Reliance, first Jio Finance was a part of old Reliance. No. Now whatever are the assets of this Jio Finance should become the assets of the new Jio Finance company. Similarly, all liabilities also should be transferred. So property should be transferred, liabilities also should be transferred. Then property and liability should be transferred at book value immediately before the demerger date. So at what value? Book value it must be transferred. And similarly, last one, shareholders having 3/4 value of the shares of the demerged company immediately gets shares of the resulting company. So at least 3/4 value of shareholding of the undertaking being demerged should be getting the new company shares. New company shares. So this is the condition for demerger. If demerger conditions are satisfied, then whenever demerged company, so what is demerged company in this case? The demerged company is old Reliance and resulting company is Jio Finance and New Reliance. Okay, wow. So demerged company is transferring to resulting company, then it is a transaction not regarded as transfer. Next point, shares issued by resulting company when demerger taking place. So now in this case I told you, no, old Reliance shareholders will now get Jio Finance shares, new shares of Jio Finance. In such case, what is happening? The person is giving up some right in old Reliance shares and getting the Jio Finance shares. This also will not be considered as transfer. So old Reliance shareholders need not pay any capital gain tax. Similarly, when there is this amalgamation happening, in that case also this Inox shares and all will expire, it will lapse, and then new PVR Inox shares will be given to the shareholders. In this case also, when the old shares are going out, new shares are coming in, this transaction also will not be regarded as transfer, so I need not pay any capital gain. So for example, if I am having Inox shares, what will happen? My Inox shares will get over and then I will get new shares of PVR Inox. In that case, I need not pay any capital gain because it is a transaction not regarded as transfer. Next one, government securities outside India from one non-resident to another non-resident. So if a non-resident is transferring government security to another non-resident outside India, then it is not taxable under capital gain. Next one, redemption of sovereign gold bond by an individual. Okay, so sovereign gold bond is an instrument given by the government. After 8 years, you have to redeem the sovereign gold bond. If at all sovereign gold bond is redeemed by an individual, then it is a transaction not regarded as transfer. No need to pay any tax on capital gain. Next one, conversion of gold into electronic gold receipt and vice versa. So there is an instrument called electronic gold receipt. It is like a digital gold which is issued by the government. So you can give the gold and get the electronic gold receipt, and later on if you want real gold, you can return back the electronic gold receipt and get back the real gold. So whenever you are converting gold into electronic gold receipt or converting electronic gold receipt into gold, in that case it is not regarded as transfer. You need not pay any capital gain tax. Next one, transferring JATSPA. What is JATSPA? Jewelry, archaeological collection, drawing, sculpture, painting, any other work of art. So transferring all these assets, then photos, printouts, etc. to the National Museum or Art Gallery or Public Museum. So when you are transferring all these type of assets to National Museum, Art Gallery or Public Museum, then you need not pay any capital gain. Next one, bonds, debenture stock, deposit certificate converted into shares or debenture. So when these types of securities are converted into shares or debenture, then it is a transaction not regarded as transfer. Bond, debenture, debenture stock, deposit certificate converted into shares or debentures, not considered as capital, not considered as transfer. Next one, preference shares converted into equity shares. So if I am having preference shares, now if they are converted into equity shares, should I pay any capital gain tax? Answer is no, because preference shares converted to equity shares is not regarded as transfer. The Income Tax Act will close its eyes. Sir, why again and again you are telling it will close its eyes? You will get to know Kanna when I am talking about cost of acquisition. No, that time you will understand. Next, transfer of assets by a company during liquidation. Okay, reverse mortgage with it. Okay, first I'll take this. Transfer of capital asset under reverse mortgage. Sir, what is this reverse mortgage? That also I have given here. Reverse mortgage means senior citizen can mortgage their house to a scheduled bank housing finance company. In class, I take example of a very old man called Jollu Tata. That Jollu Tata is there. No, he is very, very old and he is having a house, but he is not having the money to take care of himself. So what he will do, this house that he is having, he will give to the bank as mortgage, and instead the bank will give him a loan. This loan can be in monthly installment also, it can be in quarterly installment also, and it can be in a lump sum amount also. For a period of up to 20 years, the Jollu Tata will get the loan. Then the Jollu Tata can use this money to take care of his expenses. He can have food, he can live peacefully, comfortably, because he is having the money from the bank. Later on, let's say the Jollu Tata died. In that case, what will the bank do? The bank will now go to the legal heir of Jollu Tata and they will tell that you please return us the money along with interest and you take your house back. But if the legal heir are not able to give the money, then the bank will take this property, they will sell the property, and whatever amount they have received on sale, with that they will first repay their own loan and balance money they will give to the legal heirs. So this type of transaction is called reverse mortgage transaction. So, in senior citizen can mortgage their house to a scheduled bank or housing finance company. In return, the bank gives them a lump sum loan, regular monthly or quarterly or annual installment loan up to 60% of the value of the house. The above amount cannot be used for speculation or trading. So the Tata is there, no, he can't do gambling with this house, he can't do speculation, he can't do trading. Okay, maximum loan is for 20 years. After death of the borrower, bank gives the option to the legal heir to repay the loan and get the house back. Else, it is sold to recover the loan along with interest, and balance amount is given back to the legal heirs. And you know what? I told you already, when Tata is giving house to the bank, in case of reverse mortgage, it is a transaction not regarded as transfer. So Tata need not pay any capital gain. Similarly, when the bank is giving the money to the Tata or legal heirs, in that case also, it is not regarded as, it is totally exempt under section 10 clause 43. So the amount received by the senior citizen as the loan, either in lump sum or the installments, in a transaction of reverse mortgage is completely exempt from income tax. So Tata need not pay any tax on both ends. Okay, so when the house is going, that time also not taxable. When money is coming, that is also not taxable. Now last point, transfer of assets by a company during liquidation. So the company itself is liquidating or closing down. So while closing down, whatever assets are belonging to the company, it will distribute to its shareholders. In such case, when it's transferring the assets during liquidation, it is a transaction not regarded as transfer. The company need not pay any capital gain tax. Okay, so these are all the transactions not regarded as transfer. So with this, your charging section is complete. I hope you are thorough with the charging section. Now let us come to computation of capital gain. Computation of capital gain is given under section 48, and there is a format, Kanna. You have to follow this format only in the examination so that you can score full marks, and the same wordings only you have to use. You can't use any other wording. So what is the format? So first you have to take full value of consideration. This full value of consideration is nothing but selling price. Okay, generally it is the selling price of the capital asset. That is only full value of consideration. Sometimes it can be insurance claim value also. Sometimes it can be the fair market value of capital asset also. Sometimes it can be the value given by the government in case of compulsory acquisition also. So that is all full value of consideration. It can be different in different cases. When you see the cases, you yourself will be able to apply, Kanna. Not to worry about. Generally, full value of consideration means selling price. So from the selling price, you can reduce transfer expenses. What are transfer expenses? Transfer expense means to make the sale happen, you would have incurred some expense. For example, you want to sell your house. So to sell your house, you went to a broker, and to the broker you are giving brokerage. That is a transfer expense. Similarly, to sell your asset, you gave advertisement in newspaper. So that is also a transfer expense. So these are all transfer expenses. This you can reduce, but be careful. You cannot reduce STT and CTT. That is security transaction tax and commodity transaction tax. In PGBP, that is profit and gains of business or profession, you can reduce STT and CTT, but in capital gains, you cannot reduce STT and CTT. Fine. So STT and CTT are not transfer expenses. Other than that, whatever expense you incur to make the sale happen will be called transfer expense that you can reduce. reduce. So balance amount will be called what? It will be called net consideration. Net consideration. From the net consideration, you can further reduce cost of acquisition and cost of improvement. Cost of acquisition and cost of improvement, and finally you will get capital gain. This capital gain, or it can be capital loss also. This capital gain or capital loss will be either short term or long term, depending on period of holding. Depending on period of holding that I am going to discuss now in a few minutes. Then finally, there are some exemptions which are given in section 54 series. So if at all this exemption is valid, then that exemption amount also can be reduced. The balance amount will be the taxable capital gain or taxable capital loss. You get my point? So now what is how to compute capital gain? First take full value of consideration. From that you reduce transfer expense, you will get net consideration. From net consideration you reduce cost of acquisition or cost of improvement, you will get short term or long term capital gain or capital loss. From that you can further reduce section 54 series exemption, and you will get the taxable capital gain or capital loss, which can be long term also, which can be short term also. So now you know how to calculate capital gains. Computation table is very simple, Kanna. You know what is difficult? The difficult part is what figure you should write in the respective columns. There will be at least 3 or 4 amounts given in the question. You have to analyze and you have to decide which amount you have to pick, and you have to write in the exam answer sheet that what is the reason behind picking that amount. That is only the beauty of capital gain chapter. Okay, wow. This calculation and all is very simple. Now let us see firstly the difference between short term capital gain and long term capital gain. That is based on the period of holding concept, Kanna. So what is this period of holding concept? Period of holding concept means very simple. The date of acquisition till the date of transfer is called period of holding. So when you purchase the asset, from that date till the date of sale of asset will be considered as period of holding. This period of holding can be short term also, it can be long term also. If period of holding is short term, then the asset is considered as short term capital asset. If period of holding is long term, then the asset is considered as long term capital asset. So there are two categories, 12-month category and 24-month category. Some assets are covered in 12-month category, all the remaining assets are covered in 24-month category. So what are the assets? Let us see. So number 1, in 12-month category we are seeing securities listed in a stock exchange. So all securities, shares, debenture or any security that is listed in a recognized stock exchange. Then unit of a equity oriented fund or UTI. UTI means Unit Trust of India. Okay, so unit of equity oriented fund or UTI. And third one, zero coupon bonds. So what did I say? Security listed in a stock exchange, unit of equity oriented fund or UTI, and zero coupon bonds. These 3 assets alone, you have to see that if it is held up to 12 months, it is short term. If it is held for more than 12 months, it will be considered as long term capital asset. All the other assets will come under 24-month category. So jewelry means 24-month category, land and building means 24-month category. All the other capital asset come under 24-month category. Fine. So this is period of holding concept. However, there are 3 exceptions. I am not discussing them now. In that section, I will discuss that it is an exception to period of holding. Okay, wow. Moreover, one small point alone I would like to say that if at all land and building are sold together, in which land is long-term capital asset and building is short-term, can it be possible that first I bought a land, sir, that I bought 5 years back, but building I have constructed only 6 months back and now I am selling. In this case, what will happen? Building is short-term, land is long-term. In such case, how to calculate capital gain? Here you have to split it into 2 parts, Kanna. For building, you have to calculate long-term capital gain separately, short-term capital gain separately, and for land you have to calculate long-term capital gain separately. So like that you will do the working. Now let us talk about period of holding in special cases. So period of holding in special cases we will discuss along with section 49, cost of acquisition. Fine. So now you know how to differentiate between short-term and long-term. Short-term capital asset means the gain will be short-term capital gain or capital loss. Similarly, long-term capital asset means the capital gain or capital loss will be long-term capital gain or long-term capital loss. You get my point? Now let us come to full value of consideration. So full value of consideration, for now you just know it is the selling price. Whatever amount you are receiving on the transfer of capital asset is called full value of consideration. However, other cases we will be discussing in that situation. Fine. So this is full value of consideration. Transfer expenses also I have already told you. Now what is the next part? That is cost of acquisition. So cost of acquisition, let me tell you. What is cost of acquisition, Kanna? Cost of acquisition means the consideration paid to acquire the capital asset, which is nothing but purchase price. So what amount you are paying to acquire the capital asset is called cost of acquisition. But is it so simple? Answer is no. It is a detailed discussion. For next 15-20 minutes, we are going to discuss cost of acquisition only. Firstly, let me tell you about the capital gain which was happening before 23/7/2024. Okay, wow. Kanna, 23/7/2024 means what? Previous year 24/25. But for your exams, what previous year is applicable? Previous year 25/26 is only applicable. However, there is a date called 23/7/2024 which was there in previous year 24/25. Before that, the tax rate was different. On or after 23/7/2024, the tax rate has changed. But should you learn the old tax rate also? Answer is yes. You have to learn the old tax rate also, old provisions also, because in your question, there can be a situation where a transfer has happened before 23/7/2024. In that case, you have to calculate in the old method with the old tax rate and you should be able to answer. So firstly, let me talk about what was the position before 23/7/2024. Then I will talk about on or after 23/7/2024 what has changed. Okay, wow. So firstly, before 23/7/2024, long-term capital gain was taxed at 20%. So the rate of tax was 20% with indexation. Sir, what is this indexation? New concept you are telling us. So long-term capital gain tax was 20%. So tax rate is 20% with indexation. Now let me tell you about indexation. Listen here, Kanna. Firstly, if at all you have bought a asset. Okay, wow. This asset you had bought 10 years back. 10 years back, let's say its price is 1 crore. This asset now you are selling for 10 crore rupees in previous year 25/26. Okay, in previous year 25/26 you are selling for 10 crores. Fine, after 10 years you are selling. Now in 10 years, no Kanna, this asset value is there, no? First the cost is how much? 1 crore. The selling price is how much? 10 crores. So what is profit? The profit, or you can tell capital gain, is equal to 9 crores. Am I right? Capital gain is 9 crores. In this 9 crores of capital gain, now listen carefully, I am talking about a concept. It can be because of two reasons, Kanna. This capital gain can be because of two reasons. First reason is because of the decrease in value of money, and second reason is because of the increase in value of asset. Very, very important. Because of decrease in money value, over a period of time, the money value comes down, because of which everything becomes expensive. Okay, wow. So 50 years back, if you are buying rice or 1 kg of fruit, you can buy for 1 rupee. But now if you are buying 1 kg, you are buying for 200 rupees or 250 rupees. Okay, wow. So that is why the money value has come down. Similarly, for all the assets, generally the value of money has come down. That is why all the asset price keeping on increasing. Okay, so due to decrease in the value of money, this concept is only called inflation. Inflation. Fine. And second reason is due to increase in the asset value. If the asset value goes up also, you will get a profit. So if money value comes down, then also asset value will increase. And if asset value increases, then also generally asset value will increase. So both cases asset value will increase. Now what did the government say earlier, before 23/7/2024, before that, the government told we are only going to tax the increase in asset value, because this is only actual profit. But whenever you are getting a capital gain because of the decrease in money value, it is called inflation. It is not your real profit, Kanna. It is only decrease in the value of money. So why to tax it? That is why the government will only tax increase in the asset value. That is why the government told that we will remove this inflation from the capital gain. Balance capital gain alone, you give us the tax at 20%. 20% on the balance capital gain. Now the question comes, sir, how will you remove this inflation from the asset price? Answer is using indexation. So you should remove the inflation using indexation. Now what is this indexation? Indexation concept is very simple. The government will give index numbers. Index numbers. This index number is there, no? It has started from 1/4/2001, and the first index which was for 2001-2002, it was how much, 100. So the first index number was 100. Like that, for every year the government will keep on giving index number. Sir, should I memorize index number? Answer is no, Kanna. You just know that the index number for 2001-2002 was 100, and for your previous year, that is previous year 25/26, it is 376. That much it is enough. All the balance index number will be given in the question itself. Fine. So 100, 105, 110, 112, like that, the government kept on increasing. And previous year 25/26, now the index value is 376. You know what it means? It means that in 2001-2002, if you had 100 rupees, okay, in today's terms, its value should be 376 rupees. Or if you are having an asset whose value is 100 rupees, today due to inflation, the value of that asset should be 376 rupees. So that is only concept of index number. So now what you should do, you should take the cost of your asset and you have to index your cost. It means what? Increase the value of your cost to remove the inflation, But before that, I want to tell you one more point. Kana, this index number, no, it started from 1/4/2001 only. What if the asset was purchased before 1/4/2001? Let's say I purchased an asset in 1980. Then how to do the indexation? Very difficult, no? Because from 1980 up to 1/4/2001, I am not having any index number at all. So how to bring the value of the asset which was there in 1980 to 1/4/2001? How to bring the value to 1/4/2001? That is the question. Because from 1/4/2001, I can use indexation to remove the inflation. But up to 1/4/2001, what to do? That is why the Income Tax Act has given a benefit to the assessee that the assessee can take the fair market value as on 1/4/2001 as the cost of acquisition. So let's say if your purchase price in 1980 was 1 crore, but on 1/4/2001 this value became 3.5 crores, then obviously 3.5 crores is beneficial for you. If you're having a higher cost, it means you will have lesser capital gain. So definitely you will take the benefit, and now your cost will become how much? 3.5 crores. Now this 3.5 crores onwards, you will start doing inflation. So 3.5 crores, you will divide by index number, that is 100, multiplied by current year index number, that is 376. And then you will find what is the indexed cost of acquisition. Then while calculating the capital gain, we reduce the cost of acquisition. No, instead of that, you will reduce indexed cost of acquisition and calculate capital gain. So this was the method being followed. However, when it came to land and building, no, now let me come to the point. When it came to land and building, people were misusing this section. Okay, well, what did I tell? When it came to land and building, people were misusing the section, because if you take higher cost as fair market value as higher value, then obviously your cost will also become higher, so your capital gain will come down. So when it came to land and building, people used to go to valuers and they will give some good fees, and the valuer will give high fair market value as on 1/4/2001 for this land and building, because of which the cost will increase and capital gain will come down, and the people will not pay any tax at all. So to avoid this, what did the government do? The government told, okay, you can take the benefit as on 1/4/2001, no problem. But this fair market value as on 1/4/2001, no, should not be more than stamp duty value as on 1/4/2001. So maximum how much you can take? Stamp duty value as on 1/4/2001 only you can take. Fine. Now see the formula. So if at all you are having a land or building or both, then if it is purchased before 1/4/2001, then what you have to do? Take the fair market value as on 1/4/2001 or stamp duty value as on 1/4/2001, whichever is lower. Basically what you are doing, you are restricting the fair market value to the stamp duty value. Maximum fair market value should only be up to stamp duty value. That is why fair market value or stamp duty value, whichever is lower, this lower amount or purchase price. If your actual purchase price itself is high, then why to even get bothered about 1/4/2001 value? Then you will take actual purchase price. That is why the lower value or actual purchase price, whichever is higher, will give you the cost of acquisition. So you get my point? How to find out the cost, Kanna? So whatever is the purchase price, you have to see. First, you see whether the asset is purchased before 1/4/2001. If asset is purchased before 1/4/2001, you can take purchase price or fair market value, whichever is higher. But if the asset is a land or building or both, then you have to see fair market value or stamp duty value as on 1/4/2001, whichever is lower. The lower value or purchase price, whichever is higher, will give you the cost of acquisition of the land or building or both. So I'll give you an example. So let's say a land or building was purchased on 1/9/1987 for 10 lakh rupees. On 1/4/2001, the fair market value was 23 lakhs. So now you will be very happy now. On 1/4/2001, now you can take this value as your cost because it is a higher value than purchase price. But the stamp duty value was 21 lakhs only. That is why you have to restrict this 23 lakhs up to 21 lakhs. So maximum you can take 21 lakhs only. So 23 lakhs or 21 lakhs, whichever is lower, or actual purchase price, whichever is higher. So that is why you take 21 lakhs as the cost of acquisition. Fine. Then let's talk about improvement. Kana, what is improvement? Improvement means the capital expenditure incurred on the capital asset. That is only improvement. However, improvement does not include any revenue expenditure. Also, for any expenditure, if you have already claimed a deduction, that is also not included in improvement. So improvement means capital expenditure, not revenue expenditure. And if you have already taken deduction, then don't include it in improvement. So let's say in this example, On 25 to 2025, additional floor was constructed on this building for a value of 5 lakhs. So this is also a capital expenditure. Hence, I can call this 5 lakhs as improvement. If at all you are doing indexation for a capital asset, then indexation should be done for the cost also, indexation should be done for improvement also. But sir, in this example that you have given us, improvement has been taken place only on 25 February 2025, which is less than 24 months. It means improvement is short term. Still, should we do indexation for improvement? Answer is yes, you have to do indexation for improvement also. So do indexation for improvement, because the asset is long-term capital asset. No, kana. If asset is long-term, you have to do indexation. This I am telling you now only. If the asset is long-term, you have to do indexation. But if asset is short-term, you should not do indexation. Okay. So if asset is long-term, we are doing indexation. However, if asset is long-term, but improvement is short-term, then also you should do indexation, because it is very, very simple. Asset long-term means you do indexation. Okay. So here also I am doing indexation. So here, indexed cost of acquisition is 21 lakhs divided by 100 multiplied by 376. So you will get 78 lakh 96,000. Similarly, for improvement, you have to divide 5 lakhs divided by, in the year of improvement, what was the index number you have to see. So it was 363 for 24-25. Then multiplied by 376, you will get 5 lakh 79,000. Now both these amount you have to reduce against the cost, and you will find out the real capital gain. This capital gain used to be taxed at 20% kana. However, from 23/7/2024 onwards, you know what happened? From 23/7/2024 onwards, from this date onwards, the government told, we will not give you the benefit of indexation. We will not give you the benefit of indexation. Now indexation is over. Okay, then what? But the tax rate is 20. No, since they are not giving the benefit of indexation, they have reduced the tax rate to 12.5%. Okay. So now there is no concept that you should not pay on inflation, you should only pay on the increase in value of asset. Like that, there is no concept. There is only one concept. You do selling price minus cost of acquisition is equal to capital gain. On this capital gain, you pay 12.5% tax. It is as simple as that. There is no concept of indexation. Okay, but in one place, no, concept of indexation still will be coming. That I will be telling you at the end of this lecture. Okay, so that is why only we are learning all this. There are two reasons to learn the before provision kana. First reason is that they can give you a before date of transfer and ask you to calculate the capital gain. That also you should be ready. And also on or after 23/7/2024 also, in one case, still while finding out the tax, you have to do indexation. So you should be knowing how to do indexation. Okay. So this was the concept of indexation. So before 23/7/2024, the cost of acquisition and cost of improvement have to be indexed. To find out the indexed cost of acquisition and indexed cost of improvement. This only you have to reduce from the net consideration to find out the capital gain or capital loss, as the case may be. Fine. Now let me tell you about the last point about cost of improvement. Kana, if cost of improvement, if it was occurred before 1/4/2001, then you have to ignore that cost of improvement. Don't consider it. Why, sir? Why not to consider it? Because as on 1/4/2001, you are taking the fair market value, no? In that fair market value, already that improvement would have been included. That is why you have to ignore any improvement done before 1/4/2001. You know what, Kana? This improvement, this 1/4/2001 concept itself, why was it introduced? It was introduced because from 1/4/2001 only you are having index number, correct? But before that you are not having index number. That is why you have the option to take the fair market value as on 1/4/2001. But now that is on or after 23/7/2024, indexation itself is removed. So if you speak logically, should you have any benefit as on 1/4/2001? Answer is no. But still the Income Tax Act, even though there is no indexation concept now, but still the Income Tax Act is giving you the benefit that you can take the fair market value as on 1/4/2001 as your cost of acquisition. Fine. So that is why even though there is no indexation now, still if the asset was purchased before 1/4/2001, the assessee can take the fair market value as on 1/4/2001 as the cost of acquisition. And if at all it is a land or building or both, then this fair market value will be restricted to the stamp duty value. So let us read this quickly. Cost of acquisition means consideration paid to acquire the capital asset. It also includes the expenses incurred for completing the title. For example, when you buy the house, you're also paying the stamp duty. So can you increase the value of the house by stamp duty value? Answer is yes. You can include stamp duty also in the cost. If the capital asset becomes a property of the assessee before 1/4/2001, then the cost of the acquisition shall be the actual cost of acquisition or fair market value as on 1/4/2001, whichever is higher. Fine. However, in case of land or building or both, the fair market value as on 1/4/2001 should be restricted to the stamp duty value as on 1/4/2001. This also I told you. And lastly, in case of land or building, cost of acquisition does not include the deductions claimed under section 24B or chapter 6A. So for any amount, if you have already claimed the amount as deduction, that amount you should not include in the cost. For example, for interest on housing loan, you are claiming deduction under house property chapter. For stamp duty or repayment of housing loan, you are claiming the deduction under 80C, that is deduction under chapter 6A. So all those amounts which you have already claimed as deduction, that you should not include it in the cost. Okay, then cost of improvement. Cost of improvement means capital expenditure incurred on the capital asset. So whatever capital expenditure is there, capital, and then if any cost of improvement is before 1/4/2001, it should be ignored. Okay, so don't take whatever cost of improvement in any case. If it is given before 1/4/2001, you should ignore it. Okay, so this is the concept of cost of acquisition. General concept we have learnt kana. Now let us see cost of acquisition and improvement in special cases. Firstly, let us talk about intangible asset. In intangible asset means what? An asset which you cannot touch and feel, like patent, copyright, goodwill, trademark, etc. And here other examples are also there. That is copyright, trademark, patent, license, tenancy rights, stage carriage permit. So what is stage carriage permit? The permit will be there, no? Like for example, if a truck is moving to different states, it will get an all India permit or a state permit. So that is only stage carriage permits. Then loom hours. So for handloom, number of hours will be specified for a particular person. That is only loom hours. So all these are intangible assets. So these intangible assets are there, no? Here the first point is that you cannot take the benefit of fair market value as on 1/4/2001. So if the intangible asset existed before 1/4/2001, you cannot take the fair market value of 1/4/2001 as the cost. That benefit is not there for intangible assets. Then if intangible asset is generated by self, okay, for example, I am having the asset and I have only created that asset. In such case, cost will be taken as 0. Self-generated asset, cost is taken as 0. If I have purchased the intangible asset, let's say I have purchased the goodwill or I have purchased the patent, in such case, the cost of asset will be the purchase cost. Then in any other case, it can be the cost of previous owner. Okay, for example, my father was having a patent. Now he has gifted that patent to me. Now what will be the cost of this patent? It will be my father's cost. Previous owner cost will be the cost of acquisition. Then cost of improvement should always be taken as 0. So cost of acquisition in case of self-generation is 0. In case of purchase is purchase cost. In any other case, it should be taken as cost of previous owner. Cost of improvement is always 0. And fair market value as on 1/4/2001 benefit is also not allowed for intangible assets. You get my point? Now one point about goodwill. Goodwill, no, it was earlier considered a depreciable asset till previous year 1920. Till previous year 1920, it was a depreciable asset. But after 1/4/2020 onwards, it is not a depreciable asset. You cannot claim depreciation. That is why, if at all the goodwill was existing before 1/4/2020, and if you have claimed the depreciation on goodwill, then whatever is the closing WDV as on 31/3/2020, this only will become your cost of acquisition. So don't take the purchase price. You would have claimed some depreciation, no? So that depreciation should be reduced. So as on 31/3/20, what is the closing balance? That only will be considered as cost. So that only I have written it. In such case, cost is equal to purchase cost minus depreciation claimed. Fine. Now let's talk about financial assets. Financial asset. Firstly, shares. In case of shares, what is the cost of acquisition? Cost of acquisition is purchase cost. So for what value you are buying the shares, that is only cost. Then period of holding. From when will the period of holding start? The period of holding will start from the date of allotment of shares onwards. So when you buy, that date is not considered as starting date. The starting date will be the date on which the shares are allotted to you. Okay. Second one, rights exercised, right renounced and right acquired. So let me talk about right shares. Let me give you an example. Let's say Reliance is a company. The market value of the shares of Reliance is 1,500 rupees per share. Now, Reliance wants some more money from the shareholders so that it can expand its business. So it will give, it will get money and it will issue the new shares. But if it issuing new shares, no, the old shareholders will get dissatisfied or they will get angry and sad. You know why? Because the old shareholders' value will come down. That is why the old shareholders expect that whenever Reliance company is issuing new shares, then you should first ask the old shareholders. This concept is only called right. Okay, wow. So what Reliance will do? Reliance wants to get money and it wants to issue the shares. So first it will go to old shareholders and it will give them the right. In my example, let's say there is a person called Mr. X. Mr. X is an old shareholder of Reliance. Okay, wow. Now Mr. X is getting a right from Reliance, right? That Mr. X can purchase the shares of Reliance at just 1200 rupees. So pay 1200 rupees and get the new shares of Reliance. Market value is 1500, but the old shareholders are there, no, they will get at a beneficial price. So they are getting at just 1200 rupees. So now what Mr. X will do? Mr. X will see, okay, it is a very good offer for me. I will take whatever money I am having, I will give to Reliance and I will get the shares at just 1200 rupees per share. Very, very beneficial. But sir, what if Mr. X is not having the money? If Mr. X is not having the money, then what will happen? Then in such case, Mr. X, just like that, they can't let go of the right, no. So Mr. X will transfer the rights to another person who is interested to buy the rights. Let's say in my second example, there is another person called Mr. Y. Mr. Y is interested to buy the rights because here he is getting the shares at only 1200, but if he is buying from the market, he will get at 1500. So what will Mr. Y do? Mr. Y will purchase the rights. But will Mr. X sell the rights just like that? Answer is no. He will charge some money. So Mr. X tells that you take my rights to buy the Reliance company shares. I am selling these rights to you for 200 rupees. For 200 rupees per right. Now Mr. Y will buy for 200 rupees and then after getting the rights, now the rights will belong to whom? It will belong to Mr. Y. Now Mr. Y will pay 1200 rupees to Reliance and get the shares. So in the first example, Mr. X example, how much did Mr. X pay? 1200. So cost of acquisition for Mr. X is how much? 1200. Now in second example about Mr. Y, let us talk about Mr. Y. How much Mr. Y paid? Mr. Y paid 200 for purchasing the rights. Then Mr. Y paid 1200 rupees for purchasing the shares of Reliance. So in this case, total how much? 1200 plus 200 rupees. So 1400 rupees has been paid by Mr. Y. So this is the cost of acquisition of shares for Mr. Y. Okay, wow. So now let us see. Firstly, right exercised. So right exercised means what? Mr. X itself has exercised the right. So in this case, amount paid to the company will be the cost of acquisition. So in our example, it is 1200 rupees paid to the company. Fine. And period of holding, as I told you, will start from the date of allotment of shares. Then right renounced. So what is right renounced? Right renounced means Mr. X is giving his right to Mr. Y. That is only renouncing of the right. In such case, what is the cost of acquisition? Cost of acquisition is 0. Because did Mr. X pay anything to Reliance to get this right? Answer is no. Reliance has given the right free of cost only. That is why the cost of the right will be taken as 0. Sir, what will be the full value of consideration, sir? Full value of consideration will be 200. For this right renouncement, full value of consideration will be 200. Cost of acquisition will be 0. So capital gain will be 200. And generally it is always short-term capital gain because only few days are given by Reliance. So all this transaction happen within a span of 1 or 2 months itself. Okay. So the cost is 0 and period of holding is from the date of offer. That is when the date when the Reliance gave offer till the date of renouncement, till the date on which it was renounced to Mr. Y. Then right acquired. Right acquired means what? Mr. Y has bought the rights from Mr. X. In such case, what is his cost of acquisition, sir? Cost of acquisition means amount paid to the company, which is 1200 rupees, plus amount paid to the right seller, that is 200 rupees. So total 400 rupees. 1400 rupees. That is the total cost. And here also period of holding will be starting from the date of allotment. Next one, bonus shares. Now let's talk about bonus shares. Bonus shares means what? Shares which are given free of cost. Let's say I am having 5 shares. Company issued a bonus of 1:5. So for 5 shares, I will be receiving 1 share. This 1 share is received free of cost. So generally, what is the value of bonus shares? Cost price of bonus shares? It is 0. because I did not pay any money to get the bonus shares. However, if the bonus shares were received before 1/4/2001, then you can take the fair market value as on 1/4/2001 as the cost of acquisition, because I have already discussed it with you. And what about any shares issued before 1/2/2018? In such case, let us have a discussion in section 112A, when I will be telling about grandfathering. No, I will be explaining this. And for bonus shares also, period of holding will start from the date of allotment. Fine. So now we have discussed the financial assets. Now let us jump to cost of acquisition and period of holding in special cases. Kanna, here in my book, the entire concept is explained in a very different manner when you compare it with the other faculty books or with your study material. You know why? Because here I see that the students are generally rote learning, okay, by hearting, trying to memorize all the different cases. Whereas if you just apply 2 or 3 simple concepts, you are able to identify what is the cost of acquisition, what is the period of holding, and also about the indexation just by seeing the situation. That is why I am not going to explain every case by case. Instead, I am going to tell you about the concept. Then I will tell you in what and all cases this concept is going to apply, so that just by using that concept, you can easily find out the cost, period of holding, and indexation. You get my point? So this is completely different. This you will not find anywhere else. You will find only in my book and only in this revision lecture. Fine. So let me tell you. First concept, Kana. If assessee has received an asset free of cost, okay, and the assessee pays no tax for it, in such case, the cost of acquisition shall be taken as the cost from previous owner. Listen, Kana. Now you link with the section 47 that I taught you in the beginning of this video, that is transaction not regarded as transfer. Transaction not regarded as transfer. There, what did I tell you? Whenever these transactions are happening that are not regarded as transfer, the Income Tax Act will close its eyes. So let's say there is a capital asset, okay, this capital asset was gifted by a father to a son, okay, and then later on it was sold by the son. So first father gave to a son as gift. He did not pay, take any amount from the son. It was given as gift. So already I told you, if any asset is transferred as gift, then it is a transaction not regarded as transfer. So capital gain will not apply. So in this case, what will happen? Whenever this type of transaction is happening, the Income Tax Act will close its eyes. So it means what? As per the Income Tax Act, nothing has happened here. It will see the transaction only from father to sold by son directly. It will not see the transaction which has happened in between, that is the transaction of gift. Fine. That is why this father, who is considered as previous owner, the cost of acquisition will be taken from previous owner itself. From previous owner itself, you take the cost of acquisition. Then what about period of holding? What is the period of holding? Generally, it is from purchase date to the sale date. So date of acquisition till the date of transfer. When did the son acquire? The son had acquired the asset in between when the father gave to the son. However, I told you no, the Income Tax Act has now closed its eyes. That is why this transaction itself it cannot see. That is why period of holding also will start from father to selling by son. So this entire period will be considered as period of holding. To decide whether it is long term or short term, you should know what is period of holding. No. So you have to take it from the previous owner itself. Period of holding, take it from the previous owner. Now what about indexation? Kanna, if the asset is transferred before 23/7/2024 or if the asset is transferred on or after 23/7/2024 in special cases, then you should be applying indexation also. In case of indexation, how to find out what is the indexation? From where should you take the indexation? Answer is, you should take the indexation from the previous owner itself as per Manjula J. Shah case. Manjula J. Shah case. Because Income Tax Act says take the indexation from the date on which the son got the asset. Okay, from current owner only you have to take indexation, but it is illogical. Let me not go into the depth why it is illogical. That is why indexation you have to take from previous owner itself. See, Kanna, cost you are taking from previous owner. Period of holding also you are taking from previous owner. Then why to take indexation from current owner? So that is not logical. This case was fought by Manjula J. Shah and she won in the Bombay High Court. That is why that case law reference you are taking, and indexation also you should take from previous owner itself. So in your examination, whenever you are getting a chance to find out indexation and you are taking the previous owner value, in such case you have to mention that as per Manjula Jesha, you are taking indexation from previous owner. Indexation from previous owner. So what did I say? If the asset is received free of cost, so here the son is receiving free of cost and the father does not pay and the son does not pay any tax. Okay, in that case the Income Tax Act will close its eyes. It is considered as transaction not regarded as transfer. That is why you should take previous owner cost. From previous owner itself, period of holding will start. From previous owner itself, indexation also will start. Okay. Now, so in what and all cases this concept will apply, let me tell you. Firstly, distribution of assets on the total or partial partition of HUF. So when HUF is partitioning the property, then HUF need not pay any tax. It is a transaction not regarded as transfer. When the individual are receiving the property, at that time they are also not paying any tax. That is why you have to take the cost of previous owner, indexation from previous owner, period of holding from previous owner. Then gift or will by an individual or an HUF. Let's say the individual is getting a gift. In that case, if at all it is taxable, then this is not applicable. If the gift is received and no tax is being paid on it, in that case the cost will be taken from previous owner, period of holding also from previous owner. Then succession or inheritance or devolution. So even if an asset is received in succession, then take cost from previous owner, period of holding from previous owner. Then transfer due to revocable or irrevocable trust. Transfer to revocable or irrevocable trust. So when a person is transferring to a revocable or irrevocable trust, okay, revocable means temporary transfer, irrevocable means permanent transfer. Whenever the trust is receiving it, in that case cost will be taken from previous owner, in period of holding also from previous owner. Then when holding company is giving to Indian subsidiary company, then also I told no, Income Tax Act will close its eyes. That is why the cost of acquisition will be taken as what was the cost of the holding company, period of holding also will be taken from holding company itself. Then subsidiary to Indian holding. When subsidiary is transferring to holding also, it was purchased by subsidiary, but it is transferred to holding. No, when the transfer was taking place, the Income Tax Act closed its eyes. That is why it is a transaction not regarded as transfer. So in future, when the Indian holding company is selling the asset, in such case take the cost of acquisition from the subsidiary itself, take the period of holding also from the subsidiary itself. Next one, when amalgamating company is transferring to amalgamated. So for example I gave you, let's say PVR is transferring to new company, that is PVR Inox. In such case, what will happen when the transfer is taking place? The Income Tax Act will close its eyes. That is why when PVR is transferring asset to PVR Inox, later on when PVR Inox is selling the asset sold, then what you will do? The cost of acquisition you have to take what was the cost to purchase, cost for PVR, whatever was the cost you have to take, and period of holding also, entire period you have to take from PVR to the sale of asset, the entire period you have to take. Similarly, demerged company to Indian resulting company. So when old Reliance is transferring to Geo Finance, then also this will apply. Then conversion of an individual property into HUF property also, this concept will apply. So in all these cases, cost of acquisition from previous owner, period of holding from previous owner, and if at all indexation is applicable, take indexation also from previous owner itself, but make sure that you mention Manjula J. Shah. Okay, now let's come to cost of improvement. Cost of improvement also you have to take from previous owner, but I already told you, if the cost of improvement was incurred before 1/4/2001, you have to ignore such cost of improvement. Next one, concept number 2. Old asset is converted into new asset, sir, and this conversion was not regarded as transfer. So old asset being converted to new asset. Let me give you an example. Let's say amalgamating company shares converted to amalgamated company shares. So in this PVR Inox itself, let's say there was a shareholder of PVR. He was having PVR shares. Now his PVR shares got cancelled and converted to PVR Inox shares. So now his new shares is PVR Inox. And I already told you in the first part of this video that whenever this type of conversion is happening, the Income Tax Act will close its eyes. That is why whenever in future you are selling the PVR Inox shares, at that time what will be the cost? What will be the cost? Cost of acquisition shall be the cost of PVR shares. So cost of old shares only should be taken as the cost, because here the Income Tax Act has closed its eyes. That is why you should take from the previous transaction itself. So take cost from the old shares, take period of holding also from the old shares. So now cost of acquisition, cost of old asset, period of holding also from the old asset. Now in what and all cases this applies, let us see. So shares of amalgamating company converted to amalgamated company, then conversion of bond, debenture stock or deposit certificate into shares or debentures. So here also it will apply. Then conversion of equity shares into preference shares, then shares of resulting company to the demerged company, conversion of resulting company to demerged company, then electronic gold receipt to gold to electronic gold receipt. So in all these cases this will apply. But this resulting company alone you cut it here, because resulting company I have covered in the next concept. Okay, in demerger the concept is little bit different. Now listen, in demerger I already told you there was a company called Old Reliance. Okay, this Old Reliance has now split into two companies, that is Geo Finance Company and New Reliance Company. So first let's say this person would have bought Old Reliance shares for ₹1000. Okay, but now he has gotten two different shares. Now he is having one Geo Finance share and he is having one New Reliance share. And I already told you that when this transaction was happening, the Income Tax Act will close its eyes. So it will assume that no transaction has happened. So generally what do? We take it from the old asset. But here you cannot take from old asset. Why? Because how to find out what is the cost of Geo Finance and what is the cost of New Reliance? Earlier you were having only one share. That is for 1000 rupees you had purchased. But now that one share has become how many shares? It has become two shares. So what is the cost of both shares? How to find out? For that you have to divide this value of 1000 on proportionate basis, so that you can find out this 1000 how much belongs to Geo Finance shares, how much belongs to New Reliance shares. So that how to find out using the net worth formula. So let me give you the formula. See here, cost of acquisition of Geo Finance shares is equal to cost of the Old Reliance multiplied by book value of the asset transferred to Geo Finance divided by net worth of Old Reliance. So what is the Geo Finance value divided by Old Reliance value, that is the full company value. With that you are able to find out what is the cost of Geo Finance shares. You get my point? Then what about New Reliance shares? Very simple, that 1000 multiplied by Geo Finance shares is equal to New Reliance shares. So cost of Old Reliance minus cost of Geo Finance is equal to cost of New Reliance. So this only I have given here. Cost of acquisition of resulting company is equal to A multiplied by B by C, where A is equal to cost of acquisition of demerged company share, B is equal to net book value of the asset transferred during demerger, and C is the net worth of the demerged company immediately before the demerger. So like that, using this proportionate formula, you have to divide this 1000 rupees into two parts. So what is the cost of Geo Finance? What is the cost of New Reliance? Like that you have to split. Period of holding will be taken from the old Reliance itself. So from the old asset itself, you have to take period of holding. Now let's come to concept number 4. Very simple. If the assessee has paid a tax while receiving an asset, then whatever value was considered while paying the tax will be considered as cost of acquisition. So there are few cases here. Let's take example of ESOPs or sweat equity shares. Listen Kanna, this I have discussed in the salary revision video also. Here also once again I am telling you for the purpose of understanding. Let's say the employer is giving the employee shares, that is ESOPs. Okay, the value of the shares, market value is equal to 1000 rupees. But the employer is giving only for 200 rupees. So market value is how much? 1000 rupees. But the employee has paid how much? Only 200 rupees to get the shares. Now in salary head of income, what did we learn? We learned that 1000 minus 200 is there. No, that is the fair market value minus exercise price, that is 800 rupees will be taxable under the salary head of income. Under salary. So while paying the tax, what did the employee do? The employee has considered the value of the shares as 1000 and on this value he has paid the tax. So what was the value of share considered? 1000 rupees. Since the value of shares was considered as 1000 rupees and tax has already been paid, that is why for future purpose this market value will become the cost of acquisition. So in future when the employee is selling the shares, let's say in future employee is selling shares. So first we have to take full value of consideration, correct? From this full value of consideration we have to reduce the cost of acquisition. Here what you will reduce? Will you reduce 200? Answer is no. You will reduce 1000 rupees as cost, because already he has considered 1000 and paid the tax. That is why now his cost will become 1000. So in all the cases where if you are paying the tax and while paying the tax you have considered some value of the asset, that value will become your cost. So let us see what are all the cases. Number 1, is the ESOPs, employee stock option plan. Second case, stock in trade converted into capital asset. So whenever stock in trade, that is the stock, is converted into capital asset, then fair market value of the stock is considered as income in PGBP. Fair market value of stock is considered as income in PGBP. You have to pay tax under PGBP when you convert stock into capital asset. Hence, whatever value is considered as fair market value will become as cost of asset for future capital gain calculation. Then property taxed under section 56.210. So 56.210 is the section of gifts that we discuss in income from other sources chapter. Then also we learn that whenever a person is receiving movable property or immovable property without consideration or for inadequate consideration, then it is taxable under 56.210. There, whatever was considered as fair market value, it will be considered as cost of acquisition for future purposes. Okay, so for example, let's say I received a property worth 1 crore rupees free of cost from my friend. So my friend is giving me property of 1 crore. No, I have not paid anything. So for me, practically the cost is zero. But in 56.210, I have to consider the value of 1 crore, and on that 1 crore, I have to calculate my income and pay the tax under income from other sources. That is why the value of the property, that is 1 crore, it will become my cost for future purposes. So in future, whenever I am selling the property, I can reduce the cost as 1 crore. Okay. So property tax under section 56.210, and similarly fair market value of the assets received on liquidation. So whenever you are receiving on liquidation, then also fair market value will be considered as cost of acquisition of the asset. So here cost of acquisition is equal to amount considered as value of the asset while calculating the taxable income. Period of holding should be taken from the time of receiving the asset, and indexation also only for land and building case, that special cases. From the time of receiving the asset, you will calculate the indexation. So period of holding, since you have paid the tax, no, that is why when you're receiving the asset itself, start calculating period of holding. Similarly, indexation also will start from the date of receiving the asset. Fine. Here in case of sweat equity, it will start from the date of allotment. In case of stock in trade converted into capital asset, it will start from the date of conversion. Here not allotment, you can change it to conversion. Okay. Then next concept, if previous owner itself cannot be determined. So you have received from owner, but however previous owner value, what was the cost of previous owner, you don't know. When did the previous owner buy, that also you don't know. In that case, what to do? In that case, on the date of receiving the asset, whatever is the fair market value, that you take as the cost of acquisition, and period of holding also will start from that date itself. Fine. Even indexation will start from the date of receiving the asset. So these are the 5 concepts. I hope you are clear. Now let us talk about section 48 proviso 1, special case of non-resident. Okay, special case of non-resident, where non-resident is buying the shares. It is applicable to a non-resident and foreign company also. Not applicable under section 112A. So if a transaction is not covered under 112A, that we are going to discuss at the end of this video, then only this provision will be applicable. That is section 48 proviso 1. Asset should be share or debenture of an Indian company acquired in foreign currency. So Kanna, what does this proviso 1 tell? No, the proviso 1 tells that if there is a non-resident, and if the non-resident has bought shares or debentures of an Indian company in foreign currency, then you know what you should do. You should calculate the capital gain also in foreign currency, and that final capital gain you have to convert it into Indian currency and pay the tax. So what we should do? Calculate the capital gain in foreign currency. So what should be done? Whatever is the full value of consideration, whatever is the cost of acquisition, transfer expense, everything should be converted into foreign currency, foreign currency, foreign currency. Okay, then capital gain also you will get in foreign currency. This capital gain you have to convert into Indian currency. Indian currency. How to convert, sir? See, Kanna, cost of acquisition you have to convert using the average of TTBR and TTSR on the date of acquisition. So on date of acquisition, that is date of purchase, take the telegraphic transfer buying rate or telegraphic transfer selling rate and do the average of both the amount, and whatever is the average, using that you convert the cost of acquisition into foreign currency. If it is already in foreign currency, no need to convert, but if it is Indian, convert into foreign currency. Then full value of consideration and transfer expense also convert into foreign currency using average of TTBR and TTSR as on the date of transfer. Okay. Then finally, whatever capital gain is there, you convert it into Indian currency using the TTBR on the date of transfer. So this is the method of calculating capital gain in case of non-resident who has purchased the shares or debentures of an Indian company using foreign currency. With this, all the basic concepts of the capital gain chapter are now over. That is, we have discussed in the charging section and the computation section. Now let us jump to discuss all the special concepts in the capital gain chapter, starting with exceptions to capital gain charging section. Kanna, what does the charging section say? The charging section says that there should be a capital asset, it should be transferred, and the capital gain is taxed in the year of transfer. However, there are certain cases where the capital gain is not taxed in the year of transfer, it is taxed in some other later year. So let us see all those cases one by one. So first case is section 45 subsection 1a, insurance claim for damage or destruction of capital asset. So let's say when a capital asset, let's say if it is destroyed in 2023, then when does the transfer take place? In 2023. However, let's say the insurance claim is received in 2026. Hence, in the year in which the insurance claim is received only, the capital gain will be taxable. So when is it applicable? It is applicable to capital asset which is destroyed due to accidental fire, flood, typhoon, hurricane, earthquake, tsunami, riot, civil disturbance, enemy attack or any other natural calamity, and insurance claim is received. It is taxable in the year in which the insurance claim is received. If no claim is received, then no capital gain will arise. In case of long-term capital asset being land or building purchased before 23/7/2024, indexation should be taken only till the date of destruction. Karna. So here, what did I say? Destruction happened in 2023, but insurance claim was received in 2026. So when will you pay the tax? The tax will be paid in 2026 only. However, till the date of destruction only you have to do the indexation. So till 2023 only indexation has to be done. You get my point? So now whenever you are calculating the capital gain, in the computation, while writing the full value of consideration, you have to write whatever is the money or the fair market value of the asset received as insurance claim. Okay, in the full value of consideration, balance calculation will be as usual. So you have to reduce the transfer expense, then you have to reduce whatever is the cost of acquisition or cost of improvement. You will get the short term or long term capital gain or capital loss. You get my point? Now let's come to section 45 subsection 2, conversion of capital asset into stock in trade. So when capital asset is converted into stock in trade, then in the year of conversion only the capital gain will arise, but it will be taxable in the year in which the stock is sold. So transfer arises when the assessee converts the capital asset into stock in trade. However, it is taxable in the year in which such a stock is sold. Moreover, if only part of stock is sold, then only part capital gain will arise in the year in which such part is sold. Let me give you an example. Let's say there is a builder. So what is the work of builder? Work of builder is constructing the building and selling the building. Now this builder had constructed his own building for own use in 2019. 2019 he constructed a building for 100 crores which he was using for own business. However, later on in 2023 he converted this building into stock in trade. So when does the transfer take place? The transfer take place in 2023 when the building is converted into stock. However, what did I say? When is it taxable? It is taxable in the year in which the stock will be sold. So let's say in 2023 it was converted into stock. Later on in 25-26 2 floors of the building were sold, and in 26-27 remaining 2 floors of the building were sold. So that is why in 2023 itself you will calculate the capital gain. So capital gain will be the fair market value as on the date of transfer. It will be taken as the full value of consideration, then minus the cost of acquisition 100 crores, it will give you the capital gain. So let's say the capital gain in our case is 150 crores, fair market value 150 crores. Now 2 floors were sold in 25-26 and 2 floors were sold in 26-27. In such case, what will happen? In 2023 you will find out what is the capital gain. So full value of consideration will be taken as 150 crores which is the fair market value. From this you will reduce the cost of acquisition which is 100 crores. So your capital gain will come as 50 crores. Then let's say in 25-26 2 floors were sold for 100 crores. In 26-27 also balance 2 floors were sold for 100 crores. In such case, take the selling price in PGBP as the sale value. From that you have to reduce the cost to find out the PGBP income. So what should be the cost that should be reduced in PGBP? The cost should be the fair market value which was taken for capital gain purposes. So this fair 150 crores only will become the cost. However, you have sold only 2 crores. So that is why 50% will be taken as the cost in first year. Balance 50% will be taken as cost in second year. So the PGBP income will be 25 crores in year 1 and 25 crores in year 2. Similarly, this capital gain also, although the capital gain had arisen in 2023, but it will be taxed in the year in which the stock is sold. So 50% capital gain will be taxable in 25-26. Balance 50% will be taxable in the year 26-27. You get my point? So this I have given it here also in the form of a table. So whenever there is conversion, you have to take the full value of consideration as the fair market value as on the date of conversion. Period of holding also you have to take only up to the date of conversion. Then indexation also, if at all it is applicable, you have to take on the date of conversion, till the date of conversion. So minus cost of acquisition or index to cost of acquisition, cost of improvement or index cost of improvement, you will get the short term or long term capital gain or capital loss. It will be taxed in the year in which the stock is sold. So when the stock is sold, only capital gain will be taxable. You have to calculate the capital gain when the conversion take place, but you have to tax it in the year in which the stock is sold. Fine. So whenever the stock is sold, the selling price of the stock should be taken minus fair market value should be reduced, then it will give rise to PGBP income. So the year in which the stock is sold, in that year PGBP income will also come, capital gain income will also come. Fine, you get my point? And if at all 54 EC exemption will be claimed, then the 6 months period for 54 EC exemption will start from the date of sale of stock only. Okay, in 54 EC we will see to claim the exemption there is 6 months time from the date of transfer, but here you should not take from the date of transfer, you should calculate the 6 months from the date of sale of stock. Now let's come to stock in trade converted into capital asset. So when stock in trade is converted into capital asset, then in the year of conversion PGBP income will come. However, here there is no benefit Kanna. Here there is no benefit. That is why this PGBP income will be taxable in the year of conversion itself. For this PGBP income, you cannot wait till the sale of capital asset to tax it. In the year of conversion itself, it will be taxable. Later on, whenever capital gain is there, in that year, the capital gain will be taxable in the year of sale of capital asset. Fine. Then section 45 subsection 5, compensation on compulsory acquisition. So compulsory acquisition means what? The government is coming and compulsorily acquiring the property and giving the compensation. This will be taxable in the year in which the compensation is received. So when will the transfer takes place? Let's say in 2024 only the government had compulsorily acquired the property. However, the government gave the compensation in 2026. In that case, it will be taxable in the year 2026 and not in the year 2024. Fine. So capital gain is taxable in the year in which the compensation is received by the government. Period of holding and indexation are taken till the date of compulsory acquisition only. So date of compulsory acquisition is only the date of transfer. So period of holding you have to take up to the date of compulsory acquisition. Indexation also, if at all it is applicable, you have to take up to the date of compulsory acquisition. If at all the transferor dies, then compensation shall be taxable in the hands of recipient. So whoever is receiving the compensation will be paying the tax. Later on, then in interest on enhanced compensation, it is taxable under the head income from other sources. Kanna, if the government is giving the compensation late, they will also give you some interest. So this interest will be taxable in income from other sources, and there we will also be learning that whatever interest is paid by the government, on this there is 50% standard deduction also allowed in income from other sources chapter. Fine. Now let us talk about compensation being received in installments. Installment means what? The government is giving compensation in multiple installment. Okay, wow. So 50% in first year, balance 30% in second year, 20% in third year. Like that they are giving the compensation. In such case, in case of initial compensation means what? Compensation which is decided by the government. So when the government has decided the compensation and they are giving that compensation, then if at all they are giving an installment, you should not see the installment. Entire value, all the installment combined will be taxable in the year in which the first installment is received. What about enhanced compensation, sir? Firstly, you should know what is enhanced compensation. Enhanced compensation means the assessee is not happy with the compensation fixed by the government. That is why the assessee will go to court to fight against the government. In that case, the court can increase the compensation. So when the court gives the order to increase the compensation, it is called enhanced compensation. Okay, wow. However, sometimes when the court process is running, the court will not give order. In between the case itself, the court will ask the government to pay some enhanced compensation. This is called enhanced compensation due to interim order. Interim order means what? In between the case itself, the court is asking to give compensation. Now, if enhanced compensation is received, then how to tax the enhanced compensation? It is taxed as and when it is received. So whenever enhanced compensation is received, in that year, that much amount is only taxable. Okay, wow. If at all it is received due to interim order, then you have to wait till the final order is passed. In the year of final order is passed, then only it will be taxable. So enhanced compensation is taxable as and when it is received. However, if it is received due to an interim order, you have to wait till the final order is passed. In the year of final order passing only, you have to pay the tax on enhanced compensation. Okay. Now how to calculate capital gain? Firstly, let us talk about initial compensation, which is the compensation given by government. In case of initial compensation, full value of consideration will be taken as initial compensation, and then from that you reduce all the other items as usual. Transfer expense, cost of acquisition, cost of improvement. You will get the long-term or short-term capital gain or capital loss. Then let's talk about enhanced compensation. Enhanced compensation means what? The court has asked the government to give some extra compensation. That is only called enhanced compensation. In case of enhanced compensation, full value of consideration will be considered as enhanced compensation. And in transfer expense, you can reduce the litigation cost also. Litigation cost means what? Whatever fees you are giving to the lawyer, that you can reduce. Whatever court fees you are paying, that you can reduce. So finally you will get net consideration. But from the net consideration, can you reduce any cost of acquisition? Answer is no, because cost of acquisition you already would have reduced while finding the capital gain on initial compensation. So once again you cannot reduce kana. That is why you can only reduce the transfer expense, and whatever amount will be coming will be long-term or short-term capital gain or capital loss, as the case may be. Fine. So this was about compensation on compulsory acquisition. One more point I would like to say is about the exemption on compensation of compulsory acquisition. Whenever the government is giving compensation on acquisition of urban agricultural land, that is exempt for individual and HUF if the conditions are satisfied. But sir, what about rural agricultural land? Rural agricultural land is however not taxable because it is not at all a capital asset. That is why only we are speaking only about urban agricultural land. So if the government is compulsorily acquiring urban agricultural land, and if they are giving the compensation, then it is exempt if the conditions are satisfied. What are the conditions? The compensation is exempt only for individual or HUF. To other person it is not exempt. Then agricultural land should be used for at least 2 years before the date of transfer by the assessee or his parents or members of the HUF for agriculture purpose. So agricultural land should be used for agriculture purpose for at least 2 years before the date of compulsory acquisition. And lastly, consideration should be determined and approved by the RBI or central government. If these conditions are satisfied, then compensation on urban agricultural land is fully exempt under section 10 clause 37. So this was all the discussion about compulsory acquisition. Now let's talk about liquidation kana. So the exceptions to charging section are over. Now we are going to all the other special concepts. Firstly, we are discussing about liquidation. Section 46 talks about liquidation. Liquidation means what? The company is closing down. That is why it is distributing whatever asset it is having to the shareholders, and whatever money it is having also it is distributing to the shareholders. Now when the company is distributing to shareholders, when the assets are being transferred from the company to the shareholder, then it is a transaction not regarded as transfer, which we have already learned in the beginning of this video. When the company is giving the asset, it is a transaction not regarded as transfer. Hence, the company need not pay any tax. Fine. Now let's talk about the hands of shareholder. In the hands of shareholder, the assets are coming in and the shares are going out. It means what? The shares are getting relinquished. Fine. Shares are getting relinquished. So what happens when the assets are coming in? What happens on relinquishment of shares? Let us see. Whenever asset and money is coming from the company, then fair market value of the asset up to the extent of accumulated profit, whether capitalized or not, will be considered as deemed dividend under section 2 clause 22C, and it will be taxable under income from other sources. And whatever is the balance fair market value and money received minus deemed dividend, okay, will be considered as full value of consideration for capital gain purposes. Let me give you an example so that you can understand better. Let's say there is a company kana, that company is having a balance sheet, XYZ Limited, okay, the company is having balance sheet. In the liability side, you can see that the general reserve is 100 crore rupees, and in the asset side, you can see that the assets are 400 crore rupees. So general reserve means what? General reserve means accumulated profit. Accumulated profit can be general reserve also, profit and loss account also, reserves and surplus account also. So all these are accumulated profit. So this accumulated profit is 100 crores and the assets that are distributed is 400 crores. 400 crores. This 400 crores worth of asset is distributed to all the shareholders. So when the company is distributing this 400 crores asset, will the company pay any tax? Answer is no. It is a transaction not regarded as transfer. So the company will not pay any tax. Now let us talk about shareholder. Let's say there is a shareholder called Mrs. C. Mrs. C was having 100 shares in XYZ Limited, for which she had purchased for 10 rupees per share. Now what happens? She has received assets worth 8,000 rupees from the company. 8,000 rupees from the company. Now listen here. The asset was received for 8,000. Here the asset of the company distributed was 400 crores. General reserve was 100 crores. So it means what? 1 out of 4, that is 25% of the fair market value is from the accumulated profit. Balance amount or balance asset is not from accumulated profit. So in this 8,000, what did I say? 8,000 multiplied by 100 crores divided by 400 crores. It is equal to 2,000. This 2,000 has come from accumulated profit. Okay, then 8,000 multiplied by 300 divided by 400, that is the balance. Okay, it has not come from accumulated profit. Not accumulated profit. So whatever amount has come from accumulated profit, no, that much amount is deemed as dividend and it will be taxable under income from other sources under section 2 clause 22C. Whatever is the balance amount, no, so balance amount will be considered as full value of consideration for capital gain purpose. So here full value of consideration will be taken as 6,000 and you can reduce whatever is the cost of acquisition. So her cost of acquisition was 100 shares at 10 rupee per share, which is 300. Hence 5,700 will be capital gain. 5,700 will be capital gain. Okay, so this, are you clear? Now let us take one more situation which I have given in red color. Let's say the asset itself was 50 crores. Asset itself was 50 crores. In this case, what will happen? Asset value was 50 crores. General reserve was 100 crores. It means what? All the asset that is fixed at 50 crores is entirely from the accumulated profit. Since entire asset is distributed is from the accumulated profit, this red color alone you see, entire value will be treated as deemed dividend. If entire value is treated as deemed dividend, in such case, full value of consideration will be how much? It will be 0. Full value of consideration is 0. Then cost of acquisition you have to reduce 300. That is why this 300 will become capital loss. Capital loss. So in the hands of shareholder, what you should see, fair market value up to accumulated profit will be treated as deemed dividend. Balance amount, whatever is the fair market value balance and money received will be treated as full value of consideration for capital gain purposes. Okay. So here for the shares going out, for the assets coming in, let us see, fair market value of asset up to accumulated profit will be considered as deemed dividend under section 222C, taxable under income from other sources. Then when the shares are getting relinquished, then what will be the full value of consideration? Full value of consideration will be total fair market value of asset received plus money received minus deemed dividend that was considered. Okay, and from this you reduce the cost of acquisition, you will get the capital gain or capital loss. If entire asset is from the accumulated profit only, in such case entire amount will be deemed dividend under 222C. That is why full value of consideration will be taken as 0 and hence entire cost will be taken as capital loss. Fine. So this is the explanation for liquidation. Period of holding you have to take only up to the date of liquidation karna, and capital gain arises in the year of receipt of asset under liquidation. So whenever assets are received, that year only capital gain will arise. So this was liquidation. Now let us discuss section 46A, which is buyback. Buyback means what? The company shares are there. No, the company is buying back its own shares from the shareholder. Okay, so XYZ company is there, it is buying back its own shares from the shareholder and giving them the money. This is only called buyback. So buyback is very simple. No, generally how to tax the buyback, let us see. So general taxation we will see other than domestic company and other than the other specified assets, that is ESOPs. In that case, what is happening? The company is there, no, company is giving money to shareholder, okay, and shareholder is giving the shares to company, or you can also say the shares are getting relinquished. So in that case, there is a transfer of shares and money is received. That is why this money, whatever is received from the company, will be considered as full value of consideration. Okay, minus cost of acquisition is equal to the cost of purchase of shares, and you will get the capital gain. You will get the capital gain. This is the normal provision, but however, normal provision is only applicable to other than domestic company and specified security. It is not applicable to domestic company. To domestic company, no, you have to learn another method. What is that method? No, illogical method karna. What is the illogical method? The illogical method is that whenever the company is giving the money to the shareholder, in case of domestic company, when the company is giving the money to the shareholder, entire money is treated as deemed dividend under section 2 clause 22F. And you have to pay the tax under income from other sources. It is taxable under income from other sources. But sir, the shares are also relinquished, no? For that what will happen? When the shares are also relinquished, for that you can't do anything. Full value of consideration, nothing you have received, because entire amount you have treated as deemed dividend. So full value of consideration will be considered as 0 minus you will do the cost of acquisition. So balance amount will be capital loss. This capital loss you can do for doing set off and carry forward adjustment. Okay, so in case of domestic company, what happens? Whenever domestic company is giving the money for buyback, entire money, okay, you should not see accumulated profit, nothing. Entire money is treated as deemed dividend under section 2 clause 22F. Okay, and when it comes to the shares, because the shares are relinquished, that is why the full value of consideration will be considered as 0. Cost of acquisition will become capital loss. Cost of acquisition will become capital loss. This can be used for set off or carry forward. Okay, so this is in case of domestic company. So domestic company, illogical method of deemed dividend, but other than domestic company and specified security, logical method of capital gain. Fine, understood both. Now this amount can be used for set off, carry forward. Period of holding is there, no? You have to take from the date of acquisition till the date of buyback. Now let's talk about next case. Section 50 and Section 50A, which deal about depreciable asset. Firstly, let us discuss Section 50, which talks about WDV method. Because for almost all the assessees, it is compulsory to opt for WDV method, and it is a block of asset method. Now in WDV method asset calculation, how will the capital gain arise? Let us see. Kanna, whenever you are calculating WDV method, no, first what you will do, first you will see what is the opening WDV of the block. From the opening WDV, you will add what are all the assets that are purchased during the year, that is additions, and then you will reduce what is the money receivable from the assets transferred during the year, which is nothing but sale. So opening WDV plus purchase minus sales, you will get the total. On this total only you will get the you will calculate the depreciation, correct? Now if at all this total is negative, if this total is negative, it means what? The selling price was greater than the addition and opening WDV combined. If the total is negative, then the negative value will be short-term capital gain. You have to include it in the capital gain chapter as short-term capital gain. But if the amount is positive, then you have to see whether any asset is left or no asset is left. If no asset is left in the block, then it will be a short-term capital loss. However, if any asset is left in the block, then you have to calculate the depreciation normally. So what did I say? First you have to do opening WDV plus addition minus sales. Whatever the total you will get, you have to see whether it is a negative amount or positive amount. If it is negative amount, then the amount will be short-term capital gain. But if it is positive, you have to see whether any asset is left or no asset is left. If there is any asset left, then you have to calculate depreciation normally, which I have discussed in the PGBP revision lecture. And if no asset is left, then whatever amount is there, it will be short-term capital loss. You get my point? Now let us come to the point that capital gain is always short-term karna. In this case, capital gain is always short-term. So this case is an exception to period of holding concept. So period of holding, no, we learned short-term and long-term, 12-month, 24-month category. This depreciable asset is always considered as short-term capital gain or short-term capital loss. Fine. However, when we are learning section 54 series exemptions, no, there if at all you want to claim an exemption for long-term capital asset, then you have to see whether asset is held for long-term. If asset is held for long-term, you can still take the benefit of section 54 series exemptions. Fine. Now let's come to section 50A, which speaks about straight line method. If an assessee is engaged in the generation of power or generation and distribution of power, then the assessee can choose straight line method for the assets for depreciation. Now when the straight line method asset is sold, then you have to see whether selling price is lesser than WDV. If selling price is lesser than WDV, then whatever is the difference, no, it will be called as terminal depreciation, and this terminal depreciation is allowed as a deduction in PGBP head of income. It is allowed as deduction. Sir, what if the selling price is more than WDV? If selling price is more than WDV, then you have to see whether the selling price is still more than cost or less than cost. So if selling price is more than WDV but below the cost price, then whatever difference is there, no, it will be treated as balancing charge, and it is an income under PGBP head of income. Income under PGBP. However, if selling price is more than the cost price, then whatever up to the cost price will be considered as balancing charge, above the cost price will be considered as capital gain. Up to cost price, so WDV to cost price, selling price to WDV to cost price will be considered as balancing charge. Selling price minus cost price will be considered as capital gain. So hence in this case, in straight line method, there is no concept of capital loss karna, there can only be capital gain. Okay. Now let's talk about section 50AA, market linked debentures. Market linked debentures. This market linked debenture concept is very simple. Karna, people used to invest in fixed deposit and earn the interest. Whenever interest you are earning, that interest you are paying the tax under the normal tax slab. Okay, that is the up to 0 to 2,50,000 nil, then 5%, 20%, 30% slab, or in the new tax regime, the new tax regime slab. Fine. However, sometimes what people used to do, people used to invest in FD indirectly so that they can pay lower tax. So what they will do, they will invest in a mutual fund. That mutual fund will invest in a FD. That mutual fund will earn the interest and the value of the units keep on growing. Then what will happen? The assessee will keep this mutual fund unit for a long term period of time, and after long term, whenever the assessee is selling this mutual fund, whatever amount is received on that, tax will be the income will be taxed at normal long term capital gain rate of tax. So what did I say? Whenever the assessee is selling the units of the mutual fund, okay, and if at all it becomes long term, then the income will be taxed at long-term capital gain rate of tax, which is 12.5%. So 12.5% is lower than 30% now. So people started taking the benefit of this section. Instead of directly depositing in FD, they will deposit in mutual fund. Mutual fund will deposit in FD or bonds or debenture as the case may be, so that they can pay lower tax. However, to remove this type of malpractice by the people assessees, that is why the government told wherever there is a mutual fund or any other specified asset which is investing in the debt class, okay, which means they are investing in deposits or bonds or debentures and getting the interest income, they will always be considered as short term. They will never be considered as long term. If they are considered as short term, then what will happen? Short term capital gain is always taxed at normal tax rates. So here also same tax rate, there also same tax rate. Fine. So what does the section say? The capital gain on the following capital asset will always be considered as short term. So what are they? Unit of specified mutual fund acquired on or after 1/4/2023, market linked debenture or unlisted bond or unlisted debenture. So what did I say? Specified mutual fund acquired on or after 1/4/2023, market linked debenture, unlisted bond or unlisted debenture. So what is the specified mutual fund? Here there is an amendment also. The definition has changed. Specified mutual fund means mutual fund which invest more than 65% in debt and money market instruments, or any other fund which invests 65% or more funds in a fund which is referred in clause A above. So if a fund is investing more than 65 in debt and money market instrument, that is a specified mutual fund, and any fund which is investing 65% or more in such mutual fund also will be considered as specified mutual fund. Now specified mutual fund, market linked debenture, unlisted bond, unlisted debenture. So all these assets are always considered short term. That is only the section Karna. It is always considered short term. So whenever you are calculating the capital gain, you need not see the period of holding of the asset. You always consider it as short-term capital gain or short-term capital loss and solve the question. Fine. So in period of holding concept, this is also one exception that I have given, that section 50AA, always the assets will be considered as short-term only. Okay. Now let's come to next point. What is market linked debenture? Market linked debenture means a security which has an underlying principal component in the form of debt security, where the returns are linked to the market returns on other underlying securities or indexes. It includes any security classified or regulated as a market linked debenture by the SEBI. So you read this definition also one time, if at all it is tested in MCQ. Fine. Now let's talk about section 50B, slum sale. Very important, very important for the examination point of view. If at all question comes, it will directly come for 8 to 10 marks in the examination. Single question. Fine. And from past few attempts, the examiner has not even tested. So chances that it can come in the examination. So what is slum sale, Kanna? Slum sale means an undertaking or a business. As it is sold from one person to another person without deciding what is the value of the individual assets. Okay, so for example, one business is there. I have sold that business for 100 crores, but I have not seen what are all the each and every asset, and for that I have not fixed the value separately. I have just decided what is the lump sum value of this business. This is slum sale. In slum sale, how to calculate the capital gain? Let us see. In calculating capital gain, first you have to take full value of consideration. What is the full value of consideration? Full value of consideration in case of slum sale is FMV1 or FMV2, whichever is higher. So fair market value 1 or fair market value 2, whichever is higher. What is fair market value 1? It is the fair market value of the capital asset transferred during the slum sale. So FMV1 means what? Whatever capital asset are transferred, for that you calculate what is the fair market value. You add all of it together. That is only fair market value 1. Then you see what is FMV2. FMV2 means what? Consideration received. So monetary plus non-monetary. Whatever is the amount received from the buyer, that is only called fair market value 2. Okay, so see fair market value 1 or fair market value 2, whichever is higher. The higher value will be taken as full value of consideration. From that you reduce the transfer expense, you will get the net consideration. From net consideration, you can reduce cost of acquisition. Now how to take the cost of acquisition, sir? Cost of acquisition in case of slum sale means net worth of the undertaking. Net worth of the undertaking. Sir, how to calculate net worth? Net worth is very simple. Net worth is equal to all the assets minus all the liabilities. In liabilities, you should not take share capital. Okay, so all the assets minus all the liabilities. So in case of asset, the asset can be depreciable asset or other than depreciable asset. If the asset is a depreciable asset, then take the opening WDV as per the Income Tax Act. Opening WDV as per Income Tax Act. And what about other than depreciable asset? For other than depreciable asset, take the book value. Take the book value. But you know what? If at all there is any revaluation, if at all there is any revaluation, then you should remove the revaluation, remove the revaluation, remove the revaluation. So let's say there is a building, that building was only for 20 lakhs, but it was revalued to 80 lakhs. So that 60 lakhs balance is there. Now it will be transferred to revaluation reserve account. The revaluation reserve account will be there in liability side. In such case, what should you take as the value of building? Only 20 lakhs. So whatever revaluation amount is there, no, that you should remove. Only the original amount should be there. Then what about liability? For liability also you have to consider only the book value. So depreciable asset, you have to take WDV, opening WDV, then other asset book value, remove the effect of revaluation, and liabilities you take the book value. Finally, you will get assets minus liability, you will get the net worth. If the net worth is negative, then don't consider the net worth, take the cost as 0. So don't put negative cost. If net worth is negative, take the cost as 0. Then if deduction is claimed under section 35 AD, then for such asset you have to take the value as 0. If deduction is claimed under 35 AD, that is specified business in PGBP, take the value of the asset as 0. And if there is a goodwill, but if it is self-generated, then take the value as 0. So self-generated goodwill, take the value as 0. Then period of holding. Here what is the period of holding? Period of holding should be taken from the date of incorporation till the date of slump sale. Okay, and here generally in period of holding you have seen only two categories, that is 12-month category and 24-month category, but slump sale is 36-month category. Okay, so up to, if undertaking is held up to 3 years, it is considered as short term. If undertaking is considered held for more than 3 years, it is considered as long term. So this is 36-month category. So this also is an exception to period of holding concept. Okay, and in slump sale, our report, that is chartered accountant report, indicating and certifying the computation of net worth shall be submitted 1 month prior to the due date of return of income. Okay, so CA report is also compulsory in case of slump sale. So you reduce the cost of acquisition, you will get the long term or short term capital gain. And here you have to make sure that if it is 36 months, so above 36 months long term, up to 36 months short term. Now let's talk about section 50C, deemed full value of consideration for land or building or both. In case of land or building or both, whenever the sale transaction is taking place, then you might have heard that there is a lot of black money is also involved. Let's say 100 crore worth of property is sold from one person to another person. In such case, sometimes what happens, 60 crores is black money, 40 crores is only white money. In such case, the government is very, very angry because so much of black transaction is happening. And since the official value is shown as only 40 crores, that is why the tax is also paid very, very less and the government is not getting the revenue. That is why the government told that we are not able to catch you red-handed. It is very, very difficult. If we catch you red-handed, then you are gone, then you have to worry very much. However, if we are not able to catch you red-handed, then also we need some check and balance in place. That is why the government brought section 50C in the Income Tax Act. What does 50C tell? 50C tells that you have to compare 110% of sale consideration with stamp duty value. So take the sale consideration, you add 10%. So take 110% of sale consideration. Now you compare this with stamp duty value. If stamp duty value is more than 110% of sale consideration, then you have to consider stamp duty value as the full value of consideration. But if stamp duty value is within 110% of sale consideration, then full value of consideration can be taken as sale consideration itself. So what did I say? You have to take 110% of sale consideration, compare with stamp duty value. Stamp duty value, if it is still higher, take stamp duty value as full value of consideration. But if it is within the 110%, then take sale consideration itself as the full value of consideration. However, sometimes the assessee might be angry. The assessee will feel that market rate is very, very less. Stamp duty value is unnecessarily high. That is why the assessee will go to the assessing officer. Assessing officer will refer the case to valuation officer. Now valuation officer will decide whether the stamp duty value should be increased or decreased. If the stamp duty value is being decreased by the valuation officer, then you take it because it is beneficial for you. Okay, if the stamp duty value is decreased by the valuation officer, then you take it because it is beneficial for you. But if the stamp duty value is being increased by the valuation officer, then ignore it. Ignore the valuation officer value because it is not beneficial for you. So what did I say? If the assessee is not happy with the stamp duty value, then the assessing can apply to assessing officer. Assessing officer will refer the case to valuation officer. Valuation officer can either increase the value or decrease the value. If he is decreasing the value, it is beneficial, so you take the value by valuation officer. But if they are increasing the value, then you ignore the value of the valuation officer. Then you go by the normal provision itself. Okay, now in which date we have to take the stamp duty value? Should we take on registration date or should we take on agreement date? Generally you have to take the registration date only. Generally registration date. However, if agreement was done before itself, and if on or before the date of agreement, if any amount has been paid through prescribed modes of payment, that is account pay check, account pay bank draft, electronic clearing system, or any other prescribed mode like credit card, debit card, net banking, UPI, NEFT, RTGS, okay, Bhim Aadhaar Pay, all those modes, if you are making the payment, then you can take agreement date stamp duty value also. Fine. So what did I say? Generally registration date. However, if on or before the date of agreement you have paid through prescribed mode, then you can take agreement date stamp duty value also. So that stamp duty value can be considered. Okay. So this is 50C deemed full value of consideration. Now listen, this 50C provision is there, no? The same provision is also there in section 43CA for PGBP. So if the capital asset being sold, if it is a capital, if the land and building being sold, if it is a capital asset, then see 50C. Okay, if the land and building that is being sold is a stock in trade, then you have to see section 43CA. Okay, but the rules and regulation, everything is same as 50C, same will be applying to 43CA as well. Okay, and this valuation provision also is the same, and stamp duty value also on which date you have to take, that provision is also same. Similarly, when you see section 56(2)(10) in income from other sources, there I have discussed about when the person is receiving an immovable property without consideration or for inadequate consideration, then the assessee has to pay tax under 56(2)(10). There also similar provisions are there. There also, if at all the assessee is not happy with the stamp duty value, assessee can go for valuation officer. There also you have to see what is the stamp duty value date. Same provision are copy paste there also. Okay, this I have also discussed in the income from other sources revision lecture, so don't worry. Now let's come to section 50CA, capital gain on unquoted shares. Sir, what is unquoted share? Unquoted shares means unlisted shares. Okay, if at all there is unlisted shares, then you have to see if sale consideration is less than fair market value. If sale consideration is less than fair market value, then full value of consideration will be taken as fair market value. Fine. Now let's talk about 50D. Sale consideration cannot be determined. Sir, some asset is sold, but we can't even determine what is sale consideration. For example, I have sold my property to another person and I told them, instead of this property, you please give me movie and popcorn every week till I die. Till I die, you please sponsor movie for me and popcorn for me. So what is the sale consideration? Can you find out the value of movie and popcorn till I die? Answer is no. In such case, how to decide what is the value of sale consideration? In such case, sale consideration, fair market value of the asset on the date of transfer shall be taken as full value of consideration. Fine. Now let's talk about section 51, advance money forfeited. Advance money forfeited. What is advance money forfeited? Whenever a sale transaction is taking place, the seller will first take an advance from the buyer. Okay. Later on, remaining payment also will be taken and the property will be sold. Sometimes what will happen, after giving the advance, the buyer will say, no, now I am not interested to buy your property. So now the seller will tell, okay, you are not interested. No, this advance also I will not return you back. I will keep this advance with myself. This is called advance money forfeited. In case of advance money forfeited, it is an income for the assessee. That is why from 1/4/2014 onwards, whatever is the amount of advance money forfeited will be treated as income under income from other sources under section 56(2)(9). Okay, it is taxed in the year of receiving the advance. But then before 1/4/2014, what was the position? Before 1/4/2014, whenever there is an advance money forfeited, that has to be reduced from the cost of acquisition of the asset. From the cost of acquisition, you have to reduce before doing the indexation. If at all indexation is applicable, before indexation you have to reduce. So let me give you an example. Let's say there is a father Kanna. In 2002, he had bought a property for 1 crore rupees. Then in 2005, he had received an advance of 10 lakh rupees for selling the property, but later on the buyer told that I don't want the property, so he got the 10 lakhs for himself. He got to keep it for himself. But this was in 2005. If it was on or after 1/4/2014, it would have been treated as income. Okay, but it was before 2014. So what you have to do? You have to reduce from the cost. Later on what happened? Father has gifted the property to the son in 2010. In 2012, the son had received advance money forfeited of 20 lakh rupees. This 20 lakhs, since it is before 1/4/2012, what you have to do? You have to reduce it from the cost of acquisition. Later on, in 2015, again he received advance money forfeited. But this time, it is on or after 1/4/2014, no? That is why entire advance will be treated as income under section 56(2)(9). And it will be taxable under income from other sources. Now, in finally 2025, the property was sold for 10 crore rupees. 10 crore rupees. Now listen, the son is there, no? He has received the property. When son is receiving the property, will the father pay any tax? Answer is no, because the income tax department or income tax act will close its eyes. I already told you. When the son is receiving, will the son pay any tax? Answer is no, because in 56.210 in income from other sources we will learn that when the property is received from a relative, it is not taxable. Okay, but when the son is receiving, now what will happen? What should be taken as cost of acquisition? Cost of acquisition should be taken from previous owner, that is from the father. Okay, period of holding also should be taken from the previous owner, that is from the father itself. You have to take period of holding. Indexation also should be taken from previous owner. So this I have revised all the previous provisions. Now listen carefully. Advance money forfeited. No, the section tells that if you have acquired the property, then in your property only you can reduce from the cost. So when the son has received the property, no, whatever advance was forfeited by the father, that need not be reduced by the son. If the father was having the property, he should reduce. But for the son, only if he has received some advance money forfeited, he should reduce. But if it was received by the father, he need not reduce. So hence, in this case, in 2005, whatever 10 lakhs was received by the father, it went tax free. Because when you're selling the property, while selling the property, only if you have received any advance money forfeited, you have to reduce. But if previous owner has received, you need not reduce it. Okay, well, so this is the point I was trying to say. And you have to reduce before indexation. If at all you are calculating indexation, before indexation it has to be reduced. So to be deducted from the cost of acquisition or FMV as on 1/4/2001 before indexation while calculating the capital gain. Only if forfeited by present owner. If it is forfeited by previous owner, then you have to ignore the advance money forfeited. Okay, well? Hence, in the year of transfer of capital asset only, it indirectly gets taxable. Now let's talk about section 55A. It is a theoretical section only. You can give a reading. Let me jump to section 54 series exemption. Section 54 series talks about exemptions. There are 5 exemptions, Kana. In your examination point of view, 54 is important for you. Okay, well, then 54 EC is important for you and 54F is important for you. So be thorough with these 3 sections. Other sections also you go through and go. First section alone I am going to teach you in detail. Balance sections you will automatically be able to understand. Okay, well, then I will go fast. So first section alone, let me teach you. Firstly, section 54, it talks about capital gain on sale of residential property used for residential purpose. So when can you claim the exemption, sir? Firstly, who can claim exemption? Assessee being individual or HUF can only claim the exemption. On what type of asset? Only on long-term capital asset. Then what is the asset transferred? A residential house property being land or building, being a building or land appertaining thereto. So what is the new asset to be purchased? New asset purchased is also residential house property in India. So what does this section say? Section 54 is applicable only if there is an individual or HUF. Individual or HUF has a long-term capital asset being a house property. House property is being sold and with that money they are using to buy another house property. With the capital gain, they are buying another house property. Only then this section is applicable. Okay, well, so one property being sold, another property is being purchased using the capital gain. So now, what is the property sold? Residential house property being a long-term capital asset. New asset to be purchased is one residential house property in India. The assessee can purchase also, assessee can construct also the new property. If the capital gain value is up to 2 crores, if it is up to 2 crores, then the assessee can invest in 2 houses also. But this 2 house benefit is only given once in a lifetime to the assessee. So if the capital gain is up to 2 crores, so within 2 crores, he can invest in up to 2 houses. This 2 house benefit is given only once in a lifetime. But other than that, if it is above 2 crores, then the assessee can only invest in one residential house property. Then time limit. For purchasing or constructing the time limit, what is that? Per new property, what is the time limit? So it is -1 + 2 + 3. -1 + 2 + 3. It means what? Within 1 year before or 2 years after, the person can purchase the property, and within 3 years after the date of transfer, the person can construct the property. So within 1 year before or 2 years after the date of transfer, purchase the new property, or within 3 years after the date of transfer, constructed the new property. Sir, why 1 year before time is also given? Because generally before buying a new house, first you will buy the new house, then only some people will sell the old house, because after selling the old house you want to go somewhere. No, that is why generally what people will do, people will buy a new house first, then they will sell their old house. Okay, well, that is why -1 + 2 + 3 time is given. 1 year before, 2 years after, or 3 years after for in case of construction. Then deposit scheme. Listen, Kanna, the capital gain is there, no? Okay, it will arise in the previous year 25-26. Okay, the due date to file the return of income is 31/7/2026. Let's say the transfer took place on 1/1/2026. Then from 1/1/2026, the assessee is having 3 years time. So 27, 28, 29 till 31/12/2028, the person is having the time to construct the property. But the return filing due date is just 31/7/2026. Now what to do? In such case, if the person wants to claim the exemption for 25/26, he has to prove that he is going to invest in the new property before 31/12/2028. So to prove that, what can the person do? The person has to deposit the amount in capital gain account scheme. Capital gain account scheme is nothing but a bank account. It is a special bank account in which you deposit the money and you tell in your return of income that I have deposited. If you are depositing money in the capital gain account scheme, then the income tax return, it will be treated as if you have invested in the new asset, and exemption can be claimed. So whatever this deposit amount is there, from this you have to use the amount to buy or construct the house within the time limit. If you are using within the time limit, then it is well and good. But if you are not able to use and the time limit is over, then you have to reverse the capital gain. You have to reverse the capital gain exemption. Okay, so now let me tell you about deposit scheme. So deposit scheme is applicable and up to 10 crores can be invested in deposit scheme. Sir, why 10 crores? Because in this section, maximum exemption is 10 crores. Maximum exemption 10 crores. Now let's talk about exemption. So what will be the exemption value? Exemption value will be capital gain amount or cost of new asset or deposit amount up to 10 crores, whichever is lower. So capital gain amount or cost of new asset or deposit amount, whichever is lower, will be the exemption. Maximum 10 crores. Transfer of new asset. Now this new house is there, because of which you have got the exemption. This new house should not be transferred up to 3 years. If it is transferred within 3 years, then cost of acquisition of the new asset shall be reduced by the exempt capital gain. So for that new house, whatever cost is there, that cost you have to reduce by the capital gain which was exempt earlier. So what did I say? You cannot purchase any new house. Sorry, you cannot transfer this new asset within 3 years. So listen here. Let's say there is a person. Okay, in this example itself, let me tell you. Let's say one asset has been constructed on 31/7/2028. So now within the time limit, construction is complete. Now when the construction is complete for the new property, this new property cannot be sold for 3 years. So 31/3/28, 29, 30, 31. Up to 31/7/2031. This new house also should not be sold. If the new house is sold within 31/7/2031, then what will happen? You will find out what is the full value of consideration. That is the selling price, correct? Minus cost of acquisition. You will reduce the cost. In this cost, you have to reduce. While calculating the cost, you have to reduce the 54 series exemption that you have claimed. Section 54 exemption should be reduced. Balance amount should only be taken as the cost. So if you reduce it from the cost, what will happen? Automatically your capital gain in that year will increase. So that is the concept. So now let me tell you about this section once again. Then all the other sections quickly I will finish. So section 54, when is it applicable? It is applicable when an individual or HUF sells a house property which is a long-term capital asset, and using the capital gain amount, they invest in the new house property. This new house property should also be in India. If the capital gain is up to 2 crore rupees, they can invest in 2 house property, but this 2 house property concept is applicable only once in a lifetime. But other cases, if the capital gain is more than 1 crore, more than 2 crores, they can invest only in 1 house property, 1 new house property. Now, what is the time limit to invest? The time limit to invest in case of purchase is -1 + 2. That is 1 year before the date of transfer or within 2 years after the date of transfer. And in case of construction, it is +3. Within 3 years after the date of transaction also, you can complete the construction of new house. Now, deposit scheme. The return filing due date will be coming before itself. Within the return filing due date, if the assessee has not purchased the new house or constructed the new house, then whatever amount of capital gain is there, he should deposit in the CGAS account, capital gain account scheme account, in the bank account. This detail should be given in the income tax return. If detail of this deposit scheme is given in the return, then the income tax department will assume that you are going to invest, and that is why they will give you the benefit of the exemption. So what is the exemption? The exemption is capital gain or cost of new asset or deposit amount, whichever is lower. However, maximum capital gain exemption can be 10 crores. More than 10 crores, you cannot claim exemption. Then this new house is there, no, whichever is purchased or constructed, that also has to be held for at least 3 years. Within 3 years you cannot transfer. However, if you are transferring within 3 years, then whatever exemption was claimed earlier, no, that exemption you reduce it from the cost of acquisition of the new asset. Fine. So this is the concept. Now other sections, let me quickly finish. Section 54B talks about capital gain on sale of urban agricultural land and used for another agricultural land. It is applicable for individual or HUF. Then asset can be short term also, it can be long term also. What is the asset transferred? Asset transferred is urban agricultural land used by an individual or his parents for agriculture purpose at least for 2 years before the date of transfer. In such case, whenever agricultural land is transferred, then they can purchase a new agricultural land. Here there is no scope of construction because agricultural land is being purchased. What is the time limit? +2. That is within the date of transfer. From the date of transfer, 2 years time is given to purchase the new agricultural land. Here also deposit scheme is applicable. And here also, what is the capital gain exemption? Exemption is equal to capital gain or cost of new asset or deposit amount, whichever is lower. Then, if new asset is transferred within 3 years, then cost of acquisition of the new asset shall be reduced from the exempt capital gain. Same concept. Now let us come to section 54D. Compulsory acquisition of industrial land and building, and the amount is used for new land and building. So this is applicable to all the persons, company, firm, HUF, AOP, BOI, everyone can take benefit of section 54D. When is this section applicable? If the asset is short-term capital asset or long-term capital asset, it does not matter. The asset should be a land or building which was used by the assessee in the business of industrial undertaking for at least 2 years before the date of transfer, and it should be compulsorily acquired by the government. In such case, whenever the compensation is received, from the date of compensation you have 3 years time. Within the 3 years, the person has to invest in new land or building for industrial undertaking. Here also deposit scheme is applicable, and the exemption is capital gain amount or cost of new asset or deposit amount, whichever is lower. Then here also this new industrial land or building should not be transferred within 3 years. If it is transferred within 3 years, then you reduce the exemption amount from the cost of acquisition. Fine. Then in all the cases, whenever there is compulsory acquisition, the time limit will start from the date of receipt of compensation. That you have to keep in mind. So deposit scheme, I have already told. If the deposit scheme amount is unutilized, then it will be taxable as capital gain in the year in which the time limit will expire. This also I already told you. Now let's talk about section 54EC. Section 54EC, investment in certain bonds. It is applicable to all the persons. So anyone can use the section 54EC. And in exam point of view, I feel that 54EC is even more important because there is an amendment also. 2 new bonds have been added in the section. So to whom is it applicable? To any person. Okay, any person can take the benefit. The nature of asset transferred is a long-term capital asset being land or building or both. So if land, building or both is transferred, and if it is long term, then whatever capital gain amount is there, this capital gain amount you can invest in the bonds that are redeemable after 5 years. So there is a 5-year lock-in period. After 5 years only you can get the maturity value. Sir, where and all we can invest? You can invest in NHAI, RECL, PFCL, RFCL, HUDCO bond and IREDA bonds. So NHAI, RECL, PFCL, RFCL, HUDCO and IREDA bonds. So NHAI means National Highway Authority of India, then Rural Electrification Corporation Limited, Power Finance Corporation Limited, Indian Railway Finance Corporation Limited, then Housing and Urban Development Corporation Limited from 1/4/2025, then Indian Renewable Energy Development Agency from 9/7/2025. So this alone date you have to remember, Kanna. Only if you are investing on or after 9/7/2025 you will get the benefit. Before 9/7/2025 there is no benefit. Fine. Now, how much amount can be invested, sir? Answer is 50 lakhs. So here also, you can only save up to 50 lakhs as exemption. Maximum exemption is how much? 50 lakhs. Maximum exemption 50 lakhs. What is the time limit? The time limit is 6 months from the date of transfer of original asset. So from the date of transfer of land and building, there is 6 months time. Within 6 months, you have to invest up to 50 lakh rupees in the bonds. Whatever amount is invested up to 50 lakh rupees can be claimed as exemption. Here deposit scheme is not applicable, Kanna, because only 6 months time is given. Even if return filing date is coming earlier, then before the return filing date itself, you invest in the bonds. Next, amount of exemption. Capital gain or cost of new asset up to 50 lakhs, whichever is lower. Here transfer of new asset. So there is 5-year lock-in period for the bonds. So for 5 years, you should not sell that bond to anyone. You should not take maturity of the bond. Also, you should not take any loan against the bond. If you are selling the bond or taking the maturity, or if you are taking the loan against the bond, in such case, whatever exempt capital gain is there, no, it will be taxable in the year of transfer or conversion. Fine. Now let's talk about section 54F. 54F also important. 54F speaks about individual RHF, where they are transferring a long-term capital asset which can be any asset other than residential house property, and they are investing in residential house property. So listen, what did I say? In section 54, no? In section 54, what did we learn? That individual RHF is transferring long-term capital asset being house property, investing the money to buy another house property. So one house they are selling and another house they are buying. So for that you have to see section 54. But what about 54F? 54F applies when any asset other than house property is being sold and the amount is being used to invest in a new residential house. Okay, so if you are selling house and buying house, then you go to section 54. But if you are selling any other asset and buying a house, then you have to come to section 54F. But you know what? In 54F, there is a different rule than other sections. In all the other sections, we have learned that the capital gain amount should be invested. But in 54F, you should not invest the capital gain kana, you have to invest the net consideration. Net consideration should be invested in the new asset. So here, what is the time limit to invest in new asset? Here also -1 + 2 + 3. So -1 + 2 for purchase + 3 for construction. Here also maximum up to 10 crores only exemption can be claimed. Amount of exemption is equal to, here you have to do proportionate calculation karna. All the other places you have seen that only capital gain should be invested. But here what should be invested? Net consideration should be invested. That is why the proportionate exemption will be cost of new house multiplied by capital gain divided by net consideration. Cost of new house multiplied by capital gain divided by net consideration up to 10 crores will be exempt. Then this new asset is there, no, new house, that you should not transfer up to 3 years. If you are transferring within 3 years, then you have to reverse the capital gain. And there are some additional conditions also for 54F. What are they? The assessee should not own more than one residential house. So while purchasing this residential house, maximum one more house he can have. More than that he cannot have. Then assessee shall not purchase any residential house within the time prescribed other than the new asset. If this is not satisfied, then the exempted capital gain will be taxable in the year of purchase or construction. So this new house that the assessee is buying, no, up to 3 years, this house also should not be sold, and the assessee should also not buy any other house also within the 3 years. So that is also a rule. So what is the rule? First rule is that when while buying the new house, he should not have any other house. Maximum one house he can have. So while buying the new house, he can have maximum one house. And this new house also, he should not sell for 3 years. He should also not buy any other house for within 3 years. So that is the rule for 54F. So these are all the exemptions kana. Now let us learn about tax rates for capital gain. Tax rates. So tax rates discussion. Let me tell you about tax rates first. In capital gain, you can either have short-term capital gain or long-term capital gain. Short-term capital gain, there are two types of capital gain. Capital gain on certain assets and other assets. In long-term also, there is capital gain on certain assets and other assets. Short-term capital gain on certain assets is taxable under section 111A and the tax rate is 20%. Short-term capital gain on all the remaining assets are taxable at slab rate, that is normal tax rate. Long-term capital gain, certain assets is taxable under section 112A. 112A. In 112A, no kanna, there is a slab rate, that is up to 1,25,000 there is no tax. Above 1,25,000, 12.5% tax. But other assets are taxed under section 112, where the tax rate is 12.5% without indexation, and only in certain cases 20% with indexation, whichever is lower. So let us study. Firstly, let me tell you about the common points for these tax rates. So 111A, 112 and 112A, that is short-term capital gain on certain assets, long-term capital gain and long-term capital gain on certain assets. For all these three sections, these are special sections, special rate sections. So there are some points that you should remember. What are they? Number one, only resident individual and HUF can adjust the income against unutilized basic exemption limit. So let's say you are having an income, other income, or normal income of 2 lakh rupees, and you are having 111A income of 3 lakh rupees. Your basic exemption limit is, let's say in the old scheme, let us assume that the assessee is going for old scheme, so it is 2,50,000. So what you have to do, always when you are having basic exemption limit, you should not get confused whether I should use basic exemption limit against 111A income or first I should use against other income. Always first you should use basic exemption limit against other income. So first use the other income, 2 lakh rupees you use. Balance basic exemption limit is how much? Balance is 50,000. So this balance basic exemption limit you use against 111A income. So 50,000 you reduce. So taxable 111A income will be 2,50,000 multiplied by 20%. If at all there is rebate, then rebate also can be reduced. You get my point? So always when you are having basic exemption limit, first use the other income, that is slab rate income, to reduce the basic exemption limit. But if you are having 111A income, 112A income and 112 income, then you can reduce against unexhausted or unadjusted basic exemption limit, which is nothing but this 50,000. So only resident, individual and HUF can adjust the income against basic exemption limit, which is unutilized. Okay, if an individual or HUF is not a resident, then you cannot use the basic exemption limit to adjust these incomes. Fine. Then chapter 6A deduction is not allowed against 111A, 112 and 112A. Next, section 87A rebate in the old regime is not allowed against 112A income, but it will be allowed against 111A and 112 income. And lastly, in new regime, that is default tax regime, 87A rebate is not at all allowed against any special rate of tax. So not allowed for 111A also, 112 also, 112A also. So these are the special points. Now let us talk what are the tax rates. Firstly, short-term capital gain other than 111A is taxable as per normal tax rates. Fine. Then 111A, short-term capital gain on certain assets. So what are these certain assets? It is applicable to the following assets on which security transaction tax should have been paid on transfer. Okay, what are the assets? Equity shares of a company, units of equity oriented fund and units of business trust. So for equity oriented company, units of equity shares of a company, units of equity oriented fund and units of business trust, if at all during the sale of this asset STT has been paid, then such asset will be taxable under section 111A. What is the tax rate? It is 20%. So tax rate is 20%. Fine. However, if at all the trade has taken place in IFSC, that is International Financial Service Center, in IFSC, STT is not necessary. So if at all trading has taken place in IFSC, then you need not see whether STT has been paid on transfer or not. Directly you can apply 111A. Fine. Meaning of equity oriented fund means minimum 65% of total proceeds is invested in listed domestic company, and if there is any other fund, minimum 90% of total proceed is invested in a fund, and such fund invests minimum 90% in equity shares of a listed domestic company. These are only equity oriented funds. Now let's talk about section 112A, long-term capital gain on certain assets. So here also this section is similar to 111A. So it is applicable on the following assets on which STT has been paid on transfer except IFSC. So what are the assets? Equity shares of a company, units of equity oriented fund and units of business trust. So these three assets, if the STT has been paid on transfer, and here there is one small change Kana. In case of equity shares of a company, STT should have been paid on purchase also. So in case of 112A, that is long-term capital gain of certain assets, in case of equity shares, STT should have been paid on transfer also, it should have been paid on purchase also. Only then it is covered under 112A, or else it will be covered under 112. Then units of equity oriented fund and units of business trust. For all these three, what is the tax rate? The tax rate is 12.5% in excess of 1,25,000. It means what? It is a slab rate of tax. Up to 1,25,000 the tax is 0. Above 1,25,000 the tax is 12.5%. 12.5%. Okay. Then section 55, cost of acquisition for purpose of computing shall be determined as follows. Now listen Kana, before 1/1/2018, that is up to 31st January 2018, the capital gain in case of 112A used to be fully exempt. There was no tax at all for this 112A. However, from 1/2/2018 onwards only tax has come. So that time people got very angry that why are you putting tax on us? That is why the finance minister told in the budget speech itself that whatever capital gain has been earned up to 31/1/2018 for the entire capital gain, it will always be exempt. That is why if at all I have purchased any shares before 31/1/2018 on or before 31/1/2018, whatever capital gain I have earned up to 31/1/2018 will always be tax free. That is why whatever profit is there up to 31/1/2018, that you have to include it in the cost. You have to include it in the cost so that it becomes tax free. So how to find out the cost? Using the grandfathering rule. So what you have to do? You have to see whether the asset is acquired before 1/2/2018. In such case, take the fair market value as on 31/1/2018 and full value of consideration whichever is lower. Full value of consideration whichever is lower. Then higher of the step 1 value as per step 1 or actual cost of acquisition, whichever is higher. So what you have to take, fair market value or full value of consideration, whichever is lower. Okay, lower value or actual cost, whichever is higher, will be taken as cost of acquisition. Cost of acquisition. If at all it is a bonus share, then in case of bonus share, the value will be 0, or if the bonus share has been received before 1/4/2001, the value will be FMV as on 1/4/2001, which we have already discussed. So now what to do? How to do grandfathering? Very, very simple. Fair market value on 31/1/2018 or full value of consideration, whichever is lower, then whichever is lower, or cost of acquisition, whichever is higher, will give you the final cost of acquisition. This cost of acquisition only you have to use for calculating the capital gain. This you be very, very thorough. One question is also there in your material. Make sure to solve that question. You will be comfortable with the grandfathering calculation. Now let us see how to calculate this fair market value as on 31/1/2018. If the shares are listed, then the fair market value shall be highest price that is quoted on a recognized stock exchange on 31/1/2018. However, if no trading took place, take the highest price on the immediately preceding trading date. So as on 31/1, what is the highest price you have to take? And if no trading took place, then in the preceding trading date, whatever is the highest price that you have to take. Now what if the shares or units are unlisted? If shares or units are unlisted, then in case of units, you have to take the NAV as on 31/1/2018. Here you have to be very careful, Kanna. Listen, very important, that if units are listed, then take highest price on recognized stock exchange. Fine. Don't take NAV. So this silly mistake students do. Students will see units. Units means they will take NAV as on 31/1/2018. It is not like that. If unit is listed, then you should not take NAV. You should only take which is the highest price on the recognized stock exchange. If unit is unlisted only, you have to take the NAV. Fine. Now what about unlisted shares? If there is unlisted shares as on 31/1/2018, then you have to do indexation for the shares. Indexation is equal to cost of acquisition multiplied by cost inflation index of 2017-18 divided by cost inflation index in which it was first held, or 2001-2002, whichever is later. Fine. So this is the indexation you have to do. 272, should you remember? Answer is my recommendation. You please remember it. If at all it is not given in question, you should be able to answer. So cost of acquisition into cost inflation index of 17-18 divided by cost inflation index in which it was first held, or 2001-2002, whichever is later. Normal indexation you have to do. So listed unit highest price, listed shares also highest price, unlisted unit NAV, unlisted shares indexation. Fine. Indexation up to 17-18. Now let's talk about long-term capital gain on other assets. In case of other assets, long-term capital gain tax is 12.5% without indexation. However, there is an option to choose lower of 12.5% without indexation or 20% with indexation if these conditions are satisfied. So what are the conditions? The assessee should be resident individual or HUF, and the asset should be an immovable property, being a long-term capital asset acquired before 23/7/2024, and the transfer should take place on or after 23/7/2024. So what did I say? Resident individual or HUF should be having an immovable property which is purchased before 23/7/2024. It should be a long-term capital asset and it should be transferred on or after 23/7/2024. If all these conditions are satisfied, then such individual or HUF will get an option. What is the option, sir? That individual, while calculating the tax, they can take 12.5% without indexation or 20% with indexation, whichever is lower. So they can take whatever is beneficial for them. There is one question in the study material which is comprehensive question. It is covering advance money forfeited also, all these provisions also, that is for old tax also, new tax also. Definitely solve that question. It will be helpful for your examination to conceptually understand. So this is the provision, Kanna. And indexation already I told you. Cost of acquisition, if you are finding the indexed value, so cost of acquisition multiplied by cost inflation index in the year of transfer, or cost inflation index in the year of first held, or 2001-2002, whichever is later. Then in case of improvement, you have to do cost of improvement multiplied by cost inflation index in the year of transfer divided by cost inflation index in the year of improvement. However, if improvement is done before 1/4/2001, you should ignore the improvement. Indexation is not applicable from 23/7/2024 onwards. It was only applicable if the asset was transferred before 23/7/2024. So if such transfer is there, you have to do indexation. However, if transfer is on or after 23/7/2024, only if these conditions are satisfied, then while calculating the tax, you have to do indexation. While calculating the income, there is no indexation karna. Only while calculating the tax, there is indexation. Fine. If possible, that one question that I have worked out, I will take a clip from that question and I will upload on YouTube so that you are able to familiarize yourself with the question and how to present in the examination. Fine. So I hope you are clear with this. All the provisions of capital gain is over. I hope you were able to understand the provisions. Understanding is very, very important in the capital gain chapter. You just go through the provision, go through the notes once again, solve the questions, and you will be good to go. You will definitely score high marks in the examination. That is a guarantee. Now, without further ado, let us begin the revision of income from other sources. So income from other sources is a residuary head of income. What is the meaning of residuary head? It means that if there is an income which is taxable under the Income Tax Act, but it is not covered under any other head of income, then such income will be taxable under income from other sources. Fine. However, there are certain incomes which is only taxable under income from other sources. For example, dividend income and royalty income. So dividend and royalty only will be taxable under IFOS, not any other head of income. In dividend income, it is generally taxable under the normal tax rates. So that is fine. However, for dividend, when it comes to surcharge, you have to make sure that you are restricting the surcharge to 15%. This I have discussed in the tax rates revision. Fine. Now let us come to deemed dividend. There are 6 cases where it is deemed that the income will be a dividend income and it will be taxable under income from other sources. Let us see all the 6 cases one by one. First is section 2 clause 22A, distribution of assets. If a company is distributing the assets to its shareholder, then to the extent of accumulated profits, whether capitalized or not, the distribution value, that is the fair market value of the asset, will be treated as dividend in the hands of the shareholder. But sir, what is this accumulated profit, whether capitalized or not? Karna, when you see your balance sheet, you will find many reserves called general reserve, or you may find reserves and surplus account or profit and loss account. This is nothing but the accumulated profit which is there in the balance sheet. Sir, what is the meaning of capitalized accumulated profit? It means that if you are converting this accumulated profit into share capital, for example, the company has issued bonus shares and converting this reserves and surplus into share capital, in such case it is called capitalized accumulated profit. So both capitalized as well as non-capitalized accumulated profit will be treated as deemed dividend. Okay, if it is distributed in the form of assets. Now let us talk about section 2 clause 22B, distribution of bonus, debentures, deposit certificate, etc. So firstly, if there is any distribution of debenture stock, deposit certificate from a company to its shareholders, then such debenture stock, deposit certificate to the extent of accumulated profit, whether capitalized or not, will be treated as deemed dividend. Then if there is any distribution of bonus shares to preference shareholders, so if preference shareholders are receiving bonus shares, then such bonus share value will be treated as deemed dividend to the extent of accumulated profit, whether capitalized or not. Then let's talk about section 222C. This 222C talks about liquidation. Liquidation we are also discussing in capital gain chapter, so you have to link both of them and study. So 222C tells that in the process of liquidation, if the company is distributing any asset, then the fair market value of asset to the extent of accumulated profit, whether capitalized or not, will be treated as deemed dividend. So dividend value will be the fair market value of assets. Then let's talk about section 2 clause 22D. 222D talks about reduction of share capital. So I am giving you an example. Let's say the share value was 10 rupees per share. Now it has been reduced to 1 rupee per share. Now this difference is there, 9 rupee per share, that has been distributed to shareholders. This also will be treated as deemed dividend under Income Tax Act to the extent of accumulated profit, whether capitalized or not. Now let's talk about section 2 clause 22E, loans, advances by closely held company to its specified shareholder. So 222A, B, C, D that we have already studied, it is applicable to all companies, but 222E is only applicable to closely held company. Closely held company is a company which is also called as a company in which public are not substantially interested. You can keep it as unlisted company. So if you find unlisted company or closely held company or company in which public are not substantially interested, it means that 222E is going to be applicable. Fine. Now, in whose hands it will be treated as deemed dividend? Only in the hands of specified shareholder. Specified shareholder shareholder is a shareholder who is having at least 10% voting power in the company. For other shareholders, it will not be treated as deemed dividend. Only in the hands of specified shareholder, it is treated as deemed dividend. Now let us see what is treated as deemed dividend. Karna, let's say there is a closely held company. This closely held company is having a specified shareholder. Specified shareholder means what? He is having at least 10% voting power in the company. When the company is giving a loan or an advance to the specified shareholder, then the value of such loan or advance is treated as deemed dividend in the hands of specified shareholder. So if specified shareholder is getting loan, it will be treated as dividend. And you know what? It does not matter whether the specified shareholder is repaying the loan. It does not matter whether the specified shareholder is paying interest. So all that does not matter. If he is receiving the loan, it is treated as deemed dividend. That's it. Moreover, if at all there is a concern, see here, loan or advance to any concern, which can be any HUF, firm, AOP, BOI or company in which the specified shareholder is having substantial interest. So let's say there is a concern. Okay, in this concern, the specified shareholder is having substantial interest, and everywhere in income tax, you know, substantial interest means what? 20% voting power or 20% profit sharing. The specified shareholder is having substantial interest, and this concern is receiving a loan or advance from this closely held company. In such case also, this loan or advance will be treated as deemed dividend in the hands of specified shareholder. Fine. Moreover, if at all the closely held company is giving this loan or advance to anyone for the benefit of specified shareholder, then also it will be treated as deemed dividend in the hands of specified shareholder. So any payment on behalf of or for the benefit of specified shareholder will also be treated as deemed dividend in the hands of shareholder. But the deemed dividend is only to the extent of accumulated profit. Here the word capitalized or not is not given. Hence only to the extent of accumulated profit it will be treated as deemed dividend, and it does not make any difference if the loan is repaid or even if the interest is charged. This I already told you. However, there are some exceptions to this section, Kana. What is the exception? If loan or advance is given in the ordinary course of business of money lending, then it will not be treated as deemed dividend. For example, if the business itself for this closely held company is giving loans, and in the ordinary course of business if the specified shareholder has received the loan, then it will not be treated as deemed dividend. Then what is second exception? Dividend paid by the company is set off against the loan or advance already deemed as dividend. So for example, now the company gave a loan or advance to the specified shareholder, it has been treated as deemed dividend. Later on, this company is there, no, it wants to give actual dividend, but while giving actual dividend, no, it set off the dividend value with the loan value. Can the company do like this? Answer is yes, it can do like this, because this loan was already treated as dividend. Hence when the company is paying actual dividend, it can set off the dividend value and loan value, and it can treat the loan as dividend. The next exception, trade advances by a company, which is advances in the natural nature of commercial transaction. So for example, this specified shareholder is there, no, he is also a supplier for this closely held company, from which the closely held company is purchasing material. So for purchasing the material, the closely held company has given an advance for purchase to this shareholder. This advance will not be treated as deemed dividend because it is in the nature of commercial transaction. Okay, now let's come to section 222F, which speaks about buyback of shares by a domestic company. So if a domestic company is buying back its own shares and giving the money or assets to the shareholder, then in the hands of shareholder, entire amount will be treated as deemed dividend. And Kana, in this section there is no accumulated profit concept. So whatever is the amount received for buyback, entire amount is going to be treated as deemed dividend under section 2 clause 22F. Fine. This we have already discussed in the capital gain chapter as well. Once again I am telling you. Then for all the deemed dividend provision, let us discuss some common points. So 222A, B, C, D and F all applies to all the companies, but 222E only applies to closely held companies. This I already told you. Then 222A, B, C and D will be treated as deemed dividend only to the extent of accumulated profit, whether capitalized or not. But in 222E, it is treated as deemed dividend to the extent of accumulated profit. Here whether capitalized or not, wording is not there. Then capitalized accumulated profit I already told you. Then 222F does not speak about accumulated profit at all. Entire value is treated as deemed dividend. Then 222C and 222D does not apply if the distribution is fully in cash to non-participating preference shareholders. So only in this specific case it is not treated as deemed dividend. And lastly, shares allotted to shareholder of a demerged company by a resulting company will not be treated as deemed dividend. So these these are the points. Now taxability of dividend, let us see quickly. If at all a person is receiving interim dividend, then it is taxable in the year in which the interim dividend is received by the shareholder. Then final dividend is taxed in the year in which it is declared in the AGM. And lastly, deemed dividend is taxed in the year in which it is distributed or paid by the company. Fine. So this is the year of taxability. So now dividend is over. Now let us come to the next stage, which is taxation of gift. Very, very important section kanna. It can either come for 5, 6, 10 marks also. It can come for 1 or 2 marks also. It can come in MCQ also, total income question also, separate question also. So very, very important taxation of gift. Kanna, what is this taxation of gift? We are only calling it as gift, but in Income Tax Act it is not given as gift. In Income Tax Act it says that whatever is the money, asset or immovable property received by the assessee without consideration or for inadequate consideration, it will be taxable under section 56(2)(10). However, you have to refer this section only if the money, asset or immovable property that is received is not taxable under salary and PGBP. So for example, if employer is giving a gift to the employee, then employee has to pay tax under salary head of income. He will not be covered under income from other sources. Similarly, in the course of business, if I am receiving any gift, then that gift I have to pay the tax under PGBP head of income. Then you should not see 56(2)(10). Only if it is other than salary and PGBP, then I have to see 56(2)(10). You get my point? This section is applicable to all the assessees and it applies to cash, immovable property and movable property. Firstly, let us talk about cash. Here cash does not mean hard cash. Here cash means money. Okay, so if money is received by the assessee without any consideration, then if the money received exceeds 50,000 rupees, if the aggregate is exceeding 50,000 rupees, then the entire amount is taxable. So 4 friends of mine were there. All of them gave me a gift of 20,000 rupees each. Okay, 20,000, 20,000, 20,000, 20,000, total 80,000. So since the value of all the gifts combined is more than 50,000 rupees, hence I have to pay the tax on entire 80,000. 80,000 will be treated as income under 56(2)(10). Okay, now let us talk about immovable property. Immovable property means what? Land or building or both. So if the assessee is receiving land or building or both, okay, for inadequate consideration or without consideration, then it is taxable under 56(2)(10). However, if the property is received without consideration, then you have to see the stamp duty value. If the stamp duty value per transaction or per property, if it is up to 50,000, then it is not taxable. Only if it is more than 50,000, then it will be taxable under 56(2)(10). But sir, what happens if the assessee has received the property and he has paid consideration, but the consideration is inadequate consideration? Then what to do? In case of inadequate consideration, you have to calculate stamp duty value minus consideration. So stamp duty value minus consideration, you have to compare with 2 figures. First compare with 50,000, then compare with 10% of consideration. If it is more than 50,000 also and more than 10% also, in such case stamp duty value minus consideration will be taxable. However, if stamp duty value minus consideration is either less than 50,000 or less than 10% of consideration, then it will not be taxable. Fine. Read this provision at least 2 to 3 times so that you are thorough with the provision. Now let us talk about movable property. Kanna, all the movable properties are not covered under 56(2)(10). Only certain movable properties will be covered in 56(2)(10). So what are the movable properties that are covered? JADSPA, BSV. JADSPA, BSV. So what is JADSPA, BSV? Jewelry, archaeological collection, drawing, sculpture, painting, any other work of art, bullion, shares and securities, and virtual digital assets. So once again, jewelry, archaeological collection, drawing, sculpture, painting, any other work of art, bullion, shares and securities, and virtual digital assets. So only these assets are covered under 56(2)(10). If there is any other asset which is received without consideration or for inadequate consideration, it is not taxable under 56(2)(10). For example, my friend gave me a BMW car. Now is this BMW car taxable? Answer is no, because it is not covered in this JADSPA BSV. Okay, so that is why it is not taxable. My one teacher gave me a very good pen which is worth 10 lakh rupees. Is this pen worth 10 lakh rupees taxable? Answer is no, because it is not covered under JADSPA BSV. Fine. Sir, what is this virtual digital asset? Virtual digital asset means cryptocurrency, kanna, or you can also call it as Bitcoin. The taxation of virtual digital asset is in the CA final level. For now, if you only know that it is covered in this section, that is enough. Now let us talk about the limits. Here also the limit is 50,000 kanna, but here the limit has to be seen in aggregate. So all the gift combined, whatever gift I am receiving as movable property, all of it combined, if it is value is crossing 50,000 rupees, then the entire fair market value will be taxable. However, if I am receiving for inadequate consideration, then you have to see aggregate. What you have to see aggregate? Fair market value minus consideration in aggregate. If it is more than 50,000, then the fair market value minus consideration will be taxable. So what did I say? If I am receiving gift without consideration, then if the aggregate fair market value is more than 50,000, aggregate fair market value will be taxable. And if I am receiving gift for inadequate consideration, then you have to see fair market value minus consideration in aggregate for all the transaction combined. If fair market value minus consideration is more than 50,000, then the aggregate fair market value minus consideration will be taxable. Fine. So these are the provisions. Now let us see the exceptions karna. In many cases, this 56.210 section itself will not be applicable. So they can escape whenever they are getting the gift. No, even if it is covered in the section, they need not pay the tax under 56.210. So what are the cases? Let us see. I have given you a keyword also to remember this. So you can go through the keyword and remember all these exceptions. Very, very important from examination point of view. So first, LA, local authority. So if any gift, mobile property, cash, etc. is received from a local authority, then it is not treated as income under 56.210. Next, let's talk about B. From an individual to a trust created solely for the benefit of relative of an individual. For example, an individual created a trust and the trust will give the benefit only to the individual's child. Fine. So relative of the individual is only getting benefit from the trust. In such case, when trust is receiving the gift from individual, then no need to pay tax under 56.210. Next, let's talk about D, that is on contemplation of death. For example, a person is going to die and just before dying, the person is distributing the assets. In such case, whenever assets are distributed or money is distributed, it is not treated as income under 56.210. Then gift received from a relative. If a relative is giving you a gift, then it is not a taxable income for you. Sir, who is the relative Kanna? Relative means for HUF, member is a relative, and for individual, the relative definition is like this. For individual, spouse is a relative. So who is spouse? For husband, wife is the spouse. For wife, husband is the spouse. So for individual, spouse is the relative. Then brother, sister of individual is the relative. Brother, sister of spouse is a relative. Then lineal ascendant, lineal descendant of the individual. Lineal ascendant means what? Parents, grandparents, great-grandparents. Lineal descendant means what? Children, grandchildren, great-grandchildren. So they are also relatives. And lineal ascendant, lineal descendant of spouse also relative. Then brother or sister of either of parents of individual is also relative. For example, for me, my father's brother is relative, my mother's sister is relative. So all those are relatives, however not of the spouse. So spouse means wife or a father or a brother, not my relative. Okay, my father's brother is relative, but wife's father's brother is not my relative. And then finally, spouses of all the above are also my relatives. So once again I am telling you, for individual, spouse is the relative, brother sister of individual relative, brother sister of spouse is a relative, lineal ascendant lineal descendant of individual is a relative, lineal ascendant lineal descendant of spouse is a relative, brother sister of either of parents of the individual are relative but not of the spouse, and spouses of all the above are also relative. And here no Kanna, you should know that relation does not mean vice versa. For example, if somebody is your relative, it is not necessary that you are also their relative. So for example, father's brother is a relative, but brother's son is not a relative. Okay, so that you have to be careful with this section. So this is the relative. If any gift is received from a relative, it is not taxable under 56.210. Next, T. Certain transactions not regarded as transfer. In capital gain, we would have studied section number 47, transaction not regarded as transfer. There are certain sections which are not treated as income under 56.210. For example, partition of HUF. So whenever HUF is partitioning property, the property that is received by a person is not taxable under 56.210. Then when the holding company is giving to 100% subsidiary company, okay, then subsidiary company is giving to 100% holding. So in all those cases, it is not taxable under 56.210. Then amalgamation demerger also not taxable under 56.210. Then whatever amount is received on inheritance or will, that is also not taxable under 56.210. Then gift from or to any trust that is registered under section 12AA. So from 12AA trust, if you are receiving a gift, it is not taxable for you. If you are giving a gift to them, for them also it is not taxable. Then any gift from or to any institution, fund, university, educational institution, hospital or medical institution which is notified under section 1023C. So in 1023C, there is any institution that is notified. If they are giving you a gift, it is not taxable for you. If you are giving them a gift, then it is not taxable for them also. Fine. Then on the occasion of marriage. So if an individual is receiving any gift, that is cash, mobile property or immobile property, on the occasion of marriage, it is not at all taxable. But sir, what about marriage anniversary? If it is received on marriage anniversary, then it is is taxable karna. What about birthday? If I am receiving on birthday, then also it is taxable. But on marriage, it is not taxable. Then 19, received by any individual in respect of COVID-19 expenditure subject to condition is also not treated as income. And lastly, received by a family of an individual deceased due to COVID-19 within 12 months from the date of death. So if any family member has passed away due to COVID-19 and if money is received by the family within 12 months of the death, then it is not taxable if it is received from the employer, and if it is received by other than the employer of the person, then up to 10 lakh rupees it is not taxable. Fine. So these are all the exceptions of 56 to 10. So in 56 to 10, some other points let me tell you. Firstly, let us talk about the stamp duty value karna. Stamp duty value. Stamp duty value here, no, it should be taken on which date. So this you can link with section 50C. Okay, that is stamp duty value will be considered as full value of consideration. In capital gain we have discussed. There what did I tell you? That stamp duty value generally should be taken on registration date. However, if registration date and agreement date are separate, and if on or before the agreement date any payment has been made through prescribed mode of payment, that is account pay check, account pay bank draft, electronic clearing system or any other prescribed mode, then you can also take the stamp duty value as on agreement date. Okay, so same provision is there. So that is why I am linking, so that you need not study two times. One time you study and apply in all these cases. Then reference to valuation officer provision also, same way it is applicable to this 56 to 10 also. For example, if the assessee is not having, if the assessee is not happy with the stamp duty value, the assessee can approach the assessing officer. Assessing officer will transfer the case to valuation officer. Then valuation officer will decide what is the value of the property. If valuation officer decides that the value is a lower value, then it is very beneficial, no, take the benefit from valuation officer. But if the valuation officer decides that the value is a higher value, then don't take it because it is not beneficial. So if valuation officer value is beneficial, you can take it. If valuation officer value is not beneficial, then you need not take it. Fine. Then 56 to 10 does not apply if the asset received is a stock in trade. So when the asset received is a stock in trade of the receiver, then it is not taxable under 56 to 10. It will be taxable under PGBP head of income. Then value of the asset considered to calculate the income under 56 to 10 shall become the cost of acquisition of the asset under section 49 for future capital gain purpose. So whatever asset that you are receiving, no, for that asset, if at all you are paying the tax under 56 to 10, then the fair market value of that asset will become the cost of acquisition for future purposes. The same point we have also discussed in capital gain chapter. So these are the provisions of 56 to 10. You have to see this video at least 2 to 3 times so that you are thorough with the provision, and also solve the question so that you do not make a mistake in the examination. Now let's talk about the third big part of this chapter, that is life insurance policy. Taxation of dividend is over, taxation of gift is over. Now let us talk about taxation of life insurance policy. If any maturity or bonus is received from life insurance policy, then first you have to see whether it is exempt under section 10 clause 10D. Okay, wow. If it is exempt under 1010D, then no need to pay the tax. However, if it is not exempt under 1010D, then it can be taxed as 3 types of income karna. First and foremost is keyman insurance policy. Keyman insurance policy is taxable under PGBP head of income also, IFOS also, and this salary head of income also. If keyman insurance policy money is received by the company, it is taxable under PGBP head of income. If it is received by the employee, it is taxable under salary head of income. However, if it is received by other than the employer or employee, it will be taxable under income from other sources head of income. Then let's talk about other than keyman insurance policy. Other than keyman insurance policy, either the policy can be a unit linked insurance plan or not a unit linked insurance plan. Unit linked insurance plan is there, no, it is taxable under capital gain chapter. Taxable under capital gain chapter, and it is covered under CA final syllabus. However, if the policy is not a unit linked insurance plan, then only it is covered under CA Inter syllabus. Fine. If a life insurance policy is not a unit linked insurance plan, and if it is taxable in income from other sources, then how to calculate the income? Income is equal to amount received including bonus amount minus premium paid on which deduction has not been claimed. So whatever amount is received on maturity, that will be treated as income. Even bonus will be treated as income. But from this income you can reduce the premium if you have not taken deduction for that premium. So if you have taken deduction under ATC and all, then you cannot reduce the premium. But if you have not taken the deduction, then you can reduce the premium, and balance amount only will be taxable under section 56 to 13. Fine. Don't deduct the premium which had already been reduced while calculating the income in a preceding previous year. Let's say sometimes what will happen, no, for life insurance policy, they will be giving the maturity in different stage. So first some bonus will be given, later on maturity will be given. In such case, first itself while taxing the bonus, you would have reduced the premium. So once again you cannot reduce the premium later on. You can reduce it only one time. Okay, so what is the taxable amount? Amount received including bonus minus premium paid. Fine, so this is taxable value. Now let us see what are all the policies that are exempt under section 10 clause 10d. Because if it is exempt under 1010d, then no need to pay tax on the maturity of life insurance. So what are the policies? Let us see. First and foremost, this exemption is applicable only to the sum received including bonus from a life insurance policy, except sum received from policy taken for disabled dependent under section 80dd. So if for 80dd person, if any life insurance is taken, that is not exempt kanna. Then sum received under keyman insurance policy. So keyman insurance policy is also not exempt under 1010d. Other than that, any sum received by life insurance policy is exempt if received on the death, irrespective of condition. If at all life insurance policy amount is received on death of the assessee, then it is not taxable at all. Then premium of the policy should be within the below limits. Now let us see the limits. If at all premium is within the limits, then the policy will be exempt. But if premium is above the limit, then the policy will be taxable. These limits are the same limits that you are also studying in the deduction chapter under section 80C. So both places limits are the same. What are the limits? If the policy is issued before 1/4/2012, then the premium should be within 20% of the sum assured. So maximum 20% of sum assured. If the policy is issued on or after 1/4/2012, then the premium should be within 10% of sum assured. However, if the policy is issued on or after 1/4/2013, then only in case of deceased person under section 80ddb and 80u, the limit is increased to 15% of sum assured. So what did I say? If the policy is issued before 1/4/2012, maximum premium should be 20% of sum assured. If the policy is issued on or after 1/4/2012, then the maximum premium should be 10% of sum assured. And if the policy is for 80ddb and 80u case, then if it is issued on or after 1/4/2013, then the premium can be up to 15% of sum assured also. If the premium is higher than the limit, then entire maturity is taxable. If premium is within the limit, then entire maturity will be exempt from tax. Fine. Later on, the government now has brought one more provision or one more level of taxation from 1/4/2023 onwards. So from 1/4/2023, for all the life insurance policy other than unit linked insurance plan, you have to see the exemption is available only for the policy or aggregate of policies whose aggregate premium is up to 5 lakh rupees. So up to 5 lakh rupees, if the premium is there, then only it will be exempt, or else it will be taxable. If the aggregate premium is more than 5 lakhs, the exemption will be available only for those life insurance policies at the option of assessee whose premium is up to 5 lakh rupees. So if at all you are having multiple policies and all the policy combined, if the premium is more than 5 lakhs, then you can choose the policies for which the premium should be within 5 lakhs. For that, the maturity will be taxable. For the remaining exempt. For the remaining policies, the maturity will be taxable. I will give you examples also, don't worry. So term insurance policy will not be covered in this 5 lakhs. For term insurance policy, always the amount is received on death only. That is why the premium of term insurance policy you don't include in this 5 lakhs, and GST also should not be included in this 5 lakhs. So for calculating this 5 lakh limit, you have to see the premium excluding GST, net of GST. Okay, wow. So now let me explain you the taxation in a short table so that you are getting more clarity. Fine. So life insurance policy first you have to see the limits that are given under section 80C, that is the 20%, 10%, 15% limit. If the limit are not satisfied, then the policy will be taxable. However, it is taxable. If it is a unit linked insurance plan, it will be taxable in capital gains. It is not covered in your syllabus. However, if it is not a unit linked insurance plan, it will be taxable under income from other sources. So how to tax, that also I have told you. Taxable amount is equal to total value of maturity including bonus minus premium paid on which deduction has not been claimed. That is only taxable value. Now, what happens if 80C limit is satisfied? If 80C limit is satisfied, then the policy is exempt, correct? Hence, you see whether the policy is ULIP or not ULIP. It is ULIP means it is not covered for you. Only not ULIP is covered for you. Then see whether the policy is issued before 1/4/2023 or on or after 1/4/2023. If the policy is issued before 1/4/2023, then there is only one level, that is the 80C limit. That is why entire policy is going to be exempt. The maturity is going to be exempt. But if the policy is issued on or after 1/4/2023, then you also have to see the 5 lakh limit. So first you have to see the 20%, 10%, 15% limit. But if the policy is issued on or after 1/4/2023, you also have to see the 5 lakh limit. So for all the policies issued on or after 1/4/2023, if the aggregate premium is within 5 lakh rupees, then entire maturity is going to be exempt. But if the aggregate premium is above 5 lakh rupees, then you can choose the policies whose aggregate premium is up to 5 lakhs and you can keep it as exempt. Balance policies will become taxable under section 56 to 13. So this is the taxation of life insurance policy. Let us see all the examples one by one quickly so that you are clear. So first example, let's say the policy is issued on 1/4/2014. So 1/4/2014 means that what is the ATC limit? The ATC limit is 10%. So the premium should be within 10%. Let us see. Sum assured is 60% and premium is 6 lakh rupees. Is it within 10%? Answer is yes. And is the policy issued before 1/4/2023? Answer is yes. So only one level you have to see, that is the 10% level. Hence the entire maturity will be exempt from tax. Then let's see the second example. Second example, the premium is 5 lakh rupees. Maturity is 50 lakh rupees. Is the premium within 10%? Answer is yes. Now is the policy issued on or after 1/4/2023? Answer is yes. So you have to see the second level also. What is the second level? The aggregate premium should be within 5 lakhs. Is it within 5 lakhs? Answer is yes. Even exact 5 lakhs is within 5 lakhs only. That is why the maturity is going to be exempt. Now let's see this third example. Let's say policy is issued on 1/4/2023 and premium is 6 lakh rupees. And the sum assured is 60 lakhs. Is the sum assured is the premium within 10% of sum assured? Answer is yes. So first level is cleared. Now let's come to second level. Is policy issued on or after 1/4/2023? Yes. That is why the premium should be within 5 lakhs. Is premium within 5 lakhs? Answer is no. It is not within 5 lakhs. That is why the maturity will be taxable. Then fourth example, let's say there are two policies A and B. Both are issued on or after 1/4/2023. Now in both policies you will see that the the sum assured is the premium is 10% of sum assured. So first condition is satisfied. Now let us talk about aggregate premium. Aggregate premium, is it within 5 lakhs? Answer is yes, it is within 5 lakhs. That is why both the maturity will be exempt from tax. Now let us talk about fifth example. So in fifth example also there are two policies. First policy premium is 4.5 lakhs. Second policy premium is 5.5 lakhs. So for both 45 lakhs and 55 lakhs is the sum assured. Hence premium is within 10%. So first stage is satisfied karna, that is not a problem. But since the policy is issued on or after 1/4/2023, you also have to see the 5 lakh limit. Now if you see both the policies combined, it is crossing more than 5 lakhs. That is why you can choose the policy up to 5 lakhs. It can be exempt. Balance policies will be taxable. So here the B policy will however be taxable because the premium is above 5 lakh rupees, and A policy can be chosen as exempt because the premium is within 5 lakh rupees. So B policy will be taxable. A policy will be exempt from tax. Now let us see example number 6. In example number 6, there are three policies karna. All the three are issued on or after 1/4/2023, and for all the three if you see that the 10% limit is satisfied. So first policy premium is 1 lakh, second policy 3 lakh 50, third policy 6 lakh rupees. The 6 lakh rupees is going to be taxable because it is more than 5 lakhs, and balance policies both are within 5 lakhs, hence it is going to be exempt from tax. Now let us see next example, seventh example. In seventh example, see Kana, there are three policies which are issued on or after 1/4/2023 and one policy which is issued before 1/4/2023. Now which is issued before 1/4/2023, you have to see only one condition, that is 10% condition. Is the premium within 10% of sum assured? Answer is yes. That is why the maturity is going to be exempt. You need not see anything else. Now let us see all the policies which are issued on or after 1/4/2023. The premium is 1 lakh, 3 lakh 50 and 6 lakhs. Here for the 6 lakh premium it will be taxable because it is more than 5 lakhs. Balance two premiums is within 5 lakhs, hence the maturity is going to be exempt. So here for the first three policies maturity is exempt, for the last policy it is taxable. Now let's come to next example. Next example, example number 8, there are four policies. All the four policies are issued on or after 1/4/2023. Here the aggregate premium is more than 10 lakh rupees. 5 lakh rupees. Hence the excess premium is going to be taxable. Maturity is going to be taxable. Where the premium is 6 lakhs, the entire maturity will be taxable. Correct? Now let us talk about balance three policies. So one is 4 lakh 50, one is 1 lakh rupees and one is 1 lakh 50,000 rupees. Here you have to take the most beneficial answer Kana. So what is the most beneficial answer? For that you see which is the combination where I am getting the highest sum assured. Highest sum assured. So if I choose X, I am getting 45 lakhs as sum assured. If I choose policy A and policy B, together also I am getting only 25 lakhs as sum assured. That is why this X I will treat it as exempt and A and B, hence it will become taxable because only X will be within 5 lakhs. So balance will be above 5 lakhs. Now let us see ninth example. there are 4 policies kana, all the 4 are issued on or after 1/4/2023. Here also see in the policy number C, it is more than 5 lakhs, hence it is going to be taxable. Then what about policy X, policy A and policy B? Here you can choose any 2 policies because it will be within 5 lakh rupees and the maturities will be exempt, balance policy will be taxable. So here which policy we will choose? We will choose policy X and policy B because here I am getting sum assured as the highest amount. Policy A will be taxable. So policy A taxable and the other 2 are exempt. Now let's talk about last example where there are 5 policies. All the 5 policies are issued on or after 1/4/2023. In this case, for policy C, it is more than 5 lakh rupees, hence it is definitely taxable. For remaining policies, you can choose any policy where the aggregate premium is within 5 lakhs. So first, definitely you are going to choose policy B, and then out of X, Y and A, you can choose any policy because the benefit will not change. So let's say I choose A and B, both of them will be exempt and balance X and Y will be taxable. Fine. So this is how you have to find out which policy is exempt, which policy is taxable. And for the taxable policy, whenever the maturity is received, it will be taxable under section 56 to 13. Now let us talk about all the other small incomes. Okay, major part is covered. Now small incomes. First let us talk about casual income. What is casual income? Casual income means winnings from lottery, crossword puzzle, race horse, card games, other games of any sort, gambling, betting, etc. So all these are casual games. So let us study the taxation of casual games. Casual games are taxed under section 115BB and the tax rate is 30%. 30% flat rate of tax. So this is special rate of tax karna. Already we have revised in tax rates chapter, that only I am reiterating here. 30% rate of tax, and against winning no expenditure is allowed against the income. For example, I won lottery of 1 crore rupees. Against the lottery, can I claim the expense of lottery ticket purchase? Answer is no. I cannot claim any expense from the lottery income. Entire income I have to put it as income and calculate the tax. Deduction under chapter 6A is also not allowed against such income. Moreover, if you are having any loss, that loss also you cannot set off against this income. Then basic exemption limit also you cannot use against this income. Then section 115BBJ, let us talk about winnings from online games. So for online games also, the taxation is 115BBJ, tax rate is 30% and surcharge in health and education says as usual it will be applicable. Now how to calculate winnings, sir? Winnings is equal to total withdrawal from the gaming account during the previous year plus closing balance in the account minus non-taxable deposit minus opening balance. So how to find out winnings? Total withdrawal plus closing balance minus non-taxable deposit minus opening balance. This is the winnings. On this winnings only, it will be tax is 30%. Then here also no expenditure is allowed, no deduction under chapter 6A is allowed, loss also cannot be set off against such income, basic exemption limit also you cannot use. Now let's talk about all the other incomes that are taxable under income from other sources. Firstly, any interest received on compensation or enhanced compensation is taxable under 56 to 10. Is taxable under section 56 to 8, and always 50% is allowed as standard deduction. So here there is standard deduction. In your entire income tax syllabus, there are 3 standard deduction karna. First is the salary head of income, where standard deduction is 50,000 or 75,000 rupees. Then you are having house property head of income, where 30% of NAV is allowed as standard deduction. And third case is interest on compensation or enhanced compensation, where 50% is allowed as standard deduction. Fine. And interest on compensation and enhanced compensation is always taxable on receipt basis. Then advance money forfeited. If advance money forfeited is received before 1/4/2014, that will be taxable under capital gain. But if it is received on or after 1/4/2014, that will be taxable under income from other sources. Then compensation on termination of employment. If a person is receiving compensation on termination of employment without employer-employee relationship, that will be taxable under income from other sources. Then sum received under keyman insurance policy. I already told you, if not taxable under PGBP or salary, it will be taxable under income from other sources. Then income from rent or subletting, if it is not taxable under PGBP or house property. So if rental income is received by the SSE and if such rent is not taxable under PGBP or house property chapter, then it will be taxable under income from other sources. Then rent from composite income. For example, if at all a rent is given, building is given on rent along with furniture and all other facilities, and you cannot separate the value, this is only called composite income karna. In case of composite income, if it is not taxable under PGBP, it will be taxable under income from other sources. Then Director remuneration, if it is not taxable under salary, it will be taxable under income from other sources. Then income from paper setting, paper checking, seminar fees which is received by the professors from a non-employer organization, it will be taxable under income from other sources. Moreover, if member of parliament and member of legislative assembly are receiving the salary, that salary is also taxable under income from other sources, and relating to them we have also learnt under section 10 clause 17 that their daily allowance and constituency allowance will be fully exempt. Then family pension. So if a family is receiving family pension, then entire family pension will be taxable under income from other sources. However, 1/3 of family pension up to 15,000 will be allowed as deduction. So maximum 15,000. This 15,000 is not per month kana, it is per annum. Okay, wow. So maximum 15,000 is allowed as deduction. However, this 15,000 can be increased to 25,000 in case of new tax regime, that is default tax regime. So default tax regime up to 25,000 allowed, and in old regime up to 15,000 allowed as deduction. Then if received by gallantry award recipient family, then it is fully exempt. Next, interest income. If interest income is not taxable under any other head of income, such interest income will be taxable under income from other sources. Okay, wow. For example, interest on income tax refund will be taxable under income from other sources. Then awards received other than exempt awards. So whatever award is received, no, that also will be taxable under income from other sources. Then agricultural income from outside India, it will be taxable under income from other sources. Because we learnt, no, agricultural income is exempt only if the agricultural land is in India. If the land is outside India, it will be fully taxable. And then finally, royalty income also, it is always taxable under income from other sources. Now let us talk about deductions that are not allowed. Deductions that are not allowed. 58 speaks about disallowed deduction. Here you have to link with PGBP chapter because same provisions are repeated here as well. So what are the provision? Number 1, personal expenditure is not allowed as deduction under income from other sources. Then interest, salary or any other payment outside India on which TDS is not deducted. So if you are making payment to non-resident or outside India, if TDS is not deducted, 100% will be disallowed. 100% disallowed. Then if it is within India and if TDS is not deducted, then 30% is disallowed, and whenever TDS is paid in that year, it will be allowed as deduction. Moreover, if TDS is not deducted but the payee has correctly showed the income, paid the tax, filed the return of income and giving CA certificate, in such case when the payee is paying the return of income, in that year the amount will be allowed as deduction. So this also same as PGBP head of income. Next, if payment is made to a related party, excessive payment will not be allowed as deduction. Then if payment is made more than 10,000 to a person in a day other than prescribed mode, not allowed as deduction. And in case of transporter, it is 35,000 to a person in a day, not allowed. If it is more than 35,000, not allowed. Fine. Same as PGBP chapter. Lastly, any expense incurred to earn casual income under section 115BB, BBJ or BBE is also not allowed as deduction. This also I already discussed. Now let us see what are the deductions that can be claimed. It is given under section 57. So if at all any income is taxable under income from other sources, then the expense related to such income can be claimed as deduction. But capital expenditure cannot be claimed as deduction. Only revenue expenditure can be claimed as deduction. Fine. Then, is depreciation is also allowed? Answer is yes. Depreciation is also allowed in income from other sources. Then, if the income is exempt, then the expenditure related to such income will not be allowed as deduction. Then, interest on compensation of compulsory acquisition, I already told you 50% standard deduction is there. Then, family pension, I already told you 1/3 of the family pension up to 15,000 or 25,000 as the case may be is allowed as deduction. Then, in case of dividend income, you can't reduce any expense other than interest expense. You can't reduce any expense other than interest expense, and this interest expense that you can reduce should be related to the dividend income, and it can be maximum 20% of the dividend income. Okay, so for example, if you have received a dividend of 2 lakh rupees, okay, but you have paid expense of interest, 10 lakh rupees is interest. Interest is 10 lakh, but dividend is only 2 lakh. So how much you can reduce as expense? You can only reduce maximum 20% of dividend amount, that is 40,000. So 10 lakhs is not allowed, only 40,000 is allowed as deduction. Balance amount will be taxable, and that too, if the dividend income is dividend under section 222F, then that interest of 20% also not allowed as deduction. Okay. Then income of units of mutual fund or UTI, even against this income, you cannot claim any deduction. Sorry, you can claim the deduction of interest up to 20%. Fine. If at all you are earning income from unit of mutual fund or UTI, here also you can claim interest expense as deduction, maximum up to 20% of such income. Fine. Now deemed income concept also same as 41(1), remission or cessation of trading liability will be taxable under income from other sources also. Now let us speak about the exemptions. So first and foremost, section 10 clause 4 subclause 2. Interest received in NRE account is allowed to an individual who is a non-resident as per FEMA Act or permitted by RBI to maintain such NRE account. So if an individual is a non-resident as per FEMA Act or the individual is having a permission to maintain NRE account, then the interest received on NRE account will be exempt from tax. Then section 10 clause 10a, commuted pension received by an individual from a fund set up by LIC approved by IRDA or controller of insurance will be exempt from tax. So commuted pension of fund set up by LIC is fully exempt. Then section 10 clause 10bc, compensation to individual legal heir received from central government, state government or local authority on account of disaster is fully exempt. So if disaster has happened, no, like flood, earthquake, tsunami, riot, civil disturbance, etc., whatever compensation is received by the government will be completely exempt. However, if such loss has been claimed as deduction, no, anywhere, then the compensation will not be exempt, then it will be taxable. Then section 10 clause 15. 10 clause 15 speaks about interest kanna. Interest is exempt if interest received from saving bank account of post office up to 3,500 rupees for single account, 7,000 rupees for joint account. So saving bank account interest of post office is exempt up to 3,500. So here you have to make sure that if you are getting post office interest in the question, first up to 3,500 you have to claim the exemption in income from other sources calculation. Then while putting the deduction, you can take the deduction under section 80TTA or 80TTB for the balance amount. Fine. Then interest on gold deposit bond under gold deposit scheme 1999 and gold monetization scheme of 2015 is completely exempt. Then if the bonds are issued by local authority or state pooled finance entity, then interest on such bonds will be exempt. Then section 10 clause 16, scholarship granted to meet the cost of education. So entire educational scholarship received by anyone will be fully exempt. Then section 10 clause 17, daily allowance and constituency allowance, I already told you, received by MP MLA will be fully exempt. Then section 10 clause 17a, awards for literary, scientific and artistic works and other award by government or approved body will be completely exempt. For example, national award received for acting, that is completely exempt. Then section 10 clause 18, pension or family pension to a gallantry award recipient. Gallantry award recipient means a person who has won Paramveer Chakra, Mahavir Chakra or Veer Chakra. Okay, that is fully exempt. Then section 10 clause 19, family pension received by a widow, children or nominated heir of a member of Union Armed Forces including paramilitary where their death was occurred in course of operational duty, then it is fully exempt. The family pension is fully exempt. Now, without further ado, let us begin the revision of clubbing of income. This clubbing of income chapter, it is also called as income of other people, that is taxable in assessee's total income. So when other people's income is taxed in assessee's total income, this type of adjustment is only called clubbing. In clubbing, firstly we are going to learn about section 60, that is transfer of income without transfer of asset. So if there is any transfer of income without transferring the asset itself, then the income will be clubbed in the hands of transferor. Let me give you an example. Let's say there is a person called Mr. A. Mr. A is the owner of the house, fine, but rent is received of 20,000. This rent has been transferred to Mr. X, that is friend of Mr. A. So owner is whom? Owner is Mr. A only, but the rent has been transferred to Mr. X, that is friend of Mr. A. In such case, since A is the owner of the asset, that is why on the entire rent of 20,000 per month, the tax has to be paid by Mr. A only. So just like that, without transferring the asset, you cannot transfer just the income. You have to transfer the asset also, fine. And also, it does not matter whether the transfer of income is a revocable transfer or irrevocable transfer. Sir, what is revocable? Revocable means temporary transfer. Irrevocable means permanent transfer. So what are the examples? For example, let's say I have transferred my income only for 5-year period. So after 5 years, this income will come back to me. So it is a temporary transfer. Let's say I have transferred my rent and whenever I want, I can take this rent back. So I am having the power to take the rent back. So this is also called as temporary transfer or revocable transfer. Then what is permanent transfer? Permanent transfer or irrevocable transfer means once I give the right, I cannot get the right back. that is only irrevocable transfer. Fine. So when income is transferred without transfer of asset, it does not matter whether it is temporary or permanent. Always the income will be taxed in the hands of the transferor only. Now let's talk about section 61, revocable transfer of asset. See Kana, first we talked about transfer of income. Now we are talking about transfer of asset itself. So let me give you another example. Let's say the same Mr. A, who is the owner of this house from which rent of 20,000 rupees per month is coming. Now Mr. A, what is he doing? He is transferring the house itself to Mr. X. Rather than transferring the rent, what is he doing? The entire house itself he is transferring to Mr. X, who is the friend of Mr. A. Now in this case, you have to see whether the transfer is a revocable transfer or irrevocable transfer. Because if it is a revocable transfer, then clubbing will happen. If it is an irrevocable transfer, then no clubbing will happen. So let's say Mr. A transferred the house to Mr. X, and whenever Mr. A wants, Mr. A can get back the house. So this is called revocable. Mr. A has transferred the house to Mr. X, and after 15 years he will get back the house. This is called revocable transfer. But you know what? In one case, even though it is revocable, still Income Tax Act considers it as irrevocable transfer. You know what is the case? That I will tell you. So let's say Mr. A has transferred the house to Mr. X with a condition that till Mr. X is alive, he can keep the house, and after Mr. X dies only, Mr. A will get the house back. So this is also a type of revocable transfer. It means what? He will get the house back. But Income Tax Act treats it as irrevocable transfer. It means what? Clubbing will not happen. So what did I say? Exception to revocable transfer. Transfer that is not revocable during the lifetime of the beneficiary or transferee is deemed as irrevocable transfer. Hence it is exception to revocable transfer. So in this case, clubbing will not apply even though it is revocable. Now let us talk about section number 64, income of other persons included in assessee's total income. Firstly, let us talk about income of spouse. So who is spouse Kana? For husband, wife is the spouse. For wife, husband is the spouse. So that is only meaning of spouse. Firstly, let us talk about remuneration from substantial interest concern. If remuneration is in cash or in kind from a concern in which assessee is having substantial interest. So let's say I am the husband. If I am having substantial interest in any concern and that concern is giving salary to my wife, then what will happen? This salary will be clubbed in the hands of the husband only. That is in my hands. I have to pay the tax on this salary. But you know what? If my wife is professionally qualified and then if she is receiving salary, then no problem. In such case, clubbing will not attract. So what did I say? I am having substantial interest in a concern and my wife is receiving the salary. In that case, the salary will be clubbed in my hands. But if my wife is professionally qualified, then clubbing will not attract. Then what if I am also having substantial interest? My wife is also having substantial interest. I am also earning salary from the concern. My wife is also earning salary from the concern. Then what will happen? In such case, where both husband and wife are having substantial interest and both are getting the remuneration, then before remuneration you should see whose income is highest. Husband's income or wife's income. Whoever's income is highest, clubbing will be attracted in their hands. So for both persons' salary, they should only pay the tax. So what did I say? Both husband and wife are having substantial interest. Income of both will be included in the total income of the individual whose total income is higher, excluding such remuneration. Fine. Now let us talk about asset transferred to spouse for inadequate consideration or without consideration. So for example, if I transfer any asset that I am having to my wife without consideration or for inadequate consideration, then income from such asset will be clubbed in my hands only. I only have to pay the tax. Sir, what if my wife is paying full consideration? If my wife is paying full consideration, then no problem. Then clubbing will not be attracted. And you know, there is another exception, and that is agreement to live apart. If any asset is transferred in the agreement to live apart, then also clubbing will not get attracted. But here you should be careful. If it is a house property, then house property is not covered in clubbing provision, because in house property, deemed ownership concept applies. So in case of house property, if the husband is transferring the house property to the wife without consideration or for inadequate consideration, then husband will be considered as deemed owner of the property in house property chapter. Here clubbing will not get attracted. But in case of the assets other than house property, if the husband is transferring or if the wife is transferring to husband without consideration or for inadequate consideration, then the transferor only in their hands clubbing will get attracted. Fine. Then income earned by investing such income cannot be clubbed. Income earned by investing such income cannot be clubbed. So let me give you an example. Let's say I am having a machinery on which rent is coming, rent of 1 lakh rupees per month, or let's say rent of 1 lakh rupees. This machinery is being transferred to wife, Mrs. A. Transferred from Mr. A to Mrs. A. Machinery itself transferred, but it is transferred without consideration. Then what will happen? The rent of 1 lakh rupees will be clubbed in the hands of the husband only, that is the transferor. Now, what if Mrs. A is investing this 1 lakh rupee in a FD, and from FD she is earning interest of 6,000 rupees. This I call it as income 2.0. Income 2.0. So it means what? Income earned by investing such income. So income 2.0. Now will income 2.0 also be clubbed? Answer is no. Income 2.0 will not be clubbed. So for this 6,000 interest, wife only has to pay the tax. Fine. So in this case, rent of 1 lakh will be clubbed, but whatever income is arrived from this rent of 1 lakh will not be clubbed. That will be paid by Mrs. A only. Fine. So income earned by investing such income cannot be clubbed. And one more point I would like to say. My wife started arguing that I am providing you my love and affection. Is that not a valid consideration? You are telling inadequate consideration. But is my love not an adequate consideration? This case went to Supreme Court, and Supreme Court told that love is a valid consideration, Karna. However, for the purpose of this section alone, love is not an adequate consideration. That is why even if love and affection is provided, it does not matter. It will still be considered as inadequate consideration only. Fine. Then if transferred asset is used in a business, then proportionate income from such as asset will be clubbed in the hands of assessee. And if transferred asset is used as capital contribution, then proportionate interest on capital will be clubbed in the hands of assessee. So for example, if I am doing the business and in the business I need some money, my wife is having the money. So if my wife is giving me the money from this business, out of her money, whatever income I am earning, that will be clubbed in the hands of my wife. Fine. Now, what will be the proportion on which date? On which date you will take the proportion? Answer is on the first day of the previous year you have to take the proportion, or date of commencement of business you have to take the proportion. So let's say I am having an old business. Fine. For this old business I have started in previous year 23-24. Okay. So it is an old business. Now in previous year 25-26, on 15th April, my wife is giving me 5 lakh rupees. So now, which date I should take the proportion? From when onwards I should start calculating the clubbing? So since it is received after the first date of the previous year and it's an old business, so you can't do clubbing for previous year 25-26. Instead, the clubbing will start from 1/4/2026. That is from the previous year 26-27. So like this, one question is also there in your study material where the wife is giving money to the husband and the amount is being used as capital contribution. Make sure to solve that question so that your concept is clear. So on the first day of the previous year only proportion will be taken, and if the business is starting in between the year, then on the first date of business you have to take the proportion. Fine. Then if there is any transfer of asset for inadequate consideration to any person and benefit is given to spouse. For example, I transferred my asset to my friend and I told that you have to give the benefit of all this asset to my wife. In that case also, since the benefit is given to wife, so clubbing will be attracted and I only have to pay the tax. Fine. I am Pavam, no? I have to pay the tax in all the cases. Fine. Now let's come to son's wife or daughter-in-law. So if asset is transferred to son's wife for inadequate consideration, then also income from such asset will be clubbed in the hands of transferor. So if father-in-law or mother-in-law, if any one of them also is transferring their asset to the son's wife without consideration or for inadequate consideration, then the income from such asset will be clubbed in the hands of father-in-law or mother-in-law, as the case may be. So income earned from investing such income cannot be clubbed. So here also income 2.0 will not be clubbed. Fine. This income 2.0 you don't write in exam. Just for example I am telling you. Okay. Income earned from investing such income cannot be clubbed. Then if transferred asset is used in the business, then proportionate income from such asset has to be clubbed. If transferred asset is used as capital contribution, then proportionate interest on capital has to be clubbed. And proportion, on which date you will take the proportion? Take on the first day of the previous year or date of commencement of the business. So these provisions are same as provisions for spouse. There is no difference. Then if there is any transfer of asset for inadequate consideration to any person and benefit is given to son's wife, then also the transferor will pay the tax on the income. It will be clubbed in the hands of transferor, that is mother-in-law or father-in-law. Fine. Now, what is the difference between spouse and son's wife provision karna? In spouse and son's wife provision, this remuneration is there, no remuneration part. This is there only in spouse. Fine, it is not there in son's wife. However, if you see the balance provision, the same provision you will find in son's wife also. So both for spouse as well as son's wife, the provisions are applicable. And one small point clarification I want to tell, that in case of clubbing of income of spouse and son's wife, relationship should subsist both while doing the transfer as well as while receiving the income. So while doing the transfer also, husband-wife relationship should be there, or mother-in-law and son's wife relation should be there, daughter-in-law relation should be there. And while receiving the income also, husband-wife relation should be there, and mother-in-law or father-in-law and daughter-in-law relationship should be there. Only then clubbing will get attracted. Even if during transfer or while receiving the income, in any one stage also, if the relationship is not there, then clubbing will not get attracted. Fine. Now let's talk about income of minor child. Income of minor child. So if minor child is earning the income, then you have to see whether the parents' marriage subsists or parents' marriage does not subsist. Subsist means what? Whether the parents are living together or parents are living separately. If parents are living together, then you have to club the income of minor child in the hands of the parent whose total income is higher. Fine. If parents' marriage does not subsist, then you have to club the income of the minor child in the hands of the parent who is maintaining the child. Now, there is an exemption also under section 10 clause 32, and this exemption is only allowed in the optional tax regime. It is not allowed in the default tax regime. What is this exemption? 1500 rupees per child. 1500 rupees per child. So up to 1500 rupees per child, whatever income is there, it will be exempt. Balance income only will be taxable. And here you don't make silly mistake in the examination for calculating all the children together. You have to calculate this 1500 exemption for each child separately. Only then you will get the correct answer in the exams. Okay, calculate separately for each child per annum. Then not allowed under section 115 BAC. Now Kanna, for this minor child income, there are three exceptions. So exception means what? In these three cases that I am going to tell you, in all the three cases, the income of the minor child, the tax has to be paid by the minor child only. Parents need not pay the tax. The child himself or herself will pay the tax. What are the three cases? Case number 1, manual work. The child is doing manual work. Case number 2, skill, talent or specialized knowledge or experience of the child. The income is coming because of skill, talent, specialized knowledge or experience. For example, if minor child is a child artist, and that singer is doing so many performances and earning the income, this from the income from singing performance, the tax has to be paid by the child only. The parents need not pay the tax for the child. Fine. And then lastly, child suffering from disability under section 80U. So if the child is suffering from disability and if it is covered under section 80U, then deduction is allowed under section 80U. That is why the income of the child will be taxable in the hands of child itself, so that the child can take the benefit of 80U deduction. Fine. Now let's talk about income 2.0. Let's say the child is earning income because of manual work, skill, talent, specialized knowledge and experience. I gave you an example, no? Child artist is there. The child artist is doing singing performance and earning the income. Now, the income from this singing performance, if it is invested in fixed deposit and some interest is earned from fixed deposit, then what will happen? What will happen to this interest on fixed deposit? Will it be clubbed or not be clubbed? Answer is, it will be clubbed. So if a child is earning income from manual work, skill, talent, specialized knowledge or experience, then the income earned by investing such income will be clubbed. So here income 2.0 will be clubbed in the hands of the transferor. So parents have to pay the tax on the interest of the FD. On singing income, child will pay the tax. But if the singing income is invested in FD and interest is earned, then on this interest income, parents only will pay the tax. You get my point? Now let's come to next one. Once income is clubbed in the hands of one parent, it will continue to be clubbed in the subsequent years also. So once if clubbing happens in the hands of father, then in the next year also it will happen in the hands of father only, and it will keep on happening. Let's say the assessing officer now wants to shift the clubbing in the hands of mother. In such case, if assessing officer asks to change, then it can be changed. Fine. Then clubbing provision also apply to minor married daughter, stepchild and adopted child. It applies to minor married daughter. So in house property head of income, you are having an exception. Okay, that minor married daughter. If a house property is transferred from the parent to a minor child without consideration or for inadequate consideration, then parent will be considered as deemed owner of the property. Fine. So that is covered in house property chapter. There is an exemption that if the house is transferred to minor married daughter, then they will not be considered as deemed owner. Minor married daughter only will be considered as owner. But this minor married daughter concept is not applicable in clubbing. So it does not matter if it is minor married daughter, stepchild, adopted child. If it is a minor child, then the income will be clubbed in the hands of the parent. Fine. So this is the provision. Now let's talk about Hindu undivided family. Conversion of individual property into HUF property. If individual is transferring his property to Hindu undivided family without consideration or for inadequate consideration, then income from such property will be clubbed in the hands of that individual only. Fine. Later on, if the HUF is transferring the property, that is partitioning the property and giving it to the family members, in such case what will happen? So if the individual is giving the property all different family members, in such case, income from the partitioned property to the individual himself and also to the spouse will be included in the total income of individual. Fine. Now let's talk about some other notes. Income includes loss, hence clubbing applies to loss also. When income is clubbed in the hands of parent or income is clubbed in the hands of the spouse, in such case, loss also will be clubbed in the hands of parents or spouse or father-in-law, mother-in-law, as the case may be. Then, in case of transfer of asset without consideration or for inadequate consideration, if asset is transferred into any other form, then the income from such converted asset also shall be clubbed. If the asset is sold, then the capital gain also shall be clubbed. So for example, if I gave my wife 1 lakh rupees, this 1 lakh rupees, no, she has converted into 1000 shares of 100 rupees each. She has bought 1000 shares of 100 rupees each. So whatever dividend is coming from these shares, no, on that I only have to pay the tax. Clubbing will be attracted. Moreover, if she is selling the shares and earning capital gain, this capital gain also will be clubbed in my hands only. Only I have to pay the tax. Fine. Then natural love and affection is a valid consideration but not considered as adequate for clubbing provision. This I already told you. Now let's talk about cross transfer. In cross transfer, you know what happens? To avoid the clubbing, the people will do cross transfer. For example, I am transferring to my brother's wife, brother is transferring to my wife, so that the wife clubbing provision will not get attracted. So here I have given you an example. Vasudevan is transferring to brother's wife, brother is transferring 5 lakhs to Vasudevan's wife. In such case, you know what you should do? You see which is the lower amount of both the amounts. So here the lower amount is 5 lakh rupees. On this 5 lakh rupees, that is the lower amount, whatever income is coming, that income has to be clubbed in the hands of the respective husbands. So here the income is coming as 30,000 rupees. The lower income is coming as 30,000 rupees. So 30,000 will be clubbed in both hands. You get my point? So this is cross transfer. I hope clubbing is clear for you. In a very crisp manner, in just 22 minutes, we were able to complete this clubbing provision. I hope you got clarity. See all the questions from the study material also, and you will be confident enough to attend in the examinations. Now, without further ado, let us begin the set off and carry forward of losses chapter revision for your exams. So in set off and carry forward of losses, there are 3 types of adjustments. First is intra-head adjustment, then is inter-head adjustment, and the third one is carry forward and set off adjustment. So what is this intra-head adjustment, sir? Intra-head adjustment, or you can also call it inter-source adjustment, it means setting off of the loss of one head of income against the income of the same head of income. So if there is house property loss, you set off against the same other house property income. That is only called intra-head adjustment. However, it is called intra-head only if it is done in the same previous year. Okay. However, if you carry forward it, then this intra-head adjustment is not applicable. For that, we will be studying carry forward provisions. Fine. So what is intra-head adjustment? First, let us talk about salary. In salary, you will not get any loss. That is why there is no question of setting off of the loss of salary chapter. Now let's come to house property chapter. In house property, if you are having a loss for one house property, you can set off it against the income of the other house properties, and for that there is no restriction. How much ever loss if you want, you can set off with the incomes of other house properties. Now let's talk about profit and gains of business or profession. In profit and gains of business or profession, generally there is no restrictions. It means what? If you are having loss in one business but you can have profit in other business, you can set off the loss of that business against the profit of other business. There is no restriction. However, there is a restriction for loss of speculation business and loss of specified business under section 35 AD. First, let us talk about speculation business. If you are having a loss of speculation business, it can only be set off against the profit of speculation business. And if there is a loss from specified business under 35 AD. Sir, what are these specified businesses? The cold chain facility, warehousing for agricultural produce, warehousing for sugar, okay, hospital with at least 100 beds in India, 2-star or above hotel in India, all those businesses you had studied, no, in section 35 AD, where entire capital expenditure is allowed as deduction. So in that case, if at all there is a loss from such specified business, then it can only be set off against the profit of a specified business under section 35 AD. But we have already studied in PGBP that for 35 AD deduction, it is an optional deduction. If the assessee wants, assessee can claim. If the assessee does not want, he need not claim the 35 AD deduction. Sir, what if there is a loss of 35 AD in one business which has come because of 35 AD deduction? Can I set off against another specified business where I have not claimed the deduction? Is it allowed? Answer is yes, Kanna, it is allowed. It does not matter whether the deduction under section 35 AD has been claimed by the profit making business or not. So for example, I have a hospital. In this hospital, I claimed 35 AD deduction and I am having a loss. Okay, I am having another business called hotel business. Here I am having profit. And in hotel business, I did not claim 35 AD deduction, even though it is eligible for 35 AD, but I did not claim. Still, can I set off this loss against the profit of hotel business? Answer is yes, you can set off this profit, set off this loss. Fine. Now, one more thing I would like to say, sir, if I am having a normal business loss, can I set off against speculation profit and specified business profit? Answer is yes. Normal business loss can be set off against normal profit also, speculation profit also, and specified business profit also. Now, let us talk about capital gain head of income. Capital gain head of income. See, Kanna, in capital gain, you can have two types of losses. One is short-term capital loss and other is long-term capital loss. This short-term capital loss is there, no? This I call it as Vijay, and long-term capital loss, this I call it as Rajni. So Rajni is the superstar and I am the fan of Rajni only. That is why whenever there is long-term capital loss, you can only set off against long-term capital gain. It means when Rajni's movie is facing a loss, only Rajni can help himself. No other person can help Rajni. Fine. Now short-term capital loss is Vijay. So if short-term capital loss is there, it can be set off against short-term capital gain as well as long-term capital gain. It means what? If Vijay is bringing out a movie, only Vijay can help the movie as well as Rajni can help the movie. So if Rajni is coming inside Vijay's movie and doing the cameo, then Vijay's movie will become super hit because of Rajni. Okay, so Vijay can take help from Vijay also and Rajni also. But Rajni can only take help from Rajni himself because he is the sole superstar. Fine. So long-term capital loss can be set off only against long-term capital gain, and short-term capital loss can be set off against short-term capital gain also, long-term capital gain also. So this is the intra-head adjustment. Now let's talk about income from other sources. If there is a loss in income from other sources, then there is no restriction for intra-head set off. So loss of one other source income can be set off against profit of another other source income. But there are some rules regarding this betting, gambling and all that I will be telling later on in this video. Now, what about loss from owning and maintaining racehorse? If there is a loss from owning and maintaining racehorse, that can only be set off against the income from owning and maintaining racehorse. However, if there is some other IFOS loss, can you set off against income from owning and maintaining racehorse? Answer is yes, that you can do. Fine. So this is intra-head adjustment. Now let us come to inter-head adjustment. What is inter-head adjustment, sir? Inter-head adjustments means during the same previous year in which the loss is incurred, you can set off the loss of one head of income against the income of some other head of income. So for example, house property loss, you can set off against PGBP head of income or salary head of income. This is only called inter-head adjustment. So let us talk about all the rules and regulations. First, let us talk about salary. In salary, you cannot have any loss. That is why there is no question of setting off of loss. Now let's talk about house property. Karna, in house property, you have to see whether the assessee has chosen the default tax regime or optional tax regime. If the assessee has chosen default tax regime, then very sad, they cannot do any inter-head adjustment. Inter-head adjustment itself is not allowed. So if the person has chosen default tax regime, they can only set off house property loss against some other house property income in the same year. They can't do inter-head adjustment also. They can't carry forward the loss also. That also I am going to tell you. Fine. Now let's talk about the optional tax regime. If the assessee has chosen the optional tax regime, then house property loss can be set off against all the other heads of income up to 2 lakh rupees. Up to 2 lakh rupees. So you can set off house property loss against salary income. You can set off against PGBP income. You can set off against capital gain income. You can also set off against income from other sources head of income. So there is no restriction, but maximum up to 2 lakhs only you can set off. Sir, what if the loss is more than 2 lakhs? Then up to 2 lakhs you set off, balance amount you carry forward in the old tax regime. Fine. But in the new tax regime, it is not allowed. Now let's talk about PGBP loss, profit and gains of business or profession. If there is a speculation loss or specified loss, I already told you, it is only allowed to be set off against speculation profit and specified business profit. That is why inter-head adjustment itself is not possible. Now let's talk about normal business loss. So other than speculation business and specified business, if at all there is any loss, then that loss you can set off against any other head of income except salary. So you can't set off PGBP loss against salary income. That is not possible. But PGBP loss you can set off against house property also, against capital gain also, against income from other sources also. That is why I call this PGBP head of income as Power Star. Power Star. So when Power Star is having the movie, definitely Power Star can help himself. Other than Power Star himself, if Vijay is coming and doing the cameo in Power Star movie, then Vijay can also help. If Rajni is coming and doing cameo in Power Star movie, even Rajni can help. So this Power Star loss, that is PGBP loss, it can be set off against PGBP income, against capital gain income also, against long-term capital gain income also. Fine. So that is Power Star. Now let's talk about capital gain. In capital gain head of income also, inter-head adjustment not allowed. Inter-head not allowed. So capital gain loss you cannot set off against any other head of income. Fine. Then let's talk about income from other sources. In income from other sources, as I told you, if there is a loss from owning and maintaining racehorse, that can only be set off against income from owning and maintaining racehorse. So inter-head not allowed. Now let's talk about all the other losses. If there is any other loss, then there is no restriction. You can set off the loss against capital gain head of income, PGBP head of income, house property also, salary also. There is no restriction. So this is inter-head adjustment. First, always you should do intra-head adjustment. In the question, if the loss is coming, always you should do intra-head adjustment. Then only you should do inter-head adjustment. If after doing intra-head and inter-head also, if there is some leftover loss, then you have to carry forward that loss to next year. So you have to do carry forward. And in the next year, whenever there is some income, you can do the set off. Now, carry forward loss, how to do the set off? Let us see. Firstly, let us talk about unabsorbed depreciation, unabsorbed scientific expenditure, or unabsorbed family planning expenditure. What did I say? Unabsorbed depreciation or unabsorbed scientific expenditure or unabsorbed family planning expenditure. If there is some unabsorbed depreciation or these expenditures, in such case, you can set off these losses against any head of income other than salary, and it can be carried forward for an indefinite period of years. But sir, what is this unabsorbed depreciation? Let me give you an example. Let's say this is the profit and loss account where the sales is coming as 2 lakh rupees. Depreciation is 5 lakh rupees and all the other expenses put together is 20 lakh rupees. So total expense is 25 lakhs but sales is only 2 lakh rupees. That is why the loss is 23 lakhs. So it means what? The income is not even sufficient to cover the depreciation. The income is not even sufficient to cover the depreciation. Hence, whatever depreciation is not covered by the income is called unabsorbed depreciation. And whatever is the balance expense related loss will be called as normal PGBP loss. Fine. So in this case, 3 lakhs is the unabsorbed depreciation, 20 lakhs is the normal PGBP loss. Now you get the point. What is unabsorbed depreciation? Fine. If there is unabsorbed depreciation, you can carry forward for indefinite number of years. And if you carry forward in the next year, then you can set off against any head of income other than salaries. And you know what? Generally, if you carry forward a loss, after carrying forward, you can only set off against the same head of income. You can't do inter-head set off. But there is an exception. Unabsorbed depreciation, scientific research and family planning alone, you can set off against other heads of income also. So this is an exceptional case. Now let's talk about loss from house property. Loss from house property, you should see whether it is from the old source of income, old regime, that is optional tax regime, or new regime, that is default tax regime. In default tax regime, the carrying forward of house property loss is not allowed. But in old tax regime, you can carry forward house property loss. It can be carried forward for 8 years, and after doing carry forward in the next year onwards, you can only set off the loss against income from house property. So only same head adjustment you can do. Next, normal PGBP loss. So if there is normal business loss, you can carry forward the loss for 8 years. So maximum up to 8 years you can carry forward. After 8 years, what will happen? After 8 years, it will lapse. Okay, the loss itself will get finished. So up to 8 years, you can carry forward the loss, and in the future years, you can set off that loss against PGBP income. PGBP income. What about speculation loss, sir? Speculation loss, the government wants to punish. That is why they're telling if there is loss from speculation and if you're carrying forward it, maximum you can carry forward only for 4 years. Generally, you can carry forward for 8 years. However, speculation you can carry forward only for 4 years. And also, after doing carry forward also, you can only set off against the speculation income. So, speculation loss only against the speculation income. Then, loss from specified business under 35 AD. Here, no government is giving advantage. What advantage, sir? That specified business loss under 35 AD can be carried forward for indefinite number of years. So you can keep on carrying forward the loss. So if you carry forward the loss next year against what you can set off? You can only set off against the profit of specified business under 35 AD. So specified business loss can only be set off against specified business profit. Then let's talk about long-term capital loss and short-term capital loss. If there is a long-term capital loss, you can carry forward that loss for 8 years, and after carrying forward also, you can only set off against long-term capital gain. Only Rajni can help Rajni. Then if there is short-term capital loss, Vijay can get help from whom? Vijay also, Rajni also. That is why short-term capital loss, even after carrying forward, can be set off against short-term capital gain as well as long-term capital gain. And short-term capital loss also can be carried forward for 8 years. Now lastly, let us talk about loss from owning and maintaining racehorse. If there is loss from owning and maintaining racehorse, that can be carried forward for 4 years only. So here also the government wants to punish. Maximum 4 years only they can carry forward. After carrying forward also, it can only be set off against income from owning and maintaining racehorses. Okay, against any other income it cannot be set off. Sir, what about other income from other sources losses? If there is any income from other source loss other than horse race, that cannot be carried forward. So income from other source loss cannot be carried forward. Within the same year only you have to do adjustment, but you cannot carry forward to next year. Fine. Now let us talk about some points. PGBP loss. Successor of a business cannot carry forward the PGBP loss of the predecessor except in case of succession by inheritance. So let's say PGBP loss is there. Now that business is transferred from one person to another person. So the new person, can they carry forward the old PGBP loss? Answer is no. However, if business is transferred because of succession, then it can be carried forward by the new person also. Next, PGBP loss. Carried forward business loss should be set off before carried forward unabsorbed depreciation, scientific research expenditure or family planning expenditure. So Kanna, in the question, if you are having brought forward unabsorbed depreciation and brought forward PGBP loss. So while doing set off, for which you will give first preference, for unabsorbed depreciation or for PGBP loss? Answer is that you should give first preference to set off PGBP loss. then only you should set off unabsorbed depreciation. Why am I telling this? Because PGBP loss can be carried forward for 8 years only. Unabsorbed depreciation can be carried forward for indefinite number of years. That is why give first preference to set off PGBP loss, second preference to set off unabsorbed depreciation. Fine. Now let us discuss next point. PGBP loss can be carried forward even if the business is discontinued and it can be set off with some other business. So if business itself is discontinued, still can I carry forward the PGBP loss? Answer is yes, I can carry forward. Next, specified business. This I already told you. Then loss from exempt income cannot be set off against taxable income. So for example, if I am having loss from agriculture, can I set off against some other business income? Answer is no. Agriculture income is exempt income. That is why loss also I cannot set off with any other income. Next point, loss from other sources. This I already told you, it cannot be carried forward. Now let's talk about loss from winnings. Loss from winnings also cannot be set off, cannot be carried forward. Let me tell you about loss from winnings, loss from gaming and loss from undisclosed source. Loss from winning, loss from gaming, loss from undisclosed source, you cannot set off. Moreover, if you are having income from winning, income from gaming, income from undisclosed source, then against these incomes you cannot set off any other loss. So if for example I am having PGBP income and I am having PGBP loss and I am having winnings income, can I set off PGBP loss against winnings income? Answer is no. You can't use this winnings, gamings and undisclosed source of income to set off any other loss. It is not allowed. Fine. However, section 87A rebate will be allowed for winnings income, gaming income and undisclosed source of income. That is a separate point. Fine. Now let's talk about loss return. Loss return, section number 80. Kanna, if you want to carry forward the loss to the next year, you have to file your income tax return within the due date of filing income tax return. So it is compulsory to file the income tax return within due date if you want to carry forward the loss to the next year. However, there are two losses which you can carry forward even if you do not file the return within due date. What are the two losses? The two losses are house property loss and unabsorbed depreciation. So other than house property and unabsorbed depreciation, you can carry forward only if you are filing the return of income within the due date which is mentioned under section 139 subsection 1, or else you cannot carry forward. So these are all the provisions of carry forward and set off and carry forward of losses. See Kanna, for this chapter, reading the theory alone is not sufficient. Only if you solve the questions, you will know the actual practicality of solving the questions and you will get the confidence for the examination. So that is why as soon as you complete this lecture, you take the institute study material, take all the questions, refer a few questions, but at least solve a few questions practically so that you are familiar with what order you must choose. Only the most beneficial order will be the correct answer as per the examiner. All the other answers will be wrong answer. So you should know how to set off the loss in the most beneficial manner. Now, without further ado, let us begin the deduction revision. This chapter contains deductions which are there under chapter 6A, then section 10AA deduction for special economic zone, and also alternate minimum tax, that is AMT provisions. So all the three are going to be covered in this video only. I want you to watch the video till the very end. Before beginning the deductions, let me tell you that deductions in chapter 6A are of three categories. First is payment based deduction, then certain income based deduction, and third is income based deduction. So there are three categories. Now let us see what is the concepts of this deduction chapter before beginning the actual provision. It is very important to know the concept. First concept is that the deduction should not cross gross total income. So in the steps to calculate total income, I have already told you that after calculating the gross total income, from that only you are going to reduce both these deductions, that is chapter 6A deduction as well as section 10AA deduction. Now, maximum deduction that can be claimed is equal to gross total income. So for example, if gross total income is 8 lakh rupees, it means what? You cannot claim the deductions more than 8 lakh rupees. What if the deductions are actually more than 8 lakhs? Then what will happen? Then the deductions cannot result in a loss. Moreover, you cannot carry forward the deduction. Hence, whatever deductions that are not claimed during the year will lapse. So it means what? Because of deduction, you will never get a loss, and unclaimed deduction you cannot carry forward. That you should remember. Now let's go to the next one. Deduction for a sum is allowed only to a single person and only once. So one same amount you can't be claiming in multiple sections. Moreover, the same amount can't be claimed by two different persons. It can be claimed by only one person and only one time. Fine. Next, section 80AC. Section 80AC is a section which tells that certain income-based deduction and 10AA deduction. What did I say? Certain income-based deduction and 10AA deduction, both these deductions can be claimed by the assessee only if the income tax return is filed by them within the due date. So if income tax return is filed late, you cannot claim these deductions. So what are they? Section 10AA and certain income-based. In your chapter, the certain income-based deductions are 80JJAA, 80QQB and 80RRB. So these four deductions can only be claimed only if return is filed within due date. Next point, deductions are not allowed against special rate income. Deduction is allowed only against normal rate income. So in the gross total income also, you have to divide the income into two categories. One is the normal rate income, for which you calculate the income tax rate under slab rate system, and the other is special rate income. So deduction is only allowed against the normal rate income. That is only the maximum deduction that you can claim. Then, deductions discussed in this chapter are only allowed if the assessee opts out of default tax regime. So, all the deductions that we are going to discuss now, including 10AA deduction, everything is allowed only in the optional tax regime. It is not allowed under the default tax regime. In the default tax regime, no, only 3 deductions are allowed. Of all that we are going to discuss, only 3 deductions are allowed, and that is 80CCD subsection 2, 80CCH subsection 2, and 80JJAA. So, only these 3 deductions will be allowed under the old tax regime as well as new tax regime, under both tax regimes. So now with this base, let us start with the payment based deduction. In payment based deduction also, before beginning the deduction, I want to tell you about 80CCE limit. So there is a section called 80CCE which tells that 80C plus 80CCC plus 80CCD subsection 1. These 3 sections combined maximum deduction that can be claimed is 1,50,000 rupees. So what did I say? 80C plus 80CCC plus 80CCD subsection 1 is equal to maximum 1,50,000. So this is the maximum deduction. Now let us talk about the first section, that is investment in specified assets, section 80C. In 80C, firstly let us talk about life insurance. So who is eligible for 80C deduction? Individual is eligible, HUF is eligible. What is the maximum deduction that can be claimed under 80C? The maximum deduction is 1,50,000 rupees. So maximum only 1.5 lakhs rupee can be claimed for all the categories combined. Moreover, this 80C is also coming under 80CCE limit. So that is a different discussion. Fine. So first, life insurance policy. Whatever amount of premium is paid for life insurance policy, that premium is allowed as deduction up to 1.5 lakh rupees if the premium is paid for either self or relative. Sir, who is the relative, sir? Relative means spouse and children. Spouse and children. So individual for himself or for spouse and for children. If he is paying the life insurance premium, it is allowed as deduction up to how much? 1,50,000 rupees. Now, in life insurance, there is another limit also. What is the limit? You have to see what is the issue date of the policy. Whether the policy is issued before 1/4/2012 or after 1/4/2012. That is on or after 1/4/2012. If the policy is issued before 1/4/2012, then maximum deduction that can be claimed is 20% of sum assured. Maximum deduction 20% of sum assured. Sir, what if the premium paid is 25% of sum assured? Then what to do? Then you claim 20% and balance 5% you cannot claim. Fine. So up to 20% maximum is allowed as deduction. If the policy is issued on or after 1/4/2012, then it has become maximum 10% of sum assured. So earlier it was 20%. From 1/4/2012 onwards, it has become 10% of sum assured. Then from 1/4/2013 onwards, only for 80 DDB and 80 U category assessees, for them alone, it has been increased to 15% of sum assured. So let me repeat once again. You have to see what is the policy issue date. If the policy was issued before 1/4/2012, then the premium paid up to 20% of sum assured can be claimed as deduction. Then if the policy is issued on or after 1/4/2012, then the premium paid up to 10% of the sum assured can be claimed as deduction. And if the policy is issued on or after 1/4/2013, in case of 80 DDB and 80 U category assessees, for them up to 15% of sum assured can be claimed as deduction. So this is the limit, upper limit to claim the deduction, and this limit is there over and above 1,50,000 limit is also there. So that also you should remember. Then what about HUF? For HUF, who is the relative? Members are the relatives, and insurance should not be cancelled within 2 years. If you cancel the insurance policy within 2 years, you have to refund the deduction or make the deduction taxable once again, reverse the deduction. Right? Now let's come to apart from life insurance policy, what are all the other avenues where you can invest and claim 80C deduction? So first is employee contribution to statutory provident fund, recognized provident fund, approved superannuation fund, public provident fund. So this we have already discussed in salary chapter, where I told you that the employee can contribute in these funds. If the employee is contributing, then for the contribution, maximum 1,50,000 can be claimed as deduction under section 80C. Then Sukanya Samriddhi Yojana for girl child, if the parents are contributing, then they can claim deduction under 80C. Moreover, section 10 clause 11 says that interest on Sukanya Samriddhi Yojana is also exempt. Then maturity of Sukanya Samriddhi Yojana is also exempt. Then if a parent is paying tuition fees for maximum 2 children for full-time education in India, then tuition fees can be claimed as deduction. Now in the entire school fees, there will be many types of fees, no? School fees, capitation fee, donation, admission fee, lab fee, bus fee. Out of that, you should only take the tuition fee component and claim it as deduction. And this tuition is for school education, okay? It is not about private tuition. Then repayment of housing loan taken from banks, financial institution, government for purchase or construction of house. So for purchase or construction, if any loan is taken, then the amount of repayment of loan can also be claimed as deduction. Then if a new house is purchased, on that house, wherever stamp duty or registration fee is paid, that amount also can be claimed as deduction under 80C. Then central government employee will have tier 2 account in NPS, that is National Pension Scheme. In NPS, they will be having tier 2 account. In tier 2 account, whatever employee contribution they are doing, that can be claimed as deduction under 80C. Then 5-year fixed deposit or 5-year term deposit. So if a person is creating a 5-year FD fixed deposit in post office or scheduled bank, then they can claim it as deduction. Next, subscription to NSC, National Savings Certificate, NSC, and even the interest can be claimed as deduction under 80C. Then approved annuity plan of LIC is also covered. If you are investing in approved annuity plan, that is also allowed as deduction. Then notified fund, pension fund set up by mutual fund or UTI. Pension fund of mutual fund and UTI is covered under section 80C. Fine. Then what are all the other investment areas? Premium or deferred annuity contract. So if deferred annuity is taken, then the premium paid is allowed as deduction. And then unit linked insurance plan of LIC or mutual fund is also allowed as deduction. Then notified unit of mutual fund or UTI, including equity linked savings scheme, is also allowed as deduction. Then National Housing Bank tax saving term deposit scheme allowed as deduction. Deposit scheme of HUDCO is also allowed as deduction. Subscription to eligible equity shares or debentures with a 3-year lock-in period allowed as deduction. Then certain units of mutual fund approved by CBDT is allowed as deduction. Then bonds issued by NABARD, which is notified by the central government, will be allowed. And then lastly, Senior Citizen Savings Scheme 2004 also will be allowed as deduction under section 80C. Sir, all these, should we memorize all these? No need to memorize, but at least go through this list 4 times or 5 times, so that if it is coming in the examination, you should see the name and you should identify that it is included in 80C. Okay, now let us talk about section 80CCC, contribution to pension fund of any insurer. Pension fund of any insurer. For example, Life Insurance Corporation, if they are having any pension fund and if the assessee is contributing, they can claim deduction up to 1,50,000 under section 80CCC. Maximum how much? 1,50,000. And then 80CCD talks about notified pension fund or national pension scheme. Listen Kanna, pension fund is there, no? It is coming in all the 3 sections. 80C also it is coming, CCC also it is coming, CCD also it is coming. In 80C, you will see pension fund set up by mutual fund or UTI. Then in 80CCC, you will see pension fund of any insurer. Then in 80CCD, you will find the national pension scheme, or you can call it new pension scheme, or you can call it central government pension scheme, or you can call it Atal Pension Yojana. All these are same. Fine. So national pension scheme, new pension scheme, Atal Pension Yojana, central government pension scheme, everything is same. Some people even call it National Pension System Trust. That is also 80CCD only. So all those are same. Who is eligible? Individual is eligible. Individual can deposit for himself, and now there is an amendment for May 26 which also tells that individual can deposit even for child in the NPS Vatsalya scheme. For child under NPS Vatsalya scheme. Then here, let us discuss the limits first, Kanna. What is the maximum limit of deduction that can be claimed under section 80CCD? In 80CCD, there are 3 sections: 80CCD subsection 1, 80CCD subsection 1B, and 80CCD subsection 2. Fine. Let us start with 80CCD subsection 2. 80CCD subsection 2, I already told you that it can be claimed as deduction under old tax regime also, under default tax regime also. So who can claim, on what amount can you claim the deduction? Answer is on the employer contribution. So whatever employer contribution is there, no? First what you should do while calculating the total income, in the salary head of income, you should add the employer contribution. Fine. Then while claiming the deduction, you can claim the deduction under 80CCD subsection 2. First let us talk about central government or state government employee. So maximum how much deduction can be claimed, sir? Maximum 14% of the salary can be claimed as deduction. Now what is salary? Salary here means basic salary plus DA terms. Basic salary plus DA terms multiplied by 14% can be claimed as deduction. Now let us talk about other than government employees. So if then other than government employees, you have to see whether the employee has taken optional tax regime or default tax regime. In the optional tax regime, they can claim maximum 10% of salary as deduction, and in default default tax regime, they can claim 14% of salary as deduction. So deduction is higher amount in the new tax regime. This is a very rare case. There are only 3 cases in your entire income tax syllabus where 115 BAC, that is default tax regime, will give you more benefit. The first case is in the salary chapter, where in default tax regime you can claim 75,000 as deduction, but in old tax you can claim only 50,000 as standard deduction. Second case you will be seeing in income from other sources. For family pension deduction, in new tax regime you can claim up to 25,000 rupees, but in old tax you can claim only up to 10,000, 15,000 rupees. And then third exception is coming in the deduction chapter, where in 80 CCD subsection 2, in old regime you can claim only 10% of salary as deduction, and new tax regime you can claim up to 14% of salary as deduction. Fine. So this is 80 CCD subsection 2. Now let us talk about 80 CCD 1 and 80 CCD 1B. 80 CCD 1 and 1B, in both the subsections you can claim employee contribution. Then what is difference between both of them? In 80 CCD 1B, the limit is 50,000 rupees. What is the limit? Maximum 50,000 rupees. And in 80 CCD 1B only, you can claim NPS Vatsalya scheme. NPS Vatsalya scheme, which is for the children of the individual. Now this NPS Vatsalya scheme can only be claimed under 1B. That is why whenever you are getting NPS Vatsalya scheme in your question, first you claim that as deduction under section 80 CCD 1B. Then balance amount which is remaining in this 50,000, that you claim as employee contribution. You first complete this 50,000, then you go to 80 CCD 1. Okay, so always first preference should be given to 80 CCD 1B, second preference should be given to 80 CCD subsection 1. In 80 CCD subsection 1, you have to see whether the employee is actually an employee or self-employed. For employee, the maximum deduction is 10% of salary, and here also salary means basic plus DA terms, and for self-employed person, the maximum is 20% of gross total income. So 20% of gross total income can be claimed as deduction. Sir, why are you telling first preference should go to 1B and second preference only to subsection 1? Because in earlier I taught section 80 CCE. There you would see 80C plus 80 CCC plus 80 CCD subsection 1. All the 3 sections put together, 1,50,000 only can be claimed. That is why have this 80 CCD 1 as a last preference, so that you can claim as much deduction as possible. First, always try to use the 80 CCD 1B limit of 50,000. Whatever balance amount is there only, you bring it to 80 CCD subsection 1. So I have given it here also. In your book also you can take a note down. You can pause the video and take a note what I have written on the screen. So you will be even more clear. Now let us come to the exemptions related to NPS. First let us cover the upper provisions. 80 CCE limit does not apply to 1B and 80 CCD 2. This I have already taken. Then transfer of balance in the recognized provident fund and superannuation fund can be transferred to NPS fully exempt. So whatever balance is there in RPF, that is recognized provident fund, and also superannuation fund, you can transfer to NPS. The transfer will be fully exempt. Now let us talk about exemption related to the national pension scheme. First, 10 clause 12A. 10 clause 12A tells that any amount received on closure or opting out of the NPS is exempt up to 60% of the total amount. So whatever amount is you are withdrawing on the closure, 60% will be exempt, 40% will be taxable. However, if amount is received on death, it will be fully exempt. Now let's talk about partial withdrawal, section 10 clause 12B. If at all there is a partial withdrawal from the pension scheme, then up to 25% of the contribution made by the employee will be exempt, and this 10-12B exemption can only be claimed by employees. It cannot be claimed by self-employed people. So that also you have to keep in mind. Then now new section has come, that is section 10-12BA, which talks about NPS Vatsalya scheme. So in NPS Vatsalya scheme also, if at all a person is making partial withdrawal, then up to 25% of the contribution made will be exempt, and if at all any amount is withdrawn on death, then the entire amount will be exempt. Fine. So these are the exemptions. Now let us talk about section 80D, which talks about mediclaim, preventive health checkup and medical expenditure. Who can claim this deduction, sir? Individual and HUF both can claim the deduction. For whom you can claim the deduction? For whom can you invest? So the individual or HUF can invest for self also, family member also. Who is family member? Self, spouse, dependent children and parents. Self, spouse, dependent children, parents. See Kanna, here parents are not dependent. Parents are not dependent. Only children should be dependent on the assessee. So self, spouse, dependent children and parents are covered in 80D, and in case of HUF, members are the relatives. So now let us talk about the maximum limit to claim the deduction. Firstly, let us talk about self, spouse, dependent children. So there are two limits for individual. One limit is for self plus spouse plus dependent children, and second limit is for parents. So both are separate limits. You should not see together. Fine. For self, spouse, dependent children, maximum investment that can be made in medical insurance premium is 25,000. So how much ever investment you make, maximum 25,000 can only be claimed as deduction. And for self, spouse, dependent children, the individual can also invest in central government health scheme or contributory health service scheme. This is also allowed. But for parents, no, it is not allowed. For HUF also, it is not allowed. Only for self, spouse, dependent children, this central government health scheme and contributory health service scheme is allowed as deduction. Fine. Now, for parents, let us see. For parents also, you can pay medical insurance premium, that is Mediclaim or health insurance, whatever you can call it, up to 25,000 you can claim as deduction. Now, there is an extra deduction of 25,000 allowed if any one of the person is a senior citizen. So in parents, any one parent, if he or she is a senior citizen, then instead of 25,000, you get extra 25,000. So up to 50,000 deduction can be claimed. Similarly, in self, spouse, dependent children also, if any one person also becomes 60 years of age, then instead of 25,000, extra 25,000 you get. So that is why maximum 50,000 can be claimed as deduction. Maximum 50,000. Moreover, if at all the person is a senior citizen, and for senior citizen you are not able to get any medical insurance at all. Sometimes for senior citizen the insurance company itself will not give policy. In such case, what to do? If medical insurance premium is not there, then you can spend on medical expense as well. Medical expense also can be claimed as deduction, and here also the limit is 50,000. But this 50,000 limit is there. No, it is not an extra limit, Kanna. It is included in the above limit only. So either you claim 25,000 plus 25,000, 50,000 in medical insurance premium, or you claim medical expense. So it is not 50 plus 51 lakh, it is total 50 only. However, for individual spouse and dependent children, the limit is 50,000. For parents, the limit is 50,000 in case of senior citizen. So highest deduction that can be claimed under this section is 1 lakh rupees. So highest, how much you can claim? 1 lakh rupee highest. Now let's talk about preventive health checkup. Preventive health checkup also can be claimed as deduction up to 5,000 rupees. But this 5,000, no, it is not a separate limit. It is included in this 25,000 or 50,000 limit. It is not a separate limit. So 5,000 you can claim as deduction. And what is special about this preventive health checkup? No, we are going to learn that medical insurance can be paid in any mode other than cash. Okay, if you are paying medical insurance premium in cash, it is not allowed as deduction, but any mode other than cash allowed as deduction. However, in case of preventive health checkup, you can pay through cash also. So even cash is allowed as deduction in case of preventive health checkup. Fine, are you clear? Now let's talk about HUF. So HUF can claim a Mediclaim for members as deduction, maximum 25,000. If any one person is a senior citizen, maximum 50,000. And if a Mediclaim insurance is not available, then medical expense also up to 50,000 will be allowed as deduction. Same concept. Now let's talk about lump sum premium. If at all there is lump sum premium, that means what? Instead of 1 year, Mediclaim has been paid for 3 years or 4 years. In such case, what to do? Then you have to take the proportionate deduction. How to find out the proportion, sir? To find out proportion, do this formula. Lump sum premium, calculate using this formula. Lump sum premium divided by the year of payment plus all the subsequent years in which the insurance policy is in force. Fine. So use this formula. Now, Kanna, one small thing related to examination, I want to tell you that in the entire deduction chapter, no, in many sections you will be seeing payment restriction. Payment restriction. All these sections say that the payment restriction is any mode other than cash. You can invest in any mode other than cash. Like how you saw here, no, any mode other than cash. But there is only one section which has some different wordings. That is section 80JJAA. 80JJAA tells that you have to invest in prescribed modes of payment only. That is account pay check, account pay bank draft, electronic clearing system, okay, and other prescribed modes, UPI, NEFT, RTGS, credit card, debit card, etc. So that is only allowed under 80JJAA. But all the other sections, for example, 80D, 80G also you will be seeing, 80GG also you will be seeing this payment restriction. Everywhere you will find the wordings other than cash, other than cash. So if I pay any medical insurance premium using bearer check, is it allowed? Answer is yes, you can claim the deduction because it is any mode other than cash. But if you pay using bearer check in 80JJAA, can you claim the deduction? Answer is no, because in 80JJAA only account pay check should be there. Now you understood the difference. Let us continue. Let us learn 80CCH, contribution to Agnipath scheme. What is the Agnipath scheme? Agnipath scheme is where the central government is recruiting for their armed forces. When they are recruiting, no, in the initial 4 years, what will the government do? 30% of the salary is contributed to Agniveer Corpus Fund. Central government also will contribute, the employee also will contribute. After 4 years, the employee can withdraw this amount from the Agnivir Corpus Fund and use it for himself. So this 30% of salary for employer contribution, that is allowed as deduction in both old scheme as well as new scheme. So when it comes to employer contribution, what you are going to do, first you have to add it to the salary head of income, then you can claim it as deduction. But now let's talk about employee contribution. Employee contribution is only allowed under the optional tax regime. It is not allowed under default tax regime. And employee contribution also you can claim it as deduction, and here there is no maximum limit kana. Whatever is that contribution can be claimed as deduction. Fine. Then section 1012C, there is an exemption also. What is the exemption? Whatever is the amount received from Agnivir Corpus Fund is fully exempt. In class we had a detailed discussion about this Agnipath scheme, but now definitely time is not sufficient. So let us move on to the next section, that is section 80DD. 80DD speaks about medical treatment of disabled dependent relative. So who is eligible? Resident individual HUF is eligible, but not for themselves. They are eligible if they are having any relative who is dependent on them. So relative who is dependent on them. What is the meaning of relative kana? Relative means spouse, children, parents, brothers or sisters. Spouse, children, parents, brothers or sisters, and in case of HUF it means members. So all these spouse, children, parents, brother, sister, for whomever the deduction is being claimed should be the relative of the assessee and also should be dependent on the assessee. So there is the condition. What is the condition to claim the deduction, sir? The condition to claim the deduction is that either medical expenditure should be incurred on the treatment of the dependent relative or deposit any amount for maintenance of such dependent relative with any insurance company, etc., and then furnish a copy of the medical certificate. Fine. So either you incur medical expenditure or you take a policy where they are the beneficiary. Okay, and in that policy you have to pay the premium. Now what is the deduction that is allowed? Maximum deduction that can be claimed, and here it is a flat deduction karna. Here it is a flat deduction. It is 75,000 in case of normal disability and 1,25,000 in case of severe disability. Sir, what is severe disability? Severe disability means 80% or more disability, or you can say 80% or more organ damage. So that is also severe. So in case of severe disability, 125 can be claimed, 1,25,000, and in case of normal disability, maximum 75,000 can be claimed as deduction. And here it is a flat deduction. It means what? It does not matter how much money you are depositing. It does not matter how much expenditure you are incurring for medical purpose. That and all you keep it aside. How much you can claim as deduction? Flat 75 or flat 1,25,000. Fine. Then the next provision, you can read it on your end. From examination point of view, not that important, but still have a reading so that if at all it comes, you will be able to attend. Now let's discuss section 80 DDB. Deduction for medical treatment of specified diseases. Medical treatment of specified diseases. Who is eligible? Resident individual or HUF is eligible. Now who is relative? For self also, for relatives also. Who is relative? Relative is same as 80 DD, which means spouse, children, parents, brother, sister, all of whom are dependent on the assessee, that is individual. How much deduction can be claimed? Actual expense for medical treatment of specified disease up to 40,000 per month, or 40,000 or 1 lakh rupees as the case may be, can be claimed. So for specified diseases, if you are incurring medical expenditure, that medical expenditure you can claim as deduction. Fine. How much you can claim? In case of normal person, maximum 40,000 you can claim, and in case of senior citizen, up to 1 lakh rupees you can claim as deduction. Okay, in case of what? In case of specified disease. Specified disease means what? It will be given in the question karna that it is a specified disease. And also, if at all insurance claim is received, or any employer reimbursement is received, that has to be reduced, and balance amount only can be claimed as deduction. Fine. Next, section 80U, deduction for person with disability. Kana, first we had discussed the section number 80DD. There also we discussed about disability. That was disability of a relative, but not for self. Then for self, where to go? You have to go to section 80U. So 80U discusses about person with disability, where resident individual will claim the amount for himself or herself. Fine. Here also same, flat 75,000 or flat 1,25,000 allowed as deduction. 75,000 normal disability, 1,25,000 is severe disability. What is the condition? Medical prescription is compulsory. This disability is given in Person with Disability Equal Opportunities Protection of Right and Full Participation Act of 1995. If it comes in examination, they will tell you that it is a disability which is prescribed under section 80U. So after that you will get to know. Fine. Now let us discuss one point from the examination point of view. Kana, dependent word, you will find it only in the relative definition of 80D series. So D series you can call it as dependent series. In 80D also you will find dependent. Find dependent children. Then in 80DD also it talks about the relatives who are dependent on the assessee, and 80 DDB also talks about relatives who are dependent on the assessee. But in all the other sections, wherever there is a meaning of family given in the section, their dependent word will not be used. Okay, only in these three sections dependent word is used. So I hope it helps for the examination purpose. Now let's come to section 80E. Section 80E talks about interest on loan which is taken for higher education. So who is eligible? Individual is eligible. What are the conditions? The loan should be taken for higher education. Higher education means after class 12, that is graduation or post graduation. Loan should be taken from financial institution or charitable organization which is referred under 80G. Then loan can be for self also, it can be for spouse, it can be for children, or it can be for any student for whom the assessee is a guardian. So for all these persons, assessee can take a education loan. On this education loan, the interest is allowed as deduction. Sir, how much interest can be claimed? Entire interest can be claimed, there is no limit. However, there is a time period limit. Up to 8 years only you can claim this deduction. After 8 years, if at all you still continue to pay the interest, that is not allowed as deduction. So maximum 8 years or the year till which the interest is paid, whichever is earlier. Now let's talk about section 80E, interest on loan for acquisition of residential house. So who is eligible? Individual is eligible. What are the conditions? Loan should be taken for acquisition of residential house. So purchase of residential house. Then loan should be taken from a financial institution or a housing finance company. Then third condition, the value of loan should be maximum 35 lakh rupees. Fourth condition, value of house should be maximum 50 lakh rupees. Fifth condition, loan should have been taken between 1/4/2016 to 31/3/2017. So in the question, if you find out that a person has taken a housing loan between 1/4/16 and 31/3/17, you should understand that 80EE is triggered. Okay, sir, should I remember this date also? Yes, you have to remember the dates. Fine, only then you will be able to answer in the question. Then another condition is that assessee should not own any other house before the sanction of the loan. So only if all these conditions are satisfied, deduction can be claimed on interest on housing loan. But sir, interest on housing loan is already allowed as deduction under house property chapter, correct? Yes, Kana, in house property also you claim as deduction. After claiming in house property chapter, even after that if there is any scope left, that amount you can claim under section 80EE. So it is over and above the interest allowed in house property chapter. Maximum how much you can claim? Maximum 50,000. So for self-occupied property, in the old tax regime, you can claim in house property chapter up to 2 lakhs. Whatever interest is above 2 lakhs, no, that you claim under section 80EE. Fine. Then what is the time period? Till the repayment continues, you can keep on claiming the interest as deduction. Now let's talk about section 80EA. Kana, 80EA also talks about interest on loan for acquisition of residential house. But sir, 80EE also you told same purpose. Yes, Kana, but there is a big difference. The difference is that 80EE is only for the loan sanctioned between 1/4/16 to 31/3/17, and 80EA talks about the loan sanctioned between 1/4/2019 to 31/3/2022. So if any loan is taken between this period, then you should know that 80EA is applicable. So here what are the conditions? Let us see. Who is eligible? Individual is eligible. So this is the same between both the sections. Then loan should be for acquisition of residential property. This condition is also same. Then next condition, loan should be taken from financial institution or housing finance company. This condition is also same as the before section. Next one, stamp duty value of the house should be up to 45 lakhs. So this condition is different. Earlier what did we see? Value of house should be up to 50 lakhs. But here we are seeing that stamp duty value should be up to 45 lakhs. So that is different. Then loan sanctioning date is also different. Loan should be sanctioned between 1/4/2019 and 31/3/2022. And then lastly, here also the same condition is there. Assessee should not own any other house property before sanction of this loan. Here the deduction up to 1,50,000 can be claimed. Earlier it was 50,000, then it became 1,50,000 for section 80EA. Fine. This is also over and above the interest on house property which you are claiming under house property head of income. Now let's talk about section 80EEB, which talks about interest for acquisition of electric vehicle. So if you are purchasing electric vehicle, if you are using the vehicle in the business, then interest on that loan you will claim under PGBP head of income. Up to put to use, you will add it to the depreciable asset cost. After put to use, you will claim as deduction under PGBP head of income. But what if you do not use the electric vehicle for your business? In that case, you can use it. You can claim the deduction under section 80EEB. So who is eligible? Individual is eligible. What are the conditions? You should take a loan for acquisition of electric vehicle. Loan should be taken from a financial institution, and loan should be taken between 1/4/2019 to 31/3/2023. So from 1/4/19 to 31/3/2023. Sir, should I remember the dates? Yes, Kanna, you have to remember the dates. Then deduction up to 1,50,000 maximum interest can be claimed as deduction. Till when can you claim? Till the repayment continues, you can claim as deduction. Fine. Now let us talk about section 80G. Very important section karna. It talks about donation. So whatever donation is made by SSC can be claimed as deduction. And here it is not only applicable to individual HUF. 80G is applicable to partnership firm, company, AOP, BOI. For everyone it is applicable. So all the SSCs can claim the deduction under section 80G. Now in 80G no karna, there are 4 categories of donation. First is 100% unlimited category, then 50% unlimited category, then 100% limited category, and 50% limited category. So 100% unlimited, 50% unlimited, 100% limited, 50% limited. First, let me tell you about all the funds that are coming under 100% unlimited category. Here I have given you some keywords, that is PM, CM, National, State, Army, Clean Ganga, Swachh Bharat, Zilla, and LG. If you find any of these words, any of these keywords in the name, then you should identify that it is coming under 100% unlimited category. 100% unlimited category. So like PM National Relief Fund, Armenia Earthquake Relief Fund, PM CARES Fund, CM Earthquake Relief Fund, CM Relief Fund, LG Relief Fund, National Defense Fund, National Children Fund, National Foundation for Communal Harmony. So all these names are there. Please go through all these names. Sir, should I memorize all these names? No, Kanna. You read the list 4 times, 5 times. So you will be able to identify in the examination. Don't worry. Now let's talk about 50% deduction unlimited category. 50% deduction unlimited category, there is only one fund, that is PM Drought Relief Fund. PM Drought Relief Fund. So this alone you remember, because when you see the PM, you should not be confused between 100 and 50. PM Drought Relief Fund will come under 50%. All other PM related funds will come under 100% category. Now what is special about this unlimited? What is unlimited? Unlimited means whatever amount of donation has been made by the assessee, there is no limit on the donation. Entire amount can be claimed as deduction if it is made in category 1. Then in category 2, whatever amount has been invested by the assessee or donated by the assessee, 50% of that entire amount can be claimed as deduction if it is to PM Drought Relief Fund. For example, if in PM Drought Relief Fund I am donating 1 crore rupees, I can claim 50%, that is 50 lakh rupees as deduction. There is no limit. But when you come to the 3rd and 4th category, there is a limit to donation. What is the limit, sir? The limit is 10% of ATI, that is adjusted total income. So maximum donation for both the category combined is 10% of ATI. 10% of ATI. So first let us see what are the funds in this category. In 100% limited category, there are 2 keywords to remember. One is family, second is Olympics. So first fund is government or approved local authority for promotion of family planning, and second fund is Indian Olympic Association or any other notified association for development of infrastructure, sponsorship or sports. And then now let's talk about 50% limited category. In 50% limited category, the keyword is charity, temple, housing, minority. Charity, temple, housing, minority. So what are the funds? Any fund established in India for charitable purpose, government or local authority for utilization for charitable purpose, then any authority for housing accommodation or planning or development of city, towns and villages, then central government, state government, corporation for promoting the interest of minority community, and then last one for renovation or repair of notified temple, mosque, gurudwara, church or other place of historic or archaeological importance or artistic importance or renowned place of public worship. So all these are covered under 50% limited category. So what did I say? For 3rd category and 4th category, both of them put together, maximum donation is 10% of adjusted total income. So now what is adjusted total income, sir? Adjusted total income means gross total income minus chapter 6A deductions other than ATG minus income under section 111A, 112 and 112A. So what you should do, take the gross total income. From the gross total income, you reduce all the deductions other than ATG deduction, and you also reduce all the special rate income. So this only will be adjusted total income. So maximum deduction is equal to 10% of adjusted total income. 10%. Now listen Kanna, here only students will make silly mistake. So 10% is not the limit for deduction, it is the limit for donation. Now if entire donation limit is there, so you have to give preference. First preference should be given to 100% category, second preference should be given to 50% category. Let me give you an example. Let's say total donation that a person has made in 100% category is 5 lakhs, 50% category also 5 lakhs. So maximum 10 lakhs donation has been made by the assessee. Now while calculating the qualifying limit in the examination, let's say you got the limit as 8 lakh rupees. So how much donation was made? 10 lakhs. But how much qualifying limit is there? 8 lakhs. that is 10% of ATI. So this 8 lakhs only maximum is the donation allowed. So what you have to do, first preference you will give to 100% category, so that 5 lakhs into 100% entire amount you can claim as deduction. Then second preference you have to give to 50% category. So how much amount is left? 3 lakhs only you can claim as donation. Out of this donation, 50% only can be claimed as deduction, which becomes 1,50,000. So maximum deduction is 6,50,000. You get my point? Like this you have to do the ranking. First ranking give to 100% category, second ranking you give to 50% category. Now let us talk about total deduction. So total deduction is what? Limited category plus donation of 100% unlimited category plus 50% of 50% limited category, that is PM Drought Relief Fund. No deduction is allowed if the donation above 2,000 rupees is in cash. So if donation is to be made in cash, maximum 2,000 can be claimed as deduction, and if it is more than 2,000, it should be in any mode other than cash. This I already told you. Then no deduction if donation is given in kind. For example, I went to temple and the charitable organization, instead of giving cash, I gave one gold coin or gold chain. Can I claim deduction? Answer is no, I cannot claim deduction. Fine. So these are all the provisions for section 80G. Very, very important. Go through once again. One question is there in your study material for 80G. Beautiful question. Solve that question also. You will be thorough with this adjusted total income concept, ranking and everything. Fine. Now let us talk about section 80GG. Rent paid and HRA not received. So if an employee is receiving house rent allowance, the employee will claim the house rent allowance as exemption under salary head of income. But if the employee is not receiving house rent allowance, or let's say some other person who is not even having any employer, both categories can claim deduction under 80GG. So what are the conditions? The condition is that there should not be any receipt of HRA from the employer. Second condition, they should be staying in the accommodation for their own residence. Third condition, assessee, spouse, minor child or HUF should not own any other accommodation at the same place where the individual is residing. So he must stay at a rented place, and in the same city, he or his relatives both should not be having any other house. Then the assessee should file a declaration of the above details along with return of income. Now in this section, how much maximum deduction can be claimed, sir? So deduction should be the lower of number 1, actual rent minus 10% of total income. Actual rent minus 10% of total income, or 25% of total income, or 5,000 rupees per month, whichever is lower. In HRA, what were the limits? In HRA, what were the limits? Here you had actual rent minus 10% of salary, where salary was basic plus DA terms plus commission turnover. Then in HRA, what was the second limit? It was actual HRA received. Actual HRA received. And in HRA, the third condition was 40% or 50% of salary. 40% if non-metro city, 50% means metro city being Delhi, Mumbai, Kolkata and Chennai. So these were the limits of HRA. But in 80GG, what is the limit? Actual rent minus 10% of total income. Here total income will not include 80GG deduction because that only you are finding out. Then 25% of total income, or 5,000 rupees per month, whichever is lower. Fine. So you should know both the provisions thoroughly. Then section 80GGA. 80GGA talks about donation for scientific research and rural development. Scientific research and rural development. Karna, scientific research and rural development deduction can be claimed under PGBP. But if the person is not at all having PGBP income, in such case, whatever contribution is made can be claimed as deduction under section 80GGA. So who is eligible? Any assessee not having any income under PGBP and makes donation for scientific research and rural development. So what are the conditions? The donation should be given to scientific, social statistical research to organization approved under section 35. So this contribution is same as the contribution that you learned under section 35. The only difference is that 35 is PGBP head of income and 80GGA is for not having PGBP head of income. Then donation for rural development to any organization approved under section 35 CCA is also allowed as deduction. Here also up to 2,000 can be donated in cash. Above 2,000 should be donated in any mode other than cash. Any mode other than cash. Now let's talk about section 80GGB. 80GGB talks about donation to political party. So if donation is made to political party, only Indian company can claim deduction under 80GGB. Sir, what about other than Indian company? Other than Indian company can claim under 80GGC. Okay, so for them also it is allowed, don't worry. How much can be claimed as deduction, Kana? Entire amount which is donated to political party can be claimed as deduction. So entire amount claimed as deduction, but there is only one condition, that the donation should be made in any mode other than cash. So cash donation not allowed, other than cash allowed as deduction. Now let's talk about section 80 GGC. So this is also for donation to political party. Here who can claim deduction? Assessee other than Indian company, local authority or artificial juridical person funded by government. So local authority cannot donate to political party and artificial juridical person which is funded by the government itself cannot donate to political party. Even if they donate, they cannot claim the deduction. Fine. So here also entire amount is allowed as deduction, subject to the condition that the donation should be made in any mode other than cash. Any mode other than cash. Now let's talk about certain income based deduction. Section 80JJAA. 80JJAA talks about deduction for employment of new employees. And the special thing about this deduction is that this deduction is allowed under the old tax regime also and the default tax regime also. Both regime you can claim the deduction. Now who is eligible, sir? Only a person to whom 44AB, that is tax audit, is applicable. Only they can claim the deduction under section 80JJAA. Other assessees cannot claim. What is the deduction? 30% of the additional employee cost during the previous year for 3 consecutive years can be claimed as deduction. So listen Kanna. If I am having a new business, then in the new business, whatever is the additional employee cost. So in new business, all my employees are going to be additional employees only because all are new employees. For all the new employees, whatever salary I am paying, 30% of that salary I can claim in first year, 30% I will claim in second year and 30% I will claim in third year. So like this 90% you can claim in year 1, year 2 and year 3. Fine. What if my business is an existing business? If an existing business, I have to see what is the addition in the number of employees. What is meant by addition in number of employees? I should see how many employees joined minus how many employees left the organization. This will give me addition in number of employees. So for all the additional employees, how much salary I am paying, I should see that salary into 30% for 3 years I can claim the deduction. And this is not a one-time deduction, Kanna. Every year you can keep on claiming this deduction. So it is a huge benefit given to the assessee. So what is this additional employee cost? Additional employee cost means total salary or emoluments. In this section, the salary is called emoluments, total emoluments paid or payable to the additional employees. So emolument means what? Emolument means the entire salary, but this salary should not include employer contribution to provident fund, pension fund or any other fund for the benefit of employees. So whatever contribution is made to the funds, that should not be calculated in salary. Next, gratuity, severance pay, leave encashment, VRS, commuted pension and any other lump sum payment on retirement or termination also not included in salary. So whatever amount is paid as retirement benefits, that also should not be included. And thirdly, any payment made through any mode other than account pay check, account pay bank draft or electronic clearing system or any other prescribed mode should not be included in salary. So whatever salary is paid to the employees, that has to be paid through prescribed mode of payment. It means through account pay check, account pay bank draft, electronic clearing system or other prescribed mode, that is NEFT, RTGS, IMPS, net banking, credit card, debit card, UPI and Bhim Aadhaar Pay. So all these are the prescribed modes. Only through these modes you can pay to the employees. Fine. So what did I say? Entire salary you have to take, but don't take the employer contribution, don't take the retirement benefits, and if any payment is made in other than prescribed mode, that also you should not take. Balance amount you have to take as salary. Now, what is this additional employee, sir? Additional employee, I already told you, in case of new business, all the employees are the additional employees, and in a case of existing business, increase in the number of employees is only called additional employees. However, you have to make sure that this new business should not be by splitting up or reconstruction of an existing business or transfer of a business or business reorganization. Sir, I am having old business. That old business itself I changed the name and I am calling it a new business. Does it mean it is a new business? Answer is no. Hence, I should not call it a new business. New business means it should be genuinely new business. Fine. Then additional employee, who and all are not counted as additional employee. Let us see. Firstly, employee whose emolument is greater than 25,000. So in this section, only such employees are covered for whom the salary should be maximum 25,000 rupees per month. If the salary is more than 25,000 rupees per month, then the government is not going to give you deduction. Fine. Next, employees employed for less than 240 days. So if employees is serving in the organization for less than 240 days, for such employees you cannot claim the deduction. But this 240 days becomes 150 in case of manufacture of apparel, footwear or leather product industry. So if the assessee is engaged in manufacturing of apparel, footwear or leather products, for the employees you see 150 days instead of 240 days. So if the employee is working more than 240, then only that employee will be considered as new. Kanna, what if the employee is new employee who has joined in the end of the year? Then what to do? If the employee has joined in the end of the year, obviously they will be employed for less than 240 days. Then you can consider them as new employee in the next year if in next year they are serving for more than 240 days. Fine. Next, employee not participating in recognized provident fund. So it is compulsory that the employee should be registered in recognized provident fund. Only for such employee you can claim the deduction. If they are not there in recognized provident fund, you cannot claim deduction. And then lastly, employees for whom the contribution is paid by the government as per the EPF and Miscellaneous Provision Act of 1952. Basically, it means that if government employees are there, then no deduction is allowed. Why, sir? Because government does not want any deduction. That is why for government employees there is no deduction. So these are the additional employee. And last condition is that deduction is allowed only for books of accounts which are audited, and report of chartered accountant should be submitted within 1 month prior to the due date of filing return of income under section 139 subsection 1. So these are all the conditions. So theoretically only it is, you have to remember all these points. Practically, if you are solving the question, if you know the theory, it is very easy to solve. So go through these provisions 2 or 3 times, you will be able to remember. Let me brush up once again. Who is eligible, sir? A person who is engaged in tax audit or subject to tax audit is eligible. What can he claim? 30% of the salary which is paid to additional employees he can claim as deduction. For 3 consecutive years. First year 30%, second year 30%, third year 30%. Sir, who is additional employee? In case of new business, all the employees, and in case of existing business, only increase in the number of employees are additional employees. Moreover, additional employee should not include any employee whose salary is greater than 25,000. Additional employee does not include any employee who has worked for less than 240 days or 150 days. It does not include any employee who is not there in recognized provident fund. It does not include any employee for whom government is paying the provident fund. So all these employees are not included. Then what is salary? Salary means entire salary which is given, but you should not include any employer contribution to funds. You should not include any retirement benefit which is given to employees, and also you should not include any amount which is paid through other than prescribed modes. So that also should not be included. So I hope you are clear with the provision. Now let us talk about section 80 QQB, royalty or copyright fees on books of literary, artistic or scientific nature. So who is eligible, sir? Resident individual is eligible. So if royalty is received, no, in the examination you should know that first you add royalty to the income in income from other sources. Royalty is always taxable in income from other sources. So after adding it, whatever amount of royalty is there, that you can claim as deduction under section 80 QQB or 80 RRB as the case may be, up to 3 lakh rupees. So maximum 3 lakhs deduction. Here what is eligible royalty, sir? Eligible royalty up to 3 lakh is allowed as deduction. Eligible royalty means in case of lump sum royalty, whatever amount is received, that is the eligible royalty. And in case of other than lump sum royalty, 15% of the value of the book sold will be called as eligible royalty. However, if royalty is earned from outside India, then foreign exchange should come to India within 6 months from the end of the previous year. If it does not come to India within the time limit, then that is not eligible royalty. However, the assessee can ask some permission for extension from RBI. In such case, RBI can extend this time limit also. Fine. Then section 80 RRB speaks about royalty from patent. Who is eligible? Here also resident individual is eligible. So royalty up to 3 lakhs is allowed as deduction. Here also, if royalty is from outside India, it should come within 6 months from the end of previous year or time allowed by RBI, whichever is later. And in case of patent, royalty does not include sale of product manufactured with the use of the patented process. Now let's talk about other income based deduction. So first deduction is section 80 TTA. 80 TTA talks about interest on saving account. So if an individual or HUF is having a saving account in bank or cooperative bank or post office, then up to 10,000 rupees can be claimed as deduction. So whatever interest is earned, that first you put in income from other sources, then up to 10,000 rupees you can claim as deduction under chapter 6A. Fine. But let me tell you one special fact about post office interest. If an interest is earned on post office saving bank account, then we will learn in income from other sources chapter that up to 3,500 is exempt. That is why for post office interest, first you provide exemption while calculating the income from other sources itself. Okay. Reduce 3,500, balance amount only will be taxable under IFOS. Out of this amount, you can claim 10,000 as deduction under section 80 TTA. Fine. 80 TTA, however, is not allowed for any person for whom 80 TTB is allowed. Now, what is this 80 TTB? 80 TTB is the interest on deposit for senior citizen. Senior citizen means a person whose age is 60 years or more at any time during the previous year, and the person should also be resident. So, for resident senior citizen, they can claim the interest as deduction under 80 TTB up to 50,000 rupees. So 80 TTA maximum deduction how much? 10,000 is only allowed. But in 80 TTB how much is allowed? 50,000 rupees is allowed as deduction. Moreover, in 80 TTA only saving bank interest is allowed as deduction. But in 80 TTB not only saving bank interest, Time deposit interest is also allowed as deduction. So saving bank interest, fixed deposit interest, recurring deposit interest, all the interest put together allowed as deduction up to 50,000 rupees for resident senior citizen under section 80 TTB. And here also, if the senior citizen is earning post office interest, then first you claim the exemption of 3,500 rupees. On the balance amount only you can claim deduction of 50,000 rupees. So deductions are over for chapter 6A. Now let us jump to section 10AA, deduction for unit established in special economic zone. Who is eligible, sir? Any entrepreneur as per section 2J of SEZ Act is eligible. Letters of approval should be issued up to 31/3/2020. Manufacturing, production or provision of service should begin up to 31/3/2021. So maximum if the assessee is beginning the manufacture, production or provision up to 31/3/2021, only then they are eligible. Okay, but sir, now we are in 26. Why are we learning this deduction now? Kanna, because in 21, who would have been eligible is eligible to claim this deduction for 15 years. 15 years. So since they had claimed, they had started before 31/3/2021, even now they might be taking the deduction. That is why you should be thorough with the deduction, because here chartered accountant has to give report. So chartered accountant should know about the deduction. Fine. The unit shall not be by splitting up or reconstruction of an existing business. Investment in plant and machinery shall only be in new plant and machinery. So all these conditions are there to be eligible for this special economic zone deduction. Sir, for special economic zone, what is the deduction, sir? Export profit can be claimed as deduction. For first 5 years, 100% of export profit is allowed as deduction. For next 5 years, that is from year 6 to year 10, 50% of export profit is allowed as deduction. And for further 5 years, that is from year 11 to year 15, you can claim amount transferred to SEZ reinvestment reserve or 50%, whichever is lower, as deduction. So it means what this 50% is there, no, it has to be transferred to SEZ reinvestment reserve account. Only if you are transferring to this account, you can claim the deduction of 50%. So first year 100%, second year 50%, and third year 50% subject to condition that it should be transferred to SEZ reinvestment reserve account. Now what is this export profit, sir? Export profit means PGBP income of the SEZ unit multiplied by export turnover of SEZ unit divided by total turnover of SEZ unit. So you have to see all the figures only related to the SEZ unit. You should not see any other unit. So if at all in the question you are getting the figures of the entire company, then what you have to do? You have to remove the figures from domestic tariff area so that you get the SEZ area. Now sir, what is this domestic tariff area? Domestic tariff area or DTA is the area in India other than special economic zone area. Okay, so for example, if there is a district, in the district one area will be marked as special economic zone. Balance area of this district only will be called as domestic tariff area. So what you have to do, let's say one company is having a branch in domestic tariff area also, the company is having a branch in SEZ also. So for the entire company, the question will give you the figures. Domestic tariff area also company will give you the figures. So total company figures minus domestic tariff figures will give you the special economic zone figure. Special economic zone PGBP income multiplied by export turnover of SEZ unit divided by total turnover of SEZ unit will give you export profit. Export profit. This export profit only you can claim as deduction. Fine. Now let us see some points about the calculation. In export profit, you have to consider only the consideration that is received in convertible foreign exchange brought into India within 6 months from the end of the previous year or time allowed by RBI, whichever is later. So this is same as 80 QQB, 80 RRB we learned. No, same condition here also. Export turnover also includes consideration received in separate account approved by RBI outside India. So you can take RBI permission to open a separate account outside India. In that account also, if you are receiving, it is also calculated in SEZ export turnover. Then even on-site development of computer software or service is considered as export turnover. Then both export turnover and total turnover does not include. So if you are getting these three items in the question, you should remove them from export turnover also. You should remove them from total turnover also. So what are they? Freight, telecom and insurance to deliver or render the goods or service outside India. Second one is expense in foreign exchange to render the service outside India. And third one, cash compensatory support, duty drawback or profit on sale of imported entitlement. So all these three should be excluded from the export turnover and total turnover. So now you understood the calculation. First 5 years 100%, second 5 years 50%, third 5 years 50% subject to transfer to SEZ reinvestment reserve account. Now let's see other condition. assessee should obtain a CA report, Chartered Accountant report. That report should be furnished within 1 month prior to the due date of filing return of income. Then second condition, assessee should furnish the return of income within due date. So return has to be filed within due date. Then deduction under 10AA can be claimed only up to gross total income minus chapter 6A deduction. So sir, when you are claiming the deduction, if 80C deduction is also there, 10AA deduction is also there, which deduction you should claim first? First you should claim 80C deduction. Then 80 series deduction, that is chapter 6A deduction. Then only you should claim section 10AA deduction. Next, unclaimed deduction cannot be carried forward. If deduction is claimed and no other deduction, if deduction is claimed under 10AA, same amount of deduction cannot be claimed under 35AD, 80IA and 80IB. Entire depreciation is deemed to be allowed, hence WDV will be reduced accordingly. Brought forward loss also has to be set off from the profit of undertaking before the deduction. See, while calculating gross total income itself, you will do all set off and carry forward of losses. After that only you will get gross total income. From this gross total income only you can reduce 10AA deduction. Fine. Now let us talk about further 5 years, that is the SEZ reinvestment reserve account. Kanna, what is this SEZ reinvestment reserve? Listen Kanna, in your balance sheet, there will be general reserve, reserves and surplus. Like this only you should also create one more account in your balance sheet called SEZ reinvestment reserve account. And in this account only, whatever amount is there in your profit, export profit, 50% of that amount should be transferred to this account. Okay, 50% of export profit should be transferred to this account. So this is only SEZ reinvestment reserve account. This 50% is there, which is belonging in this balance sheet. This amount has to be used within 3 years to acquire new plant and machinery. And it should be put to use within 3 years from the previous year of reserve creation. So within 3 years you have to start using the new plant and machinery. Then furnish the particulars of the above with the return of income, and till you buy the new plant and machinery, this amount of export profit is there, you should not use to give dividend. You should not remit the money outside India. You should not create any asset that is outside India. So within 3 years also, when you are having this money, you should not use for these purposes. If at all you are using it for dividend or outside India, then whatever amount you are misutilizing will be deemed as PGBP income after within 3 years. And if amount is not utilized at all after 3 years, then what will happen? Whatever amount is unutilized will also be deemed as PGBP income. Fine. Now let's talk about new plant and machinery. This new plant and machinery is there. If 100% of new plant and machinery contains 20% of second-hand plant and machinery, then also 100% will be considered as new only. So up to 20% can be second-hand, that is not a problem. Moreover, if there is any imported plant and machinery, it will be treated as new if the new plant and machinery was earlier not used in India and depreciation was earlier not claimed. So first time you are bringing some plant and machinery into India, importing it and using it. Even if it is second-hand, still it will be considered as new. So here what did I tell? 20% is allowed second-hand maximum. Moreover, if you are importing second-hand plant and machinery and if you have not used it earlier in India, then also you can consider it as new plant and machinery. So these two conditions you will also see in section 35AD in PGBP chapter. So that you have to link. Same conditions are there also. Then amalgamation and demerger. Kanna, if you claim SEZ deduction, it is allowed for 15 years, correct? Now in between this 15 years, if amalgamation demerger takes place, then what will happen? Then whatever is the new company, they can continue to claim the deduction. Fine. Now let us talk about alternate minimum tax. Alternate minimum tax also only applicable for the old tax regime, not applicable for default tax regime. Alternate minimum tax is given under section 115 JC. First and foremost, it is a non-obstante clause. It means what? It overrides all the other provisions of the Income Tax Act. It is applicable to all assessees except company. So for company, AMT is not applicable. Sir, why sir? For companies, MAT is applicable, Kanna, that is minimum alternate tax. It will be covered in your CA final level. But in your inter level, you are only learning AMT, which is for all the assessee other than company. So if at all AMT becomes applicable, then assessee has to pay AMT on adjusted total income or regular income tax on total income, whichever is higher. So either AMT or regular income tax, whichever is higher. I usually tell to my students, AMT means government is giving you laddu from one hand and taking back that laddu with another hand. So on one hand, they are giving you the benefit of deduction like special economic zone, 80JJAA, QQB, RRB, 35AD. All these deductions are there. But later on what happens? They will put AMT on you and then they will take the benefit back from you. So this is only alternate minimum tax. So you have to pay higher of alternate minimum tax or regular income tax. Then what is the AMT rate? AMT rate is 18.5% of adjusted total income. And if the adjusted total income is more than 50 lakh rupees, surcharge is also applicable. And health and education cess of 4% is also applicable on the entire AMT. So all the other provisions like surcharge, cess, etc. are applicable same as they are applicable to the other tax rates. Fine. Now how to compute this adjusted total income? To find out adjusted total income, first you take what is the total income. In this total income, you add back section 10AA special economic zone deduction, then you add back 80JJAA deduction, 80QQB and 80RRB. Then you also add back section 35AD, that is capital expenditure deduction for specified business. So all these deductions you should add back. But you know what? If you claim 35AD deduction, okay, then you are not claiming depreciation. But if you add back this 3580 deduction, then you should reduce depreciation also. Hence, you reduce depreciation under section 32 for all the assets on which deduction under section 3580 had been claimed. So what you have to do, add back 10AA deduction, add back 80JJAA, add back 80QQB, 80RRB and 35AD. Then reduce the depreciation under section 32. So after doing this adjustment, you will find adjusted total income, and AMT is what? 18.5% of adjusted total income. So on this normal income, you will pay normal tax. Normal tax means what? Old scheme, new scheme, slab rates are there. No, that is normal tax. And on ATI, you have to calculate 18.5%. Now let me give you an example. Let's say in previous year 25-26, the regular income tax came as 50 lakh rupees, but alternate minimum tax came as 75 lakh rupees. So what you have to pay? You have to pay 75 lakh rupees, because whichever is higher only you have to pay, no? Correct? So hence, the assessee will be very, very angry. On one hand, your government is giving me laddu and telling your tax is only 50 lakh rupees. On other hand, they are taking back that laddu and telling that now tax is 75 lakhs, you have to pay minimum 75 lakhs. So assessee will get angry. So the government tells, okay, no problem, that you are paying extra 25 lakh. No, this extra 25 lakhs, you can carry forward for 15 years as AMT credit. AMT credit, fine. And next year, whenever regular income tax is higher, no, that time you can use this credit to pay your income tax. So now let's come to next year. In previous year 26-27, let's say the regular income tax came as 50 lakhs and AMT came as 40 lakhs. Now what to do, sir? Now since regular income tax is higher, we have to pay what? We have to pay regular income tax. Now can I use this entire 25 lakhs to pay this regular income tax of 50? Answer is no. You can't use the entire 25 lakhs. Sir, why sir? Because AMT is the minimum amount that you have to pay. That is why here you will pay 40 lakhs minimum and balance 10 lakhs. No, balance 10 lakhs. You will use your AMT credit. AMT credit. So here this 25 lakhs will reduce to 15 lakhs. 15 lakhs because 10 lakhs you have used as AMT credit. You get my point? Now let us talk about next year. In previous year 27-28, what happened? No, AMT itself not applicable. So regular income tax came as 50 lakhs and AMT is coming as 0 because AMT is not applicable. And let's say the assessee is still in old regime or optional tax regime. Now, since AMT itself not applicable, regular income tax is coming as 50. Now, can I use this 15 lakhs to pay this regular income tax? Answer is yes. If you are in the old regime, you can use. So, you can set off this 15 lakhs, balance 35 lakhs alone, you have to pay in cash. You get my point? So, even if AMT is not there, but if you are having AMT credit, you can use the AMT credit to set off against the regular income tax. Fine. But only in the old tax regime. Karna. If you are going to the new tax regime, no, then you know what will happen? Then this entire 15 lakh rupees will lapse. You can't use it in new tax regime or default tax regime. That is why whenever my client or assessee is asking you or asking me to convert from old tax regime to default tax regime, that time we should advise them that you are having this AMT credit. You please use up this AMT credit first, because it is more beneficial for you. After using this benefit only, later on you convert to the default tax regime. Fine. So now let us see the provisions. AMT credit. If AMT is greater than regular income tax, then the excess amount shall be allowed as AMT credit. It can be carried forward and set off for 15 years time. Set off can be done when regular income tax is greater than AMT, but it is restricted to the excess of regular income tax over AMT. And then finally, no interest is allowed against AMT credit. So government is not going to give you any interest on this credit. Then section 115JE, all the provisions of the act like advance tax, interest, all etc. shall be applicable to AMT as if it is applicable to regular income tax. Then section 115JE, exemption from AMT. So for whom and all this AMT is not applicable? Firstly, assessee who does not claim any deduction under 10AA, 35AD, 80JJAA, 80QQB and 80RRB. So if deductions itself are not claimed, then obviously AMT is not applicable. And then second point, any individual HUF, AOP, BOI or AJP whose adjusted total income is up to 20 lakh rupees. So if adjusted total income is up to 20 lakhs, no AMT applicable. Only if it is more than 20 lakhs, AMT will be applicable. Fine. If assessee is opting out of 115 BSE, then AMT is not applicable and brought forward AMT credit shall lapse. So here one change I want you to make. If assessee opts out of if assessee opts for section 115 BSE, because in 115 BSE only AMT is not applicable. If assessing is opting out of 115 BSE, then AMT credit is applicable. So I want you to make this one change in your book. Okay. Then if AMT is applicable, assessee shall obtain a report from a chartered accountant certifying the computation of AMT and adjusted total income. Fine. So now I hope you're thorough with AMT also. Long discussion, but very important discussion on deduction chapter. Now without further ado, let us begin the revision of TDS, TCS, advance tax and interest provisions. Firstly, let me tell you about the concept of TDS and TCS quickly so that your base is clear and you can fully focus on the provisions. Let us take an example of Mr. Pushpa and Mr. Raj. Let's say Mr. Pushpa is making an interest payment of 1 lakh rupees to Mr. Raj. We will learn in the chapter that interest is also covered under TDS provisions. Hence, while making the payment, tax has to be deducted at source at 10%. So 10% is the TDS rate. So Mr. Pushpa will deduct 10% and balance 90,000 only Mr. Pushpa will pay to Mr. Raj. Now what happens to this 10,000? This 10,000 which Mr. Pushpa has deducted, he has to pay to the government. To pay to the government only, the Mr. Pushpa who is paying the interest will take a number called TAN number, which is nothing but tax deduction and collection account number. Okay, using this TAN number only, he will pay the TDS of 10,000 rupees to the government. Then how will the government know that this 10,000 belongs to Mr. Raj? That is why Mr. Pushpa will file a TDS return using his TAN number. Okay, and here Mr. Pushpa will mention the PAN number of Mr. Raj. Only by using this PAN number, the government will know that the 10,000 rupees belongs to Mr. Raj. So for this, while making the payment of interest, TDS is deducted. So it is compulsory for Mr. Pushpa to take the PAN number from Mr. Raj. It is compulsory. Now, when the government receives this information from Mr. Pushpa, the government will put the information in the 26AS account of Mr. Raj. So TDS deducted by Mr. Pushpa will come here. Now let us take another example. So this TDS is over. Now let me talk about TCS. TCS means tax collected at source. So if a person is selling something, the person will collect the money from the buyer. The seller will also collect some TCS from the buyer. For example, Mr. Raj has purchased a BMW car worth 1 crore from a dealer. Now this dealer will receive this 1 crore from Mr. Raj. In spite of that, other than that, the dealer will also collect a TCS at 1% from Mr. Raj, which is coming as 1 lakh rupees. Now this 1 lakh rupees also, same way, dealer will also get a TAN number, and using the TAN number, dealer will deposit the TCS to the government. And in this TCS to the government, the dealer will mention the PAN number of Mr. Raj. So the government will know that this belongs to Mr. Raj, and the 1 lakh rupee will now come into the 26AS account of Mr. Raj. So this is the concept of TCS. Then what about advance tax? Advance tax means Mr. Raj himself is paying his taxes in advance. That is only called advance tax. That also will come and sit in the 26AS account. Finally, while filing the return of income, Mr. Raj will find out how much tax he has to pay. Let's say he has to pay 3 lakh rupees as tax. So while paying the 3 lakh rupees, he need not pay the entire amount. Instead, he will reduce all the taxes that have already been paid in advance, and balance amount only he has to pay to the government. This is the concept of TDS, TCS and advance tax. So all the three are nothing but taxes which are paid in advance to the government. Now let us start with the TDS provisions. Fine. I hope you are clear with the concept. Correct? TDS is deducted on payment or credit, whichever is earlier. So while making the payment, you should deduct the TDS, or if credit is done earlier, then while credit itself, the payer should deduct the TDS. Then in the following cases, TDS is only deducted on payment basis. So you need not see the credit, only on payment TDS will be deducted. What are the cases? Section 192 salary, then 192A withdrawal from provident fund, then 192B, BA and BB which talks about winnings, then 194 which talks about dividend, then 194DA which talks about sum received from life insurance policy, then 194LA compensation on compulsory acquisition, 194N cash withdrawal and 194P that is TDS by specified bank. So in all these cases, tax is deducted only on payment basis. Now the TDS rates that we are discussing below will be fixed rates kana. So 10% means 10%, 5% means 5%. It will be a fixed rate. However, in two sections alone, that is section 192, which talks about salary, and 194P, which talks about payment by specified bank. In both cases alone, you also have to include surcharge and health and education cess in the TDS. Fine, that I will tell in that time also. Then in all the sections that we are going to discuss below, the payee is a resident or a domestic company. So all these sections are applicable only if the payee, that is the person receiving the payment, is a domestic company or a resident, or else it is not applicable. Fine. However, in case of 192 alone, it applies to both resident as well as non-resident, that is salary TDS. Fine. Then Archie Junior, ACHIJR, I call it as Archie Junior. What is this Archie Junior, sir? Archie Junior means in the 6 sections, that is 194A, 194C, 194H, 194I, 194J and 194R. In all these sections, these 6 sections are not applicable to an individual or HUF whose turnover or gross receipts do not exceed 1 crore or 50 lakhs in the preceding previous year. Fine. So for them, these sections are not applicable. And moreover, when we talk about 194C, then this provision also applies to AOP and BOI, Association of Person and Body of Individual. Then to section 206AA. Section 206AA tells that it is compulsory for the person who is making the payment to get the PAN number of the payee. I gave you this example, no? This Mr. Pushpa is there, no? He should get the PAN number of Mr. Raj, because using the PAN number only the government will know that this income belongs to Mr. Raj. Hence, the PAN number is compulsory. Now what happens if Mr. Raj is not giving the PAN number? If Mr. Raj is not giving the PAN number, then TDS has to be deducted at the rate as per the section or 20%, whichever is higher. So rate as per the section or 20%, whichever is higher. Only in case of 194Q, it will become 5%. So earlier you will see that 194Q, it is 0.1%. If the person is not giving the PAN number, it will become 5%. Other than 194Q, it will be rate as per section or 20%, whichever is higher. Then, sir, what if TDS limit is exceeded? Now in multiple sections, no, I am going to tell you about the limits of TDS. For example, in 192, the limit is basic exemption limit. Then in the next section, it is sometimes 50,000, then 10,000. So all these limits I am going to tell you. Sir, what happens if the amount is within the limit? If the payment is within the limit, then TDS is not applicable. But if the payment is above the limit, so for example, here the limit is 10,000. If the payment is above 10,000, then what will happen? Then on the entire amount, TDS is applicable. Fine. So for example, if the payment is 11,000, then on entire 11,000, you have to multiply the TDS percentage. You get my point? So that is the concept. However, in two sections alone, that is section 194N and 194Q alone, if limit is exceeded, then TDS has to be deducted only on the excess amount. TDS need not be deducted on the limit value. Fine. That we will be discussing in that section. So these are all the concepts which I want you to keep in mind. Now let us discuss the core provisions of TDS chapter. Let us start with section 192, which talks about TDS on salary. So whenever employer is making the payment to the employee, the salary payment, TDS has to be deducted on salary. Sir, on what rate TDS is deducted? TDS is deducted on average rate of tax karna. What is this average rate? You find out what is the total tax for the entire year for that employee, then divided by the total income of the entire year of the employee, multiply by 100. So total tax divided by total income into 100, you will get average rate. And here when you are finding tax, no, I already told you should also include surcharge and health and education cess. Fine. So now this average rate only has to be deducted every year, every month when the payment is made to employee. And here also there is a limit kana, that is basic exemption limit. So if the salary is within basic exemption limit, then no need to deduct the TDS. Now let us see some extra points about this salary TDS. TDS has to be deducted under section 115 BAC unless the employee submits a declaration to opt out of default tax regime. So generally, if the employee is silent, then the employer should deduct the TDS under section 115 BAC, that is default tax regime. But if the employee is telling that no, please deduct for me in the old tax regime or optional tax regime, then employer should deduct under the optional tax regime. Fine. Then employer should also consider the details of other incomes, deductions, TDS and TCS furnished by the employee. So it means what? If the employee is telling, sir, for me already some person has deducted the TDS, so that much amount you don't deduct. Or when I was buying a car, the car dealer has collected TCS from me, so that much amount you don't deduct in my salary. So the employer has to consider it. Moreover, if the employee tells that I am having some other income also, I am having this interest income, I am having this business income, please consider all my incomes and on that income income also you deduct the TDS. Like that, if employee is telling, then employer should consider that also. Moreover, if employee is having a loss, then employer should not consider that loss while deducting the TDS other than house property loss. So if employee is telling that I am having house property loss, then employer should consider, but other than house property loss, the employer should not consider. Fine. Then if tax is paid by the employer on non-monetary perquisites, then the TDS need not be deducted for the same amount. Such tax is treated like a TDS for the employee. Sometime employer will, what they will do, instead of deducting the TDS, they themselves will pay the tax for the employee from their own pocket. That is only tax on behalf of the employee, which is treated as non-monetary perquisites. Now if tax is paid by the employer, then TDS need not be deducted, and the tax which is paid by the employer, it will be treated as TDS for the employee only. Next, if there is more than one employer or if there is change of employer, then furnish the details to the current employer in form 12B. So for example, if the same employee is having two employers, then it is the option of the employee that he can give the detail of one employer to another employer and tell that employer that for both the employers you only deduct the TDS and let the other employer not deduct the TDS. So this is also allowed. And if employer is changing, then old employer detail should be given to the new employer so that the new employer will consider all the facts and then deduct the TDS. Then employer should obtain some proof also from the employee. What proof? First, in case of rent paid more than 1 lakh rupees and HRA is given, then the employer should take landlord name, landlord address and landlord PAN number. Then if leave travel concession is given, evidence of LTC expense has to be taken. Then if in case of interest on housing loan deduction, the employer should collect lender name, lender address and lender PAN number. And then lastly, if the employee is claiming any deduction under chapter 6A, then the employer should collect the evidence of such investment. Fine. So all these points you have to take care while deducting the TDS under 192. I also told you that 192 TDS has to be deducted only on payment basis. Now let us come to section number 192A. 192A talks about withdrawal from provident fund. So if the employee is making any withdrawal from the provident fund, then if the withdrawal is exempt, no need to deduct the TDS. But if the withdrawal is taxable, then TDS has to be deducted at 10%. However, here also the limit is less than 50,000. Kana, you have to be very careful with the limits. Very careful with the limits. The limit is less than 50,000. It means what? If the amount is exactly 50,000, then TDS will be applicable. Fine. So exact 50,000 TDS is applicable. Below 50,000 TDS not applicable. So 50,000 and more TDS is applicable at 10%. Fine. Who will deduct the TDS? The provident fund will deduct the TDS. And here also TDS is deducted on payment basis. Then section 193. 193 talks about interest on securities. Interest on securities up to 10,000 rupees there is a limit, and here see Kana, it is an amendment limit. Earlier it was not 10,000, earlier it was 5,000, now it has become 10,000. Up to 10,000 rupees no TDS. Above 10,000 rupees TDS has to be deducted on the entire value at what percentage? At 10%. So 10% TDS. However, no TDS is applicable in the following cases. Number 1, 7-year NSC, that is National Savings Certificate. Then National Development Bond interest also no TDS. Then 54 EC bonds of PFCL, that is Power Finance Corporation Limited, no TDS. 54 EC bonds of RFCL, that is Railway Finance Corporation Limited, no TDS. Then security of central government or state government. Generally on central government and state government security, TDS will not come, but only on certain bonds TDS is going to come. What are they? 8% saving taxable bond of 2003, 7.75% saving taxable bond of 2018 and floating rate saving taxable bond of 2020. On these three bonds, TDS is applicable. Fine. Then if interest payment is made to Life Insurance Corporation, General Insurance Corporation or any of their subsidiary or any insurance company. So to any insurance company, if interest payment is made, then no need to deduct the TDS. So these are the provisions of 193. Now let us come to section 194. 194 speaks about dividend. Kana. Dividend here includes deemed dividend. So on dividend also TDS has to be deducted, and on deemed dividend also TDS has to be deducted. So this deemed dividend is the dividend from 222A to 222F, which we have discussed in income from other sources chapter. Fine. In dividend, TDS is deducted on payment basis. Payment basis at how much percentage? 10%. And here also what is the limit? Earlier it used to be 5,000, but here also it has been increased to 10,000 rupees. So no TDS is applicable if dividend is paid to an individual in any mode other than cash up to 10,000 rupees. To whom? To individual in any mode other than cash up to 10,000 rupees, no need to deduct TDS. But if it goes more than 10,000, then TDS has to be deducted at 10%. Moreover, if dividend is given to any insurance company, no need to deduct TDS. Then TDS is also required. This I already told you. Now let me tell you about grossing up principle. Grossing up principle, very very important. If you get a total income question, and in the total income question, the examiner is giving you receipts and payments account or cash and bank account. And in this receipts and payment or cash and bank, in the receipt side, if you are finding out any amount on which TDS is applicable, then high chances is that it is a net amount. So on the net amount, to find out the income, you have to do grossing up. Okay. For example, if you find a receipts and payment account, and there you find dividend received as 45,000. Does it mean that the dividend income is 45,000? Answer is no. It just means that the dividend received in the bank account is 45,000. Then what is the dividend income? To find out the dividend income, you have to use this formula. What is the formula? Formula is the receipt multiplied by 100 divided by 100 minus TDS. So here what is the receipt? 45,000 multiplied by 100 divided by 100 minus TDS. What is TDS on dividend? It is 10%. So 100 minus 10. So if you do 45,000 divided by 90 into 100, you will get 50,000. So here the income is 50,000. Dividend income is how much? 50,000. Fine. So this is only grossing up. But however, in the examination, if you are getting profit and loss account, okay, in profit and loss account, if dividend is given as 45,000, then will you do grossing up? Answer is no. Because in profit and loss account or income and expenditure account, they give the entire income. They don't give the receipt. So if profit and loss account contains dividend as 45,000, it means that the dividend income is 45,000. Fine. So I have given you a note also. You can pause the video and note down in your notebook. Fine. Now let's come to the next section, that is section 194A. 194A speaks about interest other than the interest on securities. So interest on security is covered under 193. Interest other than interest on security is covered under 194A. Here A means what? A means it is covered in Archie Junior, ACHIJR, correct? So 194A, it means that if there is any individual or HUF whose turnover or gross receipt in the preceding previous year was up to 1 crore or 50 lakhs as the case may be, then such individual or HUF need not deduct the TDS under 194A. Got my point? Then if TDS is applicable, then also there is a limit, Kana. The limit is up to 10,000. Earlier it used to be 5,000. Now it has been increased to 10,000. So up to 10,000, no TDS. Above 10,000, on the entire amount, TDS has to be deducted at 10%. Moreover, if the banks are paying the TDS, or if cooperative society with turnover of more than 50 crores is paying the TDS, then in such case, up to 50,000 rupees, no need for TDS. And in case of senior citizen recipient, up to 1 lakh rupees, no need for TDS. So up to 50,000 or 1 lakh as the case may be. In case of interest received on time deposit. Time deposit means what, Kanna? It means either fixed deposit or recurring deposit. Both are time deposit. So time deposit of bank, cooperative bank or post office for senior citizen savings scheme, Mahila Samman savings certificate, and the interest paid by a cooperative society whose turnover is more than 50 crores to its members. So in these cases, the up to 50,000, no need for TDS, and if the person receiving the interest is a senior citizen, then in such case up to 1 lakh rupees, no need for TDS. Now, when it comes to bank, you have to see whether the bank is having core banking system or not. If the bank is having core banking system, then this 50,000 rupee limit is per bank. However, if the bank is not having core banking system, then this 50,000 rupees limit is per branch. So per branch you have to see if there is no core banking. But if there is core banking for the entire bank together, all the branches combined, the limit is 50,000. Fine. Then, if at all there is an accident and the insurance company is not paying money, then the person will go to Motor Accident Claim Tribunal. If Motor Accident Claim Tribunal is asking the insurance company to pay interest, then on such interest up to 50,000 rupees, no TDS. Above 50,000 rupees means entire amount TDS will be deducted. Now let's see some payments on which TDS is not applicable. For whom and all, let us see. First and foremost, interest paid by a partnership firm to its partner. Kanna, when partnership firm is paying interest to partner, then 194A is not applicable. Instead of that, a new section called 194T will be applicable. Fine. Then interest on saving bank account. Kanna, for fixed deposit, recurring deposit, TDS is applicable, but for saving bank interest, TDS is not applicable. So saving bank account of bank, cooperative bank or post office, no interest is applicable. Then interest paid by a cooperative society whose turnover is up to 50 crores. So if turnover is up to 50 crores, the cooperative society will not deduct TDS. But if it is more than 50 crores, it will deduct the TDS, and it has the benefit of extra limit of 50,000 or 1 lakh as the case may be. Then interest on deposit with primary agricultural credit society, cooperative land mortgage bank, cooperative land development bank. So in these three cases also they will not deduct the TDS. Then interest on income tax refund. So when the government is giving interest on IT refund, government will not deduct the TDS. Then interest on zero coupon bond also TDS is not applicable. Then interest paid to bank, cooperative bank, financial institution or any insurance company, National Skill Development Fund, HUDCO, that is Housing and Urban Development Corporation. Okay, so when you are paying interest to bank, should you deduct the TDS? Answer is no. So when payment is made to bank, cooperative bank, financial institution, insurance company, etc., TDS need not be deducted. And here you should make sure that NBFC is not covered. So if a person is making payment of interest to NBFC, that is non-banking finance company, then TDS is applicable. TDS will be applicable. Fine. Now let us discuss section 194BA, which speaks about winnings from online games. Here also TDS is only deducted on payment basis. Karna, for online games, no, there is no limit. Even if 100 rupee winning is there, TDS has to be deducted at what percentage? 30%. So online games means 30%. Online games means 30%. Tax should be deducted at the time of withdrawal of the net winnings comprised in the withdrawal. Tax also should be deducted on the remaining amount of net winnings in the user account as at the end of the financial year. So when is the TDS deducted? When the person is withdrawing money from the account of online games. At that time, whatever withdrawal is there, in that withdrawal, whatever winnings is there, on that TDS has to be deducted. Moreover, if the money is not withdrawn, then it will be as a balance in their account. From this balance, you come to the end of financial year. In the end of the financial year, whatever winnings portion is there, on that you have to deduct 30% TDS. Fine. So how to find out what is winnings? This we have calculated in the income from other sources chapter, where I have talked about taxation on online games. There I have discussed the formula of winnings. Fine. Then TDS need not be deducted if net winnings in a withdrawal is up to 100 rupees per month. It can be deducted in subsequent withdrawals or end of the financial year, and the deductor should take responsibility to pay the TDS if the amount is not sufficient. So if withdrawal from the account is less than 100 rupees, then on such case, the gaming company need not deduct the TDS. But however, in subsequent withdrawal, no, they have to deduct the TDS together in the subsequent withdrawal. But however, let's say all the withdrawal are less than 100 rupee and TDS was not at all deducted, and now account balance is also Kali. Then what to do? Then out of the gaming company's own pocket, they have to pay the TDS. So if the TDS is up to 100 rupees, no need to deduct, but they have to make sure that the TDS is deducted on the subsequent withdrawals, or else they have to pay out of their own pocket. Then if net winnings is wholly or partly in kind and cash is not available to deduct the TDS, payer shall make sure that the tax is paid by the payee before releasing the payment. So for example, if winnings from online games is given in the form of kind, instead of giving cash, they are giving a car, or they are giving a free gift, or they are giving a fridge or TV or AC or sofa, whatever the price may be. If it is given in kind, then what they have to do? Out of their own pocket, the gaming company should pay TDS. But if the gaming company is not having the money for TDS, then what they have to do? They should ask the person who has won the prize money to first pay the amount to the government. How will they pay? They will pay like advance tax only. So they will pay advance tax and they will show the slip, the receipt of advance tax, to the person who is giving the prize money. So if the person who is receiving the prize is giving the proof, then the person giving the prize need not deduct the TDS. So what the payer shall make sure that the tax is paid by the payee before releasing the payment. Fine. Then what should be taken as the value of winnings? If winnings has been purchased, for example, if winnings is in kind, then if it has been purchased, then purchase cost will be taken as value of winnings. If it is manufactured, then the price which is charged to customers, okay, excluding GST, will be taken as value of winnings. In any other case, fair market value of the price will be taken as value of winnings. Fine. Now let's discuss section 194B and 194BB. Both of them let us discuss together. 194B and 194BB. Both cases TDS has to be deducted only on payment basis. Both of them talk about winnings. Winnings from betting, lottery, gambling, puzzle and horse race. Betting, lottery, gambling, puzzle, crossword and horse race. On all the winnings, TDS has to be deducted at 30%. TDS at 30%, and here there is a limit. Kana. In online games there is no limit, but for other winnings there is a limit up to 10,000 rupees per transaction. So per transaction, if the winnings is up to 10,000 rupees, there is no TDS. Earlier it used to be per year, but now there is an amendment by which the act is telling per transaction. If the winnings is up to 10,000, no need for TDS. And here also, if at all winnings is in kind and the cash is not available to deduct the TDS, then the payer should make sure that the tax is paid by the payee before releasing the winnings. Fine. And then where the bookmaker credits the winnings and debits the losses to the punter, the TDS has to be deducted before the setting off of losses. Thereafter, the net amount after deducting the TDS and losses has to be paid to the winner. So when the person who is doing the horse race, that person is only called punter. When the payment is being made to the punter, the winnings payment is being made to the punter, there will be winnings also, there will be losses also. TDS has to be deducted on winnings. So before reducing the losses, first the company has to deduct the TDS paid to the government, then only they have to deduct the losses from the winnings, and the balance amount can be paid to the punter. Fine. Then now let us discuss section 194C. 194C. C talks about payment made to contractors. Now when you see C itself, you should know that C comes in Archie Junior. ACHIJR. Hence, if there is any individual or HUF, and in case of 194C, I already told you, it is applicable even for AOP BOI. So if there is any individual HUF, AOP or BOI whose turnover or gross receipts in the preceding previous year is up to 1 crore or 50 lakhs as the case may be, then such individual HUF, AOP or BOI need not deduct the TDS under section 194C. Okay, wow. Now, sir, on what and all amount this contract TDS is applicable? Let us see. So contract means what? Contract includes advertising, broadcasting. So if I am paying any money to advertiser, I have to deduct TDS under 194C. Then broadcasting and telecasting. So if I am paying money to radio, or if I am paying money to TV channel, then I have to deduct the TDS. Then carriage of goods, carriage of passengers. So transport company, you have to deduct the TDS whether they are transporting goods or passengers. However, to Indian Railway, if payment is being made, no need to deduct the TDS. Then catering. So catering service also, if someone is providing, TDS has to be deducted at 194C. Then lastly, customized manufacturing with customer material or customer associate material. So for example, if me or my associate is giving any material to a job worker and asking the job worker to make some product using our material, then while making the payment of job work, we have to deduct the TDS under section 194C. For example, I am having some gold and I am doing jewelry business. So if I am giving the gold to the job worker will make it into jewelry and give it to me. So on the job work charges, I have to deduct the TDS under section 194C. You get my point? So all these payments are covered under 194C. Here, sir, what is the rate of TDS? The rate of TDS depends on who is receiving the payment. If the person receiving the payment is an individual or HUF, then TDS has to be deducted at 1%. But if the person receiving the payment is other than individual or HUF, then it will be deducted at 2%. So individual HUF receiving 1% or other than individual HUF receiving 2%. And here what is the limit? Here the limit is per transaction up to 30,000 and aggregate payment up to 1 lakh rupees. So single payment up to 30,000 and aggregate payment up to 1 lakh rupees, no need to deduct the TDS. Here sometimes students will get confused and will make silly mistakes. So to avoid that, let me give you an example. Okay. So what is the limit? Up to 30,000 single payment, no need for TDS. Up to 1 lakh rupee in aggregate, no need for TDS. So now let's say Mr. A is making a contract payment to Mr. B in previous year 25-26. So first on 1/4/2025, 30,000 is being paid to Mr. B. So on 30,000, will there be any TDS? Answer is no. Exact 30,000, there is no TDS. Only if it is more than 30,000, TDS will be applicable. Then next, on 2nd May, he is paying 25,000. Is there any need for TDS? Answer is no. Because single payment also within 30,000, aggregate also within 1 lakh rupees. So no need for TDS. Then next payment happens on 3/6/2025. 3rd June. How much is being paid? 35,000. On 35,000, will TDS be applicable? Answer is yes, because a single payment is more than 30,000 rupees. So what is the rate of TDS? You have to see who is receiving the payment. So the person receiving the payment in my example is Mr. B. Mr. B is an individual. That is why TDS rate is 1%. So 1% of 35,000 is 350. Fine. Then aggregate payment comes to 1 lakh rupees. Hence no need for TDS. Then now no need for TDS on aggregate. Okay, wow. Then next payment happens in July. 10,000 is being paid. Since the amount is within 30,000, no need for TDS, and aggregate is also coming to 1 lakh rupees. See, Kanna, I told you, up to 1 lakh in aggregate, no need for TDS. Now let us talk about next payment. Next payment happens in August. August, 25,000 rupees is being paid. Now per transaction it is within 30. However, if you see all the payments during the year combined, the total is coming to 1,25,000. Hence, since the aggregate payment is more than 1 lakh, TDS is applicable on the entire amount. So at what percentage? 1%. So 1,25,000 into 1%, you will get as 1,250. However, already you have deducted deducted 350, no? So why to deduct once again? That is why you reduce this 350, then on the balance amount only has to be paid to the government as TDS. So this is how you do the calculation under 194C. You get my point? Now let's come to other provisions. No TDS for individual or HUF deductor if the contract is of personal nature. So for example, if I am a jeweler and I am going to a job worker and they are making jewelry for me, then I have to deduct the TDS. But for my personal purpose, if I am going to a job worker and they are making jewelry for me, then I need not deduct the TDS. So individual or HUF need not deduct the TDS if contract is of personal nature. Then no TDS for payment for transport of goods if the transporter is owning up to 10 vehicles at any time during the financial year and he furnishes a declaration of his PAN number. Listen Kanna. So if there is any transporter who is transporting goods and is having maximum 10 vehicles at any time during the financial year, then what? They will give you a declaration. In the declaration, they will mention their PAN number and they will also write that I am having maximum 10 vehicles only. Please don't deduct for me. In such case, if the person who is making the payment is receiving the declaration, then on receipt of declaration, they need not deduct the TDS under section 194C. So for transporter, this benefit is given Kanna. For transporter, no, in your entire income tax syllabus, in 3 places we have seen benefit Kanna. First place that we have seen benefit is section 40A3, that is where we discussed disallowance on cash payment. Generally, if cash is paid through other than prescribed modes, 10,000 rupees to a person in a day, more than 10,000 rupees to a person in a day, then it is not allowed as deduction. But in case of transporter, the 10,000 limit is increased to how much? 35,000. Then we learnt one more place called section 44AE, presumptive taxation. So if any transporter is having up to 10 vehicles at any time during the financial year, then they can choose the presumptive taxation under section 44AE. And here there is a third benefit, that if maximum 10 vehicles are there, then the transportation can give a declaration. Transporter can give a declaration along with his PAN number. TDS need not be deducted for him. Fine. Next. If any amount is covered under section 194J, then no need to deduct the TDS under 194C. Next. No TDS needs to be deducted if contract is incidental and compulsory to the transaction. In GST, you would have learned something called composite supply, that concept only. I'll give you an example. For example, let's say petrol is sold for 5 crore rupees and along with that 5 crore rupee petrol sale, 10 lakh rupees freight charges has also been added. Then in such case, on this 10 lakh rupee freight charge, TDS will not be applicable. Next. In case of job work, TDS shall be on the value excluding material if the material is mentioned separately. But if material is not mentioned separately, then TDS should be deducted on the entire invoice value. So I gave you an example. No, I am giving the gold to a jeweler. Okay, sorry, job worker. Job worker is giving me jewelry. Now, when the job worker will give me invoice, in that invoice he should mention separately gold value separate, job work value separate. If it is mentioned separately, then only on the job work charges I have to deduct the TDS. But if it is not mentioned separately, then on the entire amount I have to deduct the TDS. Fine. Then TDS is applicable on payment made by client to advertisement agency, but not applicable on payment made by advertising agency to news channel. So for example, if you want to advertise in news channel, what you will do? You will pay to advertising company will pay to news channel. In that case, when you are making payment to them, since advertisement is covered under TDS, you have to deduct TDS under 194C. But when the advertising company is paying to news channel, it is for broadcasting, telecasting, no, but they need not deduct the TDS because one time already it has been deducted. Fine. Next. TDS is applicable on cold storage, providing refrigeration facility along with storage. So on cold storage, no, 194I will not be applicable. Instead of that, 194C will be applicable. So this is over. Now let us go to section 194D. 194D speaks about insurance commission. Insurance commission means payment by the insurance company to insurance agent. So when the agent company is giving commission to agent up to 20,000 rupees per annum. So earlier it was 15,000. Now it has been increased to 20,000 from May 26 exam onwards. So up to 20,000, no need for TDS. But if it is above 20,000, then on the entire commission, TDS has to be deducted at 2%. And in case of company receiving the commission, TDS has to be deducted at 10%. So for example, if I am the insurance agent, then the company will deduct 2%. But if Policy Bazaar is an insurance agent, then it is a company, no. So that insurance company will deduct 10% as TDS. So it depends on the receiver. So if receiver is a company, 10% TDS. If receiver is other than company, 2% is TDS. Now let's talk about section 194DA, maturity or bonus received from life insurance policy. So when the life insurance company is giving the maturity amount, then in such case, if the amount is less than 1 lakh rupees, less than 1 lakh. So exact 1 lakh means what? TDS will be applicable. If the amount is less than 1 lakh rupees, then need not deduct TDS. But if it is 1 lakh or more, then TDS has to be deducted at 2%. And TDS is not deducted on the entire value, TDS is only deducted on total amount minus total premium. So total sum minus total premium multiplied by 2% is the TDS. And you know what? If the life insurance amount is exempt under section 10 clause 10D, then also no need to deduct the TDS. Fine. Next, section 194G. 194G talks about commission on sale of lottery tickets. So the commission is paid by whom? Commission is paid by the lottery company to the lottery agent. When commission is paid, here also up to 20,000 rupees. Earlier it used to be 15,000. Now it has become 20,000. Up to 20,000 rupees, no need to deduct TDS. If it is above 20,000, then on the entire value, the TDS rate is 2%. Then section 194H. 194H speaks about all the other commission and brokerage. And 194H means what? It is covered in Archie Junior. So ACH. So now we are discussing H only. It means what? If there is an individual or HUF whose turnover or gross receipt in the preceding previous year is up to 1 crore or 50 lakhs as the case may be, then such individual or HUF need not deduct the TDS under section 194H. Fine. So for other than them only, if it is up to 20,000, no TDS. If it is above 20,000, TDS has to be deducted at 2%. Fine. Moreover, if commission is paid by BSNL or MTNL to PCO franchisee, no need for TDS. If TDS is paid on brokerage, which is related to securities, then also no need for TDS. For example, underwriting commission or brokerage, which is given for public issue of shares. Fine. Now, there are three sections which is related to commission that we discussed. That is 194D, insurance commission, 194G, lottery commission, and 194H, other commission and brokerage. For all the three sections, I want to say that the limit is 20,000. So 20,000 in all the three cases. Moreover, the rate of TDS is also same, which is 2%. Only in case of 194D, when the company is receiving, it is 10%. Fine. So this will help you to remember the provisions. Now let's talk about rent. Rent is covered under section 194I. And if you see 194I also, what you should remember? Archie Junior. So ACHIJR. Now we are discussing about I. So here also, if an individual or HUF whose turnover or gross receipt in the preceding previous year is up to 1 crore or 50 lakhs as the case may be, then such individual or HUF need not deduct the TDS under section 194I. Okay, wow. So 194I speaks about rent. When the rent payment is made, TDS has to be deducted. Sir, what is the percentage? If plant and machinery or equipment is given on rent, TDS has to be deducted at 2%. Then other than plant and machinery, which means land, building or furniture, if it is given on rent, then TDS has to be deducted at 10%. So plant and machinery 2% TDS, other than plant and machinery 10% TDS. And here also there is a limit. What is the limit? Earlier the limit used to be 2,40,000 per annum, but now that is not the limit. Now the limit is up to 50,000 rupees per month or part of the month per person. So to a single owner, if you are giving 50,000 rupees per month or part of the month, then no need for TDS. But if it is above 50,000 to a single owner, then TDS has to be deducted at 2% or 10% as the case may be. No TDS is applicable if rent is paid to the government. Then TDS is applicable on non-refundable deposits, advance rent paid, and also arrears of rent paid. It is also applicable on warehousing charges. So advance rent, arrears of rent, non-refundable deposit, and also warehousing charges. On all these items also TDS will be applicable. Then rent includes municipal taxes, then no need to deduct the TDS on municipal taxes. Fine. Then TDS is not applicable to passenger service fees, which is given from airline to airline operator. And lastly, TDS is not applicable on one-time lease, which is given for a long period of time. So one-time lease is there, no? On that, no need to deduct TDS. Now let us discuss section 194IA. 194IA speaks about immovable property. If any immovable property is transferred from one person to another person, then the person who is making the payment should deduct the TDS at 1%. But here also there is a limit. The limit is 50 lakh rupees. And less than 50 lakhs. So if the amount is exact 50 lakhs, TDS has to be deducted. But if it is less than 50 lakhs only, no need to deduct the TDS. So here also you have to be very, very careful. Fine. And sir, what is this 50 lakhs? This 50 lakhs is not the sale consideration, You should see sale consideration or stamp duty value, whichever is higher. Then on the higher value only you have to compare with 50 lakhs. Fine. And even TDS, this 1%, no, it has to be deducted on consideration or stamp duty value, whichever is higher. So if stamp duty value is higher, TDS will be deducted on stamp duty value. Fine. Then here consideration includes club fee, parking fee, advance fees, electricity, water supply fee, maintenance fee, etc. So all these, for example, when you are buying flat, no, while buying the flat, instead of flat amount, you will also pay other charges like this: electricity fee, advance fee, water supply fee, parking fee, etc. So all that also has to be included in the 50 lakhs or the sale consideration. Everything has to be added up. Fine. So all this is included in consideration. Now, while paying the consideration, you have to see if there is compulsory acquisition. If the government is compulsorily acquiring the property, no, then TDS is applicable under 194 LA. In that case, this TDS will not be applicable. And here also some people will get the confusion. Sir, what if there are 2 buyers or there are 2 sellers? Then how to calculate this limit of 50 lakhs? Kanna, it is very simple. This 50 lakhs limit is there, no? You see per property. It does not matter there are how many buyers or how many sellers. If there are 5 buyers and 5 sellers also, if that property worth is 50 lakhs or more, TDS has to be deducted at 1%. Fine. Then this is a special provision where no TAN number is required. I told you earlier itself, no, the person who is deducting the TDS has to get a TAN number. But in case of 194 IA, no need for TAN number. Then how to deduct the TDS, sir? That I will tell you after discussing the sections. Fine. In this video only. Next, section 194 IB. 194 IB also speaks about rent, Kanna. But this rent is only on land and building. But sir, rent we have already discussed under section 194I. Then why are we discussing once again section 194IB? Because in 194I, we had learnt Archie Junior case. Individual or HUF whose turnover or gross receipts in the preceding previous year, if it is up to 1 crore or 50 lakhs, then they need not deduct the TDS under 194I. However, such individual or HUF have to deduct the TDS under section 194IB. So the people who are covered in Archie Junior case have to deduct the TDS under 194IB. Here what is the limit? Here also the limit is 50,000 per month or part of the month. If the rent is up to 50,000, no TDS. But if the rent is more than 50,000, then on the entire amount TDS has to be deducted at 2%. There what was the TDS rate? For land and building it was 10%. But here the rate is how much? Only 2%. And there every month you had to deduct the TDS. But here every month need not deduct the TDS. Here time of deduction is credit of the last month of the year or last month of tenancy or payment, whichever is earlier. So for example, from April to March, if every month, let's say 1 lakh rupees is being paid, okay, 1 lakh is the rent payment, then what to do? Then March month alone, while making the payment of rent, you calculate for the entire year. For entire year, it will be 12 lakhs multiplied by 2%, which will be 24,000. So in the last month alone, if from this 1 lakh, you reduce 24,000 and balance amount you pay to the landlord, 24,000 you have to pay to the government as TDS. You get my point? So I hope you are clear. Next. So time of deduction is credit of last month of the year or last month of tenancy. Here also, section 206AA will create one confusion. Sir, what is the confusion? Listen, Kanna. In 206AA, what did we learn? That the landlord is there, no? The person who is receiving the amount should give the PAN number. If PAN number is not given, then TDS has to be deducted at 20% or actual rate, whichever is higher. So in this case, what will be the TDS rate if landlord is not giving the PAN number? Then TDS will become 20%. Now 20% for the entire year, if you see, it will become 12 lakhs multiplied by 20% is equal to 2,40,000. But sir, the rent itself is 1 lakh rupees. From this 1 lakh, how to deduct 2,40,000 as TDS and pay to government? That is why only in case of this section, that is section 194IB, if the TDS amount is more than the rent amount, then maximum rent amount itself you have to pay to the government. That is enough. That is enough. So in this case, 1 lakh has to be paid to the government. So as per 206AA, if the payee does not furnish the PAN number, then TDS cannot exceed the total rent of the last month. Fine. Then now and here also in this section 194IB, TAN number is not required. TAN number not required. Now let us discuss section 194J, fee for professional service. In 194J, no, 5 types of payments are covered, Kanna. Fee for professional service, fee for technical service, royalty, non-compete fees and director fees. What did I say? Professional fair service, technical service, royalty, non-compete fee, director fee. So 5 types of payments are covered under 194J. What is the rate of TDS? Generally the rate of TDS is 10,000. Rate of TDS 10,000. However, if the payment is made to a call center or if the payment made is fee for technical service, or if the payment made is a royalty for sale, distribution or exhibition of films. In these three cases, the TDS rate will be 2%. So generally it is 10%, but in three cases, the TDS is 2%. And here also, is there a limit? Answer is yes. Earlier the limit used to be 30,000, but now the limit has been increased for May 26 exam onwards. It has become 50,000 rupees per annum. So up to 50,000 rupees, no TDS. If it is above 50,000, then on the entire amount, TDS has to be deducted at 10% or 2% as the case may be. And here, let me tell you what is special. This 50,000 limit is there. No, it is not for the entire section. It is for every type of payment separately. So for fee for professional service, separate limit of 50,000 is there. Fee for technical service, it is separate 50,000. Royalty, it is separate 50,000. Non-compete fee, it is separate 50,000. But what about director fee? For director fees, no, 50,000 limit is not there. Even if 1,000 rupees director fees is given, TDS has to be deducted. And you know what? When the company is paying fees to director, if at all it is a salary, then TDS has to be deducted under 192. But if the payment is other than salary, then TDS has to be deducted under 194J. And there is no limit also for director fees. Fine. Then no TDS on royalty or non-compete fees, director fees, if the payment is made by individual or HUF. Firstly, listen, this payment is this section is 194J. It means what? It is covered under Achi Junior. Hence, if there is any individual or HUF whose turnover or gross receipts in the preceding previous year is up to 1 crore or 50 lakhs, then such individual or HUF need not deduct the TDS under 194J. Correct? Moreover, if there is any individual or HUF and if the payment is royalty, non-compete fees, director fees, then also no need to deduct the TDS. And then if at all it is professional service, and if the professional service is of personal nature, then also the individual or HUF need not deduct the TDS. So that is why I have written here. If you want, you can note down. Individual or HUF need not deduct TDS in the following cases. First is the Achi Junior case. Second is professional fees paid for personal purpose. And third is royalty, non-compete fees and director fees. Fine. Now sir, what is this professional service? Professional service definition already we have learnt in section 44AA. So 44AA in PGBP, it contains all the professional, legal, medical, accountancy, which is chartered accountancy, company secretary, film artist, architect, all those professional are there. Other than those professionals also, sports professional will be considered as professional service in 194J, umpire is considered as professional, commentator professional, referee is professional, physiotherapist is a professional, anchor is a professional, event manager is a professional, and also third party administrator who makes payment to hospital on behalf of insurance company, they also are considered as professionals. Fine. Then profession does not include teaching, sculpting and painting. These are not covered under 194J. Then fee for technical service and royalty, the meaning you can refer in residential status chapter. We have already discussed the definition. Now let us discuss section 194K. 194K talks about income of units of UTI and mutual fund. So if UTI and mutual fund is paying the income, then up to 10,000 rupees, no need to deduct the TDS. Above 10,000, on the entire amount, TDS has to be deducted at 10%. Then section 194LA. 194LA speaks about compulsory acquisition of immovable property. So when the government is compulsorily acquiring, if the payment is up to 5 lakhs during the year, no need for TDS. But if the payment is more than 5 lakhs during the year, TDS has to be deducted at 10%. Who will deduct the TDS, sir? Government will deduct the TDS, Kanna. How much? 10%. And here you have to be careful. This 5 lakh is there. No, it is per year. It is not per property. Earlier it used to be lesser, but now it has been increased to 5 lakhs from May 26 exam onwards. Moreover, no TDS on compulsory acquisition of agricultural land. So when government is compulsorily acquiring agricultural land, no need to deduct the TDS. And here compensation includes enhanced compensation also. Hence TDS will come even if there is enhanced compensation above 5 lakhs during the year. Next, section 194M. 194M covers contract, commission and professional service. But sir, already we learned contract in 194C, commission in H and professional service in J. Then why we are learning here? Because in all the three sections, we have learnt cases where these three sections are not applicable to individual or HUF. If the three sections are not applicable to an individual or HUF, then for such individual or HUF, 194M will be applicable. 194M. So 194M means individual or HUF for whom the respective sections are not applicable are paying contract, commission, professional service. Here you know what is the limit? The limit is 50 lakh rupees, Kanna. 50 lakh rupees, but it is a combined limit. So contract plus commission plus professional service put together it is 50 lakhs. I have given you example also. For example, Mrs. X paid brokerage of 6 lakh rupees, 5 lakh rupees as architect service and 40 lakh rupees as contract for construction of her house to Mr. Y. Fine. TDS is applicable since the total is 51 lakh rupees. Since the total is more than 50 lakh rupees, hence TDS will be applicable. Fine. Now let's talk about section 194N. Okay, one more point. For this section 194M, no TAN number is required. So 3 sections we have discussed till now, Karna, for which no TAN number is required. First was 194IA, that is immovable property. Second was 194IB, that is rent of Archie Junior case. And the third is 194M, which is contract, commission and professional service of Archie Junior case. Now let us discuss section 194N. 194N speaks about cash withdrawal from bank account. If cash withdrawal from account is more than 1 crore in case of normal assessees and 3 crores in case of cooperative society, then TDS has to be deducted at 2%. Now listen Karna, this section is a special section because in all the other sections we have learnt that if the amount crosses the limit, here what is the limit? Here the limit is 1 crore or 3 crores. If the amount crosses the limit, generally TDS is applicable on the entire value. But in this section, that is 194N, if the amount crosses 1 crore or 3 crores as the case may be, then on the first 1 crore or 3 crores, no need for TDS. Only on the amount exceeding 1 crore or 3 crores, TDS will be applicable at 2%. For whom 1 crore, sir? For whom 3 crores? 1 crore is for all the assessees except cooperative society and 3 crore is for cooperative society. Fine. Now, the banks are there, no? From whom cash is being withdrawn, they should also check whether last 3 years income tax return has been filed or not. So, last 3 years income tax return, if any one is also filed, not a problem. But if all the 3 income tax return of last 3 years, for which due date is already over, if they have not been filed by the assessee, then TDS will be deducted at a higher rate. What is the higher rate? TDS will be deducted at 2% on withdrawal about 20 lakhs up to 1 crore. Or 3 crores in case of cooperative society, and TDS at 5% on withdrawal exceeding 1 crore or 3 crores as the case may be. So 20 lakhs to 1 crore, 2% TDS, 1 crore if it is above 1 crore or 3 crores, 5% TDS. When will this higher TDS be applicable? If all the 3 years income tax return has not been filed for which due date is already over. Okay, well, moreover, TDS is not applicable if the person who is withdrawing the money is a government or a bank or a cooperative bank or post office or business correspondent of a bank or cooperative bank or white label ATM operators. So in all these cases, no need to deduct the TDS. Now let's talk about section 194P. 194P also talks about TDS by specified bank. When will the specified bank deduct the TDS, Kana? Specified bank will deduct the TDS only if the person is a resident individual whose age is 75 years or more. So only for old people this TDS is applicable. So resident individual whose age is 75 years or more. For that resident or individual, they should be earning only 2 types of income, Kana. One is interest income, one is pension income, and both these income should be coming only in one bank. Okay, for example, ICICI means all their interest income and pension income should be received in ICICI bank only. If it is Axis Bank means Axis Bank only. It should not be received in any other bank. Fine. Here also, if the income of this resident individual is up to basic exemption limit, no need for TDS. But if it is above basic exemption limit, then the bank will deduct the TDS. So this is applicable only if individual is having pension income and no other income except interest from any account maintained by such individual in the same bank in which he is receiving the pension. Fine. So if TDS is applicable, you know what will happen? The resident individual is there, no, whose age is 75 or more, they will give a declaration to the bank. In this declaration, they will mention that I am not having any income other than interest and pension which is received in your bank. Other than that, my LIC amount is this much, my savings is this much, all the deduction detail also they will give. Then bank will calculate their total income. Based on the total income, the bank will find out what is the tax to be paid by this individual, and that tax they will deduct as TDS and deposit to the government under section 194P. Okay, so here what is the TDS rate? It is slab rate. It means for that resident individual aged 75 or more, the bank will calculate the tax including surcharge and health and education cess, and bank will deposit to the government. If bank is deducting the TDS under section 194P, then such resident individual need not file their return of income. Fine? Need not file his or her return of income. Next, section 194Q. 194Q talks about purchase of goods. Purchase of goods. So when a person is purchasing the goods, then while making the payment, if the amount of purchase is more than 50 lakhs, then TDS has to be deducted on the excess of 50 lakhs at 0.1%. Now listen, what is the limit here? The limit is 50 lakhs. So up to 50 lakhs, there is no TDS. But if the amount crosses 50 lakhs, Generally what happens? Generally on the entire amount you have to deduct the TDS, no. But in this section, that is 194Q, TDS is not deducted on entire value. TDS is only deducted on the excess amount. So if the purchase is more than 50 lakhs, then on the excess value, TDS has to be deducted at 0.1%. 0.1%. Sir, who should deduct the TDS? The buyer should deduct the TDS only if the turnover of the buyer in the preceding previous year is more than 10 crores. If it is less than 10 crores or up to 10 crores, no need to deduct the TDS. Then 194Q is not applicable if any other TDS or TCS provision is applicable. Now listen Karna, let me tell you about preference of transaction. For example, on the same transaction, if more than one section is applicable, TDS is also applicable, TCS is also applicable, 194Q is also applicable, then what to do? In that case, you should know for which section you have to give preference. So always you have to give first preference to all the TDS sections other than 194Q. Second preference you will give to TCS, and last preference only you will give to TDS under section 194Q. So TDS under 194Q will be applicable only if the other TDS and TCS sections are not applicable. You get my point? Then, if PAN is not furnished, then TDS will be deducted at 5%. This we have already discussed with section 206AA. Then, purchase value does not include GST. So here purchase value is there, no, up to 50 lakhs, above 50 lakhs. This you should not include GST. However, we have already discussed, no, TDS has to be deducted on payment or credit whichever is earlier. That is why, what if some advance payment is being made for purchase? In that case, TDS has to be deducted. That is why the advance payment contains GST also, purchase also, but you cannot differentiate between GST and purchase value. That is why on the entire advance amount, TDS has to be deducted even though it includes GST at 0.1%. Now let's talk about section 194R. 194R speaks about benefits or perquisites from business or profession. So in course of business or profession, if a person is paying benefit or perquisite, for example, I am a shopkeeper and the dealer is giving me foreign trip or the dealer is giving me gold coin, in such case it is a benefit or perquisite for my business. Hence, the dealer will deduct the TDS under section 194R at 10%. And here it is 194R, hence it is covered in Archie Junior case. That is why if there is any individual or HUF whose preceding previous year turnover is up to 1 crore or 50 lakhs as the case may be, then such individual or HUF need not deduct the TDS under section 194R. And here also there is a limit. What is the limit? Up to 20,000 no need for TDS during the year. During the year if it is more than 20,000, TDS will be deducted at 10%. Here also, listen Kanna, the benefit can be given in cash also, in kind also. If the benefit is given in kind, then if cash is not available, then the payer should make sure that the tax is paid by the payee before releasing the payment. And TDS has to be deducted before providing the benefit. So first deduct the TDS, then only you give the benefit. So fine, this is 194R. Now let us discuss a new section for applicable from May 26 exam onwards, that is section 194T. 194T tells payment made by a partnership firm to partner. So if partnership firm is paying salary, remuneration, bonus, interest or commission, so by whatever name called, if firm is making payment to partner, then up to 20,000 rupees during the year, no need to deduct TDS. But if the amount crosses 20,000, then on the entire value, TDS has to be deducted at 10%. On the entire amount, 10% is the TDS. Now let us discuss the other provisions of the TDS chapter. Firstly, let us start with the special provisions for section 194IA, section 194IB and section 194M. For all these three sections, I already told you that TAN number is not required. So no need for TAN. Instead of TAN, the person deducting the TDS will pay the TDS using their PAN number itself. This TDS has to be deposited to the government within 30 days from the end of the month in which the TDS was deducted, along with the return of TDS. What is the return of TDS form number? For 194IA, it is 26QB. For 194IB, it is 26QC. And for 194M, it is 26QD. And TDS certificate also has to be generated. Sir, what is this TDS certificate? This TDS certificate is nothing but a proof which is generated from the portal, and it is a proof that the deductor has successfully paid the TDS to the government. So this TDS certificate will be generated in form 16B for 194IA, form 16C for 194IB and form 16D for 194M. It has to be given to the payee within 15 days from the due date of furnishing the return. So come to the due date, after that 15 more days is time is there. Within that 15 days you have to give the TDS certificate. Now let's talk about section 191 and 205. The payee is responsible to pay the tax directly if the TDS has not been deducted on the payment made to him. However, if deductor has deducted the TDS and not deposited it to the government, such deductor shall become the assessee in default. Tax cannot be demanded by the assessee directly if the tax has been deducted against his income. So for example, if I am receiving the amount, then the person who is making the payment, if they have not deducted the TDS, then who has to pay the tax? I only have to pay the tax. But while making the payment, if the person who made the payment have deducted the TDS, but they have not given it to the government, then who is the assessee in default? They only will be assessee in default. Then the government cannot catch hold of me. Fine. Next, section 195A, income payable net of TDS. After deducting TDS, deductor is required to pay only the net amount to the payee. Hence, the income of the payee will be the payment received after grossing up of the TDS deducted. So, only the net amount is supposed to be given by the payee to the payer to the payee. So for example, if I am receiving interest of 1 lakh rupees, on that TDS of 10,000 has been paid, how much balance I will get? Only 90,000 rupees balance I will get. Next, section 196, no TDS on certain payment. TDS need not be deducted if the payment is made to government, RBI and mutual fund. So if receiver is government, RBI or mutual fund, no need to deduct TDS. Then section 197, certificate of deduction at lower rate. So sometimes what happens, let's say my profit itself is very low, or I am running losses. If I am having losses, will I be having any taxable income? Answer is no. Hence I will not pay any tax. But when the person is making me the payment, they will deduct the TDS and pay it to the government. Unnecessarily, the government is collecting tax from me in the form of TDS, even though I am not required to pay any tax. Hence, what I will do is I will go to the assessing officer. I will request him that certificate for TDS deduction at lower rate. So, assessing officer will analyze my case and he will give a certificate that whoever is deducting TDS for me have to deduct TDS at lower rate. So, I can show this certificate to everyone. If I show the certificate, they will deduct TDS for me at lower rate. Fine. And if AO issues the certificate, deductor shall deduct the TDS at such lower rate as per the certificate. Then section 197A, no TDS deduction in certain cases. So in 197 Nokana, I told you that I have to go and approach the assessing officer, but the assessing officer will get so many cases like this. So for that only, there is section 197A, for which you need not even go to the assessing officer. Directly you can ask the payer that don't deduct the TDS for me. In what and all cases it is applicable, Kana? It is applicable under 194, that is dividend, for 192A PF Provident Fund, 193 interest on security, 194A interest on other than security, 194D insurance commission, 194DA life insurance, 194I that is rent, and 194K that is income from units. So for all these sections, if a person who is receiving the payment can give form 15G or form 15H. Form 15G or form 15H. Form 15G is for normal citizen, normal individual. Form 15H is for senior citizen. Fine. In that form 15G, the individual will write that the individual's income is less than the basic exemption limit. Hence, please don't deduct the TDS. If form 15G is received, then such deductor need not deduct the TDS. Fine. And what if form 15H? In form 15H, senior citizen can give form 15H. In this form 15H, senior citizen will tell that my tax liability is 0. So even if their income is above basic exemption limit, but because of the rebate their tax is coming as 0, still they can give form 15H. That is a benefit given to senior citizen. So senior citizen, resident senior citizen will give form 15H. If form 15H is received, then also no need to deduct the TDS. But how will the government know that you have received form 15H or form 15G? Hence you have to submit this form to the government within 7th of the succeeding month to the income tax department, that is to the income tax department. So within next month 7th, these forms have to be submitted to the government by the deductor. Fine. Next, section 198, tax deducted is the income. So tax deducted is deemed to be the income of the assessee. So for example, I have to receive interest income of 1 lakh rupees, but the person who is paying me has given only 90,000 and given TDS of 10,000 to government. Can I tell the government that my income is only 90 because I received 90? Answer is no. That the 10,000 TDS which has been given to government, no, that is also my income only. So my income is 90,000 plus 10,000, which is 1 lakh rupees. Then section 199, TDS credit. TDS credit is available to a person from whom income deduction is made, except in case of clubbing, credit is available to a person in whose hands the income will be taxable. In case of tax payable by employer on non-monetary purposes, employee can take the credit. See, Kana, generally, in whose name you have deposited the TDS, they will only get the credit. But in case of clubbing, for example, if I am having a minor child, if TDS is deducted on my minor child, who will get the credit? I only will get the credit because I am paying the tax for my minor child. Okay, now let's discuss about section 203A TAN number. Person responsible for deducting the tax or collecting tax should apply for TAN number, that is tax deduction and collection account number. Now let us see what are the TDS and TCS deposit and returns due date. So due date to deposit TDS and TCS. Let us just see for any other person other than government. For other than government, if the deduction of TDS has been made from April to February, then the due date to pay the TDS to the government is 7 days from the end of the month of TDS. Okay, so next month 7th is my last date to pay the TDS. However, if deduction has been made in March month, then I can pay the TDS even till 30th April. Till 30th April, payment can be made. Now let's talk about TCS. For TCS also, next month 7th is the last date, even if it is March month. So for April to March, for all the months, it is next month 7th. Only for TDS alone, this 30th April benefit is given, but for TCS, this 30th April benefit is not given. Then the TDS return for TDS other than salary is filed using form 26Q. For salary, it is filed using form 24Q, and for TCS, it is filed using form 27EQ. Fine. What is the due date to file the TDS and TCS return karna? So every quarter TDS or TCS return has to be submitted to the government. So for April to June quarter, the last date is 31st July. Then for July to August quarter, it is September quarter, it is 31st October. And then from October to December quarter, it is 31st January. For last quarter, no, from Jan to March, it is not 30th of April. Instead, 2 months are given, that is 31st of May. So for Jan to March, the due date is 31st of May. Now let's talk about TCS. For first quarter, it is 15th July, second quarter 15th October, third quarter 15th January. But for fourth quarter, it is not 15th April kana, it is 15th of May. For the fourth quarter, instead of 15 days, the person who is collecting the TCS gets 1 month and 15 days time. So extra time is given for the last quarter. Now let's come to section 200A and 206CB, correction of mistakes in quarterly return. TDS return will be processed and the following adjustment have to be made. Arithmetical errors that have to be rectified. Incorrect claims in the return apparent from information in the statement. Intimation shall be sent to the deductor specifying the amount of demand or refund, if any, within 1 year from the end of the financial year in which quarterly return is filed. So when you file the quarterly return, from the end of the year in which the return is filed, 1 more year time is there. Within this time period, the department will intimate you that you have made this mistake. So when they intimate you that you have made the mistake, you have to correct the mistake. Okay, next section 201, consequence of failure to deduct or pay the TDS. If you are not paying the TDS or if you are not deducting the TDS, then what is the consequence? The consequence is that the person will be deemed as assessee in default and up to 100% of TDS can be taken as penalty from them. However, such assessee in default provision will not be applicable if the payee is a resident and payee has paid the tax, furnished the return of income, included such amount in the return of income, and also gives a certificate from a chartered accountant. If all these conditions are satisfied, then the person who is deducting will not become assessee in default. The same thing we have also seen in PGBP head of income in disallowances. We had discussed when TDS is not deducted, then in case of resident payee 30% is disallowed, non-resident payee 100% is disallowed. However, if payee is filing the return of income, showing the income is the return of income, paying the taxes correctly and giving CA certificate, then in such case the disallowance will not be there. The amount will be allowed in the year in which the return is filed by the payee. And same here what is the consequence? If these conditions are fulfilled, then the assessee will not be called as assessee in default. Okay, now let's come to next section, very important 201 1A and 206C7 for TDS as well as TCS. What is the interest for delay in deduction or payment of TDS or TCS? If no TDS or TCS is deducted or collected but not paid, then simple interest at 1% per month or part of the month of late deduction, that is from the date on which TDS was deductible to the date on which the TDS was actually deducted, has to be charged. So if deduction is not made, what is the interest? 1% per month or part of the month. However, if deducted but payment is not made, then what is the interest? It is 1.5% per month or part of the month. So from the date on which it was deducted to the date on which it was paid, you have to calculate the interest. Now listen, here only students make silly mistake. So I am giving you an example. Let's say on 15th January, TDS had to be deducted of 1 lakh rupees. Let's say it was actually deducted only on 30th March. So late deduction is there till 30th March. Then for 30th March, what is the due date to pay the TDS? The due date to pay the TDS is 30th April. We have already studied. However, TDS was paid on next day, that is 1st May. So only one day late TDS was paid. Now let us see what is the interest. So interest firstly we have to see in case of non-deduction. So from 15th January to 30th March is the period on which the TDS was not deducted. Hence interest has to be charged at 1% per month or part of the month. So January month 1%, February month 1%, March month 1%. So 3% is the interest, which comes to 3000 rupees. Okay, wow. 3000 rupees. Now let's come to non-payment of TDS. On 30th March TDS was deducted and 1st May the TDS was paid. Listen, the due date is 30th April but it is paid on 1st May. So only one day late. So how much is the interest? Here the interest is 4.5%. 4.5% because the interest you have to calculate from the date of deduction till the date of payment. Okay, you need not see what is the due date and all. Fine. So from date of deduction, when was the deduction? It was 30th March. So from 31st March onwards, you will start calculating interest. So March month 1 day came up. So 1 month, then April month, so 2 months, and then May 1st. So 1 day has come in May month also. So 3 months. So 3 months into 1.5%, the interest will come as 4.5%, which is 4,500. So you see this example once again, you can pause and see so that you get clarity. Okay. Now let's come to TDS certificate. So in case of TDS, certificate on salary has to be given within 15th June, and other than salary, the certificate should be given within 15 days from the due date of furnishing TDS return. Fine. Now let us discuss the TCS provisions. So TCS means what? Tax collected at source. Tax is collected at the time of debiting the account of the buyer or at the time of receipt of such amount, whichever is earlier. So here also TCS has to be collected at the time of debit or receipt, whichever is earlier. Then here also Archie Junior case applies in case of 206C1 and 206C1F that we are going to study now. In both these sections, if at all there is an individual or HUF whose turnover or gross receipts does not exceed 1 crore or 50 lakhs as the case may be in the preceding previous year, then they need not collect the tax under section 206C1 and 206C1F. First, let us discuss section 206C1. Then section 206C1 covers the cases from A to F, which is mentioned in this table. So first, alcoholic liquor for human consumption. What is the rate of TCS? 1%. Then for Tendu leaves, it is 5%. For timber, it is 2%. For scrap, it is 1%. For minerals being coal, lignite or iron ore, it is 1%. So what are the TCS rates? For alcoholic liquor for human consumption 1%, Tendu leaves 5%, timber 2%, scrap is 1%, and coal, lignite or iron ore, it is 1%. So all these cases are covered under section 206C1. This 206C1 is not applicable if the buyer is central government, state government, embassy, high commission, legation, commission, consulate, trade representative of a foreign state, and also public sector company. So if the buyer is one of these persons, then this section 206C1 is not applicable. Then, sir, what is scrap? Scrap means waste and scrap from the manufacture or mechanical working of materials, which is definitely not usable because of breakage, cutting up, wearing or any other reasons. Then, mine or quarry. Listen Kanna. Now let us discuss section 206C1C. Section 206C1C speaks about lease or license of parking lot, toll plaza, mine or quarry. Parking lot, toll plaza, mine or quarry. Sir, what is quarry? Quarry means a very big hole which has been dug up so that some minerals can be extracted. So for all these four, wherever license and lease is given, then TCS has to be collected at 2%. So 206C1C, the TCS on license or lease is how much? 2%. This 206C1C is not applicable where the buyer is a public sector company. Fine. And here mine and quarry does not include. Mine and quarry should not include oil, mineral oil, petroleum and natural gas. So TCS is not applicable in case of license or lease in case of mineral oil, petroleum and natural gas. Fine. Now let's talk about other cases where TCS is not applicable. TCS is not applicable if the buyer is buying the goods for personal consumption. So if I am buying for personal consumption, then TCS need not be collected under section 206C1. So alcoholic liquor for human consumption. So if the person is buying for personal use, then TCS will not be collected. But for business use alone, TCS will be collected. However, in case of business also, if a buyer is furnishing a declaration stating that the goods will be used for manufacturing, processing or producing articles or things, or for the purpose of generation of power and not for trading purposes, then in such case also TCS need not be collected. However, if TCS is not collected, then on such transaction TDS under section 194Q might come, that has to be deducted for sure. Okay, well, then this declaration is there, no, where the buyer is telling that I am going to use for manufacture and not for trading. This declaration has to be submitted to the income tax department within 7th of the succeeding month. Fine. Now let us talk about section 206C1F. Section 206C1F. It speaks about sale of motor vehicle, etc. Earlier, 206C1F was only applicable to the sale of motor vehicle, but from May 2026 exam onwards, there is an amendment where on all these items also 206C1F is applicable. So other than motor vehicle, it is applicable on what and all? It is applicable on wristwatch, then art piece such as antiques, painting, sculpture, then collectibles such as coin or stamp, and yacht, rowing boat, canoe, helicopter, sunglasses, handbag, purse, shoes, sportswear, and equipment such as golf kit or ski wear, home theatre system, and lastly any horse for horse racing in race club and horse for polo. So on all these items also TCS is applicable only if per item value is more than 10 lakhs. So motor vehicle or all these cases, if per item value is more than 10 lakh rupees, then TCS has to be collected at 1%. TCS has to be collected at 1%. Here TCS is only collected on receipt basis. And TCS is applicable only on the retail sales. It is not applicable from manufacturer to dealer. So listen Kanna, I'll give you an example. Firstly, let me tell you, sir, what if a customer is buying two cars worth 7 lakh rupees. So both car value together, it is how much? It has become 14 lakhs. So is TCS applicable? Answer is no. TCS is not applicable because per car value is within 10 lakh rupees. Hence it is not applicable. Now what if the dealer is selling to customer for 70 lakh rupees? So for 70 lakh car, it is more than 10 lakhs? No. So TCS at 1% has to be collected from customer to dealer. But what if BMW company is selling this car to the dealer? So when BMW, that is manufacturer, is selling to dealer, in that case, no need for TCS Kanna. No need for TCS. However, TCS does not come on this transaction, but TDS under section 194Q will be applicable. Okay, that is above 50 lakhs at 0.1%, that TDS has to be deducted. Fine. So next, TDS is applicable on per vehicle per item, not on the aggregate value. TCS is not applicable if the buyer is a public sector company engaged in the business of carrying of passengers, central government, state government, embassy, high commission, legation, consulate, trade representative or local authority. So in all these cases also TCS is not applicable. So this is 206C1F. Since amendment is there, you have to be thorough with this section. Memorize all of this, memorize all the names. Okay, well, now let's come to section 206C1G, which talks about foreign remittance and overseas tour program package. Firstly, let us talk about foreign remittance. So foreign remittance means what? Exchanging money from rupee to dollar, dollar to rupee. So all that is foreign remittance. Exchanging the rupee into dollar and sending to foreign country. That is only foreign remittance. In case of foreign remittance, you have to see that what is the limit. Limit is 10 lakh rupees Kanna. So up to 10 lakh rupees in case of foreign remittance, no TCS is collected, and if the remittance is more than 10 lakh rupees, then only on the excess amount TCS has to be collected at 0 or 5% or 20% as the case may be. 0 if the remittance is from education loan, and 5% is 5% TCS if remittance is for education or medical treatment, and in all the other cases 20% TCS has to be collected. Who will collect the TCS? Authorized dealer will collect the TCS, and all these remittances are only the remittances which are covered under the LRS, which is liberalized remittance scheme. If it is not covered under LRS, then TCS cannot be collected. For example, credit card payments. Credit card payments are not covered under LRS. That is why TCS need not be collected on credit card payment. Now let us talk about overseas tour program package. So overseas tour program package also, here what is overseas tour program package? Overseas tour program package means the package which is given for tour of foreign countries, for example Thailand, Bali, Vietnam, Sri Lanka, etc. And in the package, if only ticket is there, it is not overseas tour program. If only hotel is there, it is not overseas tour program. So both ticket, travel ticket as well as hotel stay, both should be there together in the package. Then only it will be called as overseas tour program package. Here also up to 10 lakh rupees, the 5% TCS has to be collected. Above 10 lakh rupees, 20% TCS has to be collected. And here TCS has to be collected on slab rate basis Kanna. So for example, even if the value is crossing 10 lakh rupees, on first 10 lakhs always it will be 5%. Balance amount TCS will be collected at 20%. 20%. Then TCS is not applicable if buyer is a non-resident and does not have a permanent establishment in India. Then in case of central government, state government, embassy, high commission, legation, consulate, trade representative or local authority. TCS is not applicable on payments through international credit card. I already told you. This limit of 10 lakh rupees is per remitter but not per authorized dealer. So for example, if you are going to multiple authorized dealer, then authorized dealer should ask from you then that have you remitted any amount through any other authorized dealer. He will take a declaration. If you have remitted through other authorized dealer, then he will reduce that much amount from this 10 lakh limit and consider the balance amount only. Fine. So the similarly above point applies to overseas tour program package also. This threshold of 10 lakhs is separate for authorized dealer and separate for overseas tour program package. When a transaction is covered under both, then you treat it as overseas tour program package and solve the question. So fine. This is over. Now let us discuss section 206CC. Like in TDS, in TCS also PAN number is compulsory to be given by the buyer. If the buyer is not giving the PAN number, then TCS has to be collected at higher rate. What is the rate of TCS? Either double rate or 5%, whichever is higher. But it should not cross 20. Maximum it should be 20 only. Now let us talk about difference between TDS and TCS. So TDS is tax deduction at source, TCS is tax collected at source. In TDS, payer is required to deduct, but in TCS, the seller is required to collect. Then in TDS, it is generally deducted at payment or credit, whichever is earlier. In TCS, it is generally collected at payable by the buyer or actually paid by the buyer, whichever is earlier. In TDS, in some cases, the TDS is only deducted on payment basis, like salary, etc. And in some cases, the TCS is only collected on receipt basis. For example, section 206C1F, that is motor vehicle, etc. Now let us talk about advance tax. Now let us discuss advance tax. Advance tax means what, Kanna? Tax that is paid in advance by the assessee himself. So advance tax means tax paid in the financial year immediately preceding the assessment year. So tax of previous year paid during the previous year itself is called advance tax. Every person is liable to pay advance tax except for two cases. Number one, person whose advance tax liability is below 10,000. See, Kanna, exact 10,000 means advance tax is applicable. If it is below 10,000, advance tax is not applicable. Then resident senior citizen not having PGBP income. So if a resident senior citizen is not having any PGBP income, then for such person advance tax not applicable. Now how to calculate advance tax, sir? Kanna, it is very simple. Like how you calculate normal tax payable and refundable, no, same way you have to calculate advance tax. So take the estimated income. Of the estimated income, you calculate the tax, and from that you reduce the TDS, TCS and AMT credit. So whatever are the taxes paid in advance have to be reduced. Now, what is the due date to pay advance tax? Firstly, let us talk about the persons who are covered under 44AD and 44ADA, that is presumptive income. So if the person has taken presumptive income, then 100% advance tax has to be paid within 15th March. What about other assessees? For other assessees, they have to pay in 4 installments. 15% should be paid within 15th June, 45% within 15th September, 75% within 15th December, and 100% within 15th March. But sir, on how will we know the liability? It is impossible to know the exact tax amount during 15th June, 15th September and all. That is why you should estimate your income. And based on the estimated income, you have to calculate the tax. So let me give you an example. Let's say I estimated that my tax is going to be 2 lakh rupees on 15th June. So on 2 lakh rupees, I paid 15%, which is 30,000 rupees as advance tax. Then when I came to September, now I feel that I am earning higher income. That is why my entire tax can come as 2,50,000. So 2,50,000 is my estimated value. On this 45% came as 1,12,500. But Kanna, I have already paid 30,000 now. So this 30,000 I can reduce. Balance 82,500 only I need to pay. Next, when it came to December also I feel 2,50,000 only will be my tax during the year. So I estimate it and I pay 75% of the amount, which is 1,87,500. Out of this, 1,12,500 already I have paid. So balance amount alone I will pay, that is 75,000. And lastly, when I come to 15th March, now I feel that I have to pay 275 in taxes during the year. So 2,75,000 into 100%, 2,75,000 minus 187,500 already that I have paid. So the balance will be 87,500. This I will have to pay as advance tax. So now you know how to calculate the advance tax. First, you should find out the estimated income. Based on that, you have to find out estimated tax and percentage of estimated tax you have to pay. Whatever amount you have already paid, that you can reduce. Balance amount only you have to pay as advance tax. So this is how to pay advance tax. So now let us talk about the remaining provisions. Tax paid up to 31st March is also considered as advance tax. Income shall be estimated at every date of payment, that is 15th of June, September, December, March. If an assessee does not pay any installment by due date, he is deemed to be an assessee in default. So if advance tax is not paid within due date, the assessee becomes assessee in default. Then on unexpected income. Unexpected income means what? There are 4 types of incomes which are unexpected income karna. Capital gain income, winnings income, PGBP income which arises for the first time, and dividend income. Capital gain, winnings, PGBP for the first time, and dividend income. There are 4 unexpected income. On all the 4 unexpected income, the advance tax can be paid in the future installment. It need not be paid in the past installment. If unexpected income arises after the due date of any installment, then advance tax shall be paid in the remaining installments or by 31st March of the previous year. Fine. Then just one page, let me flip. If advance tax is not paid within due date, then interest under section 234C shall arise, and in case of unexpected income, advance tax is applicable only from the quarter in which the income is received. So in case of unexpected income, you can pay in future date also. It is not compulsory to pay in past date. What are the 4 unexpected income karna? Capital gain, winnings, PGBP income coming for the first time, and dividend income. Now let's talk about interest provisions. Interest provision. There are 3 sections of interest karna: 234A, 234B, and 234C. So let me explain you with the help of timeline. For example, for the previous year 25-26, you have to pay advance tax in the 4 due dates. Let's say the advance tax was not paid within due date. It was paid late, or lesser amount of advance tax only was paid. In such case, during the year if you are paying less advance tax, you have to pay interest under section 234C. Fine. Then after the year is over, let's say finally you have to pay 100% tax as advance tax. Let's say you did not pay 100%, you paid lesser value. If you paid lesser value, you have to pay interest under section 234B. 234B interest is applicable from the first day of the previous year till the date of filing income tax return. So from 1st April 2026 to income tax return date. Let's say income tax return has been filed on 30th August. So from 1st April to 30th August, the 234B interest has to be calculated. Now let us talk about 234A interest. 234A interest is levied to punish the assessee to file late income tax return. So if the assessee is filing income tax return within due date, there is no 234A interest. But if the income tax return is filed after due date, then 234A interest will be applicable. Sir, for what period? 234A interest is applicable from the due date of filing the income tax return till the actual date of filing income tax return. So 234A interest will be applicable. But sir, what if before the due date itself, some tax has been paid by the assessee as self-assessment tax? If the assessee already pays the tax, then you calculate the interest only up to the date of payment of tax as per the judgment of Supreme Court in case of Dr. Pranay Roy. So generally, the interest will be calculated up to the date of filing return of income, but if tax is paid earlier itself, then you calculate up to date of payment of tax as per Supreme Court judgment. Fine. So this is the timeline. Now let us see the provisions. First, let us cover section 234C. If you don't pay advance tax within the year, or if you pay less tax, this is applicable. So on what amount you have to calculate the interest? Advance tax payable minus advance tax paid. For the first 3 installments, it is flat 1% multiplied by 3 months. So whatever is the shortfall multiplied by 1% multiplied by 3 months you have to pay. And for the last installment alone, the interest has to be paid at 1%. So first 3 installments 3%, last installment 1%. So let me give you the example itself here. Let's say when you actually find out the tax is coming as 3 lakh rupees. Okay, 3 lakhs. Now based on this actual 3 lakh rupees, you have to recalculate what should have been the advance tax installment. Okay, 15%, 45%, 75% and 100%. Now you see what is the shortfall. See Karna, earlier 30,000 was paid, no? So actual payable should be 45,000, but 30,000 has been paid. Now listen, for the first 2 installments, no, there is one escape route also. Let me tell you about the escape route. Interest will not be applicable if assessee has paid at least 12% of estimated tax in the first installment and at least 36% of estimated tax in the second installment. So here, let us see what is the escape limit. It means what? Even if 12% you pay, you will escape from the interest. But if you have paid even lesser than 12%, then you have to calculate interest on the entire 15%. Fine. So what amount was paid? 30,000. What is the escape limit? Escape limit is 36,000, that is 12%. So amount is paid is lesser than escape limit also. That is why interest is applicable. So interest, how to calculate? Calculate the shortfall, actual amount payable minus total amount paid, which is 15,000 multiplied by 3%, 1% into 3 months. So we get 450 rupees. Then for second installment, let us see. Second installment, actual tax payable is coming as 1,35,000, but the amount which was actually paid was 1,12,500. Here what is the shortfall? 22,500. But here also there is one escape limit, no? Escape limit is 36%. So 36% is coming as 1,08,000. It means what? At least if you pay 1,08,000, you can escape from interest. So have they paid minimum 1,08,000? Answer is yes. They have paid more than 1,08,000. Hence, even though there is shortfall, but since the assessee has paid more than the escape limit, that is why the assessee need not pay the interest. Assessee need not pay the interest. Then, now let's talk about third installment. In third installment, it is coming as 2,25,000, but actual amount paid was 1,87,500. Calculate the shortfall, then multiply by 3%. Okay, then for last installment, the assessee has paid 275. Actual amount payable was 3 lakh rupees. So calculate the shortfall, that is 25,000 into 1%. So for the last installment, it will always be 1%. Okay, first 3 installment 3%, last installment 1%. Now let us talk about section 234B interest. Section 234B interest, I already told you, it starts from the first day of the assessment year till the date of filing return of income. So how to calculate the interest, sir? Calculate what is the advance tax payable minus advance tax paid. If at least 90% you have paid, then no need to pay interest. You have paid at least 90%, no need to pay interest. But if you have paid less than 90%, then interest has to be paid at 1% per month or part of the month. So listen, in this case, what is the 90% value? It is 2,70,000. But how much has been actually paid? 2,70,000 has been paid in our example. Since more than 90% has been paid by the assessee, that is why 234B interest will not be applicable in our case. Okay, wow. However, let us imagine another case. Let us imagine that he has paid only 2,50,000. Then what will happen? Then it is less than 90%. No. Hence you have to calculate interest on the shortfall. That is 3 lakh minus 2,50,000 from 1st April to 30th August. 30th August. So 50,000 into 1% into 5 months, you have to calculate the interest under 234B. So this is 234B interest. Now let us talk about 234A interest. 234A interest only comes when the due date, when the return is filed after the due date. Fine. So for what period you have to calculate? From the due date till the actual date of filing return of income, you have to calculate the interest. So what is the interest rate, sir? 1% per month or part of the month. Part of the month. So here also similar calculation. So these are the interest provisions. Now let us discuss section 234E, default in furnishing the TDS or TCS return. So if TDS return, TCS return is not filed within time, then what will happen? Then late fees has to be paid, sir. The late fees is 200 rupees per day. 200 rupees per day is the late fees, and every day it will be coming. However, maximum how much will be the late fees? Maximum late fees cannot exceed TDS or TCS amount. So maximum up to TDS or TCS amount late fees can be levied. The fees shall be paid before filing the quarterly return. Now let us talk about return of income. Sir, what happens when return of income has been filed late? That is after due date. If return of income is filed after due date, then late fees has to be paid at 1,000 rupees or 5,000 rupees under section 234F. If the total income is up to 5 lakhs, then the late fees is 1,000 rupees. If the total income is more than 5 lakhs, then the late fees is 5,000 rupees. Fine. Now let's talk about linking PAN and Aadhaar. It is compulsory to link the PAN number and Aadhaar number. The last date for linking was 1st of July 2022. So after 1st July 2022, if at all you are linking PAN number and Aadhaar number, you have to pay late fees under section 234H, which is 1,000 rupees. 1,000 rupees late fees has to be paid by you. Okay, wow. Now, without further ado, let us begin the revision of return filing and self-assessment. Fine. So return filing. Let us talk about return filing. What is this return? Section 139(1) talks about original return. This original return is also called as ITR or income tax return. Sometimes people also call it ROI, that is return of income. So everything is one and the same. Income tax return or return of income. Who has to compulsorily file their income tax return? First and foremost, if the assessee is a company or a partnership firm or a limited liability partnership, then such person has to compulsorily file return of income. So company, partnership firm, limited liability partnership cannot escape. They have to file their return of income. Now other than company, partnership firm, LLP, who has to file? Let us see. Firstly, if the total income without giving effect to 54 series capital gain exemption and chapter 6A deduction, if it is greater than basic exemption limit, then such person has to compulsorily file their return. So what should we do? We should take the total income. In the total income, you have to add back the chapter 6A deduction, and you also have to add back the section 54 series capital gain exemption. So whatever amount you will get, no, if it is within the basic exemption limit, that is 4 lakh rupees, if it is within 4 lakhs, no need to file the return of income. But if it is above 4 lakhs, then it is compulsory to file the return of income. And in case of old scheme, it is 2,50,000. Fine. Then, if an assessee is a resident and ordinarily resident and a beneficial owner of an asset outside India or signing authority of account outside India, then also such assessee has to file the return of income. For example, if I am a resident, ordinarily a resident, and if I am having a foreign asset or foreign bank account, I have to compulsorily file my return. Then, next point, if assessee is a resident and ordinarily resident and is a beneficiary of any asset outside India or signing authority outside India. Now let's take another example. Let's say I am only having a foreign asset and foreign bank account. However, for that foreign asset and foreign bank account, my mother is the beneficiary. In such case, the beneficiary, who is my mother, if she is a resident and ordinarily resident, she also has to compulsorily file the return of income. However, if I am filing my return, that is if the owner is filing the return, in that case the beneficiary need not file the return. So that's what I have written. However, this point is not applicable if such account or asset is covered in point number 3. Fine. Now let's talk about deposit in current account and saving account. So if a person is depositing more than 1 crore rupees in one or more current accounts, then such person has to compulsorily file the return. Now let's talk about saving account. If the person is depositing 50 lakh rupees or more, see here exact 50 lakh also covered karna. So 50 lakhs or more in one or more saving bank account, then also that person has to compulsorily file return of income. Then if a person is going on foreign travel, and if the foreign travel expenditure is more than 2 lakh rupees, then return of income is compulsory. Moreover, if the person is getting an electricity bill which is more than 1 lakh rupee, then also it is compulsory to file return of income. Then if the person is doing business or profession, and if the turnover in business is more than 60 lakhs or gross receipts of profession is more than 10 lakhs, then it is compulsory to file return of income. And lastly, TDS and TCS. So for example, if my TDS or TCS, whichever other people have paid for me, if my TDS or TCS is 25,000 or more, then I have to compulsorily file the return of income. And in case of senior citizen, it is 50,000 rupees or more. Okay, resident senior citizen, it is 50,000 rupees or more. So if TDS is 25,000 or more, compulsory to file return of income. And in case of resident senior citizen, if TDS and TCS combined is 50,000 or more, it is compulsory to file return of income. So for all these people, it is compulsory to file income tax return. Now let us come to the due date of filing income tax return. Firstly, let us talk about the assessee who is required to furnish transfer pricing report under section 92E. The section 92E is there, no kana? It is covered in your CA final syllabus. However, you should know that if an assessee is required to submit this audit report under section 92E, such person has to file their return within 30th of November of the assessment year. So what is the assessment year, kana? For you, the previous year which is going to come in your exam is 1/4/25 to 31/3/26. So hence this is 30th November 2026. Okay, so such people have to file their return within 30th of November during the assessment year. Moreover, if at all the person who is submitting the report is a partnership firm, then the partners of such partnership firm also can submit their income tax return within 30th of November. Next, let's talk about 31st of October. So every company and all the assessees who are liable to audit, okay, this audit can also be audited under section 44AB, which is there in Income Tax Act. So all the companies and all the assessees liable to audit should file their return within 31st of October of the assessment year. So within 31st October itself have to file the return of income. Moreover, if a partnership firm is liable to audit, then partners of such partnership firm also can file their return up to 31st of October. Now apart from these two categories, all the other persons have to file their return within 31st of July of the assessment year. So 30th November for transfer pricing case and their partners, 31st October for company, audit case and their partners, and 31st July for everyone else. These are the due dates of filing return of income. Now let us talk about loss return karna. Section 139 subsection 3 talks about loss return. What is loss return? Loss return is the income tax return in which you are showing a loss. If any one of your heads of income contain a loss, it is called a loss return. Now when it comes to loss return, you should remember section 80, which we studied in set off and carry forward of losses. There I would have told you that all the losses except for unabsorbed depreciation and house property loss, all the losses except for unabsorbed depreciation and house property loss, you can carry forward only if you are filing the return of income within the due date. So within these dates, if you are filing the return, you can carry forward the loss, else you cannot carry forward the loss. But sir, let's say I filed the return of income late. Now I'm not allowed to carry forward, but can I set off the loss during the same previous year? Answer is yes. Set off of loss is allowed karna, but carry forward is not allowed. Sir, let's say from the last year I have brought forward some loss. Now this brought forward loss I want to set off in the current year. Can I do it even if I file my return after the due date? Answer is yes. Brought forward loss you can set off even if you file the return after the due date. However, current year loss alone you cannot carry forward if you are filing after the due date. However, when it comes to house property loss and unabsorbed depreciation, this can be carried forward even if the return of income is filed after the due date. Fine. Then, sir, what are the consequences of not filing the return of income within due date? Let us see all this consequence one by one so that if you are getting a theory question like this, you will be able to answer. So what happens when you are not filing return of income in time? Number one, the PGBP loss, speculation loss, specified loss, capital gain loss, and loss from owning and maintaining racehorse. This you cannot carry forward, as I already told you. Then, in deduction chapter we learned certain income based deduction cannot be claimed. What are certain income based deduction covered in your syllabus? 80JJAA, 80QQB and 80RRB. So these three deduction you cannot claim if you are filing after due date. Then section 10AA, that is the deduction for special economic zone. This also you cannot claim if you are filing after due date. Then if you are filing after due date, additionally you have to pay interest under section 234A. This I have already discussed in the TDS revision lecture. Okay, and then moreover late fees also has to be paid under section 234F. This also I have discussed in the TDS chapter. So what are the consequences? Number one, other than house property and unabsorbed depreciation, all the other losses you cannot carry forward. Number two, you cannot claim the certain income based deduction, that is 80JJAA, 80QQB and 80RRB. Number three, you cannot claim special economic zone deduction under section 10AA. Number four, additional interest will be levied under section 234A. And number five, late fees is applicable under section 234F. So all these are the consequences. Now let us talk about section 139 subsection 4, belated return. Belated return means what kana? Filing the income tax return late. That is only belated. Can I file late? Answer is yes. But this late return also has a time limit. What is the time limit? 3 months prior to the end of the relevant assessment year or completion of assessment, whichever is earlier. This assessment is covered in your final level. Now if you know it is 3 months prior to the end of relevant assessment year, that is enough. So for example, for previous year 25-26, it is 3 months before the end of the assessment year. So what is end of assessment year? 31/3/2027 is the end of assessment year. You come 3 months before it, so it will be 31/12/2026. So even if you are filing late, you have to file within 31/12/2026. So that is the due date. Then section 139 subsection 5 talks about revised return. Revised return means what? You have already filed the income tax return, but now you noticed that you missed out on something or you made some mistake. Can you revise your return and file it once again? Answer is yes, Kana, you can revise your return. Sir, what and all returns can be revised? Let us see. You can revise the original return that you have filed under section 139 subsection 1. Then if it is a loss return, that also can be revised. If it is a belated return, that means you have filed late, still you can revise it, and even revised return can be revised. So it means what? Unlimited times you can revise the return. So one time I filed the original return, sir. Daily I want to revise my return, sir. Can I revise? Answer is yes. Daily also if you want, you can revise the return. But for this revised return also, there is a time limit. What is the time limit? Revised return time limit is same as belated return time limit, which is 3 months within the relevant, 3 months before the end of relevant assessment year. So here also the time for revised return will be 31st of December 2026. And you know what? If at all you file original return, then later on you file revised return after some time, then what will be taken as the date of filing of return? Will you take the original returns date or will you take the revised return date? Answer is that you will take the original returns date only, because the revised return replaces the original return. That is why always take the date of original return. Fine. Now let us talk about section 139 subsection 9, that is defective return. Defective return means what? Income tax return is considered defective if annexure, statement, column relating to computation of income are not duly filled in. So you forgot to fill in some column, so it will become defective. Next, return is not accompanied by proof of payment of tax. So you have paid the tax but you have not attached the proof, then also the return will become defective. And third, other compulsory attachment like audit report under section 44AB are not present in the return. So if there is any other attachment which is compulsory, that also has to be attached. If it is not attached, then the return will be considered as defective. If it is a defective return, then assessing officer will intimate the defect to the assessee. So the assessing officer will communicate to the assessee that you have filed a defective return. In such case, what to do? Within 15 days, the assessee has to rectify the defect. So defect has to be rectified. If at all within 15 days you are not able to rectify, then you can ask some extension to assessing officer also. Assessing officer is having the power to give you extension. Now within extended period also, if you have not rectified the defect, then what will happen? Then your income tax return itself will become invalid. However, let's say after the extended due date, still you have rectified the return. In such case, the assessing officer has the power to condone the delay and treat this as a valid return. Okay, so if the defect is rectified after 15 days, extended period, but before assessment, assessing officer has the power to condone the delay. Now let's talk about section 140A, self-assessment tax. Sir, what is self-assessment tax? Self-assessment tax is the tax of the assessee paid during the assessment year. If you pay the tax during the previous year itself, it is called advance tax. If you pay during the assessment year, that is after the previous year, it is called self-assessment tax. Self-assessment tax is the tax generally paid while filing the return of income along with interest. Okay, however, if the assessee is not paying the tax, no, he will be considered as assessee in default. Moreover, if the assessee has short paid the tax, means entire tax has not been paid, then amount will be first adjusted with late fees, then balance amount will be adjusted with interest, then balance amount will be adjusted against the tax. So this is the provision of self-assessment tax. Now let us talk about section 139(8)(a), that is updated return. Updated return is very important from exam point of view because amendment is also there in this provision. Okay, sir, what is this updated return? Updated return means, sir, I have forgot to file my return of income within the due date, and I also forgot to file my return of income within the belated return due date. Still, can I file my return of income? Answer is yes. Subject to conditions that I am going to tell you, you can still file your return of income. This is called updated return. Fine, updated return. Sir, what is the time limit to file updated return? It is 48 months from the end of the relevant assessment year. So for previous year 25-26, no, let me show you. You have to come to the end of the year. See here, let's say the previous year is 25-26. So what is the assessment year? 26-27. Let's say the due date is 31/7/2026. So if you file the return within the due date, it will be called as original return. Fine, original return. However, if you file the return after the due date within 31st of December, it will be called as belated return. Then if you are not able to file the belated return also, then you can file the updated return. So what is the updated return time limit? First you have to come to the end of assessment year. What is end of assessment year? 31/3/2027. So from the end of the assessment year, you will have 48 months time, that is 4 years time. So 31/3/28, 29, 30 and 31. For previous year 25-26, the updated return can be filed up to 31/3/2031. So much time is there to file the updated return. So it is very beneficial for SSC. No, answer is no. It is not beneficial for SSC. It is beneficial for income tax department only. You know why? It is because of the additional tax, which I am going to tell you in some time. Fine. So who can file the updated return, sir? Any person who has not filed the return of income can file the updated return. But sir, I already filed the return of income within due date or within belated return due date. But now I have noticed that I have missed out on showing some income. Now still, can I file an updated return where I can show my balance income? Answer is yes. So if you have already filed the return, then also you can file updated return. If you have not filed the return, then also you can file the updated return. So updated return can be furnished whether or not return was already furnished under section 139 subsection 1 to 139 subsection 5. Next, updated return cannot be submitted in the following cases. So what are the cases where you cannot file updated return? Number 1, if updated return is a loss. Okay, so in your updated return, if you are showing loss in any head of income, then you cannot file the updated return. But sir, earlier in my original return, my loss was 10 lakhs, but in my updated return, I am showing loss only 4 lakhs. Still, can I file updated return? Answer is no. Even if you are reducing the loss, you cannot file updated return. Updated return can only be filed if it is a return of income. If there is loss, you cannot file. Next, updated return had the effect of decreasing the total tax liability. So if you have already filed the return of income where you have paid the tax, you cannot decrease your tax kana. You can only increase your tax in the updated return. Next one, updated return has the effect of resulting in refund or increasing the refund. So if at all your refund is increasing, or if you are getting a refund, then you cannot file updated return. So a refund should not be there. Then updated return has already been furnished. So here I want to say that updated return cannot be revised kana. One time if you file updated return, it is final. You can never revise the updated return. So you cannot file it once again. Next, where any proceeding is pending or has been completed for the assessment year. So for that relevant year, if already the assessing officer has started taking some action against you, then you cannot file the updated return. So when can you file the updated return? Only if the government is getting benefit. It means what? You cannot show the loss, you cannot increase the tax, you cannot decrease the tax, you cannot increase the refund. Fine. And if updated return is already furnished, you cannot file it once again. And if proceeding is initiated, then also you cannot file updated return. Then, however, updated return can be filed where original return was a loss, but updated return is a return of income. So sir, in original return, I had a PGBP loss of 10 lakh rupees, but now I want to show PGBP profit of 10 lakh rupees. Can I show instead of loss, I can show profit? Answer is yes. Instead of loss, you can convert it into profit. However, if loss in such original return was carried forward and set off in subsequent years, then updated return of such subsequent year also must be filed. So listen, Kana, I'll give you an example. In this timeline, no, let's say for previous year 25-26, I filed the income tax return where I showed PGBP loss is equal to 10 lakhs. PGBP loss is equal to 10 lakhs. Then later on, I filed my updated return on 31/7/2030. Here I showed that my PGBP profit, PGBP income is equal to 5 lakhs. Can I show like this? Answer is yes. If earlier you are having a loss, now you can convert that loss into profit. So what is the difference between 10 lakhs and 5 lakhs? Answer is 15 lakhs. 15 lakhs, you have increased your income, correct? So that is why only 10 lakhs loss has become 5 lakhs profit. So you have increased your income by 15 lakhs. But now listen, for the next year, that is for the previous year 26-27, you would have already filed the return of income. When you filed the return of income for 26-27, you would have carried forward this loss of 10 lakhs, and in the next year, you would have set off this loss also against your other income. But now you are telling I'm not even having the loss, I'm only having a profit. So that is why, since you have carried forward and set off in the next year, now you are telling that you are having a profit. So that carry forward is not at all allowed, correct? That is why for the next year also, you have to file an updated return where you have to reverse the effect of carry forward and set off. You get my point? So that only I have given here. Now let's talk about tax on updated return. How to calculate the tax, sir? Updated return has to be accompanied by proof of payment of tax. So how to calculate the tax? Where no income tax return was filed earlier, it is very simple. Like how you normally calculate the tax, no? Like that only you have to calculate. So total tax payable, first you have to find out. Then from that you can reduce the TDS, TCS and advance tax. If at all you are having AMT credit, you can reduce that also. Section 89 relief, etc. Then you add whatever is the interest and late fees. So this has to be paid. So tax minus already taxes paid in advance plus interest plus late fees has to be paid. Then where income tax return has already been furnished, at that time you would have paid the taxes under section 140A, self-assessment tax. So whatever self-assessment tax is there, no, that you have to reduce. Then whatever TDS, TCS, AMT credit which was not considered earlier, you can consider it now and you can reduce it. Then you have to add the interest which you have not taken into account earlier, and add the refund also which you have to reverse. If at all refund has to be reversed, that also you have to add back. And then interest under 234B, 234C, you have to recompute and find out what is the final tax. So what did I say? If return of income is already furnished, then find out what is the total tax. From that you can reduce the tax that you have already paid, that is self-assessment tax. Then you can also reduce TDS, TCS if you have not considered it earlier, and then whatever interest, extra interest is there, no, that you have to add back. If at all refund has to be reversed, that refund also you have to add back. So this is the tax of updated return. But just like that, will the government give you benefit to file even 5 years later? Answer is no. There is a catch. What is the catch? The catch is that if you are filing updated return, you have to pay additional tax. So if you are filing within 1 year extra, you have to pay 25% additional tax. Within 24 months, it is 50% additional tax. Within 36 months, it is 60%. And within 48 months, in your your book, if you are having it as 75, earlier in study material also it was 75. So my book had 75, but the study material was corrected later on. So if at all your material is showing 75, please correct it to 70%. So it is 25, 50, 60 and 70%. Fine. Now let us see this timeline itself. So if you are filing for previous year 25-26, so first leave the assessment year. Okay, later on only you can file the updated return. So within 31/3/28, if you are filing 25% additional tax, within 31/3/29, 50% additional tax, within 31/3/2030, it is 60%, and later on it becomes 70%. So 25, 50, 60, 70. 25, 50, 60, 70 is the additional tax that has to be paid. So 25% of what, sir? This amount you have calculated, no? Above. Total tax payable minus TDS minus TCS minus advance tax, the entire calculation of 140B. In this 140B, no kanna, don't consider late fees. Don't consider late fees. On other than late fees, you calculate 25%, 50%, 60% or 70% as the case may be. And then add the late fees separately. So here you can see. Whatever is the tax plus surcharge plus health and education cess plus interest, you have to see multiplied by 25% is the additional tax. Over and above this, you have to add the late fees. So first you have to add tax plus interest plus surcharge plus cess plus additional tax on this entire amount, and then plus late fees. Okay, so this is the calculation of the additional tax and section 140B tax. I want you to solve the Rishi question which is there in your study material. Very good question. You will definitely get good clarity about the provision. So definitely solve this question after watching the revision lecture. Okay, now let us discuss all the other provisions in this chapter. Firstly, let us start with section 139, which speaks about PAN, that is permanent account number. Sir, when is it compulsory to apply for PAN card? In all these cases, it is compulsory to apply for PAN card, and due date to apply is also given. So what is the first case? The assessee's total income or total income of any person for whom he is assessable exceeds the basic exemption limit. So if the income is more than basic exemption limit, it is compulsory to apply for PAN card. And till when you should apply? You should apply up to 31st May of the assessment year. So for previous year 25-26, you have to apply the PAN card till 31st of May 2026. Get my point? Next. Turnover or gross receipts in business or profession is likely to exceed 5 lakh rupees during the previous year. So if turnover or gross receipts is going to be more than 5 lakhs, then it is compulsory to apply for PAN card up to the end of the previous year. So within the year itself, you have to apply for PAN card. The next case, resident other than individual enters into a financial transaction of 2,50,000 or more during the financial year. So any person other than individual, so partnership firm, AOP, BOI company, etc., if they enter into any financial transaction which is 2,50,000 rupees or more, then they have to compulsorily apply for PAN card within 31st May of the assessment year, that is 31st May 2026. Then MD, director, partner, trustee, author, founder, karta or CEO or principal officer or office bearer or any of the person referred in 3 above. So first, what did I say? The person who has entered into financial transaction, they have to apply for PAN card, and their MD, director, partner, as the case may be, also have to apply for PAN card up to 31st of May of the assessment year. Fine. Then next case, deposit cash in one or more accounts with a bank or cooperative bank or post office of 20 lakh rupees or more. So if a person is going to deposit cash of 20 lakh or more in a bank account, then they have to compulsorily apply for PAN at least 7 days before the date on which they intend to enter into such transaction. So before depositing 20 lakhs, before 7 days itself, they have to apply the PAN card, because with the help of PAN card only you can deposit this much cash. Without PAN card, you cannot deposit this much cash. Fine. Then withdraw cash in one or more account with a bank, cooperative bank or post office of 20 lakh or more. So if you want to deposit 20 lakh or more, then also have to apply PAN card. If you want to withdraw 20 lakh or more, then also you have to apply PAN card within 7 days before that transaction. Then if you want to open a current account or a CC account, that is cash credit account. So current account, cash credit account also, it is compulsory to have a PAN card. At least 7 days before opening the account, you have to apply for a PAN card. So all these cases, it is compulsory to get a permanent account number. Sir, if I want to get a PAN card voluntarily, can I apply for PAN card? Answer is yes. Voluntarily, definitely you can apply, and in all these cases, it is compulsory to apply. Now let us see all the cases where it is compulsory to quote the PAN number. So you have to mention the PAN number in all these transactions. Fine. First and foremost, in all the returns to or correspondence with any income tax authority. So with income tax authority, if you are having any communication, it will be using your PAN number only. Then in all the challans for payment of any sum due under the Act. So whatever amount you are paying as per the Income Tax Act, you can pay using the PAN number only. Then to all the persons responsible for deducting TDS or TCS. So if someone else is deducting TDS on the payment which is given to you, or someone is collecting TCS from you, then to such people you have to give your PAN number. Okay, wow. In TDS, I already told you that the person who is a deductor should collect the PAN number. If the person is not collecting the PAN number, then TDS will be deducted at higher rate. Correct? The rate as per section or 20%, whichever is higher. So that concept only once again it is repeated. Then in all the documents pertaining to the following transactions. So what are all the transactions where it is compulsory to quote the PAN number? Let us see. First and foremost, sale or purchase of a motor vehicle other than two-wheeler. So other than two-wheeler, if the person is buying or selling a motor vehicle, for example car, then it is compulsory to quote the PAN number. Then opening an account other than time deposit. Time deposit means what? Fixed deposit. So other than fixed deposit or basic saving bank account. In such case, it is compulsory to quote PAN number. So if the person is opening an account other than fixed deposit or other than basic saving bank account, then he has to compulsory quote the PAN number. Then making an application to any bank or cooperative bank for issue of a credit card or debit card. So for getting credit card or debit card also, it is compulsory to quote the PAN number in the application. Then opening a demat account. Demat account means what? For example, brokerage accounts like Zerodha, Motilal Oswal, Grow, etc. So to open these accounts also, it is compulsory to quote the PAN number. Then payment to a hotel or restaurant against a bill in one time cash payment of more than 50,000 rupees. So you have thrown a very huge party where you are paying the hotel bill. That hotel bill is coming as more than 50,000 and you are paying in cash. So if you pay in cash, it is compulsory to quote the PAN number. Then payment for travel to any foreign country or purchase of any foreign currency at any one time where the cash is more than 50,000 rupees. So you are going to an authorized dealer and you are getting foreign currency. For getting this foreign currency, you are paying in cash of more than 50,000. You have to compulsorily tell your PAN number to that person. Then payment to a mutual fund for purchase of its unit. You want to purchase mutual fund units, then also compulsory to quote PAN number if amount is more than 50,000. Then payment to a company or institution for acquiring debentures or bonds issued by it. So in case of debenture bond also, if amount is more than 50,000, compulsory to quote the PAN number. Then payment to RBI for acquiring bond of RBI. So if you are buying RBI bonds of more than 50,000 rupees, you have to compulsory quote the PAN number. Then you are depositing with the bank or cooperative bank or post office cash deposit of more than 50,000 rupees per day. So if you are doing a cash deposit of more than 50,000 per day, it is compulsory to get PAN number. It's compulsory to quote the PAN number. Then purchase of bank draft, pay order, banker check from any bank or cooperative bank where cash payment is more than 50,000 per day, then also it is compulsory. What did I say? Purchase of bank draft, pay order, banker's check. More than 50,000 rupees per day you are paying in cash, then also you have to quote your PAN number. Then a time deposit with a bank, cooperative bank, post office, Nidhi company or NBFC where the amount is more than 50,000 but up to 5 lakh rupees. So fixed deposit of more than 50,000 but up to 5 lakh rupees, you have during a financial year you have to quote your PAN number. Quote your PAN number. The amount is more than 50,000 per FD and more than 5 lakh rupees in aggregate, then you have to quote your PAN number. So I am changing. Amount is more than 50,000 rupees per fixed deposit or entire year if it is more than 5 lakhs, then it is compulsory to quote the PAN number. Then payment for one or more prepaid payment instrument to a bank or cooperative bank or to any other company. So prepaid debit card and all you can take. No, so that prepaid card you are taking, for that you are making a payment of more than 50,000 rupees in a financial year, it is compulsory to state your PAN number. Then if you are making a payment of life insurance premium, then also if it is more than 50,000 rupees in a year, you have to state your PAN number. Then if you are selling and purchasing any security other than shares, then if it is more than 1 lakh rupees, it is compulsory to quote PAN number. And then if you are selling or purchasing unlisted shares of a company, then also if it is more than 1 lakh rupee per transaction, it is compulsory to quote the PAN number. Then if you are buying or selling any immovable property and if the consideration or stamp duty value, if any one of the same is more than 10 lakh rupees, it is compulsory to quote the PAN number. And lastly, if you are buying or selling any goods or service where the amount per transaction is more than 2 lakh rupees, it is compulsory to quote the PAN number. So all these cases, it is compulsory to quote the PAN number. Fine. And one small point I would like to say that if minor is entering into the transaction, then minor might not have a PAN card. Instead of his PAN card, he can give the PAN card of his father, mother or guardian. Father, mother or guardian. For example, the minor is paying life insurance premium more than 50,000. So in such case, what to do? The minor can give the PAN card of the father or mother or guardian, as the case may be. Sir, all these cases should I remember for the examination? Answer is yes, but don't worry. You read it 4 or 5 times. Automatically you will remember in the exams. Okay. Now let's come to the next provision, which is interchangeability of PAN card and Aadhaar card. So now what is the provision? Every person who is required to quote PAN card can also quote Aadhaar card if Aadhaar card number, if he has not been allotted a PAN but he is having Aadhaar number, or he has been allotted a PAN and has linked Aadhaar number and PAN number as per section 139AA, which we are going to discuss now. So for example, if I am not at all having a PAN number but I am having a Aadhaar number, so now all these cases we saw, no, all these cases we have seen where we have to compulsory quote PAN number. So in such case, instead of PAN number, can I quote Aadhaar number? Answer is yes, you can quote Aadhaar number as well. Moreover, if you have linked your PAN card with your Aadhaar card, this also we are going to study about linking. If you have linked your Aadhaar card and PAN card, then also wherever if you want to quote PAN number, you can also quote your Aadhaar number. It is okay. Then PAN will be allotted to a person who has not been allotted a PAN but possesses Aadhaar. So for example, if I am not having PAN card, I told you, no, I can quote my Aadhaar number as well. Then the person who is receiving my Aadhaar will apply for PAN card for me. And now I will compulsorily get a PAN card. So hence such person are deemed to have applied for PAN card. So what did I say? If I am not having PAN card, I can quote my Aadhaar number. Fine. Moreover, if I have linked my PAN card and Aadhaar card, then also if I am having the PAN card, still I can quote my Aadhaar number. However, if I am not having a PAN card, then if I quote my Aadhaar number, the person who is receiving my Aadhaar number will apply for PAN card for me, and it is considered that I have only applied for PAN card. Then section 272 would be what is the penalty for non-compliance. So for all these provision, if I don't comply, what is the penalty? If I failure to comply with 139A, wherever it is compulsory to obtain a PAN card, if I have not applied for PAN card, then what will happen? 10,000 rupees is the penalty. Then if I am having a PAN card or Aadhaar number, PAN number or Aadhaar number, but I did not quote it, then what will happen? Per default, I have to pay 10,000 rupee penalty. Then knowingly quoting or intimating a number which is a false number, so then also 10,000 rupees is the penalty. And failure to authenticate the PAN card or Aadhaar number wherever required. Kana, in some transactions, no, for example, the 20 lakh rupees I told you that in case of depositing 20 lakhs or more or withdrawing 20 lakhs or more, you have to compulsorily apply for PAN card. In such case, when you are doing this transaction, no, the bank will authenticate your PAN card. They will check whether the PAN card actually belongs to you or not. In such case, when the bank is failing to authenticate, the bank has to pay a penalty of 10,000 rupees per default. So if you don't apply, 10,000 rupees penalty. If you have to quote but you did not quote the PAN number, 10,000 rupee penalty. If you are quoting wrong PAN number, then also 10,000 rupee penalty. If the bank is forgetting to authenticate, then also 10,000 rupee penalty. So penalty is 10,000 in all the cases. Next, section 139AA, quoting of Aadhaar number. Every person who is eligible to obtain Aadhaar number is required to mention the same in the application form for allotment of PAN and in the return of income. So if you are eligible to have an Aadhaar number, then it is compulsory to quote the Aadhaar number in the PAN card application and also in the return of income. You know what? Till 2024, till 30th of September 2024, it was okay even if you quoted the enrollment ID. Even if you quoted the enrollment ID, that is when you apply for Aadhaar, no, before getting the Aadhaar number, first you will get the enrollment ID. So in these cases, you can also quote the enrollment ID till which date? 30/9/2024. However, from 1/10/2024 onwards, it was removed. From 1/10/2024 onwards, enrollment ID provision is not there. It is compulsory to quote the Aadhaar number only. So Aadhaar number in the PAN card application and Aadhaar number in the income tax return, you have to mention. Okay, wow. So it is compulsory, and the person who have applied for PAN using the enrollment ID should mandatorily intimate the Aadhaar number to the department before 31st of December 2025. Now till 30th of September 2024, I told you that you can also quote your enrollment ID. For the people who have already quoted enrollment ID, now they have to update their Aadhaar number instead of enrollment ID up to 31st of December 2025. So this is an amended provision. This is the last date to update, to convert the enrollment ID into Aadhaar number. Next, every person who is possessing a PAN as on 1/7/2017, that is the date on which the GST Act became applicable, 1/7/2017, has to link the Aadhaar with PAN up to 31/3/2022. In case of failure, PAN will become inoperative. So whoever is having a PAN on or after on or before 1/7/2017 has to link their PAN card and Aadhaar card. Sir, what about on or after 1/7/2017? On or after 1/7/2017, no. In the application itself, they are getting the Aadhaar number, so it is already linked. But if it is before 1/7/2017, then it might not be linked. That is why whoever is having a PAN card before 1/7/2017, they have to link their PAN number and Aadhaar number. So PAN number and Aadhaar number have to be linked. If it is not linked within 31/3/2022, so what is the last date for linking? 31/3/2022. Up to this date, if it is not linked, then the PAN card will be made as inoperative. Means what? It will be considered as if there is no PAN card. Fine. However, this inoperative provision, no, this was so strict and people were suffering. That is why the CBDT moved the position to a future date, that is 1/7/2023. So PAN card became inoperative after 31/3/2022 itself, but the effect of inoperativeness started from 1/7/2023. What are the consequences, sir, if it becomes inoperative? If it becomes inoperative, then what will happen? The person will not get any income tax refund. Then no interest on income tax refund during the period that the PAN was inoperative. Interest also the government will not give. Then TDS shall be deducted at a very higher rate. We have learnt, no? If PAN is not there, PAN is not quoted, then TDS has to be deducted at higher rate. Similarly, if PAN is inoperative also, TDS has to be deducted at higher rate, and even TCS has to be deducted at collected at higher rate. So this is the consequence of inoperative PAN. So if at all the linking was not done, then from 1/7/2023 onwards, the PAN has become inoperative and the effect of inoperativeness has also started. Okay, well, however, there are four categories of persons who need not link their Aadhaar card and PAN card. Who are they? Number one, if a person is residing in Assam, Jammu and Kashmir or Meghalaya, then they need not link their Aadhaar card and PAN card. Then if a person is a non-resident as per Income Tax Act, such non-resident need not link. Then the third one, if the person is of the age of 80 years or more, that is super senior citizen, need not link the Aadhaar card and PAN card. And lastly, non-Indian citizens. If a person is not an Indian citizen, then no need to link Aadhaar card and PAN card. So in these four cases, linking of Aadhaar and PAN is not necessary. If Aadhaar is linked after 31/3/2022, fees as per 234H is applicable, that is 1000 rupees. We have already learnt in the TDS chapter. Okay, so these are the provision of quoting of Aadhaar number. Now let us come to section 139B, tax return preparers. So tax return preparers are the persons who can file the income tax return for specified person. Who is specified person? Specified person means a person who is not required to get the books of accounts audited under 44AB or any other law. For example, company. So the tax return preparer is a person about whom I am going to tell you in this section. This person can file the income tax return of any person other than audit assessee or company. So for company they cannot file, and for person who is liable to audit also they cannot file. And apart from that also, CBDT in their scheme they have told that they can file the return only for individual and HUF. So they can file only for individual and HUF, and they can file the return only if the individual and HUF are not liable to tax audit. You get my point? Then tax return preparer can help a specified person to file the income tax return, and also he can put his own signature in the income tax return. However, the following person cannot become tax return preparer. So who cannot become a tax return preparer? Chartered accountant cannot become. Legal practitioner cannot become. Employee of the specified person. So this person who is filing his income tax return, no, they are their own employee. They cannot file their income tax return. Then officer of a scheduled bank where specified person is having a current account or a regular dealing cannot file the income tax return on their behalf. So following cannot become tax return preparer. Who cannot become? Chartered accountant cannot become. Legal practitioner cannot become. Employee cannot become. An officer of scheduled bank also where they are having regular dealing or current account cannot become. TRP means a person who possesses the TRP certificate and unique ID code. So who can get this TRP certificate karna? A person who is an individual having a bachelor degree. So he should at least be undergraduate, or the person should have passed Inter exam of ICAI, ICSI or CMA. then they are eligible to get this TRP certificate. They should write one more exam for TRP. After passing that exam, they will get this TRP certificate. If they are having TRP certificate, then they can file the income tax return on behalf of others. A TRP can file a revised return only if he has himself to file the original return. So revised return can be filed by TRP only if original return also was filed by TRP, that is tax return preparer. So tax return preparer is basically a scheme which the government brought to create employment in the country, so that the graduates or inter-pass people of ICA, ICSI and CMA can file the income tax return. They will get some opportunity. Okay, they can get this TRP certificate and file the income tax return. So that is why only accountant, legal practitioner, employee, scheduled bank person cannot become tax return preparer. Now let us talk about section 140, verification of income tax return. So who can sign on the income tax return? Let us see. In case of individual, the individual himself will only sign in his income tax return. However, if the individual is mentally incapacitated, then his guardian or any other person competent to act on his behalf can sign on the income tax return. For any reason, if it is not possible for the individual to verify the income tax return, then power of attorney holder can sign the income tax return. Then let's talk about Hindu undivided family. In case of Hindu undivided family, Karta will sign on the income tax return. Okay, this sign can be physical signature also, digital signature also, or it can be OTP also. Okay, nowadays even with OTP a person can sign. Fine. If Karta is absent from India or Karta is mentally incapacitated, then in such case any other adult member of HUF can sign the income tax return. Next, let's talk about company. Generally, in case of company, managing director has to sign the income tax return. However, if managing director is not able to sign the income tax return, or if there is no managing director at all, then any director of the company or any other person as may be prescribed can sign the income tax return. Then if company is a non-resident, in such case managing director or a person who is holding power of attorney from such company can file the income tax return or sign on the income tax return. So if the company is under winding up process, liquidator will sign on the income tax return. Then where any person has been appointed as the receiver of the assets of the company, in such case also liquidator will sign on the income tax return. Then if the management of the company has been taken over by the central government or state government, in such case principal officer will file. Here central government or state government, principal officer of the company will sign the income tax return. And lastly, if any application for the corporate insolvency has been filed under insolvency and bankruptcy code, in such case the insolvency professional who is appointed by the adjudicating authority will sign on the income tax return. So these are the cases of company, and here I have said no, any other person as may be prescribed. So who is the prescribed person? Here also, in case the company is going into insolvency, then interim resolution professional might be there, or resolution professional might be there, or liquidator might be there. These three persons, as the case may be, can sign on the income tax return. Fine. Then let's come to partnership firm. Generally, the managing partner of the partnership firm will sign on the income tax return. If managing partner is not able to verify the return, or if there is no managing partner at all, in that case, any partner of the partnership firm, not being a minor, can sign on the return. Next, limited liability partnership. So generally designated partner can only sign on the income tax return. However, if designated partner is not able to verify, or if there is no designated partner at all, in such case any partner of the LLP or any other person as may be prescribed can sign on the income tax return. Here also any other person as may be prescribed means interim resolution professional or resolution professional or liquidator, as the case may be. Then in case of local authority, the principal officer can sign on the income tax return, and in case of political party, CEO of the political party can sign on the income tax return. Then in case of artificial juridical person or any other person, the person who is competent to verify can sign on the income tax return. So these are the places where income tax return can be signed by the respective persons. So with this, all the provisions of this chapter are also over. Now quickly see the questions in the study material and you will be good to go for the examination. So see you Kanna, take care, bye bye.